result of what Trump is doing?
Forecast minus 1% on the prior, three spot 2%.
I think there has been for sure a damage has been done to the economy and also to the sentiment within the equity capital markets. The uncertainty is never something good for an ECM perspective. And again, from an IPO standpoint, I'm not expecting companies to actually get listed before summer this year. There is, as you mentioned, Guy, volatility is too high. It's really, really difficult to actually get exposed for over, let's say, 10 days during the book building period to what's happening to the market. And so I'm not expecting IPOs for the first part of the year to arrive. From a capital increase perspective and more accelerating transaction, intraday volatility or very brief bounces in the market actually could play a positive role. We should assume, and I think Q1 results, publication of results will be quite important because I think companies will need to reassess and give a bit of a hint of what they're expecting in terms of, forecasts and potentially rebudgeting for a year to come. And then I think on the back of that, I think we will understand whether companies will be able to take advantage of some positive trends in the market and raise capital quickly overnight, or whether they will also need to wait for the second part of the year. Is it a structural change? For sure, currently and for the next few months, yes. Hopefully, some stability will come back at the end of the 9 months, of the 3 months, and then we will have better visibility on what can be done.
Yeah, Silvia, so to follow on from Guy's question, if you say that IPOs are not going to happen in the short term because of this expectation of heightened volatility, then that does suggest that people are waiting for something calmer on the other side of these 90 days. In equity capital markets, is that a safe assumption, do you think, given what we've seen from this presidency up to now?
No, the reality is I completely agree with you. And from an equity capital markets perspective, it's difficult right now to forecast or to make proper assumption of what's going to happen at the end of the 90 days holding period. The best thing we can do, and the discussion we're having with our clients across Europe, is keep on working in the preparation. There were many companies that were actually working and getting ready to get listed. So the suggestion is you now have the time to get ready and in full shape from a corporate perspective. Get your numbers in the row. Make sure that your forecast and from a business plan perspective, everything is secure, if possible, because clearly tariffs will play a role. But then to be ready to hit the market and take advantage of potentially more stability after summer. Is this something we can guarantee to our clients? Absolutely no. What's going to happen at the end of the 90 days is something that we can't predict yet. But the best we can assume and the best we can offer to our clients is to keep on working and be ready in order to tackle the first market window as soon as available.
Sylvia, do you perhaps anticipate any change in appetite when it comes to fundraising to, instead of accessing the equity capital markets, to do it in the debt capital markets instead? Is that a trade-off that could come from not just American issuers, but European ones?
I think it's something that we need to evaluate in the next weeks, right? I think what's quite interesting was what we saw last night in terms of the divergence between equity capital markets and credit markets. If the credit market is tightening and they're going to be companies are going to struggle to raise a capital in the debt market, I think equity raise will become more relevant. And then I think companies will need, in any event, to take advantage of the volatility, doing, as I said, accelerated trades overnight in order to raise equity to sustain their business. So I think we are not ready to make this assessment, but for sure what we are seeing in terms of divergence between equity and debt, which has not been aligned to the past, is quite interesting.
Yeah. Sylvia, what about kind of the accessibility of the U.S. markets right now? I ask this in the context of the fact that with this volatility, we're seeing a hesitation from international investors in some ways to not necessarily dive into the dollar, to not necessarily dive into the treasury market to the same extent they have in previous crises. Does that kind of almost hesitation around the United States right now, given that that's where the epicenter of the shock is coming from, translate to the IPO market? In other words, could international investors looking to IPO in New York suddenly look at London, Paris, Milan
At 4 a.m.
as
Eastern
a
Time,
more
get Italian
viable
industrial
alternative?
production month on month. Forecast
I
minus
think it's
1%
a
on the
very fair point
proprietary spot
and it's a very fair
2%.
statement. From a European perspective, I think what's happening to the US, it's a positive. If you look in-house and if you look at Europe, the fact that everyone is actually coordinating and aligned in order to take action and become more independent from the US is giving a bit of stability and solidity to the European market that is going to eventually bring more positive results to the European companies, the European investors. We have already been seeing quite a very interesting inflows of money from international investors into Europe. So net-net, I do believe if there is a concerted efforts across all the stakeholders in order to sustain and push a bit the European capital markets, that this move against the US and the US dollars could actually prove to be a positive sign for European companies and investors.
Sylvia, thank you very much. Sylvia Viviano, Head of Equity Capital Markets at UniCredit, putting the IPO story and other capital markets activity in today's context. Thank you very much for that. We're going to be speaking to Jean-Claude Trichet, or Bloomberg TV. We'll be speaking to the former ECB President, Jean-Claude Trichet. So all matters European economy. Interesting to hear about from him, of course, where the latest moves leave him. It was interesting in that conversation with Sylvia, you were referencing the dollar and the fact we haven't, I mean, it's almost like when you look at dollar charts, it's almost like yesterday didn't happen. The reversal in policy or the wind back in policy from the United States didn't really happen. And to Val's point, we're still seeing some signs of stress at the long end of the US Treasury curve.
I mean, if you're European right now, your purchasing power has increased significantly. Your dollar's at 110, given the fact that you're still talking about structurally weak economies. You're talking about some profit margins that are already looking to drop. Just take a look at the Volkswagen numbers as well. And yet, things are looking pretty good. The sentiment is pretty bullish.
I will just talk a little bit about what US futures are doing right now. They're rolling over fairly sharply at the moment, which is going to set up an interesting session ahead. Obviously, a massive rally yesterday. How does that unfold for the rest of the day? We'll wait and watch. I think the Masters kicks off at around 12:30. That's the afternoon. The morning's going to be interesting. The afternoon will be relaxing. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, former Treasury Secretary Larry Summers of Harvard on the consequences of the Trump tariffs. Ambassador Richard Haas of Centerview Partners on the TikTok deal, where President Trump might need to look to get the money to put into his sovereign wealth fund. And former Transportation Secretary Elaine Chao tells us how to fix the air traffic control system.
Reorganize the structure.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg.
Minus 0.9%. Minus 0.9%.
Biggest gain since COVID
Higher
after
than
Donald
forecast,
Trump's U-turn on
1%.
higher tariffs less than a day after they came into effect. But there's no relief for China, which now faces import levies of 125%, while Chinese leaders are set to be meeting to discuss more economic stimulus. And the EU says the about turn is good for the economy. It must now decide whether to go ahead with retaliation approved just hours earlier. Plus, coming up on the program, we'll be joined by Carlisle's Jeff Curry as oil hovers near a four-year low. We'll also be talking to Jean-Claude Trichet about inflation and bonds. Now, first thing is first, let's get straight to all of these markets. I have to say there's a bit of volatility out there. I know we're looking at European stocks opening sharply higher, so we're seeing a lift across the board. But if you look at futures in the U.S., we saw a bit of a reversal, I think, in the last hour or so. I look at Brent crude, always good to look at oil as a benchmark of maybe economic stability. 63.8, WTI down 2.5%. Cross assets. So I'm looking at a couple of things. Not only, did Trump's pivot come as a scale of Treasury sell-off on days of mounting financial stress rattle investors. So we're seeing a little bit maybe on the floor on some of the moves there. But Treasury yields were down about 1 basis point, pairing a bigger drop seen in Asia trading. And then you can see S&P futures. They were actually higher, I think, about an hour or two ago, and now they're down 1.6 and 1.9%. Again, I think after the initial jump, maybe there's a bit more recalibration on what happens after 90 days and what happens more immediately with China. Let's take a look at the European markets map. Again, the CAC 40, 5% higher. All of my producers are extremely excited, and so are we. DAX down some, actually DAX gaining some 5.6%, the FTSE MIB gaining almost 7%. These are truly extraordinary moves. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, European equities surging this morning, investors celebrating the 90-day reprieve from President Trump's latest tariffs. Now, all sectors firmly in the green, led by the banks and mining stocks. Trump announced a pause in his so-called higher reciprocal tariffs just hours after they came into force, saying he had taken notice of the turmoil in treasuries.
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. I think everything had, well, the big move wasn't what I did today. The big move was what I did on Liberation Day.
Okay, so first thing is first, let's check on the markets and some of the individual stocks that are on the move. Joe, we don't do this very often, but actually some of the moves are so extraordinary, we need to really look at industry by industry.
Yeah, that's it. It's justified today, Fran. Absolutely incredible moves across a number of sectors here in Europe today. Take a look at these chip stocks. We actually took quite a while to get these open in European trading. We're seeing ASML up around 6% now, coming down very slightly, but ST Micro up almost 9% as well, Infineon as well. Big moves. Remember, we saw Nvidia up 19% in the US yesterday, Intel as well. So that feeding through into this market this morning. Then also the sector that was catching my eye was airlines, because we saw the US airlines gaining by around 20% in the post-market, and we're seeing moves coming through in IAG, Air France, Lufthansa as well. Now, as I said, there was a lot of volatility coming in. Around half of the Stock 600 halted in early trading due to too much volatility, but also keep an eye on the shipping stocks, because if these tariff concerns continue to ease, that potentially means more shipping of goods around the sea, and therefore big moves higher in the likes of AP Moller Maersk over in Copenhagen. Copenhagen, and also Hapag-Lloyd in Germany, another sector that I've got my eye on. And banks, of course, have been absolutely slammed by the tariff worries. We've seen huge drops down in these lenders, and seeing that paired today, particularly in Barclays here in London. We're up 13% for Barclays at current trading. UBS coming up 8%. Banco Santander as well with its Mexico exposure. Potentially some relief there, so a big move on that stock. And then just to look at the consumer stocks, because remember, a lot of these companies produce their goods in some of the countries over in Asia, like Vietnam and also Thailand, and therefore they were hit by the tariffs. But a relief, a pause on these tariffs, boosting Adidas, boosting Puma, like we saw with Nike yesterday in late trading. And finally, ending on Pandora. Remember, that stock was down around 25% when Trump hit those tariffs because of all their goods, all those charm bracelets made over in Asia. But that one coming up around 10% for Pandora, and a swathe of green stocks this morning. Fran.
Okay, Joe, thanks so much. Joe Easton there from the equities team. Now, joining us now is Virginie Merzonov, Global Chief Investment Officer, Equity at Allianz Global Investors, and Tina Fordham, founder of Fordham Global Foresight. I couldn't think of a better team, also matching blues, to try and figure out, first of all, where the tariffs are, where they're not, because it's not as easy. It's not like they're all gone away. We've gone back to the 10%, and I know we've also spoken to Tariffs and Customs to really try and understand. So we'll get to that in a second, Tina. But first of all, what's going on in the markets? I mean, suddenly it's like there were no tariffs at all.
I think there's definitely a relief part, but clearly we need to have the longer-term picture. We need to have the clarity to lift off this uncertainty. So it's relief, probably a lot of shorting going on in the market that were reversed, which explains the sharpness of the reaction. But we certainly need a longer-term picture.
Yeah, and if you look at futures in the U.S., they're actually down. So again, there's a bit of uneasiness as we go through the numbers that Tina's gone through.
Yeah.
There is more than a little uneasiness, right? I mean, first of all, I think all of us who remember 2008 and remember 2020 were definitely among those who were queasy, to use Trump's words. Now, the relief rally is obvious. I'm more interested in the collateral damage and the second and third order effects of this tremendous policy uncertainty unleashed by the U.S.
And so if you talk us through the tariff, I mean, again, and we've had to, I think, go to actually Customs and Borders to see how they understand it, because they're the ones checking at the ports, you know, to see exactly what happens. So there's about 10% baseline rate applied to most goods.
Yes.
And that's, again, according to guidance from U.S. Customs and Border Protection, with the exception of China. So there's still extra tariffs from what there was 2 weeks ago.
Yes, we're still in a weaker position. You know, you could argue that this is where markets thought we would be with Trump, kind of going hard on China and perhaps raising tariffs on other countries. Again, it's the collateral damage from this intervening period and what it does over time to the U.S. negotiating position and other countries' willingness to engage with the U.S., given what appears to be a tactical approach to engaging with partners in the global economy.
And I know you're, a Global Chief Investment Officer Equity, but actually the Treasury move is still not really explained why it was so violent, and there must be longer-term implications for all asset classes, Virginie.
Yeah, absolutely. I mean, if you look at the Treasury markets, a lot of the measures are creating potentially less demand from big stakeholders in Treasuries, right? Very clearly. But to me, there's really three dimensions. The first one, of course, is macroeconomic. The second one is impact on earnings. And the third one is the geopolitical game or the shifting world order. And those are just reflected in instruments like the Treasury markets. And I think, we will see continued changes, even if we have a reversal, which, given the size of the movements, I think the way out for Trump is really to come up with a trophy deal. It could be Vietnam, could be Japan, to say, see, I've done that, because he needs to pivot very quickly onto the fiscal, the deregulation, the taxes. Otherwise, within 2-3 weeks, I would say from now, within 2 weeks, the constituents' feedback from the Republican constituents to the House will be very clear and that's going to create problems. So I think he's got a couple of weeks to really shift.
Virginia, let's also talk about China, because China has repeated its stance that it's open to talks with the U.S., of course, but the dialogue must be based, they say, on mutual respect and conducted on an equal footing. Now, this comes after President Trump ratcheted up tariffs on Beijing to 125%. So let's get the latest from Rebecca Chun-Wilkins. Rebecca, when you look at the China response, I mean, I guess they have two ways. They either retaliate even more, or they step it down and they talk.
Yeah, I think it's a dual-pronged approach, but the other element, of course, for them in the short term is trying to essentially figure out how they're going to manage the immediate impact, because even if they do find a way to come together and sit down at the table, that is going to take some time to iron out. So we do have this meeting that we're expecting tonight of senior officials. That we expect them to be discussing ways in which to support the economy through consumer spending, through support for the housing market, as well as through technological advancements. Now, some of that is likely to cover what we had already heard of and seen in the NPC, the National People's Congress, earlier this year. We know from that the number one priority is consumption. We're also expecting regulators to meet and try and manage some of the stress and the fallout that we're seeing in financial markets. But to your point, Francine, the big question is really whether or not we see China coming back to the table. You know, the impact on the economy is already being felt clearly in some of the sort of downward estimates that we are seeing from various banks. So Goldman Sachs cutting down its estimate 0.5 percentage point to 4% for this year.
Yeah. Rebecca, thank you so much. As always, terrific briefing. Rebecca Chun-Wilkins in Hong Kong. Tina, there was actually a kind of, bombastic confidence in President Trump that Xi Jinping would come to the table, or his team, despite the fact that they've been defiant so far. I mean, this is not only about the economy. This is about geopolitics and the New World Order. How can we predict what they do next?
And that is exactly why what has been unleashed is so problematic for markets, because it is geopolitics that is driving these policies. Geopolitics is what countries do to project power. No matter what the kind of ex post rationale we try to ascribe to Liberation Day, Trump will claim victory, as you've said, by getting China to the negotiating table. Is it a win for anyone, or is it just unleashing more uncertainty? I'm really inclined toward the latter. It's great if we feel like Trump has saved face and stopped inflicting damage. China plays a longer game.
Yeah. If you look at the last 7 days also, what I thought was very striking is that whether you're an ally like a Modi or even a Netanyahu, it doesn't really make a difference how the White House treats you. So when we look back in the last 7 days, what are the geopolitical consequences of these tariffs?
For me, one of the most extraordinary scenes was the fact that China, Japan, and South Korea came together, arms linked, to talk about a unified response to the tariffs. Now, these are obviously countries with very deep-seated historical animosity between them. That reflex isn't going to go away anytime soon. We also have seen China increase its military exercises around Taiwan. You know, markets were busy looking at other things. And so the forces that have been unleashed, that doesn't go back into the proverbial bottle.
Yeah, and Virginie, again, I mean, we know that China's top leaders are meeting to discuss this extra, economic stimulus in response to the tariffs. So can they support the economy more, and can they actually win as they maybe reinforce their trading relationship with Japan and Europe and others?
Yeah, absolutely. So if you remember, the support for the domestic economy was always in the card, but there was a little bit of power dry waiting to see what the tariffs were going to be. So you've got the two giants sort of talking to each other, not very nicely, but as Tina said, China has a longer-term game. China has its own challenges, demographic challenges, etc., but a lot of dry power. Mm-hmm. I think what is really important is to think, is there room in the world for a WTO ex-US 2.0? Because really, you could have the US play the game of the tariffs, unify the rest of the world, and actually let it be. It's shifting world order. That is what is happening. But for China, we have to remember that one of the strengths of China is its economic power. Currently, 32% of global manufactured goods are made in China, from 5% 30 years ago. So, every 3 out of 4 lithium batteries made in China. made in China 30% cheaper than in Europe, 20% cheaper than in the US. So ultimately, we are penalizing the global consumer through that and the people who elected Trump. So we have to also see what that hidden power is, which should prevail at some point. So I think in the end we'll have a wiser conversation at the table, but the trend for China since the tariffs 1.0 that Trump imposed has been this bifurcation, and that is going to stay.
Virginie, on equities, I want to go back to the point that actually there could be some kind of WTO rules-based new order without the U.S. But on equities, is now the time to buy? Do you just wait and see because there's going to be a lot more volatility, or where do you see opportunities?
So, at the end of last year, I came up with my 8 points for the year of the snake. One of them was watch margins, anchor portfolio, don't take big bets on the U.S. Everybody was overweight. The U.S., be balanced, etc. I think you need optionality in the portfolio because you have days like this. You can't be at 10% cash. Yeah, you might be for a week and it looks good, but ultimately our clients are expecting us to invest. So you want to be able to have those long-term structural growth trends. Tech is absolutely still in there. Why? Tariffs are high increased cost. Companies are going to go and say, okay, how do I mitigate my cost? Of course, it's going to be through technology and AI, particularly now that AI is democratized in terms of cost. So, if you don't have enough tech in your portfolio, look at those weakness days to add to them, but create more of a balanced portfolio for the rest of the year.
I want to ask you about banks as well, because they were slammed because they're exposed so much. But on this idea that actually this new world order, and I've heard chatter, right? It's like, why don't people call Mark Carney maybe in Canada? Can the EU take the lead? Who's the kind of, the counterbalance to the U.S. that's not China right now?
Well, this is the Kissinger idea, right? Who do I call? I'm not sure it's going to be Mark Carney or any one leader. I'm often asked by our U.S. clients, who in Europe is going to be in charge. What I think is a more practical way of thinking about this, relating to Virginie's point, is there a subset of large economies that are going to continue to follow the rules-based system? And yes, there is. And that also includes big countries like India. It's not only, the G7 ex-US, but I think this is part of the collateral damage that I was talking about that I don't think Washington fully appreciates at this stage.
And Virginie, I want to talk to you about the banks, but I guess a broader point, we're seeing quite a big correction or, going back to levels that were maybe more in line with what we were expecting for Donald Trump. Do you still expect quite a lot of volatility? Because these tariffs are moving around, and it takes time to see where the loans are, where the things that are going sour along. So it's not as easy as saying, right, we're over this.
Yeah, absolutely. So for the sector, the banking sector in particular, clearly the environment and the macro environment, remember we talked macro geopolitics and earnings, that is absolutely critical. What our companies are paralyzed right now. Do they invest? Do they do M&A? So you have to be very careful. Look at the cost of capital for those banks, and do you think they're going to be able to exceed in, make more money than their cost of capital? That's the key. Some will not. But if you look at the rest, at the market overall, it's going back to margins. There's going to be a sharing of the cost of those tariffs. Is it 50-50? Where's the power of demand? Is there demand elasticity or not? Because that will be where the shift of the cost burden will take place. So I think, within the financial sector, you have other companies that are interesting. In the banking sector, you want to be very mindful about that cost of capital element.
So interesting. I could talk to you for another 2 hours, but there's unfortunately other news we need to talk about. Tina Fordham, founder of Fordham Global Foresight, and Virginie Maisonneuve, Global Chief Investment Officer, Equity at Allianz Global Investors. Coming up, European equities surged the most in 5 years after Donald Trump's U-turn on higher tariffs. So we'll take stock on where we are in terms of global trade. That's next, and this is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The names that move markets are on Bloomberg.
U.S. consumers are flexible. We have options. We can produce stuff at home. We have a variety of countries we can import stuff. We can substitute into home production. Whereas countries that sell to the United States are inflexible. They've only got the United States to sell to. There's no alternative. So they're the ones who will bear the burden of these tariffs, which means that there's going to be very limited pass-through into downside economic risk or into higher prices. So I think that a lot of folks have got that wrong.
Nobody covers business like Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Well, I thought that people were jumping a little bit out of line. They were getting yippy, you know? They were getting a little bit yippy, a little bit afraid, unlike these champions, because we have a big job to do. No other president would have done what I did. No other president. I know the presidents. They wouldn't have done it.
President Trump there, and why he backed down from higher tariffs less than a day into they came into effect. Now let's take stock of where we are after Donald Trump's U-turn on higher tariffs. We're joined by Bloomberg's Charlie Wells and Brendan Murray, our trade czar. So, Brendan, I mean, I like the way, the president put it. It's a bit yippy. I mean, they were all over the place, frankly. The markets were really scared, and there was, talk about distress. But I went through, I tried to do through all of your team's great reporting, where we are on tariffs. I mean, they're still 10%. So we're back. It's not that they got rid of the tariffs, is we're back to where markets were expecting Donald Trump to land this last week.
Yeah, I think we've gone from what was basically a global shock to the system to something more of a slow burn on the U.S. economy and the economies affected by the tariffs. In particular, the move yesterday to sort of take a U-turn on all the other reciprocal tariffs allows the administration to focus on its main goal, and that's trying to rein in China. Those 125% tariffs that the president raised yesterday, they were met this morning with tough rhetoric from Beijing as well, saying we're gonna fight this to the end. So I think what this does is focuses the attention now on the real prize, and that's trying to rein China in for the Trump administration.
Yeah, and this is 100% what we're watching for. And then we also heard from Donald Trump that he may be a little bit easier on companies that are really get hit. And Charlie, that's what you're focusing on today, is trying to figure out the companies that will be slammed compared to the ones that will be maybe okay-ish.
Yeah, we're looking at the corporate reaction. And, Bloomberg Economics has this number out that kind of speaks to your point about how the tariffs are still there, right? So they have the U.S. average tariff rate. It's gone down from 27% to 24%. So that's still significant. And something else that Trump talked about yesterday that is kind of getting lost in a lot of this market euphoria right now is that he still intends to bring in these sectoral tariffs, right? He literally talked yesterday about how the pharmaceutical tariffs are coming. He wants to bring pharmaceutical companies back to the U.S., and that is a warning that European pharmaceuticals issued earlier this week.
Brendan, I mean, I know we've been reporting, and I love that your team actually went to speak to a U.S. Customs and Border, officer, because these are the people at the ports that then have to fill out everything to know how much they're taxing staff. I mean, is it chaos a bit?
Yeah, I think it's paralyzing is what it is. Companies don't know whether to order more from a different country or just stop ordering and hope that this blows over. So the dark clouds are over markets and the global economy yesterday aren't completely gone. There's still a cloud of uncertainty, and it looks like it's going to be protracted through the summer, through the next 3 months or 4 months, where global trade basically won't grow, and it could even go in reverse. The WTO's latest forecast is for a -1% contraction in global growth in global trade this year. So that's not a good thing if you're doing doing business in China, you're doing business in Europe. It's a headwind for everybody.
So, Charlie, you're an Amazon, you're a Walmart, you're even a Kohl. Like, how do you deal with this?
Yeah, I mean, Bloomberg has done some excellent reporting, really showing kind of the specifics of how this could play out. And if we want to look at Christmas ornaments, I think they tell a great story. Always a great story. They tell a story about how executives have to focus beyond 90 days. So great, we've got a 90-day reprieve. What about that? Walmart has told a factory in China that they need to stop putting price stickers on Christmas ornaments because there's still so much uncertainty about what those prices could be. We know that Amazon has been canceling orders, and also the likes of Kohl's, which is the clothing retailer in the United States. They put in orders recently and then had to tell Chinese factories to stop those orders even though raw materials had already been procured.
And are we expecting in the next couple of days to understand more what China wants to do? I mean, Donald Trump was pretty confident yesterday that they'll come to the table.
Yeah, that's not the way China operates, or at least that's what our analysts tell us, is that China does not negotiate with arm twisting and the kind of approach that Donald Trump is taking. So we'll have to see how Beijing responds. You would imagine that there's a lot of back channeling going on right now to bring these two sides. The tariffs won't help either economy, but certainly China has a toolkit of retaliation measures that it can dig into, and it could do everything from control the amount of raw materials, critical minerals that are shipped to the U.S. To targeting specific U.S. companies, big tech companies. Tesla has a big factory in China, so those kinds of things that China still has in its back pocket that we haven't seen yet.
Brendan, I mean, do we need to really start thinking about some of the permanent damage that this has done despite the turnaround?
Yeah, I think the Trump administration tried to undo a lot of that yesterday. The sort of chaotic rollout of reciprocal tariffs, one number for everybody. That's out of the picture now, at least for the next 3 months. But there still remains a 10% tariff on all U.S. imports from everybody, and 125% on China. That will, if it stays in effect and they don't get to the negotiating table, that will decouple one of the largest trading relationships in the world, with about $700 billion worth of goods moving back and forth between the two countries.
Great. Thank you both for joining us, Charlie Wells and Brendan Murray. Now, coming up, we look at it from, of course, an ECB perspective, or central bank perspective. We'll get the view of Jean-Claude Trichet. He's the former ECB president, and one of the questions we'll be asking is exactly that. Is there any permanent damage to either inflation expectations or just the economy going forward? This is Bloomberg.
According to Kyodo, Japan and UK Prime Ministers discussed tariffs over phone.
In case you missed it on the opening trade.
The president is speaking to this part of our population that we know did not benefit from globalization. You know, the IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking. And this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
In case you missed it on Bloomberg Surveillance.
I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion. And so what AI will allow us to do is not just go do things that humans don't do as well, but actually do things that humans don't have the time to get done.
Don't miss Bloomberg Surveillance live every weekday.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European markets post their biggest gain since COVID after Donald Trump's U-turn on higher tariffs less than a day after they came into effect. Well, there's no relief from China, which now faces import levies of 125%. Well, Chinese leaders are said to be meeting to discuss more economic stimulus. And the EU says the about turn is good for the economy and must now decide whether to go ahead with the retaliation approved just hours earlier. Plus, coming up a little bit later in the program, we'll also be joined by Carlisle's Jeff Curry as oil hovers near a 4-year low. Now, before that, let's get the latest from Brussels. And the European Union's digital chief, Henna Verkunen, says the bloc's rules governing digital platforms should not be considered barriers to trade with the U.S. Now, the bloc has opened a number of ongoing probes into the behavior of U.S. online platforms, including X. But the EU says it does not want a trade war with Washington.
We are going to continue the negotiations because it has been all the time the message from the European Union side that we want to negotiate and we don't want to have tariffs and we don't want to have trade war because we don't see that anyone is benefiting from that. And of course, it's very important for businesses and industries to have legal certainty and also stability.
Well, for more, let's get straight to Bloomberg's Oliver Crook, who interviewed her earlier, of course, this morning. So, Oliver, I mean, there does seem to be a direct link with, some of the digital kind of people going after big giants and a possible retaliation on trade.
Absolutely, Francine, and that's a distinction that Henna Verkunen there wanted to make, that is saying that basically these are two completely separate issues, tariffs and tech. These are issues that do not touch one another. We know from the Trump administration, however, that they don't really necessarily draw that kind of distinction. One of the main gripes that the Trump administration has had, whether it's Donald Trump, Howard Lutnick, or Scott Bessent, is this idea of non-monetary barriers, non-tariff barriers to trade, and one of those is tech regulation. And until we basically got that reprieve yesterday from the Trump administration, that 90-day hold on those so-called reciprocal tariffs, dropping it from 20% for the EU to 10%, the EU was next week going to develop a new architecture to basically be able to hit back at the United States, not just on tariffs, but potentially also targeting technology companies. I asked her if during those conversations she had been a part of them in developing that architecture. She said that basically the only line that we have here, the only thing that we're going to say is that we want to have a good and productive relationship with the United States. But for the EU, if this trade discussion re-escalates, these tariffs come back in the end of 90 days, one of their greatest point of leverage is against American tech companies. So watch that space if indeed this has to re-escalate once more.
Ollie, this comes as the EU has also approved retaliation for Trump's earlier tariffs. So take us through exactly what tariffs are in place and what is not.
Yeah, Francine. Yeah, Francine. I mean, it's Thursday, so it's perfectly normal these sort of days that we have our third sort of global tariff regime of the week. So we had those 20%. We've now come down to 10% in terms of the minimum tariff. But we should say, Francine, that despite the fact that this is a big reprieve, this is a reprieve that has sent the market skyrocketing, this is still an enormous trade barrier between the biggest trading relationship in the entire world, between the United States and Europe. We're talking about 10% tariff on the 500 billion euros worth of goods that go over to the United States every single year. And we should also say you still have those 25% tariffs on the auto sector, a major sector for the European economy. Steel and aluminum, 25%, that is still there. And just on hold is that only sort of extra 10% to the minimum tariff. So these are still the conversations that are going to be before the policymakers here in Europe. This is sort of the Trump technique, where you sort of end on a sweet note, despite the fact that you have a sort of very bitter pill that you had to swallow. And for finance ministers that are gathering tomorrow in Poland, the question is, A, what is the impact still going to be on the economy? It's still going to be absolutely vast. And B, can you really trust the United States if they're willing to use this point of leverage at every single point of the way? What is going to prevent them from bringing it back to the fore if they get exactly what they want? And that's a discussion we're going to have with the German finance minister, the Irish finance minister, and a number of different guests tomorrow in Poland.
Oliver, thanks so much. Charlie Crook there in Brussels. Now, European Central Bank Governing Council member François Villeroy de Galhau sees U.S. President Donald Trump's decision to pause on higher reciprocal tariffs as a step forward, quote, economic reason. Now, de Galhau believes that protectionism is bad policy that will negatively impact the U.S. economy. He added that the EU's cool heads and unity in its reaction to the U.S. will not lead to an increase in inflation in Europe. Now, for more on all of this, we're joined by the former European Central Bank President Jean-Claude Trichet. Monsieur Trichet, as always, thank you so much for joining us. Look, do you think, Monsieur Trichet, that there's any permanent damage from what we saw over the last 7 days, despite the turnaround from Donald Trump? Is there any lingering sense of unpredictability in U.S. policy?
The ONS say the
that will
transition
impact
to the new UK Labour survey
policy?
could be in 2027.
Hello, Francis. Thank you for inviting me. Yes, indeed. I think that there are permanent scars after what has happened. By the way, the start of the drama was decided upon by the big executive branch, which is the U.S. presidency. And I have never witnessed over all my period of time, all my professional career, such a drama which would be triggered by any executive branch. So it seems to me that what we have observed is incredible in terms of, I would say, unpredictability of what could happen. And of course, the U-turn, but I'm not sure that it is a U-turn, it's a pause. And the pause is welcome, only triggered, by the way, by the reaction of the markets, the catastrophic reaction of the markets all over the world, and particularly, of course, in the US. So we are still in a universe of unpredictability, which is extremely damaging, both, I would say, for inflation, for growth, and for the overall reaction of all partners. So I hope very much that we will go back to trust and credibility of the various partners in question. But that's, if I may, a hope. It's not what we are observing right now.
Monsieur Trichet, I mean, so many market participants yesterday, frankly, were so shocked by, almost the distress in the markets. Do you think that we were close to a global financial crisis to the scale of what we saw during Lehman?
I don't exclude that, obviously, particularly if the idea of escalating the conversation would have been the rule of the game, which seemed at the very beginning to be more or less the attitude of the U.S. president. So I think it looks a little bit like the reaction of all of us, by the way, when we had Lehman. You might remember immediately after Lehman, the rhetoric of the US Treasury was, after all, we are not in Soviet Union, we are in a market economy. When a particular entity, namely Lehman Brothers, collapses, it's normal. You behaved improperly, you manage very, very poorly, then there is a bankruptcy. This rhetoric lasted 2 days and a half. I was the witness of that, of course, in permanent conversation with the US friends. After 2 days and a half, the idea was I would say, House of Cards is collapsing. We have to do something. And the reaction of the executive branch to save the day was extremely determined. But the overall, if I may, political sphere in the US was not necessarily on board, and they first refused the program which was presented by the Treasury only when the Dow Jones collapsed. The political sphere in the US understood that it was very serious. And then in the present case, we had 7 days for the executive branch to realize that, as a matter of fact, there was a house of cards collapsing. So I'm happy, of course, by the pause, but again, it's not yet, I would say, very, very convincing in terms of the future after the 3 months.
But, Mr. Trichet, I mean, this is exactly what I wanted to ask you about. You were president of the European Central Bank in 2007, where there was this agreement also on, swap arrangement between the Fed and the ECB. Do you think that the two could come together today if there was more distress in the markets, let's say in 3 months, we don't know what happens next, to do the same like back then, or has the political landscape really changed?
Well, we will see. I have a full trust in the central banker. They proved on both sides of the Atlantic and everywhere in the world that they were highly responsible, highly able to cope with the surge of inflation that we had to cope with. So I maintain my full confidence in the ECB, in the president of the Christine and François and all the other central bankers of Europe. I know that they will do what is the best in the circumstances. I have also a lot of respect for Jay Powell. It seems to me that in the circumstances he behaved extraordinarily properly. We will see what happens, of course, in case we had a deterioration of the situation. I remain a little bit optimistic because clearly it seems to me that the executive branch in the US understood that you cannot do anything. You have to be responsible.
With so much market turmoil, though, where should regulators be looking for risk right now?
Well, again, I expect that we will have some calming down. So the main problem are the scars in terms of inflation expectations and in terms of real growth in the US and in the rest of the world. Even now, with the 10% increase of tariffs, we have an impact in terms of growth and in terms of inflation expectation, which is not negligible, of course. We are happy that the worst seems to be over for 90 days, but it is not a very good situation at all. And I expect, again, all the central banks to do the best in the circumstances, as I already said, even if it is quite complicated.
Monsieur Trichet, if you can hear me, I think we're just trying to put the earpiece back, so you should be able to hear me now. Monsieur Trichet, for Europe specifically,
yes, I am.
It's very clear that traders, fabulous, you can hear me, traders are paring bets on an ECB interest rate cut. How vulnerable is Europe still to industry shifts, for example, like cars, and exposure to China?
Again, the uncertainty is unfortunately, by the way, the decision, if I may, of the executive branch in the US, very profoundly in the picture. So uncertainty being the rule of the game, you have to prepare for anything. We will see what the ECB will decide, both, I would say, in terms of monetary policy and the decision that is very likely to be taken in terms of decrease of rates. The markets were projecting an interest rate decrease. The present situation will not guide me to say, no, they will wait to see exactly what inflation is doing and so forth. It seems to me that the overall situation does not call for a change in the present expectation. The rest of it depends extremely importantly on what is likely to happen in the US, frankly speaking. The US is the, I would say, place where the drama is played. And so we will see. I have no other I would say, message than at this moment confidence in both central banks and the central banks the world over.
Yeah. Understood. I mean, longer term is the era of dollar dominance, and with that comes exorbitant privilege, actually, for the U.S. Is that over? Are there any longer-term implications that the euro could strengthen its international role?
Yeah, you're very right to ask the question, of course. What is strange with the U.S. attitude, at least in the last weeks or month, is first the fact that the U.S. attacked friends and allies exactly as they were seemed to attack the enemies. So it's very, very strange. And of course, it's an immense disappointment for the European and for allies in general to see this behavior. And the scars are considerable. As regards the dollar, it looks the same. The dollar is, of course, a very important currency the world over, having a position in the overall currency situation of, say, 60%. All the indicators are giving the dollar 60% of the overall global position, when we have 20% with the euro. To play against the dollar seems strange, and I have not witnessed such an attitude from the U.S. executive branch. I don't expect that it will last, but one never knows. And of course, as everybody knows, the euro is a credible, a solid currency which keeps its value over time and is a full success. So we will see what happens.
Thank you so much. As always, the former European Central Bank President there, Jean-Claude Trichet, with all of the insights and, of course, a history of what we've lived through in the last 20 years. Now, coming up, Jeff Currie from Carlyle on his outlook for the energy and commodities markets. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, former Treasury Secretary Larry Summers of Harvard on the consequences of the Trump tariffs. Ambassador Richard Haas of Centerview Partners on the TikTok deal, where President Trump might need to look to get the money to put into his sovereign wealth fund. And former Transportation Secretary Elaine Chao tells us how to fix the air traffic control system.
Reorganize the structure.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The conversations that matter, the insights you need. This is the Pulse, and I'm Francine Lacqua here in London. Now, oil extending its volatile run as investors grapple with President Trump about face on his signature trade policy. Now, this comes as the U.S.-China trade war and OPEC's Plus decision to loosen output curbs weighs on oil prices. Well, we're now joined by Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle. Jeff, I'm just so happy to speak to you because actually it's been crazy. Like, there's been distress, the markets were all over the place. Like, what have we lived through in the last 7 days?
liquidation now, ask questions later. And I think that's the reason why correlations have broken down. But, yesterday the markets hit a bottom and they came back up. And when we look at oil in specific and commodities more generally, the dead cat bounce was really a dead cat bounce. It was relatively small, which I think is telling you a lot, that there's still a lot of risks left in the system. And when we look at the overall tariffs, they're the highest in a century. They're still at 25%. And then second, when we look at who got hit the hardest, it's the superpower of manufacturing. And then the other thing to keep in mind, and this goes to oil and commodities, U.S. is the largest exporter in the world and producer of oil. China is the largest importer of oil. So oil and commodities are in the crosshairs right now. And, when we look at China, I want to emphasize in the United States how they fit together. Yep. The United States is a barbell economy. It's got tech on one end, commodity production on the other. What sits in between? Everything China has. And so when we think about where this trade war currently exists, everybody, viewed as reprieve because everybody else got a 10% and China goes elevated to 125%. China is the critical component here relative to where the U.S. sits. So I think oil probably has this right in repricing the risk again this morning.
But do you think, are we headed towards a severe recession in the U.S., but even globally, even with where we are now, this 3-month reprieve? Or could we at least be headed to 2008 crisis style?
Well, I think, the situation is radically different because it begins with policy. The policy put is kind of, benign, to say to be kind here. And I think that the risks here are very different than anything that we've ever seen. I think what happened yesterday was a liquidity issue. And you could see it in gold. Gold sold off. When you're in a crisis and gold is selling off, that's telling you got a liquidity problem. And then, boom, they came out with a reprieve, gold bounced back up, which is telling you that, hey, liquidity came back into the system. So I think, that the environment we're dealing with is not like 08 and those other environments because it's policy driven.
Okay, but will this kill, for example, U.S. shale?
I think that's the biggest risk here. What is the U.S. biggest dog in the fight? It is the oil. In fact, I like to point out, what are the 3 Bs of U.S. exports? Bushels, barrels, and bombs. Those are the big 3. And the biggest one of them all is the barrels. It's $350 billion of exports. And here's the critical point. As you asked the question, shale is highly
Japan's economy minister Akazawa says U.S. imposition of tariffs on steel and autos is regrettable.
They're fungible. China can get them from Brazil. They can get the oil from OPEC. The problem with the U.S., all the stuff that China exports is non-fungible, which means they can't go other places to get it, which means the U.S. consumer is going to feel more of this than what the Chinese consumer feels.
So your base case is what, that the U.S. president realizes and then does a U-turn like he did yesterday also on China, or how does this end?
I think how it ends is who's going to feel the most pain here. As you ask, shale, we get below 55, which we were last year. Even the Permian shuts down. Below 65, you're shutting down other parts of the shale patch. The other one that's getting hit hard are farmers, the bushels. So when we think about, which are the congressmen to break ranks or the lawmakers to break ranks in the Republican Party, they're from states that have farmers and oil men. In fact, who is it? It's Nebraska, it's Iowa, it's Texas that are now beginning to break ranks. And so you ask you, where is it going?
Japan Economy Minister Akazawa says there's no specific date set for the U.S. visit.
So first of all, how quickly could we go to those levels? And are senators and governors going to start going to the White House and saying, hey, hold on, this is a massive mistake because I'm going to lose my constituents?
I think we got there yesterday. You were at $56 a barrel in WTI. We're down at that point where you're now digging into the cost curve. And let's not remember the decline rates on U.S. shale are massive. It'll just drop off a cliff as you begin to cut expenditures. And these cycles are rather quick. I like to point out the United States in 2020 through 2021, from April 21, oil prices went negative. It shifted in being a net importer. This could increase the current account deficit because they lose their biggest dog in the fight. And by the way, you get the wheat prices when they're an exporter, and by the time they swing to being a net importer, you were back to $100 a barrel.
But Jeff, this spells disaster.
We look at the commodity markets; they are the most.
And Japan Economy Minister Akazawa says, "I'm still calling for a review of U.S. metal and auto tariffs."
Non-fungible goods it's exporting. United States' biggest dog in the fight are fungible commodities that are very supply elastic.
But Jeff, if you're China, you just play the long game, right? You try and support the economy and wait this out.
That's, you look at what you learned in 2020 and 2021 during the pandemic, that production came off really fast. Which means that the drop in production could impact the current account deficit in a negative way. Because, again, what was the biggest driver of the current account deficit over the last 50 years? It's oil.
Where does all of this turmoil leave the energy transition?
When we look at it, improves the energy transition. I like to point out a security-driven energy transition is faster,
Japan's
more
Tamaki
profitable,
says, "I want the government to
and
consider cutting sales tax
the
to
energy
5%.
transition started in 1973 with the first oil crisis. From 1973 to 1993, we saw massive investment in nuclear power, renewables, and the rest of it. It dropped fossil fuels from 94% of overall demand down to 85%. The net zero 2050 transition took you from 85 to 81, and it was expensive and it was difficult. So when people are scared and energy security is a priority, they act quick. And I like to point out, you need to have energy security over affordability over the environment, and you'll get there.
But even in the U.S.?
So
this is like an unintended consequences of what this trade war looks like.
Yeah, I'd like to point out, France has the lowest carbon emission footprint in the world because of its nuclear power. It didn't get there because it wanted to save the climate. It got there because of energy security issues. So there is a silver lining in the cloud here per se, but energy security is typically a much faster and quicker driver of a transition.
Jeff, is there any way that the U.S. at this point can avoid a recession?
I'm not the macroeconomist, and when I get in there, but I would argue that in energy, the shale patch is going to go through a really difficult time here. You're already feeling it. And let's not remember, when we think about oil prices, I know that the administration targets 50 to 55, which is below the Permian break-even. It's going to cause problems. The United States is the world's largest oil producer and the world's largest oil exporter. Really low prices are a bad thing for the United States. And you saw this in 2015, and you saw in 2020. But let's look at 15 because it was different. Yes, it benefited Chicago when the oil prices came off in the northern states. But by the time the CapEx came off in 2015 and 2016, it was detrimental to the U.S. economy because that's a lot of CapEx and jobs that would be lost from the energy sector.
Jeff, given all of this, has OPEC Plus made a terrible mistake? Will it fall apart?
Yeah, I think their 400,000 barrel per day increase last week was a shot across the bow to the rest of OPEC members as well. Do not cheat. Now, the problem with that explanation was the following morning on Friday, Russia came out and backtracked on shutting down the CPC pipeline. So somewhere there was probably some pressure on Russia somewhere there. But I think the key point there is, when we look at the situation right now, there's a lot of downside risk here. And you and I have been doing this for a while. We know that this oil market, it doesn't do three-point landings on 50 to 55. Odds are it's going to overshoot to the downside.
Jeff, as always, thank you so much for joining us. Jeff Curry, they're a Chief Strategy Officer at Energy Pathways.
According to Interfax Ukraine, Ukraine's deputy PM says technical consultations between the Ukraine and US on the minerals deal will begin in Washington on April 11th.
On the higher tariff pause, what it means longer term, and dollar dynamics. Up next, a Bloomberg Brief, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
What's the best thing and what's the worst thing about trying to put money to work in this market?
Technically, we're an endowment, but we use the best of the endowment model and the hedge fund model so we can react very quickly. And I think we're very good, I would argue probably one of the best in the world at connecting the dots across asset classes. And from our perspective right now, The volatility is great. I think market structure is still challenged in that liquidity at moments in time when there's a lot of volatility is challenging. So you can see a great trade, but sometimes buying as much of it as you want is easier said than done.
Do you have a favorite trade right now?
So we are tactically, at the end of last year, we bought call spreads on Hong Kong equity indexes. And I continue to like that trade, so we're holding that position. And again, when you see kind of the micro and macroeconomic data coming out of the US and you see the data in China, I think you will see a tactical deal out of economic necessity between China and the US. And I think when you look at investors generally,
Iran may expel
they've left
nuclear
China for
inspectors
dead.
if military
so I think
threats
there's going to
continue.
be money forced into that market.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Big swings, futures fall after the biggest stock market rally since 2008. A punishing Treasury session fuels turbulence in global bonds. No reprieve for China. Top officials in the nation dust off their stimulus plans as President Trump goes forward with China tariffs. And the data amid the confusion. Fed officials emphasize inflation risks with the latest CPI print hitting later this morning. And what a week it has been. And it's barely even Thursday. Well, at least now we know Donald Trump's pain threshold, 12% down on the S&P 500, followed by a 60 basis point jump in the 10-year yields. You get the biggest rally in stocks since October 2008. But look at this morning's session. We are down by more than 2% across the board. For Russell 2000 futures, it's nearly 3%. Do we now need to focus on still the damage coming from 125% tariffs on China? For the bond market, Trump, much like most of people watching this program, was watching the bond market. Stocks saw a rebound, but bonds didn't yesterday. They're still 20 basis points higher since Liberation Day. High-yield credit spreads still 92 basis points wider. But we do add something of a rally today. Your 2-year leads that rally down 5 basis points, 10-year yield down 4. Your 30-year barely changed this morning. So that is the overall market picture. Let's take a look at what's happening below the surface here with some stocks to watch. It's Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So we are seeing broad declines in the Mag 7 today, given those massive rallies we saw yesterday. Take a look at Tesla. We're down almost 5% on this stock after a jump yesterday that saw Elon Musk increase his fortune by around $36 billion. One stock not giving up the gains, though, is the Donald Trump's social media company, DJT. Remember, Trump saying yesterday it's a great time to buy, including that ticker in his post as usual, and it was up 20% yesterday, continuing to rise this morning on that one. Then going the other way, we have got US Steel declining. Donald Trump says, although he does love Japan, he doesn't want the country to take ownership of the firm, and Nippon Steel potentially not going to be able to push through with the takeover of X, according to analysts this morning. Finally, just a quick shout out, as usual, for our Before the Bell opening wrap, which is available on the terminal, and we'll run you through all these pre-market moves and more ahead of the open in New York.
It's the deal that just won't go away with U.S. Steel. Joe, thank you so much. Bloomberg's Joe Easton. Coming up this hour, we're going to be catching up with Tim Graff of State Street, Keith Lerner of Truist, and Rob Arnott of Research Affiliates, an hour you do not want to miss. But first, we start with our top story. President Trump pausing tariffs for dozens of nations, except one country.
I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out. I think it's going to work out amazing. I think that our country is going to be at the end of a year or shorter, but I think we're going to have something that nobody would have dreamt possible.
And China's Commerce Ministry says, let's talk, but only on equal footing.
China's stance is clear and consistent. Our door is always open for trade conversation, but conversation must be based on mutual respect and equality. If the US pursues a trade war, China will fight to the end. Exerting pressure and threats are not the right way to have a relationship with China.
And our team coverage starts right now. Joining us is Bloomberg trade czar Brendan Murray and Rebecca Chung-Wilkins in Hong Kong. Brendan, let me start with you. What seemed to cause the blink from Trump yesterday?
Yeah, it seemed like the markets was going to go from a Wall Street problem to a Main Street problem, and the pressure there in the bond market was too much for many in the Trump administration to take. So they said, look, rather than let's fight a trade war with everybody at the same time, let's dial it back and let's focus on China. But what you have shaping up there is basically a $700 billion game of chicken. That's the size of the trading relationship between the two worlds, the two leading economies, and it's as the Chinese government has said, higher and higher threats, are not the way to bring us to the bargaining table. So it's hard to see what will break this impasse at the moment. 125% tariffs on all Chinese imports into the U.S. is going to decouple those economies over time, according to Bloomberg Economics. So we'll have to trade the ball's in Trump's court now, and we'll see if what he does next in terms of ratcheting up the pressure.
The ball might be in his court, but Rebecca, let me bring you on this. Is there any willingness from the Chinese side to negotiate? The Trump team has seemingly expected that they would come sooner and negotiate. Instead, they put on reciprocal tariffs of 84%.
Yeah, that's right, Danny. I mean, I think we've seen Beijing clearly express its willingness to go toe for toe with the US here. And in part, that's because once you go over a certain rate of thresholds with those tariffs, it's really marginal gains if you continue to move from, say, 80 to 100 to 125% or beyond. We don't really have any signal from Beijing that its willingness to come to the table, particularly not at this point. And the comments that you had from the Ministry of Commerce there right at the beginning, I think underscore one key issue, which is this issue of trust. It's come up again and again, and this issue of respect. This feeling that Beijing doesn't necessarily think that they're going to sit down at the table and face counterparts that truly want to get a deal done. They have, although they've sort of continued their own rhetoric, trading barbs, promising to fight to the end, they have still continued to say they do want to sit down with the US, but this question of mutual respect continues to be reiterated by officials.
Rebecca, we also have great reporting from the team that China's leaders are set to meet today on stimulative measures as they face the consequences of this. What might we get from that meeting?
Yeah, that's right, Danny.
Voice
so we
news
are expecting
disconnected.
senior officials to sit down tonight. The discussions on the table are ways to support the economy, including the housing market, getting consumer spending going, as well as a regulatory meeting. Regulators there trying to find ways to stabilize the economy, stabilize the markets that we've seen. Of course, we continue to see a lot of movement in Chinese equity markets, as we have around the world, of course. But we also now are getting signals, too, that we might be seeing some kind of monetary easing finally coming. This has been a long time in the works, but it now looks like perhaps the stars are aligned. We had this front page commentary from the Securities Daily saying it's now the time is right. Also, if we look at bond swaps, for example, does reflect that perhaps that rate is being priced in. And we also have had this important signal from the PBOC itself that it's shifting its stance away from prioritizing stabilizing the yuan to allowing and prioritizing growth, allowing some weakening coming through. So we've had a weakening, although in a sort of moderate way, but we've had a weakening in the currency for 6 straight days now. So there is some expectation that we may see a rate coming, and that speculation is building in markets too.
Yeah, the onshore currency falling to the weakest since 2007 at one point overnight. Brendan, let me just give you the final word, because the Trump administration has said that they've fielded calls from 75 or so nations coming in trying to make a deal. The reciprocal tariffs aren't dead. They're just on pause. What does the outlook look like for possible deals beyond China?
Yeah, I think from the perspective of economists, the economy has gone from the global economy has gone from headed off a cliff into a period that's more like a roller coaster ride. So we've got 90 days until to work these out. We've got countries like Vietnam, South Korea, Japan, India talking about doing deals with the U.S. So we'll have to see how quickly these deals come together and whether they actually yield results and perhaps encourage the Europeans to sit down and work out some of their differences. So we'll have to see if those deals have sort of a contagious effect and encourage others to come to the table. In the meantime, the U.S.-China trade war plays out in full display, and which could be quite disruptive in its own right.
Yeah, maybe that's why we're seeing futures do as they do. You see the Russell 2000 futures off 3% this morning. Brendan, Rebecca, great work as always. That's Bloomberg's Brendan Murray and Rebecca Chung-Wilkins. Now, as Brendan mentioned, it was the bond market that Trump and his team had their eyes closely on at one point. Nearly 4.5% yesterday. Is that the pain threshold? The New York Times, as many outlets did, writing about the move in yields that played a role in the decision to reverse course. They wrote, but the real credit, Mr. Trump's advisors admitted privately, should go to the bond market. Mr. Trump's decision was driven by fear that his tariff gamble could quickly turn into a financial crisis. Pleased to say that joining us this morning is Tim Graff, head of EMEA strategy at State Street. So, Tim, is this it? Is this the Trump put yields at 4.5%?
Yeah, I think whether it's the put or not, I'm not certain. But I think the potential for financial dislocation to extend and to maybe require some sort of policy response or market soothing from the Fed, certainly that prospect would have gotten his attention. If yields kind of naturally rise over time to levels like that, I don't think that's really a problem. It's the dislocated nature, it's the breakdown in market functioning, and it's, again, the potential for regulators or the Fed to need to really bring this to the administration's attention that I think that got their attention, and rightly so.
It's an interesting point, Tim, because it's not like all of a sudden all these bond vigilantes came to the market and pushed yields higher. It was unwinding of trades. It was something of dislocation. Does that make a difference going forward in the market's ability to push back against policy, if that's what was the driver behind the move higher in yields, not something like pricing more inflation, for example?
Yeah, no, I don't think this had anything really to do with inflation. Inflation expectations, if you look at market-based measures, have been mostly going down. This was about whether it was basis trades blowing up and needing to be unwound or just the liquidation of liquid assets to raise cash. Whatever it was speaking to elements of market panic. So, again, I don't think if fundamentals justify inflation, justify yields going up. And I suspect given, the net, it's always dangerous doing back of the envelope calculations on what the effective tariff rate now is. But it actually hasn't gone down that much when you consider how much it's gone up for China, even if the rest of the reciprocal tariffs are scrapped. So the inflation dynamics, I don't think, have really changed too much. And if those drive bond yields higher, well, that's fine. That's one thing. That's just the market finding a level. But this was dislocation and disruption that potentially threatened the gears of the financial system, and I think then warranted the response it got.
To the point that not everything is in the clear, Anna Wong of Bloomberg Economics has been writing about this, that if you actually look at where we stand this morning, it's worse than where we were yesterday morning, because 125% tariff on China is a problem when China exports more goods to the U.S. than any other country. Does that mean that the rally we saw yesterday is misplaced? In the market action this morning, that is of risk off, makes more sense to you?
Yeah, 100%. You mentioned in the opening this was the biggest rally in stocks in one day since 2008. Go on and look what happened after that big rally in 2008. It's not pretty. Bear market rallies like this, of this magnitude, those aren't signs of health. So, yeah, I think have we seen the worst? I really don't know, but I don't take comfort from stocks rallying nearly 10% in a day, because that doesn't really happen when you have properly functioning markets that, where everything's fine.
Can you take comfort in the fact we had a 10-year auction yesterday that went off without a hitch, despite the eruptions in the global bond markets?
Yeah, for sure, because there's all this talk about, foreign central banks trying to pare down treasuries and, who's going to buy all the bonds, right? That was the question until we got a huge rally a couple of weeks ago. And it does seem as though there is a clearing price for bonds, which no doubt 100% is good news.
Is there some sort of fragility still there, Tim? Because one of the remarkable things was to see this massive we're talking massive here, turnaround in U.S. equities. Yes, the bond sell-off did pair itself, but we still ended higher in terms of 10-year yields, duration, 30-year yields on the day. Is that a problem?
Problem, I don't know, but I would say yes, fragility is likely to remain high. Volatility events tend to cluster, I don't think this is anything like 2008, it's nowhere near that serious, but using that as an extreme case, volatility clustered for a long time. And I suspect the same will be the case. We have measures that actually capture market fragility in the pattern of market prices and correlations. And you won't be shocked to learn it's spiked to the highest levels we've seen in years. And that tends to persist. It takes a while for kind of the hangover of this to go away. So who knows if asset markets have found a bottom? I really don't know. I don't think they have, but I'm guessing that's a guess. But fragility, the ability for markets to be susceptible, or the susceptibility of markets to shock, I think will be with us for several months.
As if the start of the year hasn't felt long enough. Tim, thank you so much for joining us. Tim Graff of State Street. Let's get you some other top stories that are trending on the terminal this morning. House leaders have decided to postpone a key vote to fast-track President Trump's tax cut proposals and increase the debt ceiling. Leaders determined that they lacked the votes to pass the budget in the Senate. There's still deep divisions in the party over whether to cut Medicaid or other parts of the social safety net. President Trump signed an executive order to set up port fees and direct Elon Musk's Doge team to investigate how and why the U.S. Navy's production of ships has been slower than rival nations. Bloomberg sources reveal that the order is an attempt to blunt China's maritime dominance by offering new funding streams, including tax breaks, to American shipbuilding. And TSMC delivering a beat. The Taiwanese chip-making giant delivered greater than expected results last quarter for its revenue. It does reflect growing demand for AI servers and smartphones in the months before U.S. tariffs kicked in. It marks the company's fastest pace of growth since 2022. Coming up, oil markets sink with risk this morning after President Trump's U-turn on tariffs. We're going to discuss more coming up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising chorus conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Weekdays at 9 a.m. Eastern, only on Bloomberg.
liquidation now, ask questions later. And I think that's the reason why correlations have broken down. U.S. is the largest exporter in the world and producer of oil. China is the largest importer of oil. So oil and commodities are in the crosshairs right here, right now.
Jeff Curry of Carlisle speaking to Bloomberg's Francine Lacqua earlier. Oil is extending its volatile run. Investors still grappling with President Trump's dramatic reversal on his signature trade policy, and OPEC Plus deciding to loosen output curves, weighing on oil prices. We're back above $60 a barrel, but still down more than 3% for both Brent and NYMEX this morning. Joining us is Bloomberg's Anthony DePaula. I mean, Anthony, what a volatile run for markets, for oil. What do you make of the latest declines despite yesterday's reprieve on tariffs?
Yeah, we were below $60 even on Brent yesterday, first time in a long time. So that just shows the fragility of the market there. And really what's underpinning it is what has been holding back oil for a long time now, which is that kind of weakness in the recovery of China and the weakness in the outlook for continued demand growth there. So it's
China
still
Commerce
growing.
Ministry
The
says
economy
we
is still
will
growing.
strengthen
Demand is still
dialogues
growing,
on export control.
but it's not growing as fast as it had been in the past, and that's what had really been supporting this commodities boom. We saw oil get whipsawed and bouncing back with the delay of those tariffs. The idea that there's a delay, possibly investors thinking, well, this is that negotiation tactic coming into place now, and those tariffs perhaps might not come into place or might not come into place as strongly as they've been forecast so far. So investors looking at that, but we've still got that underlying issue of the demand, and now on top of that, we've got some OPEC supply, more production coming into the market as well too, and that's also weighing on the price. So we've got a lot of factors, this uncertainty about the tariffs. We've got the additional supply coming in, and those questions about demand. So that's all really moving oil and keeping it lower in this current range.
I was going to say, Anthony, that OPEC Plus decision to revive output was a huge head scratcher just because of prices and demand. Do we have any sense of just how deep of a price route the Saudis and others are willing to accept with current output levels?
Yeah, we don't at the moment. I mean, a lot of people in the market are talking about $50 a barrel as kind of the low end potentially. And we've seen some comments from the U.S. administration thinking that shale producers could sustain production at about $50 a barrel. So potentially one of the Saudi aims is again trying to target shale, trying to get some of that incremental growth from the United States and from other producers not coming to market and giving space to OPEC Plus producers. OPEC Plus has been suppressing production, and they've been giving up market share to other producers that have been coming into the market, increasing their production. We've had new fields from Brazil. We've got Guyana, of course, the U.S. shale patch coming on. So those producers have been taking up the demand increases we've seen in the market while OPEC has sat on the sidelines. Now OPEC is trying to eke back some of that market share and thinking that some of those lower prices could potentially keep some of those other barrels off the market and give more market space. So that's probably some of the thinking that's going in to this increase in production that was greater than expected, really.
Yeah, Brent crude trading at just above $63 a barrel this morning. Anthony, thank you so much for your time this morning. That is Bloomberg's Anthony DePaula. Coming up, we're going to take a look at what's making headlines around the world. We got your front pages for you on your Bloomberg Brief.
in case you missed it on Balance of Power.
Governor, I wonder if there's a silver lining in any of this for the great industrial towns of your state from the last century. Syracuse, Rochester. Based on what we're hearing from this administration, they will again have a seat at the manufacturing table. Do you believe that?
I hope so, but we have advanced manufacturing, we have pharmaceuticals. In fact, I was able to lure Micron with a $100 billion investment, the largest in our nation's history, to build semiconductors in the Syracuse area, and they'll be affected by this. The component parts to what they're building and the supply chain, they're going to see an increased cost, not just because they're in New York, but because they're in America. And that's what worries me. There could be a silver lining, as you say. I don't know how old I'm going to be when that happens. I mean, what are they going to do? Start building factories now? And, I just don't know. All I know is that people were promised lower prices on Inauguration Day. And guess what? They're going up.
Don't miss Balance of Power live every weekday.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
ECB, banks deposit 2.8 trillion euros with institution overnight. ECB, banks borrowed 6.0 million euros at marginal rate.
Executed one of the biggest economic policy reversals in modern history. The story starts.
ECB, 6 million euros borrowed using overnight loan facility, 2,816.24 billion euros deposited.
Discussions over $1.4 billion deal had reached the 11th hour before financial market volatility, as you might imagine, caused some complications. And in the FT, the Trump administration is threatening to end consultancy contracts worth billions of dollars. They're accusing 10 large consulting groups, that includes IBM and Deloitte, of being, quote, insulting in their proposals for finding savings. As we head to the break, a quick look at your commodity market this morning. Oil continues to drop after a rally yesterday that brought us back above $60, but metals rallying, copper up nearly 4% with hopes of China's stimulus.
Just have to strategize with each other, with our team, with our agents, with everyone to figure out how can we package something that's going to be able to go straight down the middle and hit it out of the park. Because right now, people are going to be more adverse. We'll look at our slate, and while something was amazing 3 years ago and felt like we were going to be able to get it made, we have to figure out how to build off of that today. How can we make it feel more desirable? How can we make it feel more undeniable?
It's important to clarify that straight down the middle doesn't mean
bland.
No.
It doesn't mean for the most common denominator. It doesn't mean trying to make something for everybody, something that doesn't have edges or specificity. Straight down the middle almost means the opposite in this moment, right? It means so strategic, so specific, so clear. So I think one of the kind of unexpected, wonderful impacts of how challenging the ecosystem has become is that we have had to make sure that we are more committed to content than we've ever been before. Because the fight is so real that if we jump onto something or we develop something, we have no choice but to have to love it.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Mondays on Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Big swings, futures fall after the biggest stock rally since 2008. A punishing Treasury session fuels turbulence in global bonds. No reprieve for China. Top officials in the nation dust off their stimulus plans as President Trump goes forward with China tariffs. And the data amid the confusion. Fed officials emphasize inflation risks. The latest CPI print hits today. What a week it's been, and we are just 5 hours and 30 minutes into your Thursday. S&P, NASDAQ, Russell 2000 futures. Here's what the scores look like. We fall more than 2% across the board. We are back squarely into risk on after a huge rally yesterday. The biggest one-day rally since 2008, the second best day on record for the NASDAQ. And Trump, much like us, was watching the bond market. That appears to be the reporting of why he did indeed backdrop. But here's the weird thing.
Forecasts include US tariffs on steel and aluminium and cars, and unemployment will rise to 6.3% this year and fall again to 6.2% in 2026. Tariffs announced on April 2nd and later suspended could double the negative effects. And on the debt break reform, additional public spending of 24 billion euros in 2026, adding 0.5% points to GDP.
The latest CPI print. Let's break it down with Valerie Teitel. Good morning, Valerie.
Good morning, Danny. Yes, with all this market mayhem, many have forgotten that today is CPI day for the U.S. We are expected to see a tick down in both annualized figure of the core and headline when it comes to inflation, maybe hinting at some inflation reprieve before the tariffs come. But we'll be parsing this data release very closely for any hints of any tariff-led inflation. If you flip on, we can just check on how CPI month on month is expected to come in at 0.1%. Danny, that is going to be a 7-month low if we do get that. Also ahead is a lot of Federal Reserve speakers, not just one, Danny, but 5. I want to add another one to this list. We also have the Fed's Michelle Bowman heading to Capitol Hill for her confirmation hearing as the Vice Chair for Supervision. I want to know what these guys think about the Treasury market, should we call it dysfunction, of yesterday.
That is a crazy schedule. Valerie, thanks for laying it out for us. Bloomberg's Valerie Teitel. Joining us now is Keith Lerner, co-CIO and Chief Market Strategist at Truist. Keith, we'll certainly talk about the market action as of late, but can we just start with the data today? How much do you pay attention to it? How much do you care when every day feels like a different narrative?
Yeah, well, great to be with you, Danny. I mean, it matters. I mean, maybe it gives a little bit of flexibility if the CPI number came in a little bit light, or maybe the opposite if it comes a little bit high, but it's not the main driver right now. The main driver, as we have seen the last couple of days, not only on the decline, but also on the rebound, is it's all about tariffs.
Can I just ask, what are you telling clients and advisors at this moment, Keith? I'm sure, much like the Trump administration, your phone has also been ringing off the hook. What do you tell them in a moment like this where you can see wild swings of 5% plus in either direction in the course of a single trading day?
Yeah, well, the first one is we showed them in the stats that when you make emotional decisions, when the market is swinging, is often investors do the wrong thing at the wrong time. So we just start there. But no, up until yesterday, we had 3 main messages for our clients over the last week after the sell-off. One, we would not be selling into the lows here because the market was effectively pricing in over a 60% chance of recession already. Number two, it was time to start thinking about two-way risk, not just risk to the downside, but also risk to the upside. And thirdly, was a little bit of good news could go a long way. And obviously, we didn't know when the news would come, but the market was like a coiled spring based on how oversold it was and how much it had moved down. So again, so we're also saying maybe more taking a step back is that make sure you know what your long-term investment objectives are, and then work from that as opposed to trying to time this market each day.
Well, Keith, to that point of a little bit of good news, let's be clear, at this point, it is just a little bit of good news because we still have 125% tariffs coming onto China, or they are here. We are poised for something of a decoupling between the world's two largest economies. Does a rally like yesterday look misplaced with that in mind?
Well, it doesn't look misplaced relative to how oversold we were. Again, markets move on expectations and relative to expectations and positioning. And on a short-term basis, if you look at something like the percentage of stocks above their 50-day moving average, we were down to 5% heading into yesterday. What does that mean? That means there was indiscriminate selling. And again, we had moved down 19% off the highs in a short period of time. So you normally expect a reflex rally makes sense. I will say this is the third strongest one-day rally we've seen since 1950. The next day, we've only been up 7 out of 10 times. The average decline is 2%. So what we're seeing right now is somewhat normal. And also, as you look out over the next 3 months, the risk reward tends to be more mixed. So listen, at this point, what we're saying to our clients too is we said, we know that some clients are kind of nervous moving down. We want to be selling at the lows. As you move back up and you have these bounces, use that to dial back risk to be more of kind of a neutral posture in your overall equity allocation. For those investors that have been on the sidelines, we still think it's going to be somewhat of a bumpy road because of what you just alluded to. There's a big change. This doesn't solve everything. We're going to see the economy slow down, corporate profits get hit a bit. So dollar cost average in as opposed to being very aggressive here at today's levels.
I say if you're an investor, you can maybe rightly or wrongly react to how the narratives swing within the span of one day. If you're a company, Keith, you have to make capital expenditure decisions that last years. We've heard two different playbooks, one from Delta not giving an outlook, one from Walmart holding on to their outlook. What are you expecting this earnings season and corporate's ability to cope with just this constant changing and what the tariff outlook looks like?
Sure, and we really didn't resolve anything yesterday. We still have uncertainty over the next 90 days. So it's not as if you've given CFOs a huge amount of clarity about what they should be doing. You've given them a little bit of reprieve. So what I expect during this earnings season is more of what we saw yesterday, more of the same. If you're a CFO, especially of a multinational company, really hard to give guidance. I expect more companies to pull in guidance. Now, we had downgraded equities back in February because we thought the economy was slowing and that wasn't translated into forward earning estimates. Those forward earning estimates still need to come down. The only thing I will say, though, is that part of this market decline we saw is that the street is expecting earnings to come down, right? That's why we had such a massive move. So what I would be looking for as an investor right now is not just what the earnings numbers or what companies are saying, how do the stocks react? The tell yesterday morning was you had that kind of pulled guidance from Delta and the stock was up, not down. So that's what I think the more important thing is, how do the stocks react as they pull guidance, or maybe they're more, more mixed in the outlooks.
But is it a problem, Keith? Yes, the reaction there, but the swings that we've had, you have these large cap companies, you have the Mag 7 swinging wildly, adding and removing trillions of dollars in one day. Does it speak to a moment of market fragility that should be concerning?
Well, yeah, in some ways, yes. I mean, the one thing that we in our work, it suggests that that volatility clusters, meaning the biggest down days tend to be followed by the biggest up days. And so far, what we're seeing is a little bit more accustomed to what we saw in October of 2008. And it does create some flux. And when you have big swings, each data point is over extrapolated, right? Because there's high uncertainty. So yeah, it makes it for a more challenging time. I will say in that work that when we looked at whether 2 big down days or we looked at kind of something that's similar to now, the near term was mixed. As you started to expand your time horizon over the next 1 or 2 years, the probabilities of the market being higher is better. But listen, I don't think this is over. I think we have choppy markets, and I don't think this is time to be on offense Now, I mean, I was thinking more on offense the last couple of days, but after this big run-up, I think the risk reward is now coming back more towards that neutral state, and that's how we're positioned.
Keith, we're certainly living in interesting times. Thank you so much for taking the time to join us this morning. Keith Lerner of Truist, always a pleasure. Okay, let's get to you some other top stories that are trending on the terminal this morning. House leaders have decided to postpone a key vote to fast-track President Trump's tax cut proposals and increase the debt ceiling. Leaders determined that they lack the votes to pass the budget in the Senate. There are still deep divisions in the party over whether to cut Medicaid or other parts of the social safety net. President Trump signed an executive order to set up port fees, as well as direct Elon Musk's Doge team to investigate how and why the U.S. Navy's production of ships has been slower than rivals. Bloomberg sources revealed that the order is an attempt to blunt China's maritime dominance. It offers new funding streams, including tax breaks to boost American shipbuilding. And overnight, TSMC delivering a beat. The Taiwanese chip-making giant delivered greater than expected revenues last quarter. The results reflect growing demand for AI servers and smartphones in the months before U.S. tariffs kicked in. It marks the company's fastest pace of growth since 2022. Coming up, we're going to get more reaction into a chaotic week in markets. The legendary Rob Arnott, founder and chairman of Research Affiliates, joins us next. Stick around on your Bloomberg Brief.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates, how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. And that's not good for the economy. Growth is really critical. And I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Japan's Shiba saying U.S. tariffs implementation was extremely regrettable.
I do know that consumer sentiment has started to take a dip. The question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy, that as how it played out for most of the pandemic? Right now it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Nobody covers the Fed like Bloomberg.
To me, last week, I thought America's cut off both its arms. Today, one arm.
Thank goodness for independent financial markets, which I believe bounded and forced the president and his team to reverse themselves pretty much across the board.
Everything was on sale, so quality growth has been on sale, and that actually creates opportunities for long-term focused investors.
Honestly, I think the basis trade very well could have forced Trump's hand, and I don't think
it's wrong to think that based on what's happened just in recent days with yields.
If the trade war is really all about China, that's a lot more manageable than a global trade war.
You can legislate, or not even legislate, you can dictate tariffs.
Hans-Peter Schieber said he set up a task force to do more measures against tariffs.
To tariffs.
Reactions from our guests yesterday after that dramatic tariff pause for 90 days from President Trump. Let's just take stock of what the stock market did in that period. We went from the cusp of entering a bear market on Tuesday, closing 19% down from the peak. But then we saw the biggest rally since 2008. That peak to trough now stands at about an 11% drawdown. I'm pleased to say that joining us this morning is Rob Arnott, founder and chairman of Research Affiliates. Rob, really great to see you this morning. And I'm really looking forward to getting your thoughts, because it wasn't that long ago that you had been warning of something that looked like a bubbly market akin to the 2000 dot-com bust and boom and bust. What is your read on the quality of this equity market now?
Well, an 11% decline feels like a big deal. It's not big enough to change the relative valuation figures. The U.S. is still the most expensive market in the world. The spread between growth and value is still very close to record levels. The spread between large cap and small cap is still close to record levels. So the dispersion, I think the breadth of opportunities available to us now is really quite extraordinary. One of the things, when we last spoke, one of the things I mentioned is that the whole notion of Wall Street trying to forecast inflation, GDP, and unemployment based on presumed tariffs is kind of silly, because the rules change daily. And as we saw yesterday, they even change intraday. As I said then, what we can expect under Trump is volatility. And volatility, markets don't like volatility much. And so that creates a threat for markets. Looking back on 2000, the dot-com bubble, it's difficult to this day to identify what was the catalyst that burst that bubble. But if indeed what we're seeing is the bursting of a new tech bubble, then it's fairly clear that the catalyst that really set it in motion was the tariff games.
Rob, you are talking about a tech bubble, but I want to know if we can expand that out to all of U.S. equities. If we're witnessing a period where capital flow into the U.S. is crimped because of that policy uncertainty, because of some of the unreliability of what tariff policy looks like coming out of the U.S., is this a story of flows to America in general starting to undo themselves?
That's entirely possible, but I think it's important to note that the spread in valuations between growth and value remain near record highs. That means that the market can be selective. The market crash of September, October of 2008 was a take no prisoners market crash. Pretty much everything went down. Then the subsequent 3 to 4 months, we saw a sorting out. Some things went up a lot, some things went down a lot. And what happened was that whatever was newly cheap did just fine. Now, I look back at the dot-com bubble, and sure, it broke in March of 2000. But if you roll the clock forward 2 years, the first 2 years out of a 2.5-year bear market, that first 2 years, the S&P was down 27% on its way to a 46% drop. NASDAQ was down 50 on its way to being down 80. Russell 1000 value was down 4. Russell 2000 was up 3. Russell 2000 value was up 53% in a bear market. So bear markets don't necessarily take no prisoners. What's cheap can actually do rather nicely. And, frankly, Europe is looking pretty darn cheap these days. Emerging markets are looking cheap these days. Domestic U.S. small cap value is cheap these days. So these are markets that can shrug off whatever bad news may be coming with regard to large cap growth. I'd stay clear of large cap growth. It's priced for perfection even today, and vulnerable.
Is the entire system vulnerable, Rob, though, when you look at bond yields moving double-digit basis points like they did yesterday, that you can get a rally going underway in equities, but bond yields don't react as much? Equities, as we mentioned, recovered a lot of their peak-to-trough losses. Bond yields are still higher by some 20 basis points since Liberation Day. Is that vulnerability if we're getting a U.S. bond market sell-off as risk also comes under pressure?
You got to wonder, why did bonds react so well to the first announcement of the tariffs, the first 2 days, and so horribly this week? Was there a whale of a seller? Quite possibly. So I'm speculating here. I don't know for a fact, but it wouldn't be at all shocking if China reacted to the tariffs by quietly deciding to sell $100 billion a day. That kind of action can move markets in a big way. One of the things I think is interesting, and we've talked about this, Sun Tzu's book, Art of War, written 2,500 years ago, is Trump's Bible. Now, in the corridors of power in Washington and across Europe, I would venture to guess maybe 1 out of 100 of our legislators and other elite leaders have bothered to pick up the book Art of War, even though they've heard that it's his Bible. All right, well, it's an important book, and everyone in Chinese leadership has read Art of War. So the notion of not paying attention to something that's been Trump's Bible for life is pretty naive. The Chinese reaction was unsurprising, retaliatory tariffs, and quite possibly quietly selling large quantities of treasuries.
Rob, does that speak from something of a trade war transforming into something bigger or something additional, something of a financial war? Is that what you're talking about might be on its way?
I think that's exactly right. I think we're in a trade war with China. I think a trade war is part of a multifaceted battle. I think under the hood, not that visible, not spoken of all that often, is the fentanyl issue. The fentanyl that's killing 100,000 people a year in the United States. Almost all of it comes from China. And so there are elements here that are big and not necessarily all that visible and not talked about enough.
Rob, I wonder then if we're overlooking what actual decoupling between the U.S. and China looks like. Do you think we're too sanguine on the future between the world's 2 biggest economies?
I think the goal of the tariffs is probably China. The purpose of putting what in the UK is called swinging tariffs in place across the world, the goal really is China. And that showed up when Trump backed off, paused for 90 days, and China was carved out as an exception. Trump has said to the G7 some years ago, you want zero tariffs? We'll do zero tariffs if you do zero tariffs. Now, of course, he also counts VAT as a tariff, which is a little puzzling because we also have sales tax in the U.S., although it's a lot lower. But he said he's fine with zero tariffs. Now, he's not fine with zero tariffs on adversaries, and he views China as a very serious adversary. He'd be fine with 10 and 10. As a libertarian, my view of the perfect tariff rate is 0. But Trump uses tariffs as a blunt instrument. He is a bully. He uses it as a blunt instrument to get his way. And the market reaction was probably not what he expected. And frankly, it wasn't what I expected. I was surprised that the market was so surprised by the magnitude of the tariffs, because they're exactly in line with what he promised. But what's his end goal? His end goal is to pressure trade counterparties into getting rid of their tariffs. And where he perceives 20% tariffs, he's fine charging 10. He made that clear. So this is this has been a week of intense skirmish in a longer term trade war and tariff.
Can we talk about the lasting impacts, the lasting scars of that skirmish, even if we do get negotiations elsewhere? Because to your point, it did catch a lot of people by surprise. And there seems to be a sense that it also caught economic partners by surprise and that it went further than just tariff barriers. You look at Vietnam offering zero tariffs, and still that's not enough for the Trump administration. Does that mean that we're going to enter a period where there's a desire for more strategic independence from the U.S. across all fronts, across our trading partners and our adversaries and allies alike?
I think that's part of his goal, too. He wants us to return to supply chain independence. Sorry. He wants us to return to supply chain independence. And one way to get that is to impede trade. The implications of all of this really hinge on what's the end goal.
EU considers pausing its countermeasures due on April 15th against US tariffs for 90 days, according to EU diplomats.
Those tariffs descend eventually to zero. I think he made a very bad tactical error in his speech on Wednesday. He didn't describe what he'd do with the revenues. Now, if he said, we're going to impose these tariffs and we're going to have a big, beautiful tax cut, that would have played a lot better than just, here's the blunt instrument.
Rob, along the same lines, does it also mean that you'll have foreign investors less willing to fund the U.S. external deficit? And what ramifications could that have?
Investors have short memories. I think that any determination today as to what investors will do a year from now is not useful.
Hey, and fair enough. And we had a bond auction yesterday that went off without a hitch, despite all the crying and fear that it would be complicated. Exactly. Rob, it is always so great to speak with you. It's been far too long. Please join us again soon. Rob Arnott of Research Affiliates. A quick check on your markets as we head to the end of the hour. S&P 500 futures off the lows of the session, but still down 1.8%, just about. The U.S. dollar also weaker this morning against most of its major trading partners. Again, there does seem to be a continued flight from U.S. assets. But to the relief, I'm sure, of many, yields are lower. We do have a rally underway in this bond market, about 6 basis points lower for your 10-year yield at 4.27. There still is some resistance on the long end, that not participating in the rally quite as much. Still a concern over if we're headed to a recession, which, by the way, are we? Goldman withdrawing their recession call within 12 hours. But if we are heading to more economic pain, how big will deficits get? Can you really continue to buy duration? Speaking of which, we're going to get a read on inflation today. Let's just set you up for the day. The main event, CPI numbers, come alongside jobless claims. Many people might have forgotten that amid the chaos. That comes out at 8:30 a.m. Eastern. We're also going to hear from Fed officials. There are so many today, including Logan, Schmid, Goolsbee, Harker, all throughout the day. And then another auction. $22 billion of 30-year Treasury bonds go on auction at 1 p.m. As we mentioned, yesterday's auction was strong despite the fear. Okay, a couple movers here. U.S. Steel extending double-digit declines. Trump saying he doesn't want a Japanese company to buy it. DJT, one of the few rallying this morning after President Trump's pivot tariff, and NVIDIA. That leaves Mag 7 stocks lower alongside Tesla, again, in what is a broad market sell-off. But hey, the end of the day might look completely different as we keep learning. That is it for Brief Surveillance. We'll take it from here.
Asia is a continent of contrasts. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
If NASA is designing a lander, their approach is they're designing a Formula One car. So we take, say, a Jeep approach.
Minso, give us a sense of how you translate Korean architecture for the rest of the world.
We call this madang. In general terms, it's where we can be ourselves, where we belong.
There is an old saying in Korea that says, "거미 불루, 화이 불치." It means simple but not humble. So it has a tremendous impact on Korean architecture.
People tend to think the robot AI taking the job from them. We want to use the robot as a basic asset, meaning people have an income through the robot.
From space tech in India to robotics in
What minutes
Japan,
we do expect Bundesbank
Asia is
monthly
driving
report?
the future, reshaping industries, societies, and the way we live. Join me as I take you through the bold innovations. Discover Asia's next-gen technologies on Momentum.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Kuala Lumpur. This is Bloomberg.
You really have to believe that uncertainty is arriving at peak, and you have to believe, and we do, that Washington has no desire to precipitate a recession.
It's the volatility, it's the uncertainty. Where are we going from here?
RBA's Bloomberg saying the market and economic volatility is likely as the season unfolds. It's too early for RBA to determine path ahead for rates.
But the issue is they just don't know that the cure
will take some time to see how tariffs play out.
This is
Key is how
Bloomberg
uncertainty
Surveillance
affects
with Jonathan
household and
Farrell,
firms' decisions.
Lisa Abramowitz, and
Not
Anne-Marie
seeing the same
Hordern.
impacts at market events like
Just
2008.
double-checking what day of the week
will
it
be a
is.
period of
What a
uncertainty
week.
and adjustment
Live
to
from
tariffs.
New York City this
Too
morning.
early
Good
for the
morning,
US to
good
determine
morning for
what
our
path will
audience
be for
worldwide.
interest rates.
Bloomberg surveillance starts right now, coming into Thursday as the White House chooses de-escalation.
Many of you in the media clearly missed the art of the deal. You tried to say that the rest of the world would be moved closer to China when in fact we've seen the opposite effect. The entire world is calling the United States of America, not China, because they need our markets, they need our consumers, and they need this president in the Oval Office to talk to them.
The president backing down, authorizing a 90-day pause on major reciprocal tariffs while choosing to double down on China.
So every country in the world who wants to come and negotiate, we are willing to hear you. We're going to go down to a 10% baseline tariff for them, and China will be raised to 125 due to their insistence on escalation.
One social media post sending equities to their biggest one-day gain since 2008 and offering some support to a nervy bond market.
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy.
The bond market very much in focus going into inflation data later this morning. The latest read on consumer prices, that number is just around the corner.
And that number won't probably matter very much at all at a time where President Trump, whether some people are saying that now we've reached a new level of calm, not quite so much. It is unclear to see what kind of data could supersede what we saw yesterday, which sure, on one hand, gave us some insight. Number one, it took the worst case scenario off the table. And number two, it showed that yes, he does care about markets, the bond markets, and that they do have a call. They do have a strike price. It's just not maybe as comfortable as we previously thought.
Check out the equity market this morning. We're down again. We're down by 2% on the S&P 500. We're down across the board. We've got 10% baseline tariffs still. We've got 125% tariffs on China. Goldman's Jan Hatzius putting it this way, Anne-Marie. We've gone from a recession level increase to a still very growth negative increase.
There's still a tremendous amount of uncertainty when you look at what's going on in China and the tit for tat and the rhetoric you see out of China and Washington, D.C. Many economists are looking at this and they're basically saying this is decoupling when it comes to goods between these two economies. And then it comes to the 10% baseline. Donald Trump talked about this on the campaign trail. There's going to be a 10% tariff wall. So he's going back to that promise. The issue is when it comes to the reciprocal tariffs, it's a 90-day pause. It's a reprieve. It's a halt. What happens when he doesn't get the deals he wants for some of those top trading partners? We're going to be doing this for weeks and months on end.
The uncertainty remains. Sure, we've taken the temperature down over the last 24 hours, but for many people, investors, officials alike, business leaders, they face similar risks this morning.
If you're counting on the psychology of one person whose insight into his decision-making process was, it was fluid. I just did it on the fly. It was an impulse. It was a feeling. It doesn't give people confidence in how to predict. How do you trade in a market where 6 stocks can gain $1.7 trillion in market capitalization in one day?
I heard that maybe he just wants to relax and watch the Masters over the next 4 days. Maybe that's what this is about.
So we're basically going to look at the golf schedule and then decide when things are going to ratchet down before they ramp up again. Again, this goes back to what does this do over the longer term to U.S. assets? I think it's notable that the dollar is weaker again today and that gold was the best performing asset that had a best day yesterday in a couple years. To me, that speaks to the moment we're in.
Rory McIlroy teeing off at 1:12 Eastern Time. Coming up this hour, Russ Kostrick of BlackRock on tariff whiplash, Andrew Bishop of Signum Global Advisors as the White House backs down, and Subhadra Rajappa of SocGen as Trump watches the bond market. We begin this hour with stocks falling following their biggest daily gain going back to 2008. President Donald Trump announcing a 90-day tariff pause on most trading partners. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, welcome to the program. Let's just start with where we are and where we might be in 90 days' time.
Yeah, hey, John, good morning. Well, that 90-day pause only applies, as you've been discussing, to those so-called reciprocal tariffs, but that 10% levy is still in place across the board, plus that 125% tariff escalation with China, not to mention that Canada and Mexico didn't see any reprieve from this because their plans were never rolled in to the so-called reciprocal tariff plan. But it does appear that this White House did have its limit, particularly after really downplaying the investor concerns in recent weeks. You heard President Trump yesterday indicating that the market turmoil did have an impact on this decision. He said he felt that people were getting, quote, yippy, a little bit afraid when it came to the economy. And of course, as you've been discussing, pointed out explicitly that he was watching the bond market amid, of course, as you know, these heightened concerns about the future stability of the debt markets. Now, interestingly enough, Treasury Secretary Scott Bessent did come out yesterday and he said this was the plan all along, that this shows the White House wants to negotiate in good faith, and it actually gives the U.S. more leverage in these negotiations. But we should be clear that President Trump said that this decision was only made yesterday morning after earlier in the week dismissing a pause altogether. Now, John, the Treasury Secretary did confirm that he does have meetings on the books with Japan, South Korea, Vietnam, and India. But it might not just be countries that are soon negotiating with the U.S. President Trump was asked if he would consider exemptions for companies, and he said that those would be coming in the future. But when asked how he would make those determinations, he said that it would be based on his instincts.
Tyler Kendall with the latest from Washington. Tyler, thank you. The door just slightly open for one particular company, Apple. Can we have some exemptions in the months to come?
Absolutely, and I'm sure Tim Cook is putting on his diplomatic hat, calling the White House and saying, look, something needs to be done, or we're going to be dealing with $3,000 North iPhones, which I don't think you want to have under your presidency when it comes to a consumer that's pushing back on higher inflation.
Futures down across the board this morning. NASDAQ futures down by 2 percentage points. A wild start to the week in financial markets. Russ Kostrick of BlackRock joins us now for more. Russ, a big change, a U-turn from the President of the United States. Does it make you more bullish on equities or on bonds?
I say right now it makes us cautious. Good morning, Jonathan. We have been pulling in risk for a while. Clearly, yesterday was a relief. Market took it as such, but as I was looking at a report this morning, you often get these big rallies during periods of turbulence. Our view is that you're still in an environment where policy uncertainty is heightened. You're also in an environment that wherever you came into 2025, whatever your economic assumptions were, they've got to be lower today. So if we've got a world of higher uncertainty, probably higher volatility, slower growth, you've got to adjust the portfolio accordingly.
Russ, in the past, that would mean going to bonds. This time around, is that still true?
Well, we have been raising our allocation to bonds. We're underweight, as you might remember, over the last few years, we've been talking about it. Generally modestly underweight bonds, particularly on the long end of the curve. We've been bringing that back closer to benchmark. And I'd say that is more of a reflection of the economic environment than trying to make a bet on policy. Now, if you do have an environment where growth is going to be slower, it's not crazy that your bond allocation is going to be closer to home. But by the way, we've done a similar thing in equities. We brought our equity allocation down closer to benchmark. So, what's happened, generally lowering the risk in the portfolio in this type of environment, rather than a strong bet on you want to be in bonds and equities, you want to bring risk down.
Maybe the larger question is U.S. assets versus ex-U.S. assets at a time where the source of volatility is the United States, and this has to do with bonds, but more broadly with dollar-denominated assets. Does it make you rethink some of what you have in your portfolio based on where the source of volatility has been coming from?
This is a great question. I think this is actually a harder question to answer, but what I would say is I don't think you have a knee-jerk reaction to move away from dollar assets. Couple of points. First of all, we might remember 2011 during the debt ceiling crisis. The U.S. gets downgraded, the epicenter of the crisis. What happens? Treasury bonds go up. The dollar is still the reserve currency. We can debate what's going to happen in 5 or 10 years. It is still
So the EU weighs pausing
asset.
metals counter tariffs against the US for 90 days.
You've got to be skeptical about calling the end of dollar dominance. The other point on the equity side, we are still modestly overweight the U.S. Now, why would you do that with all the turbulence going on? Simple answer, we still find better companies in the U.S. We think about what do we want in this environment? We want profitability. We want companies that can generate consistent earnings. Still find more of those companies in the U.S. rather than Europe or Japan. So to my mind, even with the turbulence, from a bottom-up perspective, still an argument to be modestly overweight the U.S.
Given all the uncertainty, even whether or not Trump decides to blank, walk off the cliff, give these reprieves, do you still like gold?
We do like gold. Again, I think you have to trade around it. It's been a huge move. We like gold back 6 months ago. We definitely like it today. Couple of reasons. First of all, Anne-Marie, as you suggest, still a asset that works during times of turbulence. You look at the performance of gold when volatility is rising. Again, I think it's safe to say we're probably in a more volatile environment. Generally does very well versus stocks. The other argument is the long-term fiscal picture. One of the reasons we like gold is you can't print more of it. It is a store of value. It's still not obvious that there's going to be a significant improvement in the fiscal picture. If we are in an environment of these $2 trillion structural deficits, they're not necessarily going away. Having something that you can't increase the supply, that is a store of value in the portfolio, we think that makes sense over the longer term.
Russ, just wanted to jump in with some news out of the European Union. The headline just crossed on the Bloomberg terminal that the EU is considering pausing counter tariffs against the United States for 90 days, in line with that 90-day pause that the president announced just yesterday. Just taking the temperature down just a bit more this morning.
And I also think the European Union is looking around the room and saying, look what's going on with Japan. Look what's going on with South Korea. They are pushing out olive branches. They are saying they want to do deals with this president. He's come out and said you're going to get a 90-day reprieve. So why should we escalate? At this moment, maybe we should send a team over and try to de-escalate and come to a trade agreement.
The latest headline from the team here at Bloomberg that the European Union is considering pausing counter tariffs against the United States on metals for 90 days. Russ, just to bring you back into the conversation as we take the temperature down worldwide, how close did we come to an accident in this bond market? What did you see developing in the previous few days going into the announcement from the president just yesterday afternoon?
Well, I think the bond market move was definitely something we were paying attention. And it was not just the Treasury market. You'll remember that, during the initial phases of the sell-off, credit markets were remarkably well behaved. That all started to change on Friday. We saw spreads back up dramatically. I think that gave a lot of people pause, because now it's not just a matter of growth, it's a matter of liquidity, it's a matter of what's happening with the availability of credit, and that was something that definitely unnerved investors. If you see the bond market calming down, It's definitely a development that's going to give a little bit more comfort to the equity side of the market.
Things settling down in the bond market this morning. Russ, appreciate your time. Russ Kostrick there of BlackRock on the latest. The latest in fixed income. Yields lower across the curve. We're down 5 basis points on a 2-year, on 10s down a similar amount. Your yield this morning is 4.29. With an update on stories elsewhere this morning with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Trump is giving dozens of countries a 90-day reprieve from his tariffs. However, China is not one of them. Trump announced a record 125% levy on Chinese goods. That move puts Trump on a collision course with Chinese President Xi, whose government has vowed to fight to the end in any confrontation with the U.S. In China, the top leaders there are set to meet today to discuss additional economic stimulus in response to those increased tariffs. Sources tell Bloomberg that the meeting will focus on support for housing, consumer spending, technological innovation, among other areas. A check on U.S. steel shares in the pre-market down nearly 12%. President Trump has said that he doesn't want a Japanese company buying the steel manufacturer. Earlier in the week, the president ordered an additional national review of Nippon Steel's proposal to buy the company. The U.S. Committee on Foreign Investment has 45 days to finalize its review. And that's your brief, John.
Hey, Danny, thank you. More drama. More from Danny a little bit later this morning. Up next on the program, the president backs down.
We had to take the medicine. We had to go through the operation, and that's what we've been through, and a lot of presidents would not have done it. No president would have done it, I think.
That's for sure. Andrew Bishop of Signum Global Advisors joins us next, live from New York City this morning. Good morning.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
All right, let's cut right to it. This is Bloomberg's new show, Primer.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
If you want to understand what's coming, you'll want to watch Primer, because details matter. So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The latest from UBS this morning and the team. Trump blinks, but the damage isn't all undone. You see that again this morning. We're down 1.4% on the S&P. We're down 1.7% on the NASDAQ 100. Under surveillance this morning, the president backs down.
A lot of winning out there. We're having a good day in the stock market, as you can see, an all-time record day, and hopefully it continues. I think it should. Country's stronger than it's ever been, and somebody had to do that. We had to take the medicine. We had to go through the operation, and that's what we've been through, and a lot of presidents would not have done it. No president would have done it, I think.
It's the latest this morning. President Trump sending stocks to their biggest one-day gain since 2008 after announcing a 90-day pause on higher tariffs. The president making an exception for China, raising duties to 125%, and China responding to moderately reduce the number of imported U.S. films. That headline just crossing the Bloomberg terminal. Ollie Crook, seconds ago. Ollie, let's talk to you, sir, in Brussels about how the Europeans might respond in the coming days and weeks.
Yeah, well, Jonathan, it's sort of hard to know because we're on our third global tariff regime, and it's just Thursday of this week. And this is what the basically European policymakers need to be sort of reacting to and really feeling a lot of whiplash. I mean, I've already spoken to a few today. Everyone is intensely relieved, but let's not lose sight of the fact that you still have 10% tariffs that are going from all goods going from the European Union into the United States. We're talking about 500 billion euros worth of goods. And let's not also lose sight of the fact that you have 25% tariffs on cars. You have 25% tariffs on aluminum and steel. And now the European Union has said, because they come up with these measures to retaliate, to hit $21 billion worth of American goods in retaliation just to the steel and aluminum, that is now on pause for another 90 days in order to have conversations with the United States. Of course, it was very difficult for the Europeans to get into a room with the Americans in the sort of lead up to this to get those negotiations going. They have wanted to have negotiations from the very beginning. But if you're a European policymaker today, how much reassurance are you taking in what you've gotten out of the Trump administration? We also know from sources that next week they are not going to deliver the architecture in retaliation to the reciprocal tariffs. They were originally planning to do that, but I suspect, John, they're still going to put up that architecture. They're going to have it written down somewhere. They're just not going to talk about it, because if this is a problem not today, maybe next week, maybe the week after.
Ollie, the press secretary called out the media yesterday in a briefing and said you tried to say that the rest of the world would be moved closer to China. Has Europe moved closer to China? What's your reporting in Brussels?
Yeah, there has been a little bit of discussion on that. So we were hearing something about that from the Spanish side. We know that Pedro Sanchez, the Prime Minister of Spain, the Socialist of Spain, will be arriving in Beijing tomorrow. But whenever I spoke to policymakers earlier in the week, and I did drill these sort of different trade ministers about this, saying that basically if the U.S. is an unreliable partner, does that change at all your relationship to China? Does it change even how you think about it? They were very, very cautious about moving in that sort of direction. Because remember, before Trump was elected president of the United States, the biggest threat to Europe, they thought, was China. They have this whole new commission. It's all about European competitiveness and trying to push back against that Chinese threat. And again, that is sort of a caution that is well appreciated, I would say, by the Trump administration over the last few days, given what we heard from Scott Bessent saying yesterday, that if Europe moved towards China, they'd be slitting their own throat.
Ollie, appreciate the update out of Brussels. Ollie Crook there, Bloomberg's very own. A lot to stay on top of over the last 15 minutes or so. So in the last 24 hours, the president is backing down on Europe and doubling down on China. And this is what we've heard so far this morning. Just in the last 10, 15 minutes alone, the Europeans weighing a pause on retaliation, and the Chinese reportedly moderately reducing the number of imported U.S. films.
So there's trade war certainly happening between Beijing and Washington while it's cooling off, as the president said, be cool, when it comes to everywhere else. China right now is going to reduce the number of imported U.S. films. This has been circulating in Beijing for a number of days. There was an illustration of a potential response from a number of Chinese bloggers that people watched to try to read the tea leaves of what's going on with the CCP. And they were saying it include duties on American farm goods and a ban on Hollywood films. And we're starting to see a lot of that play out.
Let's continue the conversation. Joining us now is Andrew Bishop of Signum Global Advisors. Andrew, welcome to the program. Just describe for us what you think the next 90 days are going to look like.
So I think the most important thing to keep in mind, given the news yesterday, is that in Trump's modus operandi, a delay is not a cancellation. So I know that a lot of people are saying, you know, the tariffs have been put on pause, but that doesn't mean that the uncertainty is gone. I would go a step further. That doesn't mean that the tariffs are gone, right? And very tangibly speaking, what we've seen time and time again in the past with this president is that he'll hit pause, but will then actually move forward with a measure. So what I suspect may happen is that by the end of the 90 days, we may have perhaps a more competent team in place to actually see these tariffs through, but just with, you know, a more professional framework in place and being rolled out.
Has the strategy somewhat changed to squarely focus on China and bring allies along for the ride?
So that's always been a hypothesis, and it's a hypothesis that gets a lot of backing from recent news, right? Given the president's decision to focus on China. we at Signum have been warning not to jump into these monocausal explanations, right? So up until a few days ago, it was a war against everyone with no negotiations. Then it was a negotiation with everyone. Now it's a negotiation with everyone except China. Our view, to be very clear, is that the president does not have a single motivating driver for his use of tariffs. And as he has himself said, the reason he likes tariffs is because he can accomplish many different things. So I would not focus too much on China, actually.
When it comes to this pause on tariffs, how does this work hand in hand with what they're trying to do on Capitol Hill? Because I thought part of the tariff regime is to bring in
I'm Renee
revenues
Ritchie,
to
YouTube's
pay
creator
for the
liaison.
tax extension.
I'm Johanna Vulic, YouTube's Chief Product Officer.
Johanna, I'm so happy to be back with Release Note and talking about shorts again.
I love shorts, and I love...
But that the president's approach to tariffs has always been and will remain more transactional than any measure really bringing in revenue would need to be, right? The exception to that is now probably the 10% baseline universal tariff, and that does bring in some revenue. But considering the fact that it's done outside of Congress, as you say, and the fact that it's not enough revenue, we really don't see it as a one-to-one measure with the tax cuts.
Andrew, what is your timeline now for the tax cut plan?
So the president, I think, and the president's team are trying to hasten it, right, and shorten it to sort of paper over some of the bad news on the tariff side. Our timeline has not changed, which essentially means that late summer at the earliest, around the period when Congress will go on a break, is the absolute earliest we could see a bill. And frankly, we lean much more towards post-summer.
Interesting. Andrew, thanks for the update. Appreciate it. Andrew Bishop there of Signum Global Advisors. So what do the next 90 days look like? Neil Dutta of Renmac. He says this: the issue is prolonged uncertainty. It weighs on investment. Consumers save more. Labour markets are still frozen. And his words, not mine, housing still sucks. Neil Dutta.
Well, this is the issue. Can you really put the genie back into the bottle, put the toothpaste back into the tube? This is what we've been talking about. To more tangibly talk about it, Amazon already canceled orders in China. We talked about Haas Automation, which already said that it was reducing production and in some of the hours for its workers. You start looking at the moves that companies are taking. They're taking risk down. They're not taking a lot of comfort in this pause.
We should give Neil a little bit of a high five and a hat tip, because before Trump came out and announced this plan, Neil had a note out that said exactly what they should do. It makes more sense. Start with a 10% universal baseline tariff. Check. That's what they did. Work on bilateral deals on country-by-country basis and starting the process for 232. Check. That seems to be what they're doing. Starting from the ceiling and working backward. That is what they're doing now. And this was actually the plan the Treasury Secretary set forth moments after Trump announced Liberation Day with that huge chart. He said, actually, this is going to be a cap. Don't retaliate, and we will do deals with you.
So we've got bank earnings tomorrow morning. Kicks off with JP Morgan. I don't think this makes it any easier. I don't think it makes things any clearer. How can they offer guidance in a moment like this one? It's a 90-day pause, and that's all it is.
I mean, this is the reason why a lot of people are just darn frustrated, because how do you come up with anything? The fact that Goldman Sachs retracted their recession call yesterday after the 90-day pause, again, what we just got was taking the worst case scenario off the table, maybe. Taking the temperature down. Does that really remove the threat? And this is the reason why earnings are going to be interesting, not only for what they say, but also the reaction of markets.
A major move on stocks yesterday, the biggest one-day pop on the S&P 500 since 2008. This morning, equity futures lower by more than 1 percentage point. Up next, Amrita Sen of Energy Aspects saying crude could trade under $50 a barrel. Live from New York, you're watching Bloomberg TV.
So von der Leyen, EU agrees on a 90-day pause in countermeasures due on April 15th against US tariffs.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well.
If negotiations are not satisfactory, our countermeasures will kick in.
We've seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes. Do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go? I don't have to go to rodeo for that. That's
no. You could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What a phenomenally wild few days in financial markets worldwide. Equity futures this morning down by 1.5% on the S&P 500. The S&P trading like a penny stock in yesterday's session. Check out this range on S&P 500 futures. At the highs, plus 10%. At the lows, negative 3%. A 13 percentage point range intraday on S&P 500 futures. Just absolutely mental. Danny Berger, chaos. Danny Berger has your morning movers this morning. Good morning, Danny.
Unfortunately, John, I've got another big company for you that is trading like a penny stock. So add this to the headache of market participants. U.S. Steel dropping nearly 12% in this morning's session. This coming after President Trump late yesterday saying that he doesn't want a Japanese owner for U.S. Steel, of course referring to Nippon Steel, which has been trying to take over this company. Part of the reason we're seeing such a big reaction is there was a lot of hope built up to start the week on Monday. Trump ordered a national security review of this deal, sending shares their highest since 2024 with hopes, hey, maybe this will actually happen. Maybe now this is finally the time we can stop talking about this deal. Also on the move to the downside this morning is Constellation Brands. This is the maker of the beer Corona, along with other brands. It was lower in the pre-market session. It has now moved to unchanged, it would appear. They had their earnings, and again, you see the impact of a consumer company that was already struggling, plus tariffs. Yes, we don't have the dramatic tariffs on Canada and Mexico, but there's still a 25% tariff if you're importing beer cans into the U.S. Constellation Brands pointing out that and changing consumer behavior for giving a dim outlook. The last mover for you, this one just starting to be on the move. It is Disney. It was unchanged, starts to fall 2.6% after the headline that China would reduce some of the U.S. films coming into the country. This, of course, has a direct impact on Disney, which produces films that go into China. Just looking at their financial statements, about 10% in fiscal 2024 of their revenue came from Asia Pacific. So that would indeed be a hit if it starts to get pared back. John.
Danny, thank you. Great work. More from Danny later on this hour. On our radar this morning, President Donald Trump announcing a 90-day tariff pause on most trading partners. The move coming roughly 13 hours after higher tariffs took effect. At the same time, Trump also raising duties on China to 125%. Just finding out what Europe's official response will be from the European Commission President Ursula von der Leyen, saying, we took note of the announcement by President Trump. We want to give negotiations a chance while finalising the adoption of the EU countermeasures that saw strong support from our member states. We will put them on hold for 90 days. If negotiations are not satisfactory, our countermeasures will kick in.
So here's the start of the negotiations really between Brussels and Washington. 90 days. Can they get to some sort of framework to get to the bottom of a deal? What I would take note in a lot of this is the fact that President Trump gave them an olive branch. They're coming back with an olive branch. But what does this mean in terms of the uncertainty in the market? it still remains, at least for the next 90 days. Because if Trump doesn't get what he wants, who's to say he doesn't come back with a vengeance when it comes to Brussels?
If you want that supply side response, you've got to know what the rules are. 5 years out, 10 years out, 15 years out. And if you keep getting told that there is a 90-day pause for negotiations, those plans to build the factory in the United States are going to be on hold, perhaps indefinitely.
Absolutely, because why would you spend any capital when you don't know the rules of the game? Which is probably why this cannot extend longer than 90 days. I'm sure there's a tremendous amount of advisors. I know the president has been taking phone calls. Susie Wiles has been taking phone calls from executives, and I'm sure they're telling him this is the problem with not having clarity. So I think a lot of these executives are pushing him to get to an agreement by the end of the 90 days. But with Trump and trade, you might see 2 steps forward, 1 step back.
Waiting to see the reaction from China. China's top leaders said to meet today to discuss additional economic stimulus. Sources telling us here at Bloomberg the meeting will focus on support measures for housing, consumer spending and, Lisa, technological innovation.
This is the tricky place that China is in. As much as everyone is talking a hard line, there is some sort of incentive to come together. And one thing that we've seen from Goldman Sachs, from Bloomberg Economics, they've been downgrading their expectations to Chinese growth. This will be a hit to them at a time where so many U.S. factories produce in China. Remember with Shein, however you say it, they actually prevented them from exporting jobs overseas and said, we will arrest you and we will make sure that you get fired if you do that. So there clearly is more tension under the surface in China.
How are companies responding? So here's the latest from Walmart. Apparently asking a factory in China to leave price stickers off Christmas ornaments for the first time in 10 years. The change comes as the company continues to navigate tariff uncertainty. That's the challenge many companies face. And at the moment, this is something that Mohammed Al-Arian has warned about repeatedly.
What I find interesting, though, is that when it comes to China, Trump suggested yesterday that this number, this rate of 125%, that's going to be the top when it comes to how high he's willing to go in that tariff rate on China. And then he said, I can't imagine it. I can't go any higher. He did say that we calculate it very carefully. I think there's a lot of criticism towards how they actually got to these calculations. And then he said something interesting. He said, at some point, we're going to get a call. He is waiting for Xi Jinping to pick up the phone and call the Oval Office.
And he hasn't done it yet. And we've heard that from the president repeatedly over the past few weeks. Let's turn to commodities. Crude is lower this morning by 2% on Brent to 64, on WTI to $60.91. Oil still flirting with $60 a barrel as trade tensions between the US and China continue to escalate. And Rita Sen of Energy Aspects writing, Trump needs higher supplies to lower oil prices in a manner that can provide a tailwind for global growth as an offset to his tariff policies. Instead, tariffs will lead to lower oil prices by hurting demand growth. And Rita joins us now for more. And Rita, welcome to the program. You made some headlines in the past few days on some very, very low numbers in the crude market. So what are you expecting now?
Well, I think the prices, or the general trajectory is still lower. I know there's been a 90-day pause. We saw a little bit of a bounce, but ultimately, if you look at the trade-weighted tariffs, reciprocal tariffs globally, on the 2nd of April, it was actually 19.1%. Yesterday, it was 26.2%, despite the pause, because of just how much the China bit has escalated. It just tells you that that is ultimately the one that matters the most when it comes to kind of global growth. Of course, it's better news for some of the countries. Some of those tariffs have been paused, but like you guys were saying just now as well, there is definitely no certainty that they will remain off. We are hearing more and more from our clients that consumer and particularly business sentiment has completely come to a stall. Nobody's investing. There's no capex investment. And we're going to see a pretty big demand hit. We've just reduced our oil demand number for the second half of the year by 450,000 barrels per day, the same for 2026. So I just don't see how oil prices are going to start moving higher anytime soon until we see the supply response.
How low are we talking, Amrita, do you think oil prices can go?
So look, the difference now versus in the past cycles is that the shale break-evens are higher. And when I was there just last week as well, I would say my biggest takeaway was that outside of the Permian, all the other basins, you're talking about like in the 60s, well into the high 60s in some basins, which are now their break-evens. In the Permian, it's in the 50s. But that is effectively the floor. The difference is it's the timing of it, right? We need to be here for one whole quarter before supply response. And the response will be significant this time around. You are going to lose a few 100,000 barrels per day pretty quickly. But it it is just that timing. Like within that time frame, prices can continue to go lower. Remember, there's positioning driven. A lot of this is positioning driven, and people are just liquidating positions. So then it just becomes a number. But ultimately, the floor should be around where we are now, maybe a couple of dollars lower. But I don't necessarily see sustained prices in the 40s or the 50s. But we can absolutely test the 4 handle in the short term.
I know that OPEC Plus and Saudi Arabia says they do not target price, but given this environment you're describing, why did they go further and add even more barrels to the market?
Yeah, I mean, look, the timing of it has obviously led to plenty of rumors about, like, were they doing this on the back of tariffs or to appease President Trump ahead of his visit to the kingdom. In reality, OPEC just has its own timelines for doing things. The Saudi OSP always comes out around the 5th of the month, so they had to take the decision before that. So it was an unfortunate timing, but the decision was entirely to do with internal OPEC dynamics. As we've been saying, we have seen laggards, a couple of, OPEC as in Middle Eastern countries itself, but it's mainly Kazakhstan. If you look at Kazakhstan's production, 400,000 barrels per day higher than where they are meant to be, and they are just not showing any signs of coming off. And I think that is where I worry, even for next month, regardless of price, because if this is about getting cohesion and getting the message across that everybody needs to do their bit, then it will not matter until and unless Prince Abdulaziz sees that compliance number pick up.
Rita, let's put that into English. Basically, this is all designed to punish Kazakhstan with lower oil prices for a margin grab unless they are into compliance, and then there could be some sort of agreement.
Yes, I think long story short, that's it. And not just Kazakhstan, the few of the laggards. But yes, it's to say the cuts need to be equitable. It can't just be Saudi Arabia that carries the cuts for everybody.
At a certain point, there's also a knock-on effect that this potentially could become punitive at that kind of level for U.S. shale producers, for the U.S. oil export system that has been one of the drivers of a lot of growth that we've seen in the United States and the GDP here for the past decade. I'm just wondering at what point that factors in as well.
Mm-hmm. Well, that's what I was saying just now, right? The shale break-evens are significantly higher now, which is why I was saying that I don't see prices sustainably going below 55 to 60 or even 65. But in the short term, it could be, because even at these price levels, we are hearing from our shale producer clients that they have just stopped drilling, or they're planning to stop drilling. They could even drop rigs. You're going to see a very significant turn down in shale production very quickly. And like you said, that has, and we forget this, we tend to talk about the U.S. as a consumer nation. Production, and given how much U.S. production is a huge part of U.S. GDP right now.
And Rita, just quickly, we've seen commodities drop across the board over the past week or so. Seems some evidence that, particularly with copper, Chinese buyers might be stepping back in. Ahead of stimulus, are you seeing anything like that with crude?
We've seen a little bit here and there, but I do think right now there's just a bit more panic because it's still a moving target. They have come out with an SPR program as well, saying that we need to stockpile, but that's really from July onwards. The biggest hit is actually going to be on LPG, ethane in particular, and propane. Crude's still okay, but the physical market is actually still very strong. Even in the East, it's, stocks are still drawing, but it is really about the fear of the future.
Got it. Amrita, appreciate the update. Thank you. Amrita Sen there of Energy Aspects. Quick update on prices for you. We're down 2% on Brent, 2.3% on WTI, $60 and about 94 cents on WTI crude. Brent crude this morning, $64 unchanged. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The EU will pause counter tariffs on U.S. metals for 90 days. Sources tell us the bloc is weighing a proposal where it would move forward with tariffs on around $23 billion of U.S. goods, but then immediately suspend them. EU Commission President Ursula von der Leyen saying this morning that she wants to give talks a chance. Goldman Sachs has rescinded its recession forecast in the space of just a few hours' time after its initial call. The reversal came after President Trump announced a 90-day pause on most tariffs, and as there still see policy uncertainty leading to a sharp economic slowdown this year and 45% odds of a recession in the next 12 months. Now, ahead of President Trump's tariffs, Apple flew as many as 1.5 million iPhones to the U.S. from India after it ramped up production in the country. Reuters reporting that Apple chartered several flights to transport 600 tons of its flagship product. Analysts have cautioned that iPhone prices will surge if the tariffs on China remain in place. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny later on in the next hour. Up next on the program, a beautiful bond market.
I thought that people were jumping a little bit out of line. They were getting yippy. Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful.
It's beautiful. Sabahat Rajafar of SocGen joins us next, live from New York City. You're watching Bloomberg Surveillance.
In case you missed it on the opening trade.
The president is speaking to this part of our population that we know did not benefit from globalization. You know, the IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking. And this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest. Weekdays at 9 a.m. Eastern, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Futures this morning down by 1.5% on the S&P 500. On the S&P on Tuesday, a close below 5K for the first time since April 2024. By Wednesday, we closed above 5,400 with a major move higher. This morning, we take some of it back. We're down by 1.8% on the NASDAQ. Speaking of wild trading ranges, check out the bond market and look at the front end of the curve, the 2-year 388, down just 2 basis points. Look at the range yesterday. At the low 365, at the high 4.03%. A 38 basis point trading range in a single trading session. Under surveillance this morning, a beautiful bond market.
I thought that people were jumping a little bit out of line. They were getting yippy. Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy. The big move wasn't what I did today. The big move was what I did on Liberation Day.
So here's the latest this morning. The president backing down from major tariffs, attempting to offer some support to a very nervy bond market. Subhadra Chapra of SocGen writing, Trump raising the pressure on all U.S. trading partners may not bode well for their willingness to hold treasuries. Subhadra joins us now for more. Subhadra, good morning.
Good morning.
Is it a big, beautiful bond market this morning?
I think it still is, but the signals from the big, beautiful bond market is worth heeding to, right? Less bad is not good. If you look at the effective tariff rate, it's still around 25%. You're going to see that impact on both consumer, spending, consumer sentiment, business investment, and ultimately growth. And yes, we have kind of reduce the odds of a recession, but growth is still going to be at or close to flat for this year. Mind you, in December, in the summary of economic projections, the Fed had 2.1% growth for this year, and core PCE heading lower. Now we're looking at inflation somewhere between 3 to 4%, and very nearly flat growth. So that is not necessarily a good thing.
So still negative for growth, which should be good for bonds, but at the same time bad for trading relationships, which might be bad for bonds. So is this good or bad for bonds this morning?
I think it's still, somewhat bad for bonds. And the reason why I'm saying this is that coming into April 3rd, our expectation was that that would be the day we get certainty on tariffs. And then that stays in place for a while. People can go about their business. But guess what? It turns out that's the beginning of the volatility in bonds, not the end. So the next 90 days is going to be quite volatile in the bond market. And we're going to be looking at every news that comes in, how our trading partners respond. And that, I think, is going to add to a lot of volatility. And that skittishness is going to be very evident in the bond market.
The bond market will remain yippy. That's what I hear from you, that yippy is not going away. I'm curious about the auction that we saw yesterday. It was pretty hyped. People were very concerned we could see some sort of failed auction of 10-year bonds. But it was actually really successful. There was a record amount of indirect buying of these notes. What signal did you get from that, given that that came before President Trump's announcement? It's
definitely a step in the right direction, because that was really the most important data point of yesterday that I was watching to see if we'd see another tailed auction. I mean, the 3 basis points tailed auction, the 3-year on Tuesday was quite dramatic. So, if you start seeing more tailed auctions, then you start questioning the demand for treasuries. I mean, today we get a tranche of 30-year supply, and we'll have to see how the market takes that down. But that's one of many barometers that I use to gauge the demand dynamics for the treasury market, because you're looking at a trajectory for debt and deficits that's still quite dire, right? Even if we have some sort of a tax deal, you're looking at deficits going up. We could raise some revenues by way of tariffs to offset those deficits, but it's not going to be nearly as enough as people think it will be.
So what do you need to see to not be yippy? I mean, I guess, what do you need to see to feel like you're confident that U.S. bonds, U.S. treasuries could act as an offset in some sort of economic downturn?
So we did see that price action initially when you saw the rout in equities. You saw investors fly to the safety of bonds. The 10-year yields got to like 380, 390, but then it kind of moved all the way back up because the market started to view that as a sign of instability. So when you have sort of a little bit more of a crisis of confidence, if you will, then you're going to see that bias towards higher yields. And that's my concern, is that you need to see stability in the data. You need to see some level of clarity, if you will, on tariffs for this sort of volatility to subside in the bond market.
Is there a problem with subscribing a narrative to something that might be more just fundamentally liquidity driven? The fact that we haven't gotten the regulatory break to a lot of banks to hold a certain amount of treasuries, that there are certain liquidity constraints. And frankly, when you get that level of uncertainty, all buyers step back at the same time that there's a basis trade unwind. How much is this purely liquidity driven? And we can't really make too much of all of these moves.
A lot of it is liquidity driven, but when it is liquidity driven, you have to make a lot out of these moves, right? Back in 2020, in March, the entire rout in the bond market was because of a lack of liquidity, and the Fed had to step in to be that backstop provider of liquidity. So the lack of liquidity is something that's definitely a serious concern. What was also interesting to me in the price action in the last week was the fact that the haven assets were actually bonds and JGBs, because that Treasury bond and JGB spread actually widened. So that leads me to believe that investors are not viewing Treasuries in the same way that they did or they used to in past crises. I mean, going back to either COVID or you look at the great financial crisis, you see that the market very quickly prices in a lot of cuts. You see a pretty dramatic rally in bonds. You saw none of that this time around. So that's something that's worth paying attention to.
Nouriel Roubini this morning is talking about how the bond, credit, and stock vigilantes ended up being the most important people in the world. What do you take in terms of this entire episode of signal we should learn from to understand potentially what Trump might do next, depending on where bond levels or stock levels are?
So I think it was wise on his part to pay attention to the signals coming from the bond market, because as Lisa was pointing out, the basis trades, the unwind of any sort of unruly unwind on those basis trades, any sharp move higher in repo rates could be something that could really roil the markets. So we need to see that there's steady demand for treasuries. There's not that same level of volatility in the bond market going forward. So if anything, I think that President Trump is going to be paying more attention to the bond market, because that's something, if we see more uncertainty, you're going to have to see the Fed or some other big, large backstop buyer step in to provide that liquidity.
CPI data, 8:30 Eastern Time. Are you going to hang around? Going to look at it? How useful is it?
We have CPI today?
Precisely.
So, no, the data is, of course, very, very important. We saw this sort of services side inflation coming off. But really what was interesting to me in last month's print was really the fact that you saw goods inflation starting to rise. So the sort of divergence between goods and services inflation might start to become a theme for this year. So we saw that during COVID when we had supply chain disruptions. This is sort of the same type of event where you're going to see disruptions potentially from the supply chains reorganizing and redistributing.
Are you expecting higher prints in months to come?
It really depends on what tariffs stick. Right? If there is a very high tariff regime as it stands, if we see at least 10% tariffs on all the countries and maybe 50-60% tariffs on China when the dust settles, that's still a big number, and you should see perhaps higher inflation over the next couple of years.
Subhadra, it's good to see you. As always, a lot to figure out. Subhadra Japa there of SocGen on a big, beautiful bond market. Yields are lower this morning on a 10-year by 5 basis points or so, around 4 now to about 4.30 on 10s. At the front end of the curve, down 2 basis points. Lisa, just wild swings at the front end of the curve and across the curve in yesterday's session.
There was this feeling, and you alluded to this earlier, that potentially it was getting dysfunctional, given these wild swings and given some of the sell-off that we saw. And there was this speculation that the Fed would have to step in. After what we heard from President Trump, now all of a sudden you have Neil Kashkari of the Minneapolis Fed saying the bar is very high right now to make any kind of move because of the uncertainty, because of tariffs. And frankly, that has made inflation and getting inflation expectations under control our primary objective before even our dual mandate.
The Federal Reserve has played this really well over the last week or so, but they're still stuck between a rock and a hard place. Downside risk to growth and upside risk to inflation. Coming up in the next hour of Bloomberg Surveillance, we'll catch up with Stuart Kaiser of Citi. We'll speak to the former Deputy Treasury Secretary Wally Adeyemo, Eric Resnick of KSL Capital Partners on the luxury hotel business, and former Kansas City Fed President Thomas Hoenig on what the next move should be for this Federal Reserve. Live from New York City this morning, following some wild swings in financial markets worldwide. Equity futures this morning down by 1.7% from New York. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity
or in direct lending. What we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
The top names at the Fed are on Bloomberg.
I do know that consumer sentiment has started to take a dip. The question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy, that as how it played out for most of the pandemic? Right now it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Nobody covers the Fed like Bloomberg.
You really have to believe that uncertainty is arriving at peak, and you have to believe, and we do, that Washington has no desire to precipitate a recession.
It's the volatility, it's the uncertainty. Where are we going from here?
The scarcity in the marketplace is certainty.
Certainly the markets are challenged.
Everyone knows there's going to be pain, but the issue is they just don't know that the cure seems to be worse than the disease right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Trump blinks, but the damage isn't all undone. That's the line from UBS this morning, and it's reflected in the equity market. Live from New York City, good morning. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P lower, and on the NASDAQ too. We're down by 1.6% on the S&P 500. On the NASDAQ, down by close to 2. On the S&P, the range on futures yesterday, positive 10%, negative 3. A 13 percentage point range on S&P 500 futures. Wild. Even wilder than that, in the bond market, major swings at the front end of the curve. The two-year yield, a 38 basis point intraday range at the front end of the curve. Yields lower by 3 basis points this morning, 387.65. Later on this morning, 90 minutes away, CPI data in America. No one's talking about it. Lisa, more inflation data just around the corner.
Yeah, no one cares. I mean, at a certain point, it's backward-looking, and people are trying to understand what is the policy backdrop in a quickly moving world. It is hard to get much confidence from what happened yesterday. Yeah, you had the biggest rally on the NASDAQ going back to 2001. Yay. But there isn't a sense of exactly why or how durable this is. How much are tariffs still on? We don't even understand what the average blended tariff rate still is. There's one particular average of 27% going now down to 24%. Others saying around 15%. No one can actually pinpoint what to even model at this point for the effective tariff rate at this moment.
It's super difficult. Trade's not static. And if you come up with a major tariff on China, presumably some trade will shift away from China. In the meantime, though, compare where we are now to where we were only a week ago, and tariffs are higher they're not lower.
They are when it comes to China, 125%.
The Bank of England
That
is
is a
to
levy
amend the
for
gilt
these
sales
Chinese
schedule.
goods coming into the United States. You also have a 10% tariff ring around the United States. That is staying put. The issue that investors have, the market has, is the goalpost keeps changing when it comes to reciprocity for each individual trading partner. And we're not going to know where they end for another minimum 90 days.
We have revealed one thing. We've discovered that the Trump put has moved away from the Dow to the bond market based on comments just yesterday.
That, to me, was the big takeaway. The bond market's in the driver's seat. It was yippee. He actually responded. What is the strike price of that, though? Is it just almost getting to a dysfunctional place where the Fed would have to step in? Does it mean that Scott Bessent now has the ear of the president? What's to say that it's not going to be Peter Navarro tomorrow? There is this question of how much can you rely on something that seems to be driven more by impulse and intuition rather than some sort of formulaic policy.
The Treasury Secretary said yesterday outside the White House that he had a conversation, they all had a conversation on Sunday. And on Sunday, what happened? On the way back to Washington, D.C., on Air Force One, who is standing behind the president? I peek my head out. It's Scott Bessent, the Treasury Secretary. On the way down to Palm Beach, it was Howard Lutnick. It does feel like this idea is really stemming from the Treasury Secretary. It is what he told me after Liberation Day. This is a cap. We can do deals coming down. And the president said this has been percolating for a few days.
England to
We
reschedule
decided
long
to
maturity
make the
auction
decision this morning.
to the
I was looking
following
at the bond
quarter.
market overnight, and then we sat around and wrote it from what he calls their hearts.
Looking at the bond market this morning, yields are lower. We're down 3 basis points on
The
a 10
Bank
year
of
to
England
430.
to
On
auction
twos, we're down
short
4
instead of long
to
maturity bonds
387.
April
Coming up this
14.
hour, Stuart Kaiser of Citi, as stocks stage another historic bounce. Former Deputy Treasury Secretary Wally Adeyemo as President Trump's U-turn isolates China, and former Kansas City Fed President Thomas Hoenig as Fed officials signal they'll stay on hold. We begin this hour with stocks lower following their biggest one-day climb since 2008. Stuart Kaiser of Citi staying cautious, writing, "We shift to a neutral footing on U.S. equity risk as 2/3 of the dip buying conditions were fulfilled by a 90-day tariff pause. We are not necessarily comfortable with long equity exposure and expect continued headline volatility." Stuart joins us for more. Stu, good morning.
Good morning.
Wow. Okay, so this is what we've got. 10% baseline tariff and then something north of 100% on China. Good or bad?
As you said, worse than last week, probably better than Sunday night as a blended, type thing. I think basically what the market is telling you now is they sort of took some of the tail out of the
Bank of
tariff
England
risk.
cites the market
and we're gonna
volatility
need to
for the
see
change to
successful
sales.
and observable negotiation progress over the course of actually probably the next couple 2 to 4 weeks, without the market to react negatively.
It doesn't sound like you've got too much confidence that this is over.
No, I mean, look, even if you just, to Lisa's point, we don't know what the blended tariff rate is. At steady state now, to your point, is much worse than it was last week. And we have not really gone very far to pricing in the knock-on recession risks if the current tariffs are held in place. I'm also of the view there's probably less than 3 people in the world that know exactly, what the future looks like on this front. So just a tremendous amount of uncertainty there. So, yeah, we're still pretty cautious, though. To be fair, I think in instituting this delay does trim some of your worst case tail risks off, which is why we're kind of a little more neutral than I think we were extremely cautious over the weekend. We're kind of more neutralish now.
Can you take us into some of your conversations with clients recently to give us a sense of what the flavor has been like, what the tenor of them has been, and what you say?
Look, I think honestly, as many opinions as are around the table is what we're getting from clients. I would say, look, the outlook has been very, very bearish on U.S. equities. You see that in positioning, you see that in flows, you see that in our conversations where it's, maybe the view was, hey, I don't know, the plurality of outcomes is you get a negotiated deal and it's better than worst case. But there is this situation where if you took your tariff hit and you threw a decent sized recession on top of that, you get S&P earnings down to $200 or below, and you put some reasonable multiple on that, and the number doesn't look as big as you would like it to. I think is the best way to put it.
3,600,
so,
right?
Yeah, you could be, 4,000 or below with, reasonably conservative math. So I think a lot of folks were saying, even if I wanted to buy this dip, I can't fully discount, that negative there, because if you think of that number as, let's say that's your recessionary outcome. Well, what are your recession odds? If your recession odds are anywhere near 50-50, now you have a 1 in 2 chance of an outcome that looks really poor. So I think investors were respective of that, and we're just very, very cautious about putting risk back on. And the fact is, we've had 2 of these 5% rallies, over the last week. they lasted about 15 minutes. So it wasn't like, as an investor, you had the opportunity to catch those, really. You either happened to have the risk on or you didn't. And I think that's been equally frustrating, that I suffered all the way down. The market rallied, what, 6% in 15 or 20 minutes yesterday? Like, you didn't get a chance to engage in that.
Have you noticed a difference in tone between domestic investors and international investors?
A little bit. I mean, I think in a lot of these cases, when you have domestic policy issues, the domestic investors tend to be more bearish, than the international investors are. In this case, I think it's shades of gray, because the international investor is also very frustrated. If you're up in Canada meeting with those investors, they're not feeling so great either. And I think the same is in Europe. But I think U.S. investors probably incrementally a little bit more negative than the international folks, just because we're so close to it. But again, it's going to be hard to find a bullish or optimistic investor right now.
If these markets were Chinese, wouldn't we be calling them uninvestable?
I wouldn't, but you you might be.
I'm asking the question right now how investable this market is, given these wild swings.
No, I mean, I think it's not particularly. And I think you saw that actually on Monday, where you had that, very sharp squeeze in the morning. And then after that, you got some negative China headlines on tariffs. Shorts did not really aggressively lean back into that. And I think it was because you got so hurt in that sort of flash rally that you didn't have confidence, to put the risk on in the other direction. And I think what you're seeing overnight is a little bit of that, where the market rallies so quickly higher. Sponsoring the next leg of that feels really poor risk reward, and I think you're seeing that a little bit overnight. So yeah, it's from a tactical perspective, it does feel very, very hard to invest in. I won't call it uninvestable, but very hard to invest in. And even from a long-term investment perspective, it's really hard to handicap stuff, and you're probably thinking, I might get a better entry point here to begin with.
Things have been really brutal. You've set up the next month or so. We need to set up the next 90 days. What these negotiations are going to look like over the next 3 months.
And trade deals normally take 2, 3, 4 years, and they're trying to get stuff done in the matter of 90 days or maybe a little bit more, a few months. What I would take from everything Donald Trump has said, on the campaign trail, he promised 10% tariff ring around the United States, 60% on China. We know that he goes into everything with a maximalist approach. Well, maybe the China is going to come down. That tariff rate will come down to 60%, and we might end up exactly where he planned on starting, but just going through a lot of emotions to get there.
In the meantime, we're going to be looking at uncertainty, negotiations, and more uncertainty. And Stu, I've got to ask you how you and the team will be navigating the incoming data. We just caught up with Sogjan Sabaj-Rajappa, who said CPI, what's CPI? 8:30 Eastern Time, there's an inflation report. There is. How are you navigating the data? How will this market respond to incoming information?
Well, I mean, CPI, look back to payrolls last week, they probably felt like the forgotten child a little bit. I think the data we're getting last week and this week is much more what was the state of the economy coming into this. And if you got a strong enough labor market report where at least it was, okay, the economy was solid before I put these tariffs on. If you had gotten a weak payrolls report and then added tariffs, that would have been incrementally negative. I think that today's data is going to be interesting because the last inflation report, the data was actually pretty good. The market traded down because they treated that softer inflation as weaker demand. So the data today is going to be really interesting. If the data prints hot, it's going to be, oh my God, we had an inflation impulse before tariffs. If it's light, it's going to be, oh, maybe the demand's getting destroyed already. So it's hard to see actually a positive outcome from the inflation report today, but luckily it might get ignored. So I guess we don't have to worry about it too much.
Will earnings get ignored? Because right now it's very hard to really trade on the guidance that also seems a bit, I don't know, unreliable as well.
Earnings, I think, are going to be all over the place because if you're a company, you either have to defend numbers, and boy, you better have a good story about why you're defending them. You say, I don't know. Frankly, I don't think that's going to be rewarded as an answer. Or you kind of throw in the towel a little bit, which I think we talked about a month ago. And that side of it, I think if you kind of throw in the towel and your stock is washed out enough, that might help you. But again, none of those three outcomes are good. Broadcom the other day announced a buyback. It wouldn't surprise me if you get some guidance maybe pulled or widened, but then some buybacks announced behind it to kind of support the stuff. But yeah, it's going to be a very, very interesting earnings season.
Stu, it's good to see you. Thanks for breaking it down. What a couple of days. We all need some rest. Stuart Kaiser there of Citi. Your equity market on the S&P 500 negative by 1.7% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. House Speaker Mike Johnson has canceled a vote on the Senate's budget resolution last night, with fiscal hawks saying it would add too much to the nation's debt. The House and Senate need to adopt identical versions before they can move on Trump's domestic agenda, led by a $5 trillion extension of his expiring 2017 tax cuts. Elsewhere, U.S. Supreme Court Chief Justice John Roberts let President Trump temporarily fire top officials at 2 independent agencies while the High Court decides how to handle presidential power. The case tests a 1935 ruling that let Congress shield high-ranking officials from being fired. The decision could determine whether Trump has the power to fire Fed Chair Jay Powell. And Amazon CEO Andy Jassy out with his annual shareholder letter, writing that the company has to act like the world's largest startup in order to meet demand for AI and trim its bureaucracy. Jassy said that Amazon will continue to invest heavily in AI alongside forays into healthcare, including Amazon Pharmacy. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny later this hour. Up next on the program, doubling down on China.
China wants to make a deal. They just don't know how quite to go about it. You know, it's one of those things they don't know how quite. They're proud people. They're in the process of figuring it out, but they want to make a deal.
Up next on the program, the former Deputy Treasury Secretary Wally Adeyemo, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, former Treasury Secretary Larry Summers of Harvard on the consequences of the Trump tariffs. Ambassador Richard Haas of Centerview Partners on the TikTok deal, where President Trump might need to look to get the money to put into his sovereign wealth fund. And former Transportation Secretary Elaine Chao tells us how to fix the air traffic control system.
Reorganize the structure.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Equities this morning lower across the board on the S&P 500, negative at the moment by 1.8%, down 2 on the NASDAQ 100. Under surveillance this morning, doubling down on China.
China wants to make a deal. They just don't know how quite to go about it. You know, it's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well, and they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal.
So here's the latest this morning. President Trump isolating China as the primary target of his trade offensive, hiking tariffs to a record 125%. China's top leader said to discuss additional economic stimulus later on today. Joining us from the nation's capital, Bloomberg's Tyler Kendall. Tyler, what's the state of play this morning?
Yeah, hey, John. Well, you heard President Trump there signaling optimism that there could be a potential deal with China. He said that once Beijing calls, they'll be, quote, off to the races. The only thing is that per our current knowledge is it appears Beijing hasn't called. And as you've been reporting this morning, there was that apparent escalation with China announcing those potential curbs when it comes to imports of U.S. films into the country. President Trump did say yesterday, though, that he couldn't imagine raising that tariff, that 125% levy, any higher when it does come to Beijing. Now, when it comes to the other countries, Treasury Secretary Scott Bessent has said that this was all part of the plan all along. It shows that the U.S. wants to negotiate in good faith, but Bloomberg Economics writing that these whipsaw movements do very little to quell any of the record high uncertainty that we are seeing, not to mention that companies have been really hitting the pause button of their own as they try to discern if any deals can actually get done in this 90-day timeline. Now, Bessent has confirmed that he has meetings on the books already with Vietnam, South Korea, Japan, and India as we try to see if any deals can be done there. But the big question is, what does it take to actually clinch something in such a short amount of time? John, the Commerce Secretary yesterday did give us some further hints to things that we've already been tracking. He said that the U.S. has been rather intrigued by the concessions these countries have been putting on the table, particularly when it comes to those non-tariff barriers.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. I think we're all just totally desensitized. You wake up, see futures down 1.8%, just kind of shrug your shoulders. Big deal. What's 1.8% these days? Extending the conversation now. Joining us around the table, the former Deputy Treasury Secretary under President Biden, Wally Adeyemo. Wally, good morning.
Good morning.
How good does it feel to be on the other side?
It feels really good to be on the other side at the moment.
What do you make of what you've seen down in Washington so far? Give us your opinion on things.
I do think that everyone agrees with the president that we need to do more advanced manufacturing in the United States.
That he was on the call with Trump and the Swiss president yesterday.
Over the last few days, broad-based tariffs ultimately are going to cause pain for American businesses, but also American consumers. And I think that everyone was encouraged, and that's why we saw the relief rally when the president paused. But the important thing is a pause is not a stop. And you still end up in a place where you have 10% tariffs across the board and 125% tariffs on China. And that's going to mean that Americans are going to pay more for groceries, they're going to pay more for housing, and our companies, especially small businesses, have uncertainty because what's going to happen in 90 days. But the thing the president has said that I think is encouraging is that he's open to negotiating, and the goal now is for him to define what does he want to accomplish in these negotiations, and hopefully for those things to happen very quickly.
But trade deals take years. You've been in the rooms with all of these counterparts. Do you think they get deals done in 90 days?
It's really hard to get a trade deal done. We negotiated a deal with the Japanese over critical minerals as part of the IRA, and that happened relatively fast because both sides wanted to get to an agreement. And the hope here is that over the next 90 days, the administration can accomplish three things. One, lower tariff barriers for the United States so our companies can be level playing field, and non-tariff barriers as well. And then the third piece is also important because what we found was after President Trump cut his first deal with the Chinese companies moved to Vietnam and Malaysia. So the question now becomes, when you're cutting a deal with these other countries, can you get them to put in place restrictions so the Chinese firms can't take advantage of their economies to ship things to the United States? But even more importantly, when you think about what's going to happen now that China has these huge tariffs on them, they need to sell their things, and they're going to sell them to Southeast Asia, they're going to sell them to Europe. So now they need to think about, do you need to put safeguards in place to make sure that Chinese overcapacity doesn't overtake our shores? And that's where you have the opportunity potentially to partner with some of these countries to confront China. And my hope is that the president and the secretaries he's appointed to do this work with our allies and partners to confront the Chinese.
Recently in The Economist, you wrote that the global trading system needs new rules, not tariffs. Is this what you're talking about? Basically more bilateral rules and then taking the friends along for the ride to confront Beijing?
It's critically important because what we've seen is that if you care about our steel industry, preventing Chinese steel from getting to the United States doesn't mean the price isn't going to be lower if they're selling that steel to the rest of the world.
A National Economic Council's HASET says two trade deals are almost closed as of last week.
We all agree that we should do more advanced manufacturing in the United States, but the U.S. is 4% of the world in terms of population. We want to make sure
and
that
HASET says there's a big inventory of deals that are right close to the finish line, and that's according to a CNBC interview.
And if we're not willing to work with those countries, it's going to be really hard for our companies and our workers to be open to those markets.
When it comes to the end goal, you actually sound a lot like a Trump official, even though you were part of the Biden administration. But the Biden administration used subsidies, industrial subsidies in the United States to try to cajole business to do work here. Do you think Trump is right to use this carrot and stick approach as well?
I think the key thing to remember is that we did do things like the Chips and Science Act, where we provided companies with funding to help them build in the country. And it wasn't just about the manufacturing jobs, it was about the entire ecosystem. But we did also strategically use tariffs, because the key thing you have to do is, on all of the above strategy, ultimately you have to give incentives to companies to build here, but to create really good paying jobs. But when a country is unwilling to create a level playing field for you, for example, China, sometimes you have to use tariffs strategically. The problem is when you do broad-based tariffs, you get into a situation where it hurts American consumers, farmers, and also our businesses more than sometimes it hurts the other country.
Hassett says the bond market may have contributed to tariff decision, but did not cause a panic move.
With the idea being that if you can reach an agreement, where you end up with is fewer tariff barriers for American companies, because I think the thing that you believe across the aisle in D.C. today is that if American companies are given the ability to compete on a level playing field, our companies and our workers are going to do well. The key now is how do you get there?
Given your negotiations with international partners, do you think that there's legitimacy to this feeling that maybe some of the other nations who used to be our trading partners are going to get closer to China, not further away, as a result of some of the tariff turmoil?
My view is that the United States still has an incredibly good hand, but it matters how we play it.
Hassett says we have set up a process for tariff deals so they can be orderly.
To build a coalition by reducing getting them to reduce tariff barriers and non-tariff barriers. But we also have to remember that the U.S. has tariffs on their economies too. So, for example, we have tariffs that protect certain industries here. Are we going to be willing to lower them as well as part of this process? And then what we have to remember for all of us is that Chinese overcapacity is not a problem just here in the United States. It's a problem in Southeast Asia. It's a problem in Europe. And we have to be able to work together to solve it, because if we take a unilateral approach, ultimately that overcapacity is going to wash up on the shores of other countries.
Why aren't Democrats coming out and saying that Donald Trump's goals are the right way to go? That actually this is correct. It's just that we disagree with the measure.
I think that what you heard from Governor Whitmore yesterday was exactly that, which was that we think that we should have more manufacturing in the country. We can use tariffs, but ultimately the problem is that it can't be the only tool. You can't do it in a broad-based way. What are you doing to create incentives for businesses to build advanced manufacturing in the United States and to create good jobs is going to be just as important as how you strategically use tariffs. The challenge we have today is that for American people, when they go to the grocery store, when they go and try and buy a house,
and White House Economic Advisor Hassett says deal schedule is very doable.
If you're a small business today and you're thinking about your supply chain, how are you going to buy the things you need to be able to get things to your customers? That's harder today than it was a week ago. And if you're a big business thinking about earnings season, how do you give forward guidance in a world where you have a 90-day pause? And I think ultimately we agree that we need to have more manufacturing in the country. And I think that Democrats and Republicans can work together to accomplish that. Tariffs should play a role, but it has to be an all-of-the-above strategy that includes how do we create the right incentives here in the United States as well.
Wally, can we just finish on what I'll call the European problem? Why is it so difficult to get the Europeans on side with US policy? Why is that so hard?
I think Kissinger put it well in terms of Europe is not a country, it's a jurisdiction, and there are a number of different countries there, and it takes them time to get to the right place. But the reality is that we'd rather the Europeans be arguing with each other over politics than what happened before we had the European Union. And fundamentally, Europe has been an ally, but we have to hold Europe accountable as well to being in a place where they create a level playing field for American firms as well. And in doing that, it's going to be not only good for the United States, but it's ultimately good for Europe, frankly, because Europe needs to grow. Their economy has been stagnant for too long. And without a partner like the United States that can help drive that growth, it's going to be really hard for Europe to compete with China and compete in Asia. So ultimately, the goal here has to be to reach an agreement that will be good for the United States, that will mean that the United States is in a better position to manufacture things, but ultimately needs to be good for Europe too, because overcapacity from China is a serious problem that is ruining Europe's industrial base as well. So there is room here for a deal. The key is to make sure that both sides get into the same room and think about ways in which we can grow the global economy and Europe and the United States economy.
Wally, tremendously smart, as always. It's good to see you. We've missed you. Let's catch up again soon. We need to talk taxes. Former Deputy Treasury Secretary Wally Adeyemo. Up next on the programme, Eric Resnick of KSL Capital Partners as tariffs weigh on global
travel. White House Economic Advisor Hassett says conversations on China have not begun yet.
in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
All right, let's cut right to it. This is Bloomberg's new show, Primer.
This is the fundamental building block.
And Hassett says tariff revenue is expected to help reduce the deficit and help bond markets.
By anybody, ever.
If you want to understand what's coming, you'll want to watch Primer, because details matter. So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
60 minutes away from the CPI report, equity futures are negative and near session lows. We're down 1.7% on the S&P 500. 2 hours away from the opening bell. With your morning movers, it's Danny Berger. Hey, Danny.
Hey, John. It's the deal that refuses to go away. U.S. steel share prices falling nearly 10% this morning. President Donald Trump saying that he does not want to see a Japanese owner for this company. The reason it's moving so much on that is the fact that there had been hopes to start the week that maybe this deal would go through, with Trump ordering a review of the deal. He has said Nippon Steel, you can get creative, but he's been advocating for something of a minority stake, not a majority stake. Also on the move this morning, we had earnings from CarMax. Another sort of case study in how you address the macro uncertainty. They've removed their timeline for long-term goals, saying we're still keeping those long-term goals, but we don't know exactly when we're going to get there. The interesting thing is, if you look through the earnings report, they don't talk about tariffs, they don't talk about trade. It's literally business as usual, except for one little line that says broader macro uncertainty. That's what they're attributing to. But of course, used car prices very impacted by tariffs, considering new used car prices are likely to move higher. Those shares down by more than 7.5%. Wrapping up with Dell, another case study for you. This in what happens when component prices go up. A Bloomberg study of their website shows that they have removed countless discounts on their products. It appears that Dell indeed will be charging consumers more when the component prices go up. The company did not respond to that study from Bloomberg, but the CFO did say earlier this year that they plan to pass prices on. Those shares down more than 2.5%, John.
Hey, Danny, thank you. Appreciate it. Danny was talking about this a little bit earlier, exemptions. How many exemptions will we see for big tech? And I'm thinking almost exclusively of Apple at the moment. How many exemptions will we see in the weeks to come?
Well, there's certainly all these companies are lining up and they're asking for these exemptions, these carve-outs. You saw exemptions and you saw carve-outs in the first Trump administration. And then Trump yesterday pretty much signaled that he's open to it, depending on what it is and what the company is. I think if you make
everyone
your
expects
case
10%
to the
tariffs
president,
to be the
you like
baseline.
they're going to get one.
Futures down this morning on the NASDAQ by 2%. On our radar this morning, President Donald Trump pausing tariffs on most global trading partners for 90 days, but raising levies on China to 125%. The U-turn coming roughly 13 hours after duties on 56 nations and the EU took effect.
So obviously the Trump administration is coming out, Caroline Leavitt saying this is art of the deal. We all missed it when it comes to what the president was doing. I think maybe it's a bit of both. We know that the president likes to start out from a maximalist position. At the end of the day, he wants to get deals done. At the same time, this did happen at a time when you saw some unraveling in the bond market. That certainly got the attention of the Treasury Secretary Scott Bessent, who on Sunday, after an interview with the American media, went down to Mar-a-Lago, clearly had a meeting with the president, and then they came back to Washington, D.C. together. So how this played out, I'm not actually surprised about. The question now is uncertainty remains. Who gets the deals first?
Certainly felt like the bond market had a key role to play in all of this. This was the president's quote just from yesterday, Lisa. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. But I saw last night where people were getting a little queasy, and maybe he was getting queasy too.
It shows just how much the bond market is the ultimate constraint right now on a president who is looking to reduce borrowing costs, and he's a debt king. He loves debt. He could see the disruptions that were happening in the market. Key question is how long this will last, what kind of level he's targeting, and do we have a better understanding of a strike price, or is it just simply that level of volatility that could potentially invite the Federal Reserve to have to intervene because of market dysfunction that could potentially get his attention?
So we've got lots of talks coming up and a 90-day pause. Is a 90-day pause realistic? Is that long enough, a decent time frame to get a lot of this stuff sorted out?
To be honest, I didn't think it was. Maybe when you're talking about a comprehensive bilateral trade agreement, it's not. But what did Wally Adeyemo, who's the former Deputy Treasury Secretary, say just now? There was an impetus and a need to get a critical mineral deal done with Japan, and they got it done very quickly. So when you have two parties that want to get to an end game as quickly as possible, then potentially they can get at least some of these, a handful of these deals done within 90 days.
Speaking of Japan, the president also had some comments on U.S. steel. He doesn't want to see U.S. steel owned by a Japanese company. Trump pointing to the steel producers' rising orders as evidence that it doesn't need outside investment. And on Monday, ordering another national security review of Nippon's proposed takeover.
So I think his comments are really interesting because on Monday, what individuals took from that memorandum and that new order he gave for CFIUS is that potentially that he would amend the decision by the Biden administration and the predecessor to block this $14 billion transaction. Now what he's saying is CFIUS is going to look at it, but I still don't want it to be U.S. owned. Potentially, though, on the margins, there's a way to get a deal done and it still be an American owned, maybe just more money coming in, a bigger just investment, not a full takeover. Remains to be seen.
Watch this space. So at the moment for companies, it's a tricky moment. How much guidance can you actually provide for 2025? Delta
bookings are up about 10% for the year. That's virtually all volume. Only a couple points of that are price. Now, price is up a little bit more if you look year to date at the more luxury end of the travel spectrum, but it's not up tremendously. The pricing increases that we saw in 21 and 22 were unique. It was a unique period of time. Those have come off quite a bit in 23 and 24, but the prices have stayed high. So I think what you're reacting to is that high level price more so than a dramatic increase in price that's happening right now. We're not seeing that today.
So what's the #1 destination right now?
Look, for Americans, one of the most attractive destinations is Mexico and the Caribbean. Always has been and always will be. Lisa mentioned Italy. We actually see Italy being off a little bit right now from Americans. I don't think that's because of the tariffs. We saw that before. I think that's coming off of the incredible peak last summer in Italian travel.
So right now, going forward, what are going to be the signs to you that there is a material shift? Where do you expect to see it first? In the low end, the medium term, the high end, the bleisure, which we talked extensively about? Where do you think what will be the sort of front-leading indicator?
That indicator we have already seen a bit, which is, I would say, the lower end, bookings to select service hotels, to mid-scale economy hotels, those are not as robust as they are at the luxury end. Bleisure is definitely not bleisure. Bleisure, we've talked about this term before, it's a terrible word, but 75% of people want to combine business and pleasure trips, bleisure, right? But we are seeing, we have seen pretty soft trends at the more economy level. So I think that's where you're seeing it in the data, and that was before last week.
Eric, it's good to see you. Keep us updated.
Great to see you.
Thanks for dropping by. Thank you. Eric Resnick there of KSL Capital Partners. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. China is reducing the number of imported U.S. films and introducing more films from other countries. According to a statement from the Chinese government, U.S. tariffs on China will make the films less favorable to domestic audiences. Elsewhere, Lego has opened a new factory in Vietnam. The world's largest toy maker says it plans to invest $1 billion over 15 years in the complex, which will produce toys for Asia. Lego CEO told Bloomberg that the company sees growth in new markets as a buffer against any possible headwinds from tariffs. And a new United States Postal Service proposal would see first-class stamp prices increase by 5 cents starting in July. That amount ties the record as the highest increase ever. It'll be the first of 5 planned price hikes for stamps currently planned through 2027. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on in the program. Up next, the Fed on the back burner.
What gets the Fed to move by more is financial conditions.
I don't think there's any case for the Fed to cut interest rates.
The Fed can't play the hero anymore.
Up next on the program, the former Kansas City Fed President Thomas Hoenig joins us next. Live from New York, this is Bloomberg.
In case you missed it on Balance of Power.
Governor, I wonder if there's a silver lining in any of this for the great industrial towns of your state from the last century. Syracuse, Rochester. Based on what we're hearing from this administration, they will again have a seat at the manufacturing table. Do you believe that?
I hope so, but we have advanced manufacturing, we have pharmaceuticals. In fact, I was able to lure Micron with a $100 billion investment, the largest in our nation's history, to build semiconductors in the Syracuse area. And they'll be affected by this. The component parts to what they're building and the supply chain, they're going to see an increased cost, not just because they're in New York, but because they're in America. And that's what worries me. There could be a silver lining, as you say. I don't know how old I'm going to be when that happens. I mean, what are they going to do? Start building factories now? And, you know, I just don't know. All I know is that people were promised lower prices on Inauguration Day. And guess what? They're going up.
Don't miss Balance of Power live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like
White House
Bloomberg.
economic advisor Hassett, in an interview with Fox News, says, "I'll present a list of deal
Get
priorities
your
to
fixed
Trump
income
on
fixed.
Thursday."
Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern.
And Hassett
right
says we have
here on
offers from
Bloomberg.
15
Context
countries.
changes everything.
China scoops up Brazilian soy as trade war with the US worsens.
Equity futures negative here by 1.6% on the S&P. On the NASDAQ 100, we are down by 1.9. On the Russell, by 2.4. Out of Savannah's this morning, the Fed on the back burner.
What gets the Fed to move by more? It's financial conditions.
Now what we're seeing is deglobalization. That ties the Fed's hands. And the Fed can't play the hero anymore.
I don't think there's any case for the Fed to cut interest rates.
It would be best for the Fed to be patient as we go through this price shock.
They're kind of in a position where they can't act. They're going to have to wait and see.
So here's the latest this morning. The Fed isn't blinking in the face of downside risk.
That will then put pressure on the Fed. And it's when that begins to occur, if we continue with the trade war, that I think the real pressures on the Fed will come forward to monetize, that is, buy some of this debt. One other thing I want to point out to you, though, is You may have seen where there is
White
a
House economic advisor Hassett tells reporters, I expect a lot of movement with world leaders in the next 3 to 4 weeks.
Supervision talked about, and that is removing the exempting treasuries from the so-called capital leverage. Their cost of capital will be favorably affected, and that's designed to make them more able to buy more of the U.S. debt. That is, a banking industry to buy more of the debt. And then when they put that debt on, the Fed has to backstop that for liquidity reasons. If the interest rates were to shoot up, the Fed would have to be right there. So the Fed's kind of going to still be the backstop, but in a little bit different way.
How much is this the reason why you're hearing from an increasing number of Fed officials a real priority on inflation ahead of even the employment mandate? And Minneapolis Fed President Neil Kashkari wrote a blog post this morning where he came out and said, our first priority must be keeping long-run inflation expectations anchored. And he said, in my view, the hurdle to change the federal funds rate one way or the other has increased due to the tariffs. Do you think that this prioritization of inflation over the employment mandate, over the dual mandate, is what they have to do?
I think it is what they have to do, frankly, because, we've said it for years in the past. That is, you can't have maximum employment without stable prices. And inflation right now is 3%. That's 50% above their target. And 2% inflation is a fair amount of inflation over time. So I think it's about time the Fed refocused. In the 2010 period, they decided to make the dual mandate.
Hassett, when asked if Trump was trying to control the markets, says Trump believes in the future of America.
Much higher, that part of the mandate much higher. And Chairman Powell has emphasized that even more recently. And that, I think, takes the, shall we say, the eye off the ball. They have to focus on inflation. It's not going to come down a lot today, I suspect, when they report it. That's even before the tariff war. So, yes, I think Kashkari is saying the right thing.
How difficult is it to focus on inflation when the goalposts keep moving in terms of the rates the U.S. is going to charge trading partners?
Well, that's the difficult thing, because the U.S., instead of focusing on its national debt and its increase of national debt and the debt that has to be funded, they're starting to fight a war, a trade war. And therefore, they've taken their eye off the ball in one sense, made it more difficult for the Fed and for the Treasury for that matter. So they need to get back to, we can solve a big part of our trade problems if we solve our own national debt problem and our spending, our government spending problem, which is a problem. And they're not looking at it, I think, carefully enough.
Yesterday, we had the U.S. Chief Justice letting the President of the United States, Donald Trump, remove 2 agency leaders for now. Are you concerned about Powell and his position?
Well, I think this is a big deal. I think the fact that you can fire board members of an independent agency, the Fed is always thought to be special. I saw where one of the justices said that. But when you come down to law, if they make that decision for one independent agency, people have got to immediately think of what does that mean for the others, and that includes the Fed with its independent board of governors.
What kind of market response, Thomas, do you expect should there be some sort of threat to Jerome Powell and his role as Fed chair?
I think it will be pretty significant, because it clearly says we're going to politicize the Fed completely. And what's going to happen then? That's another source of great uncertainty in the market. And I think it will be destabilizing to a degree.
How much do you care about CPI, which comes out in about almost 40 minutes?
Well, I care a lot about it, because it tells people where are we taking things. And, 3%'s been there for a long time now, more than a year, in my opinion, and it's not coming down. They're going to spend a lot more money. The Fed's going to be under a lot of pressure to monetize some of that. The banking industry is going to be under pressure, especially if they make it easier for them to take on these debt. So there's no discipline to our fiscal side, and the Congress is going to pass another very significant spending and, shall we say, borrowing bill. So, yeah, CPI is going to tell the world where we're headed.
CPI drops at 8:30 Eastern Time. Thomas, appreciate your time.
Thoughtful stuff. The former Kansas City Fed President Thomas Hoenig there going into the next Federal Reserve meeting. The first week of May, Bramo, not too long away.
Honestly, what are they going to say?
At 8 a.m.
Given the
Eastern
fact
Time,
that
we
right
expect
now
comments from
they've played it
ECB's
cool.
Bush
They've said
at
we
the
don't want to get ahead of our
SGH
skis,
Warsaw School
but they
of
have to talk
Economics.
more about what tariffs do. And we are hearing some of that from Neil Kashkari saying that the bar is a lot higher for them to move either way, which is the first time I've heard rhetoric like that for a while.
If we don't have the trade deals and the goalposts keep shifting, we don't know what the final rates are going to be, how does the Fed take anything into consideration and decide to cut? Because they don't know what the future is going to be. Imagine they moved before Trump's decision yesterday to pull back.
Then they're offside.
Exactly. It's very difficult right now, and the uncertainty is not just pervasive in the business community, in the media, trying to understand what the Trump administration is doing, but it is at the Federal Reserve.
The fate of the economy at the moment dictated by one individual who can dictate how talks go over the next 90 days or so. Equity futures at the moment on the S&P 500 negative by 1.6%. In the bond market, we get a bit of stability after a rocky few days. In the bond market at the moment, yields are lower by 3 basis points, the 10-year 4.30. On twos, we're down about 5 or 6 basis points at the moment. The yield 3.85. The data drops 8:30 Eastern Time. In the next hour of Bloomberg Surveillance, we'll catch up with Greg Bowdle of BNP Paribas, Erica Najaran of UBS, Torsten Slok of Apollo, and David Kelly of JP Morgan Asset Management. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance just around the corner.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime, and now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Weekdays at 9 a.m. Eastern, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates, how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and
Shortly
federal
expecting
deficit.
comments from
and
ECB's
that's
Bush.
not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity.
Secured
I
overnight
hope that we
financing
can
rate 4 spot
continue
4
to produce
2%
2%
April
and
9th
definitely
versus
on
4 spot
productivity. I think that
4%
would be
April
great.
8th.
But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest
Newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
I don't think Fed cuts are necessarily the help the investors might be hoping for.
I don't think there's any case for the Fed to cut interest rates.
It'd be best for the Fed to be patient as we go through this price shock.
What ends a market cycle is an oncoming recession.
An abrupt start to the third hour of Bloomberg Savannah.
ECB's Booch says more needs to be done to remove barriers to banking integration.
Here by 1.6%. Let's check out the price action and move to the NASDAQ. We're down by 2%. This was the biggest one-day pop since 2008 on the S&P 500. Coming off the back of it with some declines. What's changed? Not much has changed. We still face 125% tariffs on China and 10% tariffs across the board. If you're looking for what's happening right now in the bond market, bond yields at the moment down by a few basis points. We're down 3 on 10s to about 430. On 2s, we're down 5 or 6 basis points to 385. And Anne-Marie, the bond market playing a major part in the back down from the president in just the past day.
It is absolutely. When you heard from Scott Bessent, the Treasury Secretary, and the President, that they've been thinking about this for a few days. The Treasury Secretary talked about the fact that he was at Mar-a-Lago on Sunday. They had this meeting. He came back with the President to Washington, D.C. But then it felt like yesterday morning, and the President talking about the bond market overnight. He said it's tricky, but now it's beautiful. And he looked at it. And apparently that was the final threshold for this president to decide, I need to walk some of this back. We're going to go all in and dig our heels when it comes to China. But our other trading partners, we're opening the doors. You have 90 days to strike a deal.
Does it put a ceiling on the volatility? Later on this morning, it's going to be about the economic data, 8:30 Eastern time. We get US CPI. That's the next stop for this debate in this market. Inflation data, Lisa, just around the corner.
And how much does it actually matter given the volatility that we're getting in some of the policy? We just heard there from Thomas Honig, formerly of the Federal Reserve, saying it does matter quite a bit to get a sense of where we're coming from. And I think that will matter, but also what will matter is data like how much foreign buying will there be? How much are people actually buying the bond market when there is volatility in the stock market? And those are some of the data points that might be more constructive going forward about the future path.
Truly historic swings worldwide in the past few days. Coming up this hour, we'll catch up with Greg Bowdle of BNP Paribas as stocks whipsaw on changing tariff policy. Erica Najarian of UBS looking ahead to bank earnings, and Torsten Slok of Apollo reacting to the latest read on inflation. We begin this hour with stocks struggling to add to Wednesday's major rally. Greg Bowdle of BNP Paribas writing, bear market rallies can be very large and violent. A short-term market rally and compression vol, similar to what we saw yesterday, sets up entry points to add hedges ahead of earnings season. Greg joins us now for more. Greg, good to see you.
Good to see you.
Would you describe the last 24 hours as just a bear market rally?
I mean, it has the attributes of it. If you go back through history and you look at what were the largest one-day rallies for equity markets, they all occurred in bear markets and generally not at the end of them.
The president's in control here. He seems to dictate things. Does that make it different?
I'm glad somebody's in control. I think it makes it incredibly hard to navigate. We see that the way things have flip-flopped over the last week. I think anyone who says they have certainty on where the growth outlook is going, where earnings are going, where the tariff picture is going to settle, is probably exaggerating somewhat.
How much do we have a real price check at a time when anyone who tries to short this market is, you know, we talked about this before, going to get their face ripped off based on a tweet? How can you really get any conviction to give a check on any potential volatility?
I think one of the things that we've seen develop over the last couple of years are flows in the equity market that have changed the market structure of how the equity market trades. We saw absolutely massive flows yesterday. Some of that was discretionary buying. There were very large inflows into the ETF complex, but some of it is systematic. There's essentially a short gamma profile in the market, which means there are forced flows when the market has large moves. So we think these systematic flows contributed more than 50 billion of buying flows yesterday. So this is something that amplifies moves in the market, both on the downside and the upside.
This is important. CTAs you're talking about, right, to some degree?
I'm not talking about CTAs. So CTAs are trend following that contributed to the first legs of this sell-off. But what we're talking about is more flows from things like the levered ETF complex or rehedging of option flows.
Okay, so if that's the case, how much does that structurally mean that the biggest tech stocks will keep trading like penny stocks for the foreseeable future? Because if that's the dynamic in markets, that's how you get a $1.7 trillion increase in valuation of just 6 names.
It creates this reflexivity that when you have large moves, say a 5% move, it's much easier for it to snowball into a 10% move, as we saw yesterday, than it would be in another market regime. So that's something that's structural, and it hits there.
So you think the next leg lower is down? Sorry, the next leg is lower.
I think it's more likely that we revisit the lows than we don't. I think looking forwards, things are going to move a little bit from a very macro headline-driven environment to one where we try and distill what is the impact for this. Earnings season is coming up. Obviously, the backward-looking earnings aren't going to be a focus, but the forward-looking guidance and the commentary from CEOs will be.
So what do you do in the next 90 days if everything is headline-driven and they're working on striking deals with 70 trading partners?
I think you have to look for asymmetric opportunities. So the option market is really where we would focus. And it has been challenging because equity volatility has absolutely exploded. But as we get moves like yesterday, when the market rallies, we see volatility come in rapidly. And we think that can give some opportunities to strike hedges. So one of the things you can look at is the implied probability from the options market as to where the market could trade. So for example, if you think the NASDAQ is going back to where it was just yesterday morning by the end of next week, the market implied probability of that is about 10 to 1.
So you have a Trump put and a Trump call. Basically, what are what's the price? What's the strike price?
So I think the strike price is less of a market level, and I think it's more a function of volatility when things are breaking. This is also how we've tended to think about the Fed put historically. People will ask you, where is the Fed put struck, thinking that you can think in S&P terms. My view is it's more when things start to become dysfunctional and you get signs of stress in the market, that's when you're more likely to see a policy put kick in.
We're talking about the most liquid, deepest, most traded market in the world. And we're talking about a greater likelihood of a 10% move on any given day, up or down. John was saying earlier that if we were talking about Chinese stocks, we would say almost uninvestable. How much does that change the profile of U.S. markets in a pretty profound way if this is the new normal?
I think it obviously has an impact on people's ability or willingness to put money to work. The anecdotal evidence, though, is that there are still pockets of the market, I think particularly retail, who have this very entrenched buy on dip mentality. And right now the flows tell you that is still what they've done right the way through this crisis.
Oh, you don't think we've shredded that at all over the past week or so?
No, I think the anecdotal evidence of that in terms of what we see in flows is that there was dip buying from retail last Thursday, last Friday, and indeed at the start of this week.
Domestic retail, what about international, institutional?
I think it's much more challenging for institutional investors, particularly international investors. And I think when we look at the positioning data that we track, we basically saw that the institutional positioning landscape basically reached capitulation point going into yesterday. And that also, I think, plays a part in the velocity of the move higher.
So at this point, going forward, how much do you see a reduced interest in U.S. equities than you had from international investors? Or is this just a momentary blip? Do you get the sense that maybe this isn't necessarily structural? This is a moment in time that we're going to look back on as, oh yeah, that time, but we've moved on?
It was something where this was already emerging at the start of the year in a more positive than negative way, where people were starting to look at other markets such as Europe and make a more positive case, which definitionally means some rotation out of other markets that are overowned, like the US. So I think at the back of people's mind, there is this idea of this rotation trade can play out. But when you go to markets like Europe, which have historically been more volatile, had fatter tails, tend to have more leverage and lower quality corporates in general, that's a hard thing to navigate in this market.
Is this fun?
It is a little bit, yeah.
Is it really?
I think it's something that if you work in markets, then when you get some of the largest moves in markets, you get massive outliers understanding why and what's driving that.
Tweet or a truth posting.
Off one tweet, yeah.
Yeah, so that's fun, evidently.
You're going to be saying that in a few weeks' time?
Probably not.
Yeah, I wonder. Greg, it's good to see you.
Thank you.
Appreciate your time. Thank you, buddy. Greg Battle of BNP Paribas. Truly historic moves we've seen in the past 24 hours. And one social media post shaking up this market big time, sending equities to a monster rally and attempting to put a floor in this bond market, because the moves we saw in bond yields over the past few days clearly unnerved the White House. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Speaking of those moves from the White House, President Trump is giving dozens of countries a 90-day reprieve from his tariffs. However, China is not one of them. Trump announced a record 125% levy on Chinese goods. The move puts Trump on on a collision course with Chinese President Xi, whose government has vowed to fight to the end in any confrontation with the U.S. The U.S. and Vietnam, though, are set to start negotiations on a trade deal. The two sides have agreed to consider minimizing non-tariff barriers and strengthen coordination to prevent trade fraud. Vietnam was among the first countries singled out by Trump for showing willingness to negotiate. China has bought an unusually large amount of Brazilian soy this week. People familiar with the matter telling Bloomberg that importers scooped up at least 40 cargoes of beans, taking advantage of the recent dip in Brazilian prices. It also comes as U.S.-China trade tensions escalate. Soy is America's top agricultural export to China. And that's your brief, John.
Brazilian farmers driving around in Lamborghinis at the moment, that's for sure. Up next on the programme, the morning calls. Plus, a little bit later, we'll catch up with Erica Najarian of UBS, looking ahead to big bank earnings. That kicks off tomorrow morning. Live from New York, you're watching Bloomberg TV.
According to a poll, European Central Bank to cut deposit rate to 2.25% on April 17th, say 61 of 71 economists, and Eurozone economy to grow 0.8% and 1.2% in 2025 and 2026, previously seeing 0.9% and 1.3% in the March poll.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
We said this yesterday morning, you can't look away from the Bloomberg terminal at the moment. Blink and you miss it. It's a 10% rally. Just like that. Equity futures on the S&P 500 at the moment negative by close to 2% on the S&P. On the NASDAQ, we're down by 2.4. Just a little bit of stability for now in the bond market. Let's see if it sticks. 10s at 432. At the moment, 2s at 388. Let's get you some morning calls. First up, Goldman Sachs downgrading Ford to neutral, citing weak demand and higher costs from tariffs. Your second call from Mizuho, lowering its price target on Tesla to 375, noting Trump's 90-day tariff pause does not apply to autos. Tesla's down by 3.75%. And finally, Dan Ives of Wedbush cutting his price target on Microsoft to 475, pointing to uncertainty from the, quote, tariff game of poker. That name is down by 1.5% in the pre-market. Let's turn to the big banks. Earnings kicking off with JP Morgan, Wells Fargo and Morgan Stanley reporting first quarter results tomorrow morning. Erica Najarian of UBS writing management teams are between a rock and a hard place, as any outlook seen as quite bearish could also punish the sector. Erica joins us now for more. Erica, always good to see you.
Good to see you.
What do they tell us tomorrow morning? What can they tell us?
What can they tell us that will matter? A lot of investors are thinking that whatever they'll say, which is actually not so bad, is going to be seen as backward looking. Now, I think there are really two things that investors are looking for. Number one, are activity levels now just permanently impaired from both the corporate side and the consumer side? So clearly we had this animal spirits economy that we really wanted to come through. And if you're a corporation, how do you make decisions in this environment, right? And so as you think about investment banking and loan growth in commercial, you would think that has to be at least delayed, although I wonder if the equity market continues to rally, obviously not today, but I wonder if there's some deals that it's going to get pushed through the pipeline over the short term. On the consumer, you know, American Express is not normally seen as a bellwether report, but given that 10% of Americans account for, or high-end Americans that make $250 account for 50% of the spend, all of a sudden they're a bellwether report, because if they're slowing down, that's not good for consumer activity for the rest of the year.
So the banks are the best data points we have at the moment. It's the best real-time data we'll get. A lot of people looked at payrolls and just said that's old news. When you were in touch with the management teams over the past few days, you put together a picture of where things are at currently. What are they telling you about activity at the moment? Have things slowed down?
Things are slow. If you look at the regulatory data and you catch up with the banks, commercial activity, it's slow. It's quite flat. And if you look at the deal logic data, I mean, it's depressing. The whole capital markets renaissance is just not quite happening. But trading, you know, as you can imagine, given all this volatility, trading could be lights out for this quarter.
Okay, hold on a second. I remember when we used to get volatility, and it was good volatility, and then it was bad volatility.
Yes.
And volatility isn't always a good thing. So is this good volatility or bad volatility in terms of bank profits?
So far, again, you know, speaking about backward looking, if you think about the month of March and think about the equity market volatility, sell-side desks are typically long volatility, so that could be good for them. Now, what makes me nervous is what's been happening to the Treasury market in terms of dealer capacity. So the key question for the month of April is, you know, is there something going to happen? Is there bad volatility now happening in the fixed income markets that is not going to be good news for the second quarter?
So going forward, what do you think is going to potentially be the bigger driver? Is it going to be the trading side of things, or is it going to be the M&A wave that doesn't come to pass, or is it going to be deregulation, which we've seen some of, but not necessarily the full package?
So investors just never really value trading earnings much, right? It's super volatile. It's like throwing a dart on the board. Who knows in any given quarter, right? I think what they're really looking for is, you know, honestly, any signs of credit at this point, because the reaction of banks up until yesterday really told me that investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, let's say if credit costs go up in anticipation of a tougher economy, I think that's what the market sort of needs to hear for now. On the deregulatory point, what's gotten lost in all of this is I feel like the deregulatory momentum in Trump 2.0 is actually much stronger than Trump 1.0. I mean, we went to that lunch. I mean, he started off, Secretary Bessent started off with bank deregulation at this lunch at the Economic Club in New York, and everybody just wanted to talk about tariffs. And he started off with bank dereg. But for now, until we understand, you know, the range of outcomes for the economy, the macro volatility uncertainty will trump the deregulatory positive catalyst.
But do you even believe these CEOs when they come out and potentially say we're not going to have a recession, or we are? Goldman Sachs pulled their call yesterday after Trump came out.
According to a Punchbowl reporter on X, they expect US House Speaker Johnson and also Senate Leader Thune to do a presser this morning in which they say they are committed to finding a $1.5 trillion in cuts.
And they're saying to themselves, well, I have no, you know, I don't know what the outlook is, so perhaps they're going to build reserves a little bit, but you don't have an inventory of losses that are coming down the pipeline. Card delinquencies are actually flat to down, and commercial delinquent or non-performing loans are pretty flat and improving. And so it's tough, but they have to talk defensively, or else investors will think they're burying their head in the sand.
It's an important point you brought up about Scott Bessent at the Economic Club of New York, where we saw each other last, because he wanted to talk about deregulation and tax cuts, but the entire room wants to talk about tariffs, because at the moment there was all this uncertainty what they were going to do with trade. When you take the entire policies of the Trump administration, deregulation, tax cuts, and tariffs, how much more constructive is that for banks towards year end? So deregulation is super, super constructive, right? Particularly as we start thinking about changes in the stress test, which I think could be a 2026 catalyst. I know it's not 5 minutes from now, as we like. So deregulation, I think, is a big catalyst. You know, tax cuts, obviously the continuation of, the Tax Cuts and Jobs Act would be, beneficial for corporate activity, but that's something that's already embedded, right? It's already baked in the base case. So just extending that isn't necessarily going to pump up activity, which goes back to trade, right? It's like the big overhang that is overshadowing everything else that's good.
So do the big banks benefit the most from deregulation and an uncertain regime where they consolidate a lot of trading volumes?
It's been 10 minutes time now at the bottom of the hour. We see the release of the US CPI data for the month of March. CPI year over year forecast 2.5% from the prior 2.8%, with a range of 2.8 to 2.5% expected. Month over month forecast 0.1% from the prior 0.2%, with a range of 0.3 to 0% expected. Core CPI year over year forecast 3% on the prior 3.1%, with a range of 3.1 to 2.9% expected. And the core CPI month over month forecast 0.3% on the prior 0.2%, with a range of 0.5 to 0.2% expected. With this, we also see the release of the weekly jobless claims numbers. Initial claims forecast 223K on the prior 219K, with a range of 230K to 215K.
I think it's too early. I mean, trading
Continued claims forecast 1.884 million on the prior 1.903 million, with a range of 1.92 to 1.86 million expected. We also get Canadian building permits month over month, with a forecast of minus 0.5% and a prior of minus 3.2%. So as a preview for this upcoming CPI release then, we have a note from Wells Fargo who said that the March CPI report is expected to show no change in headline inflation on a month-over-month basis, which brings the annual rate down to 2.5%. Its lowest in 6 months, they note. However, the softer headline number is primarily due to a sharp drop in energy goods prices, likely the largest monthly decline in over 2 years, driven by concerns over slowing economic growth and favorable seasonal adjustments. While some food staples such as eggs saw price declines, increases in other grocery categories likely offset any broader relief in the food at home inflation sector. Wells Fargo also note that core inflation will exclude volatile food and energy prices. It's estimated to have risen 0.2% month over month for a second straight month, pushing the year-over-year rate to 3%. They note that's the lowest since mid-2020 and say that while this marks progress, the underlying details may prove less encouraging. Core goods inflation is beginning to rise again, and disinflation in services continues at a frustratingly slow pace. As a result, despite the headline improvement, the report may not significantly ease concerns about inflation's persistence, especially in light of recent trade policy shifts that could reignite price pressures going forward.
Tomorrow morning, kicking off things on Wall Street with JP Morgan. In just a moment, 8 minutes away, you'll get US CPI, the latest read on inflation data in America. Mike McKee joins us now for a preview. Good morning, Mike.
Good morning, John. Well, coming into this, everybody's kind of expecting a little bit of good news, drop in the year-over-year rate of inflation for both the headline and the core. The core is going to get a lot of attention because people are going to want to see what happened in terms of prices during the month of March. We did have some tariffs on. So did they affect particularly goods coming in from China, apparel, furniture, toys? And we'll keep an eye on that for you. And then jobless claims have just been a good news story ongoing, even though we've seen all these reports of layoffs from the federal government. And now we're beginning to see them from companies. So what is the status of the labor market? That's another one to watch because Fed officials are saying labor market's okay. They're on inflation watch. Let's see if the data give them anything to watch today.
Mike, Fed officials did not blink. And a lot of people frame the situation they're in at the moment as facing upside risk to inflation and downside risk to growth. And they seem to be very keen over the past few days to really lean into the idea that they are going to anchor inflation expectations. That seemed to be the priority of Chairman Powell going into the weekend. When do you expect this inflation data to change, Mike, in the months to come off the back of some of the announcements we've seen from the White House over the past few weeks?
Well, we could start to see it this month in the April data if we see prices go up for goods coming in from China, because remember, he raised tariffs on China in February, so we could see an impact there. But it would probably take another couple months before the rest of the world gets to that point, because you don't know what people have in inventory and you don't know what is on its way and when it would hit the ports. But probably by the June meeting, the Fed would have an idea of where they're going.
And there's a meeting between now and then. Mike McKee, appreciate it. May 7th is going to be an interesting one, Lisa, for this Federal Reserve. A Fed official you follow closely, the San Francisco Fed President Mary Daly, making the point that she believes the policy is in a good place.
Yeah, because they cut by 100 basis points, it still is, less restrictive, but at the same time, it's restrictive enough to bring inflation down. There is dissonance for them, because on one hand, they're looking at companies that still have pretty healthy situations with consumers that are still spending, but they have to project forward at a time where that's unknowable. Erica Najarian was saying that, if next year isn't 5 minutes from now, which might not be desired. Actually, I think it would be very desired for a lot of us, and it's sort of hard to see the path from here to there.
And we see the release of the US CPI data for the month of March.
Look at the headlines this morning. You have China coming out
and saying,
actually, we're going to ditch some of our U.S. soybeans and we're going to lean into Brazil.
With a range of 2.8 to 2.5%
and guess what the U.S. government had to do? Trump's administration, in that time around, they had
US
to go
CPI
to
month over
Congress
month
and ask for a
forecast
bailout for our farmers.
0.1%
So
on
if
the
you're
prior
the Federal Reserve,
0.2%, with a range of 0.3 to 0% expected. Core CPI year over year forecast 3% on the prior 3.1%, with a range of 3.1% to 2.9% expected, and core CPI month over month forecast 0.3% on the prior 0.2%, with a range of 0.5% to 0.2% expected. We also get the release of the weekly initial jobless claims number, forecast 223K on the prior 219K, with a range of 230 to 215K expected. Continued jobless claims, forecast 1.884 million on the prior 1.903 million, with a range of 1.92 to 1.86 million expected. As well as this, we get Canadian building permits month over month, forecast minus 0.5% on the prior minus 3.2%. A quick note from UniCredit ahead of this CPI release. They note that the March CPI report is expected to show that while headline inflation remained relatively mild, rising just 0.1 to 0.2% month over month due to a sharp drop in gasoline prices, underlying inflation pressures were building. Core CPI likely accelerated to 0.3% month over month from 0.2% in February, with the year-over-year rate holding at 3.1%. UniCredit note that meanwhile, headline inflation likely eased to 2.6% from 2.8% annually. The uptick in core inflation appears to be driven by rising core goods prices, influenced by front-loaded consumer demand and newly implemented tariffs on imports from China, Mexico and Canada, as well as key industrial metals. Additionally, UniCredit note that strong early-year wage growth likely fueled a pickup in non-housing core services inflation, while housing inflation remained stable due to its usual lag adjustment. With inflation still above the
Voice News disconnected.
The hold rate steady at its May 6th to 7th meeting.
top names at the Fed are on Bloomberg.
I do know that consumer sentiment has started to take a dip. The question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy, that as how it played out for most of the pandemic? Right now, it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Nobody covers the Fed like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry.
Social says the big beautiful bill is coming along really well.
Like
Republicans are working together nicely.
IQ, Mondays on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, former Treasury Secretary Larry Summers of Harvard on the consequences of the Trump tariffs. Ambassador Richard Haas of Centerview Partners on the TikTok deal, where President Trump might need to look to get the money to put into his sovereign wealth fund. And former Transportation Secretary Elaine Chao tells us how to fix the air traffic control system.
Reorganize the structure.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Inflation data in America
2.4%, 2.4% lower than forecast, 2.5%. Month over month coming in now minus 0.1%, minus 0.1%, that's lower than forecast, 0.1%. Core CPI year over year 2.8%, 2.8% lower than forecast, 3%, and the core CPI month over month at 0.1%, 0.1% lower than forecast, 0.3%. Initial jobless claims 223k, 223k as expected.
John. Well, we come in much better than expected on headline CPI and a little bit better than expected on the core up. By 0.1%. The forecast was
to the markets, bit of weakness in the dollar, strength in the S&P 500 again. The headline and core CPI numbers coming in lower than expected. The jobless claims as expected.
Headline goes down by 0.1%, and that pushes the number to 2.4% on a year-over-year basis. We're getting very close to the area in which the Fed thinks we should be, what they're looking for. Jobless claims right on the screws. Forecast 223,000.
Short-term interest rate features rise after the data as traders add to bets on Fed rate cuts following the cooler than expected CPI numbers.
50,000, and that is a bit of a decline from 1,893,000 revision to last week. So are we getting any kind of pop from this, John? I'll check the details here while you...
We're seeing some moves, Mike, but in the bond market. So yields down at the front end of the curve. We're down 9 or 10 basis points. Your 2-year at the moment back to 381. But the volatility we've seen at the front end of the curve has just been unreal. As we mentioned a few times on this program yesterday, a 38 basis point trading range intraday at the front end of the curve. This morning on 10s, we're down about 4. So off the back of that, you unlock some dollar weakness, euro strength. Euro dollar now highs at a session through 111, 111.22 at the moment on that currency pair. Equities, the smallest of bounces. At the moment, we're down about 1.4%. Mike, as you go through the details, when you get softer prints like this, just to frame things, typically we'd have a conversation about the Federal Reserve maybe getting some confidence to reduce interest rates even more. But Mike, this time around, I just get the feeling that for the Federal Reserve, they've just got to wait a whole lot longer to see how these policy changes of the past few weeks bleed into the data in the coming weeks and months.
Absolutely. This is backward looking.
For those users that were monitoring the calendar at the time of that release, apologies for the delay with the data appearing there. We did experience some technical issues.
It's good news. It shows that they were on track. Remember, they were telling us that we were going to get down to 2%. They'd leave rates where they were, and that would put pressure on inflation. So to the point of Trump putting on tariffs, they were making progress. Now the question is, what happens from there? And speaking of Donald Trump, here's something that's not necessarily
CPI minus 2.243%,
gasoline prices went down during March, and that held the headline number down to a 0.1 decline. But food prices went up by 0.5%. Food at home by 0.5%. So people are going to go to the grocery store and say, "Well, we're not seeing inflation relief here," and the president promised that. That's something they're going to have to deal with.
Mike McKee on the latest data. Mike, we'll come back to you in just a moment. Stay close. Torsten Slok of Apollo joins us around the table. Torsten, good morning, sir. It's good to see you.
Morning.
Can I ignore all that?
Well, this is a Goldilocks starting point for the Fed, at least. I mean, the dual mandate says inflation should be 2. We moved a little bit more in that direction, better than expected. And on jobless claims, we also had a labor market that still is reasonably
so US
strong.
Supercore CPI year over year again at 2.86% on the prior 3.78%, with the Supercore month over month at minus 0.24% on the prior 0.22%.
Could still add as much as 1 percentage point to tariffs over the next, to inflation over the next 12 months. So in that sense, this is backward looking, as Mike is saying. The risks are, of course, that there's now more upside coming to inflation.
So this is the issue, and it's a sequencing issue, and I'd love to get your thoughts on it. So sentiment's collapsed, basically created over the past few months. What we've started to see with CPI is just a bit of softness. That's encouraging. How long before we see the weakness in the output data, before we then see the higher prices in months to come? What comes before the other?
Well, let's think about how companies might respond to this. So now you know tariffs are coming. For example, if you think about Amazon, of the sellers on Amazon, 71% they source their goods in China. So one very important aspect is that it will be visible for everyone that prices are going up on things that are imported, of course, from China. So the conclusion to your question is, how do you respond to that? Do you take your existing inventory and sell that at the old prices? Do you take your existing inventory and raise the price immediately? That profile will probably be individual for different companies, depending on the competitive situation, which sector they're in, how sensitive they are to tariffs. So we just don't know yet what the impact will be and how quickly this will feed through. But we do know that higher prices are coming as a result of goods coming from China becoming significantly more expensive. So even if companies decide to sell the existing inventory at the old price, we will over time see some upward pressure on goods inflation coming from this source.
Is there a risk that we ignore this data at our own peril? The idea that actually lower energy prices are giving more disposable income to consumers to potentially go out there and buy, and then, oh yeah, it's also an offset for a lot of potential producers in the US?
After the March CPI data, again, that's a cable up around 1%.
But the other thing, of course, is that the whole surrounding sentiment around what's been going on is that we literally went from the last few days from nuclear winter to now back to talking about stagflation. And stagflation has these risks, of course, that you have headwinds from consumer sentiment being weak, corporate sentiment being weak. If you look at the Fed surveys for capex planning, they are really beginning to turn south. So companies are beginning to pull back more, likely because of the uncertainty. And let's not forget, we still have a $5 trillion net wealth effect on consumers from the stock market going down. So if I add this whole list together of weaker corporate sentiment, weaker consumer sentiment, tariffs coming, and a negative wealth effect, and on top of that also retaliation from foreigners who might be doing things to us simply because of the trade war, that brings you a fairly long list of downside risks to the outlook overall.
Which raises this issue of how we even game out the idea of inflation. Why potentially are we not talking about deflation or disinflation? And I say this given the fact that we see Walmart, for example, saying that they are going to invest in price competitiveness. Basically, they're going to absorb all of the costs from tariffs. At what point could potentially the lack of demand be the main story more than inflation?
And that's why the key issue here is who is going to absorb the increase in tariffs? Who's going to absorb the price increase in goods that are coming here, in particular from China? Is it going to be consumers that will face higher prices? Or is it going to be taken out of margins? Will the E in the PE ratio go down as a result of this, as companies such as Walmart, Costco, and of course Amazon begin to say, well, maybe we are going to absorb some of this. And that remains to be seen exactly. Maybe it's going to be split across corporate and across consumers. But the bottom line still is that someone has to foot the bill.
Traders boost bets on a full percentage point of Fed policy rate cuts by the year end.
The president privately acknowledged that his trade policies could potentially lead to or trigger a recession, but he said he wanted to make sure it didn't cause a depression. Where are you now in terms of potentially having a recession this year?
So, of course, the last few days, it was pretty clear that there would be a sudden stop in the economy where prices would go up significantly, literally on all trading partners and everything coming in. So that was a scenario where a recession was very likely, almost at 100% where we came from. Today, the recession probability is probably 50-50%, meaning we think that there is still a likelihood we will have a slowdown. But the risk is we just don't know what the response is going to be from consumers, corporates, how much will markets go down further. In particular, this wealth effect on its own. Think about how we normally talk about when the stock market is going down.
TASS News reports that Russia and US talks in Istanbul are over.
How do consumers react when the stock market goes down? Here on its own, the stock market down now $5 trillion so far, and of course now it's rebounding and then coming a little bit back again. That's on its own a fairly significant hit to consumers and the wealth effect for the consumer outlook.
We still don't know what the policy will be in a few months' time, including the tax code. This came from the president just moments ago.
Keep in mind, Amazon CEO CEO, currently speaking in a CNBC interview, says we're doing everything we can to keep prices low.
The biggest tax cuts in U.S. history getting close.
Well, it's because yesterday they had to pull a vote to vote on the budget resolution from the Senate in the House because fiscal hawks are saying that Senate bill doesn't do enough for cuts. So what's happening this morning? Speaker Johnson, leaders
ago, we just had CPI data. Let's bring Mike McKee back in for an update. Mike, you've had a second look. What stands out?
Well, a couple of things, John. We talked about grocery prices, and meat prices were up 1.1%. Chicken prices were up. Pork prices were up. So people will really be noticing it at the meat counters in their stores. More bad news for the president. He'd been bragging about the price of eggs coming down, but they rise by 5.9% on the month, which puts them up 60.4% for the year. Last month, it was 58%. So egg prices are going back up. Now, the China impact, perhaps. We saw furniture prices rise on the month, and that is something we get a lot of from China.
Punchbowl reporter on X, following up from earlier, did say that they expect U.S. House Speaker Johnson and Senate Republican leader Thune press conference this morning. They're now putting the time down at 8:50 a.m. Eastern Time. That's today in around 10 minutes.
Because Christmas and Hanukkah are behind us. Smartphone prices, surprisingly, go down by 1.1%. So maybe that's an inflation number that is coming, but is not there yet. The big well, let me do housing because everybody follows that. Owner's equivalent rent up 0.4. That's a rise of 0.1%. So I was going to say the big thing that people are going to be watching going forward is energy prices, which were down 6.3% for gasoline. If that continues, it takes some of the edge off the food prices, and it does help the administration's case a little bit. But all in all, this is sort of a mixed report. The things that we thought would go down, airfares were down 5.4%, did go down. Some of the things we got from China did go up, and that's something that could continue with the big tariffs that they now have.
Mike, thank you for the update. Mike McKee there, following inflation data about 10 minutes ago. David Kelly of JP Morgan Asset Management joins us now for more. David, welcome to the program. How encouraging is that data this morning?
I don't really think it changes the narrative much. I think, Mike McKee was pointing out that airfares are down 5.4%. Actually, lodging, hotels and motels and so forth, was down 4.3%. So I think what we're seeing is a lot of softness in the travel industry, which I think is going to get worse over the course of this year.
Amazon CEO says, I think sellers will pass costs on to customers.
Storm. We're going to get some higher inflation out of the tariffs. I mean, remember, we left the 10% universal tariff in place. That's a lot higher than anything we've seen really for decades. So that's high. And then, of course, there's enormous tariff on China, which is going to clog supply chains and push up prices too. So I think we will get some inflation there. But what I actually see in the data, looking particularly at the travel numbers, is a sort of a deflationary tinge to the economy or slowdown tinge to the economy already. So, I'm glad that the market rallied yesterday, and I'm glad that we've
Treasury two-year yields fall 10 basis points on the day now to around 3.8%.
We are far from out of the woods here. I think that these data do sort of still suggest that there is a slowdown coming in the economy.
So the slowdown is what worries you more than the inflation, David, if I'm hearing you correctly, at a time where CPI just came in, when you strip out energy and food at the lowest level going back to 2021. Are you saying that that's really what markets ought to be focused on, both bond and stock?
Yes, because people talk about stagflation all the time, but really it's always inflation stag. You get the inflation first, and then you get the stagnation. And the problem is that with the labor supply falling away, with these impediments to trade. With cutbacks in government spending, government grants and so forth, a lot of fiscal drag this year. I can see a lot of things that are going to slow the economy down. We'll get a temporary surge in inflation from this, but I think we're going to be left with a pretty stagnant economy afterwards. And the real question is, does that revolt in the House yesterday in terms of House members who are fiscal hawks? Is that really something or not? Are we going to have a bigger deficit in fiscal stimulus next year or not? If we have fiscal stimulus, then I start worrying about inflation again. But in the absence of major fiscal stimulus, I think people need to worry about recession more than inflation here.
Are bonds still the best bet? U.S. Treasuries in that type of scenario, recession, comes very much back on the table.
Well, yes. I mean, I think that, first of all, I think long-term interest rates at 4.2%, 3%, 4.2% on a 10-year Treasury. I think that's fine. And I think people need, I'd be level weight in fixed income. I realize that we may have a mild recession here, but, longer term, whatever recession we have, we'll pull out of it again. And these bond yields are reasonable for the long run. I don't expect inflation to hang around the long run because, we'll get these tariffs and then tariffs just don't work and eventually we'll pull back from them and that'll actually have a deflationary impulse in the economy. So long term, I'm not that worried about inflation. I am worried that there won't be much dynamism about the economy overall.
David, appreciate the update. I know you're busy this morning, so thanks for making time for us. David Kelly there of JP Morgan Asset Management. If you are just joining us, downside surprise on CPI. Market just kind of looks through it. Equities still session lows. We're down by 2% on the S&P 500. There is a bit at the front end of the curve. You see yields falling back by 8 basis points at 383 on a 10-year. And in the FX market, that unlocks further dollar weakness. Euro dollar through 111. We're at 111.15. Torsten Slock of Apollo is still with us. Torsten, David Kelly, calm before the storm. Focus on a growth story more than inflation. Do you agree with some of that?
Well, I'm not so sure. I mean, the last few days, the Fed has made very clear that they will also be focusing on inflation. So the real big question for them here is, do they want their legacy to be Arthur Burns or do they want their legacy to be Paul Volcker? Because if they walk out the door and have allowed inflation to be a lot higher, then of course they will have a serious risk. So I do think that this becomes a very, very important debate inside the Fed in terms of what weight should they put on the dual mandate when one side of the dual mandate says the Fed should be cutting, namely growth, and the other side of the dual mandate, inflation, said they should be hiking.
It's difficult to read minds, but based on the communication of the past week or so, do you get the feeling the weight of history is on their shoulders?
Because I do see some finer nuances between what's being said, in particular compared also with Jay Powell last Friday. Very importantly, can they get away with just saying, oh, we're going to cut because long-term inflation expectations in markets
Amazon
are very well
CEO Jassy
anchored?
says,
Because
I haven't seen a meaningful impact
going
yet
up quite
from tariffs.
significantly, both in the short term and in the long term. So it really becomes a matter of where do they put their weight when it comes to inflation? Is it on actual incoming inflation or is it on some measures of inflation expectations which are well anchored?
But Torsten, you said it earlier. You have tariffs still in the pipeline. Can they do anything until they actually understand the rules of the road?
I think they do the same calculations, of course, that the street is doing in terms of the impact on inflation is between half and a full percentage point higher over the next 12 months. Then I do think that they come to the conclusion that the forecast is saying inflation is going up, and therefore it's going to be difficult for them to signal a lot of rate cuts. So that's why the market currently pricing 3 cuts. It does make sense that we have a modest amount of cuts, but not that, even if growth does last to slow down more meaningfully.
Do you have a sense of how close they were to intervening with the Treasury market yesterday?
I don't know the answer to that, but I do know that they bought $100 billion during COVID, of course, in March of 2020, every single day in the Treasury market. And I do guess that they were probably worried that they would have to take out some of the same tools if this were to continue. So if both it was caused by Japanese sellers, if the sell-off in rates was caused by risk reduction in asset managers, and if it also was caused by the basis trade unwinding, that combination and the fact that we don't even know which of these things were most powerful just still created a significant amount of risk to financial stability if this were allowed to continue.
Do you think people are trying to drift away from dollar assets? Do you see that building over the past week?
I don't see that because the dollar would have gone down a lot more in the last few days than it actually did. So there are some discussions around maybe China or others were selling in custody holdings and just kept the money in dollars and didn't sell it and took it back home. But nevertheless, the fact that the dollar index just moved relatively sideways, the yen did appreciate, suggesting that it's correct that there might have been some Japanese sellers. But broadly speaking, the DXY index on my Bloomberg screen was relatively flat for the last few days, suggesting that this was not a questioning about U.S. exceptionalism. I still think the U.S. is exceptional, still the most dynamic economy, still the biggest financial market. We still have, of course, a lot of investors that are looking here to come and invest, and that does make sense. We just have, at the moment, some turbulence, of course, that people are thinking about, that this is probably mainly viewed as a short-term quibble in markets.
I hope you're right, Torsten. Well said. It's good to see you, as always. Torsten Slock there of Apollo. Equity futures at the moment down 2% on the S&P. The opening bell is about 43 minutes away with an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Just to recap the most recent data, March headline and core CPI both rising less than expected. A softer print with markets weighing the whiplash from the White House. The data is a welcome signal for the Fed. The central bank so far has been saying that it's prepared to stay on hold as it awaits any inflationary impacts from tariffs. And we have a deal in the luxury retail space. Prada is buying Versace from fashion conglomerate Capri Holdings. Prada will pay $1.38 billion for the company. Capri said it will use the proceeds of the sale of the business for investments, debt reductions, and stock buyback. Now, ahead of President Trump's tariffs, Apple flew as many as 1.5 million iPhones to the U.S. from India after it ramped up production in the country. Reuters reporting that Apple chartered several flights to transport 600 tons of its flagship product. Analysts have cautioned that iPhone prices will surge if the tariffs on China remain in place. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the program, we'll set you up for the day ahead. Live from New York City, you're watching Bloomberg Surveillance.
In case you missed it on the close.
I think our sports fund.
So S&P 500 futures down 2.2%, NASDAQ futures down 2.6%, Dow futures down 1.6% there, erasing the gains from the core CPI numbers.
About 50% plus. So what you find in new leagues and new teams is if you're
so in 10 minutes time now at the top of the hour, Bank of England's Breeden speaks at a Market News International event on UK economic and financial stability prospects. There's a registration link pinned to their entry on the calendar if anybody is interested.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
no, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll try it offline.
Don't miss the close, live every weekday.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Downside surprise on CPI. This equity market not taking comfort from that. We're down by 2.2% on the S&P. We're down 2.8 on the NASDAQ. As we count you down to the opening bell, should we get you some movers? We can get those movers right now. Let's cross over to Danny Berger, I believe, for more. Hey, Danny. No, Danny. Let's get to your trading diary. At 1 p.m., the U.S. Treasury auctioning $22 billion in 30-year bonds. At 4 p.m., President Trump participating a bill signing. On Friday, PPI and UMich sentiment, plus bank earnings kicking off with JP Morgan, Wells Fargo, and Morgan Stanley. On Monday, Goldman Sachs earnings. Tuesday, Bank of America and Citi reporting, plus United Airlines results after the closing bell. One thing that is happening right now, I'm pleased to say, Speaker Johnson and Leader Thune will be holding a news conference, a briefing, any second from now. Tyler Kendall joins us from Washington with more. Tyler, what are you looking for?
Yeah, hey, John. Well, this presser comes after last night the House delayed a crucial vote on passing the Senate's budget resolution. At issue here is that fiscal hawks in the House don't think that the Senate's plan has enough spending cuts. The Senate plan calls for about $4 billion worth of spending cuts. You'll recall the House had wanted that number to be up to $2 trillion. Now, there is reporting that the two leaders could be announcing here a deal for $1.5 trillion in spending cuts. We'll have to see, because that is still going to raise some pretty big questions when it comes to what that could potentially mean for some benefit programs like Medicaid that really started this disagreement between the two chambers to begin with. John, these two chambers do need to ultimately agree in order to kickstart actually crafting the budget reconciliation process, which President Trump is really banking on because it's tied to his tax cuts.
Tyler Kendall, thank you with the update from the White House. Tyler, thank you so much. Anne-Marie, are we getting closer to this deal? How long is this going to take?
Well, obviously, having Speaker Johnson and Leader Thune come together and talk about potentially how they can bring both their caucuses together, yes, we are getting closer. But this is going to be so challenging, because say you have these fiscal hawks in the House that say, I'm not signing up for something until I see the Senate cut back on some of their spending. Well, then you're just going to have Republican senators saying, there's no way I'm touching anything close to Medicare. So you're going to have this dance back and forth for a while. Push is going to come to shove if they include the debt ceiling within the package, and they have no choice but to vote it. And also when Speaker Trump starts getting on the phone and pressuring these individuals to sign up to his plan.
The president says the biggest tax cuts ever. There's a big difference between extending tax cuts and delivering new ones.
These aren't tax cuts.
Are we going to get additional tax cuts?
Potentially. We'll get no tax on tips, maybe one other add-on, one other sweetener, but all this is an extension of current policy, which is why, I mean, Erica was talking about it earlier. This is all already baked in. There's nothing that exciting about this bill. I know it's one big, beautiful bill potentially for the president, but all it is an extension of current policy.
That would have implications for this big, beautiful bond market at the same time.
Very much so, because if you end up with a bigger fiscal deficit, then all of a sudden, how much does that become the main driver?
I
remember a long time ago, like 3 days ago, when people were actually talking about
UK economic and financial stability prospects.
Than they did tariffs. Well, that changed for a hot second. But now there's going to be also a focus on the fiscal sustainability, especially if there is Japanese selling, especially if there is potential aversion from international buyers. We've heard mixed things, but that, I think, will become very much to the fore.
3 days ago feels like an absolute lifetime ago. Just yesterday, the president backing down, authorizing a 90-day pause on tariffs and doubling down on China, 125% on China. That unleashed a major rally in the equity market, the biggest one-day move we've seen going back to 2008. This is what Peter Chia of Academy said this morning, a Liberation Day do-over, and that's exactly what it feels like. Where will we be 90 days from now? Will we have to have another pause for another 90 days? And what happens in between? This market is not paying attention to the economic data. A downside surprise on CPI, and we're taking very little comfort from it. Your S&P 500 is down by 2 full percentage points. Coming up tomorrow to continue the conversation, Cameron Dawson of New Edge Wealth will be catching up with us as bank earnings season kicks off. On Wall Street, we'll catch up with Gerard Cassidy of RBC. We'll speak to Sarah Hunt of Alpine Saxon Woods, and we'll catch up with Veronica Clark of Citi before we go into a much-earned weekend for you all. From New York City, enjoy the Masters at Augusta National. From New York, get some rest if you can. This was Bloomberg Surveillance.
All right, let's cut right to it. This is Bloomberg's new show, Primer.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
If you want to understand what's coming, you'll want to watch Primer, because details matter. So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
You just have to strategize with each other, with our team, with our agents, with everyone to figure out how can we package something that's going to be able to go straight down the middle and hit it out of the park. Because right now, people are going to be more adverse. We'll look at our slate, and while something was amazing 3 years ago and felt like we were going to be able to get it made, we have to figure out how to build off of that today. How can we make it feel more desirable? How can we make it feel more undeniable?
It's important to clarify that straight down the middle doesn't mean
bland.
No.
It doesn't mean for the most common denominator. It doesn't mean trying to make something for everybody, something that doesn't have edges or specificity. Straight down the middle almost means the opposite in this moment, right? It means so strategic, so specific, so clear. So I think one of the kind of unexpected, wonderful impacts of how challenging the ecosystem has become is that we have had to make sure that we are more committed to content than we've ever been before. Because the fight is so real that if we jump onto something or we develop something, we have no choice but to have to love it.
In case you missed it on the opening trade.
The president is speaking to this part of our population that we know did not benefit from globalization. You know, the IMF has been talking about those
bullish on
left
recent
behind
market volatility.
for decades.
Says so far we have
really
seen relatively normal market reactions. We monitor this carefully. It's business as usual.
President Trump is speaking to, but we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking, and this is going to unpick a lot of the fabric of the economy
And the
that we have
effective
seen
Fed
for the
fund rate
last
is
20 years.
unchanged
So
at
for me as an
4.33%
investor,
for April the
it's
9th.
really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
After the biggest rally in stocks since 2008, we are back down on futures. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, investors aren't letting their guard down as President Trump hits pause on tariffs for everyone but China.
Inflation unexpectedly cooled in March, offering some relief to consumers before tariffs filter through the numbers.
And CarMax joins a growing list of companies indicating that trade uncertainty is certainly making long-term planning difficult. All of that and more coming up. Let's take a look at what stocks are moving this hour ahead of the bell. Tesla leading the Magnificent Seven lower this morning, but that's after a more than 20% jump yesterday.
Apple has shipped about 1.5 million iPhones from India to the U.S. in an effort to beat President Trump's tariffs. This, according to Reuters.
And we're looking at guidance from companies. CarMax is out with earnings today. The firm is removing time frames for long-term goals due to broader macro factors. Katie.
Now, all of this stems from an unclear endgame for President Trump's tariff onslaught, which he partially paused yesterday. Let's take a listen to his rationale.
Well, I thought that people were jumping a little bit out of line. They were getting yippy, you know? They were getting a little bit yippy, a little bit afraid, unlike these champions, because we have a big job to do. No other president would have done what I did. No other president. I know the presidents. They wouldn't have done it.
Let's get the latest from Bloomberg's Tyler Kendall. She is at the White House. And Tyler, do we now understand clearly all the details of who will and who won't be tariffed with these reciprocal measures?
Yeah, hey, Matt, still some really big questions. And as Bloomberg Economic writes, these whipsaw movements do very little to bring down those record amount of uncertainty. As of now, the so-called reciprocal tariffs are paused, but we have to keep in mind that the 10% levy across the board is still in place. And of course, that 125% escalation against China. And then also Mexico and Canada didn't see any reprieve as part of this because they weren't a factor in that original reciprocal plan. Now, Treasury Secretary Scott Bessent says that this was the plan all along and that it shows that the U.S. is negotiating in good faith, but there are still some pretty big questions about what it actually takes to clinch a deal. Now, NEC Director Kevin Hassett, in an interview this morning, did give us a little bit more insight. He said that while more than 75 countries have reached out to the U.S., that he said that the White House was approaching about 20 countries who have made deals or offers to this White House that he called sensible. And he said to watch out for the non-tariff barriers.
Bank of England's Breeden says the latest developments have a material impact on economic outlook and risks.
Into these deals. So we're going to, of course, be watching that very closely. And Matt, just quickly, I'd also mention it's not just countries who are soon going to be negotiating, but also companies. President Trump yesterday was asked whether or not he would be interested in giving exemptions to some companies. He said that that could come down the line. But when asked what would be the determining factor for that, he said that he was going to trust his instincts.
Bloomberg's Tyler Kendall reporting from the White House. And of course, here in New York, we're watching inflation. Investors are keeping a close eye on CPI day. Inflation slowed more than expected in March. Let's break down the data with Bloomberg's Michael McKee in the last big report until inflation starts to hit the line.
Yeah, we didn't really see any impact of the tariffs in this report, maybe just a little bit, but we didn't see much movement in the stock market or the bond market afterwards either because people are looking through this. The Fed has said the labor market's in good shape, and claims gave us no reason to doubt that. Comes in at 223,000, not a big deal.
Bank of England's Breeden says we have seen substantial progress on disinflation.
But it's the CPI that people were watching, and it did come in light, down 0.1% on the headline and up just 0.1% on the core, pushing both numbers down into the twos, well into the twos for the headline, which ordinarily would be celebrated as progress for the Fed, but with the tariffs, we don't know what's going to happen. So what happened with the tariffs? Well, what we were looking for was to see if there was any change in the goods to services ratio because the tariffs are not on services. And we didn't really see that during the month. The blue line there is services. White is the goods prices. And goods prices stayed down. They have flattened out, but we'll have to see next month if they start to go up again. Where did we see the big movements? Well, we didn't see some of the China stuff you'd expect.
Says the world has moved on significantly since the March MPC meeting.
That's going to change a lot if we do continue these tariffs because of Apple. Furniture, though, comes from China, up 0.6 on the month. Apparel, up 0.4 on the month. But here's where, and this gets to what Katie was talking about, the inability of people to plan or the people who are reacting in advance. Airfares down 5.3%. Hotels and lodging down 3.5% as people apparently put stuff on hold while they wait to see what the impacts are going to be. And I know, Matt, you're going to care about this. The administration's been making a big deal out of eggs. Food prices went up 0.4, food at home by 0.5%. Egg prices went up, and now on the year they are up by more than 60%. Last month it was 58%. So the president is not keeping his promise to bring down egg prices.
Yeah, I wonder where he gets that data. He always says he's brought down eggs like 59%, but they seem to be the same price at the store.
Bank of England's Breeden says it's very unclear what the overall landscape will be for tariffs in the medium term.
Great breakdown, of course. And we were talking about it yesterday. It feels like any single data point that isn't
adding
real
that
time
the US tariffs are the biggest change in trade policy in a century.
In this market, let's take a quick check on futures right now. The S&P 500 lower by about 2% pre-market, but that follows a rally of 9.5% yesterday. Your best day since October 2008. That's after
Bank of England's Breeden says overall tariffs are likely to lower UK growth.
90-day pause on tariff implementation for certain countries. Let's talk about this all with Heyman Capital Management founder and CIO Kyle Bass joining us now. Kyle, it's great to have you with us. I know that last week on a competing network, you said that I think the tariffs are thoughtful. I think they will work. With that in mind, I would love to hear your thoughts on what you make of the tariff rollout.
Breeden adds that the impact on inflation from US tariffs is not clear-cut.
I'd use the same adjectives. I mean, look, and you got 75 countries to reach out to us in 2 days, and they're all the countries that matter minus China on a trade perspective. So, you know, it takes 90 days to sit down with someone and iron out something that isn't simply a tariff number. There's tariffs, non-tariff barriers, there's currency, there's all kinds of inputs to this equation. And so giving a 90-day reprieve while they hammer out trade deals is a good idea.
Kyle, we have had a lot of big multinationals pulling their outlooks due to this uncertainty, and then small Main Street businesses writing in en masse and saying it's just impossible to do business in
so
this
far, sterling
economy.
has not weakened
who are
due
these
to tariffs.
tariffs good
This
for?
could change.
It's more important to reset the trade relationships between the United States and the rest of the world. And I believe President Trump thinks that bilateral trade negotiations end up being better for the world's largest consumer, which is the United States. And so if we can get to a place where trade is more fair, then I think we can get to a foundation where we can where we can grow once again and grow from a much stronger foundation. These tariffs, these non-tariff barriers, the manipulation that's gone on against the United States for so long is no longer going to happen.
It's too early to call the overall
our trade
impact on
relationship with
inflation.
China is the one that doesn't look to have any off-ramps at this moment in time. But I can tell you that once all of these agreements get hammered out, the U.S. is going to be in a much better place.
Well, Kyle, to that point, I know that you're focused on China. Do you see any chance of a de-escalation? I know that you said that there isn't a clear off-ramp right now, but do you see any chance that things could cool down, or do you think that this trade war, specifically between the U.S. and China, is just getting started here?
Yeah, I mean, it actually got started back when China ascended the WTO, and China's been at this trade war with the United States for its entire ascension, call it 23 years. And so the U.S. has just figured out what China's malign intentions are. And we all know, we've seen their militaristic belligerence in the Second Thomas Shoal in the Philippines. We've seen it surrounding Taiwan. We've listened to the rhetoric of Xi Jinping, and we are now in a place where we're going tit for tat on tariffs, where I think China's made a grave error here. As you know, we only export about 140 billion a year to China, and we import, call it 450 billion from them. And so I think that if we're doing tit for tat on tariffs, then China loses, because there is no functional equivalency in the amount of goods and services moving back and forth. So we'll see what happens here. But I think it looks like we're in a game of we can call it a Chinese standoff, or we can call it a Mexican standoff.
US's Hassett says Trump has a good relationship with China's President Xi, but no talks yet. The National Economic Council's Hassett, currently speaking on Fox Business
Now. You're looking at two whales in the ocean going at it, and you do have investors getting increasingly concerned about a weakening here of Chinese currency in order
Bank
to
of England's
boost
Breeden
their
says
exports.
government bond yields
How
have
many
been
tools
volatile.
does China have really in order to fight the U.S. on this battle?
Yeah, I mean, you heard Treasury Secretary Bessent said they're playing a poker hand with a pair of twos. They've got a banking system that's 3.5 times more levered than ours, and they've only been at banking roughly for 20 years, like real banking. So they've got a system that's levered to real estate, and real estate in China is down 30 to 50%, depending upon where you are. So they've got an insolvent banking system. They've got runaway unemployment amongst your youth. They've got another 12 million kids graduating their universities this year. And so you've got youth unemployment, a banking system that's insolvent. You've got a real estate collapse. And so when you're asking me what tools China has, they've got a couple of places where they could really press us, right? One, believe it or not, we still have the majority of our active pharmaceutical ingredients for all antibiotics in the U.S. made in the city of Wuhan. Yeah, that's just it's a sad truth. And then on the finishing side of synthetic graphite, on rare earth minerals, if you remember back in our trade spat in 2019, Xi Jinping made a visit to where they do the rare earth metals finishings, and we haven't seen Xi since April 7th.
Bank of England's Breeden says there is high risk of sharp correction in risky assets.
See. We'll see what he does.
U.S. House Speaker Johnson repeats that he's committed to finding $1.5 trillion in savings.
Minerals, but this is something that our administration has thought through.
Well, Kyle, I wanted to talk to you as an investor now, too, because as Shonali mentioned, of course, China has been signaling that it'll gradually let the yuan weaken. And I'm curious how you're approaching that, whether you're seeing that as a trade and betting against the offshore yuan.
No, I think I'm not at the moment, but I would say that it is not under China's control.
UK banking system will still have capacity to support the economy, even if conditions worsen substantially.
And 98. it wasn't Thailand's decision to let go. It was Thailand running out of reserves. And so when you look at China and the offshore yuan,
and
in the
Hassett
end,
says, I'm confident the
China's
speaker will get the budget across the line.
that relationship. And China needs a strong yuan. They buy 13 million barrels of crude every day, 8.5 Bs of gas every day, and they buy 40% of their food every day in dollars. So if for some reason they have to let that relationship go and the yuan weaken, as we saw it weaken 2 days ago to its weakest level ever, we'll see if that
interview on Fox Business
relationship
has now
holds.
ended.
And my view is that when you look at the differentials in interest rates and you look at China's bond market, the one thing that can't be lying coming out of China is their bond market. Look at the Chinese 10-year; it's collapsed. So their economy is in a very different place than ours, and that relationship between the yuan and the dollar, and the Hong Kong dollar and the dollar, that's a tenuous relationship, and we'll see what happens.
Hey, Kyle, just quickly, what do you think the most they can allow the yuan to weaken is? I mean, where's the point where they have to step in and can't allow any more slippage?
Bank of England's Breeden says, we'll closely monitor the role of hedge funds in gilt trading and market-based finance.
A move from roughly 620 to 740 over a period of time. So, typically, again, when countries run out of reserves, as you know, the currency flaps in the wind. So there's this concept of them, quote, controlling where it is, and then there's the uncontrollable moves. And what we saw in the Asian financial crisis, even with the largest player back then was
and US
South
Senate
Korea.
Leader Thune says, I'm aligned with the House on finding savings.
Moves. And I think that's
so
coming.
They are currently having a press conference on the budget, and we have posted the video to that on the feed.
The interest rate differentials, the business cycle differentials are going to dictate the movements in the currency. So we do expect the Chinese currency to weaken pretty materially against the dollar.
Kyle, you are sticking with us. Of course, that is Hayman Capital's Kyle Bass. We're going to take a quick check on futures here before we head to break because, of course, you are seeing a bit of shaking off the exuberance you saw just yesterday. The S&P 500 futures down almost 2% ahead of the market.
US Senate Majority Leader Thune says a lot of senators see the $1.5 trillion savings as a minimum.
This is Bloomberg Open Interest.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation.
And the press conference with Johnson and Thune has now ended.
Global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bank of England's Breeden says markets have continued to function despite deleveraging and will continue to monitor this.
Transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India but to the planet and the world. And the world needs it now than ever before.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power
Some data
at
from
1 and 5
Alltex
Eastern,
Technologies. They
only
say
on
short sellers
Bloomberg.
targeting US companies with market caps greater than $1 billion lost $75 billion on Wednesday's market rebound.
And we're back now with Heyman Capital CIO Kyle Bass. Kyle, I want to talk about the tariffs that are still in place. Of course, we got the news about the 90-day pause on certain countries yesterday, but you take a look at what still stands. You have 25% on steel, aluminum, autos, 25% on auto parts starting from May 3rd. And I want to bring this to your home state of Texas. I know that you're a Texas guy, and you think about Texas's economy. There's a lot of car dealerships.
White
There's
House's
a lot of car
CEA Moran says we never thought we were headed for a meaningful recession.
What you think the impact on Texas might be?
Yeah, I mean, in the near term, the impact is going to be slightly negative, right? But when you think about the carve-outs, first of all,
US CEA's Moran says need to get regulations out the way so that companies can build factories faster.
Roughly 40% of those imports were already exempt from this new round of tariffs. You mentioned the 232 tariffs, right? Steel, aluminum, autos, auto parts, things like that. But I think it's important to understand that those 232 tariffs, Section 232 tariffs, were put on by Trump in his last administration. And if you remember, Biden ran on we're going to cancel the tariffs. In the end, what happens is when someone like China, a state actor, can act uneconomically or non-economically, and they can flood your market with steel or aluminum or synthetic graphite or anything like that. And why it's important is they can act for a longer period of time to put your businesses out of business. So they can take capacity utilization down enough to where they can literally turn our steel industry off, turn our aluminum industry off. So those tariffs are necessary, and those will live, and they will live into the future, and they may not be high enough. We must maintain domestic production of certain things from a national security perspective, and that's why those stand where they stand. For autos, it's just you see China building plants in Mexico and Canada, so basically to avoid the tariffs on their cars. And so our negotiations with Mexico and Canada are primarily on fentanyl, secondarily on Chinese transshipments, and we'll end up getting this right.
Kyle, even if you believe that the tariffs are ultimately necessary for the American economy, how much more pain do investors have to bear? Because you do still see the S&P 500 after yesterday's rally still down more than 7% this year. You saw the bond market whipsawing wildly just this week. How much more pain is there as this transition and this negotiation proceeds?
I think so. We need to separate a few things that you said. The bond market had a fit, in this sell-off, and it was largely due to it wasn't a basis trade. It's the fixed floating swaps, and I know that gets in a world that a lot of people don't want to talk about, but it was very simply a regulatory trade that bond traders had on, expecting banks' abilities to buy treasuries to increase. And then the tariff mayhem showed up, and that had to unwind. I think that had a lot to do with the crazy move in the 10-year. So I think things are settling down. But, as far as stocks are concerned, you've heard the president, you've heard the Treasury Secretary say, we have to make some difficult choices, and we must reset our trade relationships for the rest of the world. We also must narrow our fiscal deficit in the United States. And both of those things might be slightly recessionary. And if that's true, we might have to go through a brief recession in order to rebuild our foundation. And you say, how much longer can investors hold? Look, the market's not up and to the right, every year of every decade. And I think that this is a necessary resetting so that we can grow again in the future and grow more thoughtfully.
Kyle, as an avowed free market capitalist, I care mostly about myself, right? So the 2017 Tax Cuts and Jobs Act, President Trump punched me in the gut with a massive tax raise, right? Because he takes out all of a sudden this state and local tax deduction cap that's been in place, or it puts in a cap after we had a state and local tax deduction for 104 years. If I can get a discount now on my taxes because of Doge cuts or because of revenue on tariffs, I'll be happy. And you have said you think that Doge is going to cut $600 billion out of government costs and that we could raise $600 billion in revenue. Is that going to offset the tax increase that Trump handed me in 2017 somehow?
No, and look, let me begin by saying, Matt, I know you're out in things for yourself, and that's, I guess, what you care about. The good news is you and I and Wall Street are not setting trade policy for the world, because if all we did was open ourselves to unrestricted free trade, we'd all be speaking Chinese tomorrow. We need to be thinking about national security in the long run. On the tax side, there are going to be some tax breaks, but they are not going to be for the top of the scale. It's going to be focused more in the middle class. And as far as state and local deduction caps, I mean, it's interesting to see the migration in the United States. You live in a place that sounds like it has state and local taxes. One could say
we all pay property taxes, right? Don't you in Texas?
Yeah, we do. We pay property tax. But when you think about high tax, high cost jurisdictions that some might say are mismanaged,
US CEA's Moran says Trump's policies are working at keeping inflation at bay.
The South, to Florida, Tennessee, Texas, South Carolina. And that's where major businesses and people are moving. And so I think that tax arbitrage or movement is going to continue for the next, call it 10 years to come. And I think you're seeing people vote with their feet.
And I do want to defend Matt a little bit. I know you care about more than just yourself, but people care about their pockets.
In terms of the wealth of nations, right? Adam Smith, that's how capitalism works. Right. Every man for himself. That's how it's supposed to work.
Well, Kyle, with that in mind, I want to talk to you about you and your future, because Bloomberg reported in January that the Trump administration was considering you for a post at either the Treasury Department or the Defense Department. And I'm really curious, here we sit in April, are you joining the administration?
I mean, I'm going to go no comment there. It's not worth talking about unless there's actually a deal on the table, and there certainly is no deal on the table. My biggest regret in life is that I've never formally served our country. And if there's a place where I can serve it and it can work out in my life as well, then I'm always open. I've got open ears.
Well, definitely come back if and when you do have a deal. But I also have another question, Kyle, for you about you and your portfolio. When you look at this market, how do you play this? What are the trades that you would put on right now?
I think when the market's down 20, it's year to date, which was, I guess, a couple of days ago. I think it's an overreaction. But when I think about the coming GDP prints, you're going to see a recessionary impulse. You're going to see a slight inflationary uptick on a couple of goods that ended up in the tariff melee.
But in 5 minutes' time now, at the bottom of the hour, we are expecting comments from Fed's Logan. Fed's Logan due to be giving welcoming remarks at a Dallas Fed event called Outlook for North American Trade and Immigration.
So I think 6 months from now, the market's going to be in a much better place. And that's with the caveat of if China doesn't attack Taiwan.
There is a registration link pinned to Logan's entry in the calendar if you did want to watch this live.
I think things are going to look better in the next 6 months. If China invades Taiwan, I think all bets are off.
All right, Kyle, we got to leave it there. You've been very generous with your time this morning. Really appreciate it. That is Heyman Capital's Kyle Bass. Hope to speak to you again soon. But let's check on these futures ahead of the opening bell. You're seeing a little bit of a give back when it comes to the S&P 500, down about 1.6% at the moment. You can see that similar move is reflected when you take a look at big tech, when you take a look at small caps. But certainly, you guys, we saw quite a pop yesterday, if you can call it that.
Yeah, insane. I mean, the biggest since 2008. Right? 9.5%. It was, I don't think, a huge surprise that Trump blinked in terms of tariffs, but it was definitely a massive rally. Still doesn't bring us to the 5,500 level, that Wall Street bear, Morgan Stanley's Mike Wilson, said was a floor.
Yeah, and it didn't reach the second floor, though. I think that's another silver lining. We never hit that 4,700 level that he was talking about breaching and causing much more damage.
Well, the day is young. Markets aren't even open yet, so who knows what will happen. But less than 4 minutes to go until the opening bell. We'll kick off the trading day with Morgan Stanley's Andrew Sliman. This is Bloomberg Open Interest.
Asia is a continent of contrasts. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
If NASA is designing a lander, their approach is they're designing a Formula One car. So we take, say, a Jeep approach.
Minso, give us a sense of how you translate Korean architecture for the rest of the world.
We call this madang. In general terms, it's where we can be ourselves, where we belong.
There is an old saying in Korea that says, "거미 불루, 화이 불치." It means simple but not humble. So it has a tremendous impact on Korean architecture.
People tend to think the robot AI taking the job from them. We want to use the robot as a basic asset, meaning people have
We're shortly expecting comments from Fed's Logan, who gives welcoming remarks at a Dallas Fed event. Again, the registration link is attached to their entry in the calendar. Also at the top of the hour, so at the bottom of the hour, do get the US markets open and the markets on open imbalance.
Discover Asia's next-gen technologies on Momentum.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Tom McKenzie in Frankfurt. This is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest.
So we're looking now to the market on open imbalance. S&P 500 sell side 825 million, NASDAQ 100 sell side 37 million, Dow 30 sell side 154 million, Mag 7 sell side 35 million. Text release from Fed's Logan now. Important to keep any tariff-related price increases from fostering more persistent inflation. Says if higher inflation expectations get entrenched, the road to price stability is longer and economic scars are deeper. Says for now, the stance of Fed policy is well positioned. Higher than expected tariffs would very likely raise both unemployment and inflation. Says financial markets have been volatile, and a sustained burst of inflation could lead to a rise in inflation expectations. Fed's Logan adds that inflation persistence will depend on how quickly companies pass through cost increases and if long-term inflation expectations remain well anchored.
Stocks to watch today, and in terms of the action after yesterday's indiscriminate buying, what are you seeing?
Well, we're seeing that there's still plenty of uncertainty out there. We had CarMax report earnings today highlighting that continued uncertainty. Even though we got a little bit of relief yesterday, the firm actually removing its time frames for its long-term goals due to broader macro factors. You can see that the stock absolutely getting punished right now, down 12, now 13%, Shanali.
Yeah, I'm looking at Apple here as well, getting punished once again this morning, down more than 4.5% at the market open. They have shipped about 1.5 million phones from India to the United States in an effort to beat President Donald Trump's tariffs, according to a Reuters report.
And let's get a check on the overall Mag 7 index. I think it's BM7T index on the Bloomberg terminal. It is down right now
Bank of England's
about
says the potential impact on UK exchange rate is one key uncertainty for my inflation outlook.
We're still looking at double-digit losses even after yesterday's big gains. Let's get a closer look with Caroline Hyde. She is, of course, the co-host of Bloomberg Technology, and she joins us here on set.
US stocks extend their fall with the NASDAQ down 3% out the gates here.
And not really giving up so much today in terms of the mega cap tech stocks.
I mean, considering it was the best day for Apple since 1998, and you're only down 3%, a bit of profit taking is going to be totally unsurprising. Same too with Nvidia, off by about 3%, having soared since May 2023, but still up more than 20%. Tesla up more than 20% as well, having its best day since 2013. These stocks ramped hard, even though they remain exposed to China. And this is what everyone's trying to get their grips with. Morgan Stanley saying with Nvidia, look, the tariff chaos isn't over yet for Nvidia in terms of the overall macro pullback that you might see in terms of spending spending on AI more broadly. You've got Apple. You were just saying, Shonali, what a fascinating story coming out of Reuters more broadly. 600 tons of iPhones managing to be shipped, all the memes about all of the aeroplanes coming over and on airplane mode. But all of this is just, do you like that? But more broadly, this is a company that's going to have to navigate how much really can they send and sell us via India. They still have about, what, 90% of their iPhones made in China, according to Dan Ives. You've got Dan Dolev thinking that's maybe about 85%, but whatever you call it, bulk being assembled in China, they've got to re-navigate. They ain't bringing their manufacturing to US for the iPhone.
We make a great point. I mean, Matt, you said that there was indiscriminate
Bank of
selling.
England's Breeden says it's not the case that I'm more focused on inflationary than deflationary channels for tariffs.
Are exposed to China. I want to talk about what's going on in China's stock market, though, because I noticed some of their e-commerce ADRs were popping this morning. What is the outlook there now?
Well, the consumer may be a little bit more buoyant if they get the stimulus that the government is now trying to navigate. If you're going to put this much pressure on a macro economy, well, you're going to get a macro response coming from the government trying to give the stimulus, and therefore PDD is going to go a little bit higher. These companies that operate e-commerce like Alibaba, maybe they will get a little bit more support. And of course, the local domestic EV makers, many feeling that there's going to be a flock to BYD, to NIO, if you're going to be a push against Tesla, for example, from a political standpoint. So maybe some of those domestic names start to rally a little bit, and that's why you're seeing like the Golden Dragon Index, the NASDAQ Golden Dragon, which is some of the top performers, the internet names in China, traded here in the US in terms of ADRs. That's on the higher side, even though the NASDAQ is pulling back.
You know, it's interesting. To make a case for Apple, for example, just yesterday, despite the China risk, that idea that Goldman dropped their recession
Bank of England's Breeden says the lack of a preset path for monetary policy in the latest minutes reflects the uncertain environment.
Recession all of a sudden because of a pause in tariff escalation, fine. But speaking to that pause, how are companies now navigating that next set of 90-day uncertainties?
Well, Apple's got to be rethinking how they, of course, use India, use Vietnam, use some of the other countries that they particularly outsource to. But what's so interesting in terms of the stockpiling that was done, how many more of these jumbo jets are we going to see full of iPhones?
US natural gas
when
futures extend losses on forecasts for mild weather and lower demand for the next 2
weeks. They
weeks.
did phenomenally well. Their quarter, 42% increase in revenue for their preliminary numbers. This is the chip maker for Apple. This is the chip maker for NVIDIA. And they saw a real push forward in terms of buying and trying to onboard and get your inventory in check. That's likely to continue into the next 90 days. So their next quarter is looking really rather rosy. Interestingly, analysts are thinking, look, in the longer term, the AI spend, the commitment that you're still hearing from NVIDIA, from the likes of, well, Amazon, for example, in an investor letter, we're likely to still see the AI trade work.
Caroline, great having you here with us today. Thank you so much for joining us, and we'll tune in to your show at 11. Joining us now is Andrew Sliman, Senior Portfolio Manager at Morgan Stanley Investment Management. And I guess, you know, your head, like all of our heads, must have been spinning yesterday. Even if you expected President Trump to blink, that rally was unreal. What do you make of it?
Look, I think there's more certainty. I know this is controversial. I think there's more certainty around the ranges the market will trade at today than there was yesterday at this time. And that is that 15% declines, they happen, not they're not that infrequent. You can have 15% declines, but 20% declines is when credit markets tend to seize up. And we got close, but we weren't at 20% declines, and the president pivoted. And because of, as he said, because of credit markets. So I think that puts a downside cap, somewhere at 4,900 on the S&P. I'm not, as I've articulated all year, I think this is a pause year for stocks, but I don't think it's going to be a real negative year. And I think the president just told you he's not going to let it get too negative yesterday and too many shorts. What I saw, the good news going into yesterday is at the beginning of the year, there was a lot of optimism.
Right.
Kind of strategists were predicting 6,700
US stocks extend their fall out of the open here, with the Dow Jones now down 2.01%.
Since last week, that's, as the market dropped, that's actually healthy. There's more pessimism. You don't want when everyone's optimistic, and that's what I saw at the beginning of the year. So I think it sets up better, but I still think, this is a trading year. It's not going to be a great year for equities, but what I learned yesterday is you got a president who doesn't want it to be too bad either.
Yeah, I like that framing. It's not going to be a great year, but it's going to be a trading year, and that certainly sounds fun for some people. With that in mind, I want to ask whether you would buy a dip here. You see the S&P 500 down about 2% at the open. You had Citi's Wealth Head come out and say, don't try to catch this knife. Don't buy this dip. Where do you stand, though, if this is a trading year?
Sure. So I'm really excited because on Tuesday morning, before this all happened, we sent out a commentary to our investors saying the market is down 15%. And based on history, because I don't think anyone really knows unless you have access to the Oval Office, you don't know what's going to happen. When the market's down 15%, the playbook
Trump says inflation is down.
To step up and add to your equity allocation.
So that's Trump on Truth Social citing the CPI report this morning saying inflation is down.
You should add more and down 25% even more, because at the end of the day, the returns off minus 15% declines or greater 1 year out are better than the normal average return for equities. So to answer your question is, I wouldn't be a buyer here, but if you miss that 15% first step, I think you might have a second chance. I think there's a good chance you'll have a second shot at it. I don't know if it's going to come in the next couple weeks, but usually the playbook, Sonali, is the market rallies off the low and then the VIX comes down, so the uncertainty recedes, but the market kind of bleeds back lower to a previous low. And if that's down below 15%, yeah, I think you'll have another chance. I just wouldn't chase it here after yesterday.
One question I have is how much you are watching the headlines. We were all sitting here yesterday morning when Donald Trump was tweeting about having to buy stocks or saying that you should be buying this dip, right?
Posting on Truth Social.
Right.
That was a huge moment.
Do you listen to that? Do you watch him post on Truth Social and follow him as though he's the one that's giving the ultimate financial advice?
Well, I mean, just think back to the great financial crisis of 2008. It was a snowball that politicians couldn't reverse because of all the internet connections of derivatives. They couldn't stop it. So it ended up being a very, very bad for the economy and very bad for the stock market. This is very different. As we learned yesterday, one politician can change everything. And that's what we learned yesterday. So yes, you have to have, you have to know what's going on, because this is the markets are being driven by what's coming from, the White House. So I think it is very, very important. And that's why it's my belief that we learned yesterday that 4,900 is probably a low level that won't be breached, because that's when markets tend to seize up down 20%, and we learned that the president doesn't want that.
Andrew, great to get some time with you today. Thanks so much for joining us. Morgan Stanley's Andrew Sliman, I guess, holding our hands through these volatile market times. Some more stocks, some more movers on our radar today. Prada agreed to buy Versace for $1.3 billion. Constellation Brands issued downbeat guidance due to tariffs and muted demand. And then tomorrow we get bank earnings. I got to pay special attention to all this stuff because I'm playing against Sonali a little later in the pointed quiz.
My poker hand has a flush in it.
Nice. I think you're going to win this. We're doing this pointed thing. You know what pointed is?
Yeah,
it's
I
like
love pointed.
A quiz on Bloomberg.com.
It's a new Bloomberg.com quiz. It involves leverage. It's super Bloomberg, but it's super fun.
All right, so we'll be doing that later on. And coming up, U.S. President Donald Trump says U.S. Steel should remain an American company, pushing back on its potential $14 billion sale to Japan's Nippon Steel. We'll have the latest with Joe Doe. This is Open Interest.
in case you missed it on Bloomberg Crypto.
We believed in crypto for a very long time. We believed in DeFi. When you look at DeFi and the power of that, I mean, it's really restoring the power back to the people. There's nothing that DeFi, there's nothing that cryptocurrency on blockchain can't do better, cheaper, in every way, faster, more transparently than the financial system that we have right now. There's not a Friday that goes by where I'm not chasing a swift wire transfer, hoping it comes in on, before the 4 p.m. deadline, or trying to send one out. You could transfer millions and millions and millions of dollars worth of Bitcoin overseas, while having a glass of wine with your wife at 11 o'clock at night. That's a beautiful thing. Our financial system in this country is antiquated. Our financial system in this country has been punitive to so many different people. And so we're reinventing the financial system. I'm all in, personally. I really, truly believe in this with every part of my heart and soul.
Don't miss Bloomberg Crypto live Tuesdays.
Today's CFOs focus on much more than revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has.
We're in an evolving business.
Our first job is to intimately understand and anticipate the consumer's needs.
We've been on a journey to be higher growth, more nimble, and more capital efficient.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this spring, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to?
The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Bank of England's prudence says today's move in the market prices has eased some of Wednesday's pressure on market functioning.
Action in focus this morning, and first up, Comcast getting downgraded to a sell over at BNP Paribas Exane. The firm citing earnings risks in areas such as advertising and media. Next up, we have Carnival actually getting upgraded over at Morgan Stanley. The analyst says that most of the bad news is already priced into cruise stocks, but you can see currently down about 8%. And finally, we have Ford getting cut over at Goldman Sachs. Ford is especially vulnerable to Canada's 25% retaliatory tariffs, since the majority of the cars that it sells in the country are manufactured in the U.S., Shanali.
And let's turn to another stock that we are watching, U.S. Steel, because President Trump says the steel maker should not be owned by a Japanese company,
says underlying market vulnerabilities have not gone away. We need to stay vigilant.
Bid for the steel maker. Bloomberg's metals reporter Joe Doe joins us
NASDAQ
at the
100
desk.
falls 3%
You're seeing a big
now.
drop-off, and the reason you're seeing a big drop-off is because you saw a big boost the other day when he called for a review of the previous CFIUS review, didn't he? It's confusing, the messaging.
I mean, you really cannot make this stuff up. I haven't seen anything like this. We've followed this since August of 2023, and it's been a wild story since then. Monday, when the president came out and did the order to re-review the CFIUS review, a day later, Ancora, the activist investor, says they're actually withdrawing their activist, trying to nominate the board and put in a new CEO. And it felt like, kind of for the first time, like since March of 2024, that this deal might actually have a chance. And you were talking to the people invested in the stock, and they're like, well, this is pretty good. And then after a great day in the markets, right, you know, the stock jumped up to $46 along with everything else. That's the highest we'd seen since March 2024. The president comes out in the Oval Office, and amid talking about steel generally, says this about U.S. Steel. And the stock immediately dropped off after hours by 16%. And I started getting calls and texts just saying, what the F? Right? I mean, this is really hard for investors to understand. The president has said, listen, I don't want U.S. Steel to be owned by a Japanese company or any other foreign company. He's made that clear. But the fact that in the background we had reporting that Lutnick was meeting with Nippon Steel and the activist investor, it felt very much like a Trump, let's get the deal done type of thing. But obviously he came out yesterday and said what was on his mind.
Well, I mean, I think it's pretty fair to say that on both sides of the aisle, steel is considered of national security interest, right? We have to have our own steel makers, but we do have others, right? We have Nucor, we have Cleveland Cliffs, we have Bethlehem Steel. So do we need to have U.S. Steel? Is that important for national security just because the letters U and S happen to be at the front of the name?
Listen, you don't want like a company to just go bust, right? And to be clear, U.S. Steel will not go bust if this deal doesn't happen. Like, this is not a company that, by the time the deal started to happen, it wasn't like U.S. Steel was where it was in 2015, there were serious questions about whether or not this company could survive. The company since then bought a bunch of mini mills down in Arkansas. They doubled the capacity down there. Investors liked that narrative. That narrative is what attracted so much interest in the market to buy the company. Listen, U.S. Steel is here. It is here to stay. The question is, how is it here to stay? Does Nippon Steel ultimately get this deal? I don't know.
Bruden says the recent bond market problems were in the U.S. markets in the first instance, would spill over to the U.K.
It's just that yesterday, the president came out for the first time in what felt like nearly 2 months and gave his latest opinion, which was Japan should not have a majority stake in this company. I don't know what to tell you guys other than it could change tomorrow or the next day, or he may actually just kill the deal. We just have to wait and see.
Well, we'll have you back when he does. I'm sure we'll see you again soon. Good luck covering the ins and outs here. That is Bloomberg's Joe Doe. Now coming up, investors hitting the brakes on CarMax after the company missed fourth quarter estimates and pulled its financial targets. We'll take a closer look next. This is Bloomberg Open Interest.
In 10 minutes time now at the top of the hour, we're expecting comments from Fed's Bowman in their Senate nomination hearing, as well as comments from Fed's Schmid as well. White House posts an order on modifying reciprocal tariff rates. So at the top of the hour, Kansas City's Fed Schmid is to speak on the economic outlook and monetary policy at an event in Kansas City. There's no indication whether there's going to be a text, but there will be a Q&A. As for Fed's Bowman, again, they are giving their Senate nomination hearing for their new position as Vice Chair for Supervision. A text and Q&A are both expected for Fed's Bowman.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. The names that move markets are on Bloomberg.
The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond.
Nobody covers business like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
This is Bloomberg Open Interest. Let's get a check on stocks right now. We're seeing down moves after the absolute hysteria that accompanied buying yesterday. The S&P was up 9.5%. The NASDAQ was up 12% and change. So these moves down, normally, 2.25% off. on the benchmark index would be a real problem, but they don't look so bad compared to what we saw yesterday, holding at 53.35. In terms of absolute levels, that's not great. Let me look quickly here at yields, because this is important to watch. We're going to talk to Richard Farley about leveraged loans and the credit markets. A lot of people talking about a potential train wreck there, but it looks like that's been averted as well. In terms of individual stocks, you can see we have moves down across the board here of the big heavyweights, NVIDIA and Apple, Ford and General Motors off, as well as Stellantis and Tesla. A lot of car stocks there because we want to highlight CarMax right now. That stock sputtering after pulling the timeline of its financial goals due to macro uncertainty. It also reported worse than expected fourth quarter results. Bloomberg's Craig Trudell joins us now, our global car czar. And Craig, I figured CarMax has an ace up its sleeve because prices are rising quickly, both in the new car market and the used car market. Do they not profit well from that?
I think that may be a big part of why we're seeing the reaction here, because you would have seen analysts come out and say, look, this could be a company that's essentially a refuge from all of this chaos when the new car market is going to have this big disruption, this big inflationary event. It's going to lead to a lot of consumers being priced out of the new car market. They're going to go to the used car market. And here's a company that's sitting on, an awful lot of vehicles that just got a heck of a lot more valuable. I think, of course, there's more to the story than that. It needs to go out and acquire more inventory for the used cars it needs to sell, and the wholesale market is going to be sort of turned on its head by all of the chaos that we've seen out of the Trump administration. So it's not necessarily as clean a story as it might seem to be, sort of on the surface.
Craig, what are the cross currents here? It's a great distinction to make between the used car market and the new car market. But ultimately, when you think about the state the consumer is in and potential pains, we're going to see it in the next couple of weeks from some of the big lenders here. Can consumers afford new or used cars with leverage in this coming environment?
That's a great question. I mean, just yesterday I saw a headline out of Edmunds, which is a car market researcher, where they noted that in the first quarter we saw a record share of new vehicle loans taken out that were 84 months or longer, and that is just sort of incredible. That I believe it was more than 20% of new vehicle loans taken out in the quarter were of that length of term, and so the consumer is absolutely stretched. We're seeing that in a lot of places, but in the car market in particular, especially since, to your question, the car market has never been sort of more unaffordable to the consumer than it has been the last few years.
Craig Trudell, our global car czar out of London, thanks very much for joining us. By the way, fantastic story by Gabby Coppola on the Bloomberg terminal about Audi's best-selling car. In the U.S., it's the Q5, right? A kind of compact SUV. But since it's put together in Mexico and they're not USMCA compliant, they're going to be a total of 52% tariffs on that vehicle.
That is quite the sticker shock.
That's unsellable.
So buying the tiny cars are not going to get you away from buying a more expensive car per se. Guys, can we check on these markets quickly? Because you were seeing almost every sector in the red today. Yes. A lot of negative feelings out there after that big rally we saw yesterday.
Indeed, you can see the S&P 500 down 2.5%, but still, that's not doing much to erase that 9.5% gain yesterday, though. As Shanali pointed out yesterday, we are still in the red for the year, Matt Miller.
Yeah, coming up in the next hour, Richard Farley joins us on credit markets. Did they almost seize up? Mandy Sue joins us on the options market. Plus, AOL co-founder Steve Case talks to us about venture capital. This is Open Interest.
have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld.
And coming up, stocks slide. A surprise slowdown in inflation does little to calm concerns that tariffs will bring lasting economic damage.
Another test comes tomorrow with JP Morgan, Morgan Stanley, and Wells Fargo all set to report earnings.
Plus, what does all this volatility mean for investment, innovation, and American competitiveness? We'll ask AOL co-founder Steve Case. All that and more coming up, but a check on these markets. The bounce down in effect right now. The S&P 500 down 2.6% on elevated volumes. The NASDAQ 100 down 3%. Just for context, you probably already know this. The S&P 500 up 9.5% yesterday. The NASDAQ 100 up 12%. So it's natural to see some of that enthusiasm drain out a little bit here. The 10-year yield is an interesting one at 4.3%, down 3 basis points or so. You really didn't see a huge reaction in the bond market yesterday to that pause that we saw from the president, Matt, at least in the Treasury market, certainly not relative to what we saw in the equity market.
Yeah, I think the Treasury market is the most fascinating, even though you have a big superlative on equity markets, right? We saw a 10% rally.
Yeah.
That's mind-blowing.
Yeah.
But more people have written in saying they're really concerned about the credit market, which is why I wanted to bring on our next guest. It's time for the Wall Street Beat. Credit is holding up seemingly well amid the recent volatility over President Trump's tariffs. That's according to Goldman Sachs chief credit strategist. He spoke earlier today.
Not all crises are credit crises. Violent as the price action has been, I do take comfort from the fact that the microstructure of the market, or the plumbing of the market, has actually held up very well.
Now, on the other hand, a viewer just wrote in and said, we missed getting hit by a train in the last 36 hours, but the long end direction of travel is likely to be up and up. Liz Truss moment is not hyperbole.
So on the 10-year yield is up and up.
That's, yeah, or the 30. That is a little bit spooky. Joining us now is Richard Farley, partner and chair of the Leveraged Finance Group at Kramer, Levin, Naftalis, and Frankel. He's also the author of a new book called Drop Dead, all about corruption in New York City during the 70s. We're going to talk about that book, Drop Dead. But first, on the credit market, my buddy who wrote in said, I'm really trying to unpack this in a quiet room devoid of emotion.
Oh, boy.
Yeah.
How bad was it?
Well, look, you can't watch the equity markets day to day. The bond market, the Treasury market's a little more sophisticated. The syndicated loan market's very sophisticated, right? These are institutional investors, professional investors, and what you've seen is a consistent pulling back of risk over the course of the year until there's resolution on the trade issue. And it's not just tariffs, it's trade holistically. And if you look at the 10-year, it has not been that volatile, but the yields have come down. Now, some of that may be flight to safety. The inflation prints have been pretty good. The syndicated loan market has traded down significantly, okay? In January, 78% of credits were at par or higher. Yesterday, even after the pause, it was around 3%. So that's a significant pulling back of risk. And it's the old story. If I have 10...
That's huge.
If I have 10 containers on the shelf and 9 of them are single malt and 1 is poison, you're probably not going to buy any of them until you know which one. And I think that's where the riskier end of the credit markets are behaving right now.
Well, one thing...
And it's a bifurcated market. If you're not overly exposed to trade and your fundamentals are otherwise okay, there's probably no better time to be accessing now, particularly with the large amount of dry powder in private credit that needs to be deployed.
We'll talk about the good stuff in a second because, of course, this is the environment where, like, Apollo, Oaktree, they do very well. But with that said, one thing Jamie Dimon said yesterday on Fox Business that caught my eye was that there are already hung deals out there. Banks tend to lose money on hung deals. There are quarters, guys, where J.P. Morgan brings in $1 billion in debt underwriting alone.
For people who don't know what hung deals are, like...
It's deals that they're not able to get off their books.
Okay.
Yeah, banks don't commit to these deals because they want to hold the loan in terms of LBOs. They want to distribute those loans to the market and make fees. Okay? Now, yes, there are hung deals in this environment because there's been a pause, but if you look at the size of that pipeline, it's relatively modest. It's about 10 to 20 billion. Okay? If you look at what it was in 2007, 2008, for example, it was probably 5 or 6 times that, and that's on a non-inflation
What was it in COVID?
basis. I think it was about what it is now. Okay? Now, if you look and see what happened to those deals that got hung, if you look at Twitter, if you look at the others,
took years to get past
it. If you were patient, you didn't get burned all that badly. If you panicked and sold into a bad market, you got hurt. So the good news is relatively modest pipeline, and 2, there's no systemic issues out there in the plumbing. You can afford to be patient. And I don't see this as a 2-3 year issue, right? I think this is hopefully going to resolve in relatively short order.
Well, Richard, one place where you are seeing a lot of selling is in CLOs. I track the ETF space really closely, and one of the hottest corners has been these CLO ETFs, taking in billions and billions of dollars. It's really been a one-way trade into these types of funds. That's reversed. We're starting to see, or at least prior to what we saw yesterday, we'll see how it settles out, but we start to see some cracks start to emerge if you take a look at NAV discounts and the like. What do you make of what's going on there?
Well, look, I think looking at a day-to-day fluctuation in publicly traded vehicles and NAVs is also going to get you a skewed result. I think you got to look at the market holistically. And again, the trend has been down, as we just discussed. But I think overall, it's a pretty stable base. And I think the fundamentals, once we get beyond these trade issues, are still strong. I mean, the employment numbers were great. The inflation prints are modest. The fundamentals are pretty good, given all that's going on in an exogenous sense.
Speaking to the bifurcation for a moment, because I do want to acknowledge once again, yes, it is a golden moment for a lot of people, but how many...
Golden age, I believe, is the term.
Golden age.
The president
golden
used.
age. Yes. But I want to point out that there is a lot of trouble under the surface. A lot of people are very worried about private markets, the flywheel effect. If things go wrong there, banks are still exposed because the banks lend to the private credit firms. So how many of your clients right now are calling and asking for restructurings?
We have not seen a huge uptick in that over the past couple weeks. So that really hasn't happened yet. I think it's more a pulling back of deployment of risk, much more so than people worrying about performance of existing credits. So I think the original issue deal flow is going to be subdued until these trade issues get resolved.
I do want to talk a little bit more broadly about private credit, though, because, you know, for those who don't follow it as closely as Shonali, there's just this lingering suspicion, worry that, you know, because we can't look at it so easily, we can't watch, you know, how it's trading day to day, that maybe something bad is brewing there. I mean, how are you thinking about those sort of high-level concerns that remain out there.
Well, given the talent of your reporters, the minute there's any hint of trouble, I'm sure it'll all be uncovered very quickly.
Right.
Look, these managers are regulated by the SEC. They report to investors. There are a lot of eyes on all these investments. And like I said, it's a professional market, and the people putting their money in, believe me, they're keeping a very close watch on all this. So I think if there's a systemic issue there, you're going to hear about it pretty quickly.
I want to ask about your book. So we're done. Let's put a bow on the credit thing and then move on, because this is your third book, dude. I've known you for 10 years. You've written 3 books in quick succession. This one isn't the same as your other 2, which were more Wall Street focused. This is about New York City.
Well, all of them are about a financial crisis of one form or another. And again, this is the 50th anniversary of the 75 fiscal crisis in New York City. It's a good time to discuss the issues. A lot of mythology out there. If you ask even an informed person about it, they'll say 2 things. One is President Ford told the city to drop dead, and Felix Roden came in and saved the day. Well, that isn't quite exactly what happened. Ford bailed out the city. He was always going to bail out the city, but he got blamed for it, and he got no credit for it because he was outfoxed by 3 Irishmen. One was Hugh Carey, the governor of New York. The other was Tip O'Neill, the House Majority Leader. And the third was a fellow by the name of John Patrick Scanlon, who was a PR genius and a semi-rogue. But again, the rogues back then were a lot more interesting and colorful than the rogues today. They hung out late at night. You could sit down with them, have a drink up at Elaine's today. The rogues are in bed by 11 o'clock and up at 6 a.m. doing Pilates. So, I mean, it's a much more treacherous world. But there are a lot of great characters, and it's a very interesting story. And when you see what actually happened, it's much more interesting than the myth.
Feels like the bonfire of the Vanities precursor moment here. You got the 70s, they've got the 80s down. But, you know, for you, a lot of people look at the 70s and say there are parallels to to today.
Yeah, look, if you look what happened in COVID, right, we all learned that, hey, you can do a financial services job anywhere. And the taxes and the weather are much better in Texas and Florida. So there has been a migration of jobs out. Now, the fiscal crisis was the migration of industrial jobs out of New York City. But now we're seeing the move of the financial jobs. And of course, the financial sector exploded at just the right time to save the city. Is there going to be something else that comes in to replace the loss of the financial jobs? And that's, to me, the biggest risk. So just keep an eye on that. And we were talking about Larry Fink and his speech at the Economic Club. He had mentioned that the growth in jobs at BlackRock had been disproportionately outside of New York. So that's what you need to keep an eye on.
There you have it. A lot of big existential questions there. Before we let you go, I do just want to ask about your process, because what is the size and scope? 3 books in how many years?
It's like 6 years, right?
Well, a little more than that, about 8 years.
You had Gonzo Wall Street was the last one.
Wall Street Wars was the first one.
Wall Street Wars was the first one, yeah.
Well, how do you find time? I'm asking actually for myself.
Right.
I'm working on a novel. It's fiction, though. How on earth do you find time?
Well, you need a respectable excuse to not spend time with your family. So writing a book is perfect for that.
All right, there you go. Richard, it's always great to see you. That is Richard Farley of Creamer, Levin, Naftalis, and Frankel, and the author of Drop Dead. Meanwhile, let's get a look at some of these stocks moving this hour, and we have to start with Apple. Reuters reporting that the company has shipped about 1.5 million iPhones from India to the U.S. in an effort to beat the tariffs, still down 3% there. You take a look at CarMax, you can see it is lower by 17%. We have been talking about how it pulled its long-term financial goals, and it doesn't seem like investors like that. And boy, we are just looking at U.S. Steel as well, also down 7%, the deal that never ends. This is Open Interest.
this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to? The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, former Treasury Secretary Larry Summers of Harvard on the consequences of the Trump tariffs. Ambassador Richard Haas of Centerview Partners on the TikTok deal, where President Trump might need to look to get the money to put into his sovereign wealth fund. And former Transportation Secretary Elaine Chao tells us how to fix the air traffic control system.
Reorganize the structure.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Let's get now to high interest. Look at what's making headlines around the world. White House National Economic Council Director Kevin Hassett says that trade talks with some U.S. counterparts are advancing well. He says about 15 countries have made explicit offers that the U.S. is studying and considering. Hassett did not specify which countries were involved in those talks. Now, it's a Bloomberg scoop. The Audi Q5 is the German brand's top-selling vehicle in the U.S., but now it's unsellable in America thanks to these tariffs. 3 separate tariffs hitting the model, with the total fee coming in at 52.5%. This car is emblematic of just how globalized automotive supply chains are. Some of the Q5's engines are sourced from Hungary, transmissions shipped in from Germany. Dozens of local suppliers provide other components. And the world's wealthiest people added $304 billion to their combined net worth yesterday after President Trump said it's a great time to buy stocks. In the largest one-day gain in the history of the Bloomberg Billionaires Index, we saw winners like Elon Musk, Mark Zuckerberg, and Jensen Huang. Katie?
Well, volatility remaining high today in these markets, despite plunging during that big face-ripping rally that we got yesterday afternoon. You saw a record $30 billion worth of shares traded, but the gains largely driven by low liquidity and also aggressive short covering. Joining us now for more on these market swings is Mandy Zhu. She is SIBO Global Markets Head of Derivatives Market Intelligence. Great to see you in person, Mandy.
Great to be here.
So we were talking about this sigh of relief, and we pointed to the equity market, but it was really a cross-asset move. Where did we see the most relief coming through?
Yeah, so yesterday's rally, not surprisingly, led to a decline in volatility across asset classes. You know, the VIX went down almost 20 points. But where we actually saw the biggest decline, what I thought was interesting, was from the credit market. If you look at our credit VIX index, VIX IG, which tracks the volatility in the CDX options market, investment grade, that fell by far the most and is trading just above its long-term average. So the credit market right now is signaling almost average levels of volatility, expected volatility going forward, which, given the backdrop, I think, you know, that move may be overdone.
So how are investors looking to play the future right now?
Yeah, I think, you know, what's interesting, well, the 2 things that I took away from yesterday's move. The first is just kind of how the incredible intraday volatility and how headline-driven we are. And I think that's going to really put upward pressure on volatility or help stabilize VIX at current levels. And the second thing I thought was interesting is, you know, for all kind of Trump saying that we don't look at markets, they obviously care, right? And that means potentially that some of the downside tail risk in the market that was really people were looking at may be reduced in this environment.
They reportedly were concerned about the 30-year yield jumping up above 5%. Have you noticed a lot more interest in the Treasuries market over the last couple of days?
Yeah, so we've seen incredible options activity in TLT, which is the ETF that tracks 20-plus year Treasury options. And actually, what's interesting there is for most of the past 2 months, TLT options were signaling more fear of downside in yields, so more fear of recession risk. And over the past week, that has flipped, so now that puts are trading at a premium to calls, signaling more fear for inflation. So that was a pivot that I thought was interesting. The bond market, up until very recently, more concerned with recession risk, now turning to focus more on inflation risk.
Interesting. I mean, we got CPI this morning, and it was pretty quiet, but as we were talking about with Mike McKee, it feels like everything that's not real time is stale. We're finally showing the VIX IG there, and you can see that real sigh of relief really coming down. But I want to talk about where we stand right now. You mentioned the flip that we're seeing when it comes to TLT positioning. Where else have we just seen a washout? I have to imagine that a lot of people were just blown out of positions yesterday.
Yeah, so I think, again, I mentioned volatility declining, just collapsing across asset classes. To me, what really stands out in this environment, I think short-term vol likely to be supported given the high intraday volatility, the high realized volatility that we're seeing. To me, the decline in longer-dated volatility is maybe overdone or underpricing potential longer-term risk, right? So I think what Trump has done is pushed out a delayed potential tariffs, prolonging the uncertainty and potentially exacerbating some of the economic impact. As we know, uncertainty really kills markets and really kills the economy. So if you look at S&P 1-year implied volatility, it's trading just 1 point above its long-term average, right? And typically it's trading around 20. Typically in recessions, it's as high as 40. So the options market is really not signaling any risk of a potential more prolonged downturn in the economy.
But what are you looking for in terms of moments that investors are willing to take on far more risk? Of course, yesterday was a big risk-on day. You're seeing some of that really popped out of the bubble today, some of it. But is there a marker here? Are there dates that people are looking for? What's the next catalyst to really put those large trades on?
I mean, the most obvious is the 90-day, right? The 90-day delay. But honestly, I think yesterday's price action just tells you that we're all kind of held hostage to the whims of one person, right? So the next tweet, the next press conference, these could all be volatility catalysts. I think that's why you're seeing short-term volatility really starting to pick up today after that collapse yesterday. As people were understanding it's not over.
It's so funny. On the one hand, there were a few people, Bob Michael was one, talking about the potential for an emergency Fed intervention. On the other hand, it seems like the Fed hasn't mattered less in quite a long time.
Yeah, and I'm a little skeptical about emergency Fed intervention just because, as we saw yesterday, things can really change on a dime, right? So the Fed comes out and cuts, and if Trump then presses back on the trade war, then what happens to the economy, right? So I think that uncertainty is really what is going to really have the most negative impact, and that should be reflected in longer dated volatility in the options market, and that is not what we're seeing right now.
Well, it's going to be really interesting to see how the next 90 days or so go. Mandy, it's great to see you on Today of All Days. That is Mandy Zhu of SIBO Global Markets. Meanwhile, a quick check on these markets, now open for just about an hour or so. You can see the S&P 500 down 2.9%, really giving back some of those gains that we saw coming in after 1:20 p.m. yesterday. The NASDAQ 100 leading losses. Big tech really taking a hit right now. Still very exposed to China, as Caroline Hyde mentioned to us, down 3.5%. And the bond market's still pretty quiet, but a little bit of a rally. We'll continue to track all the market moves. This is Open Interest.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
In case you missed it on the opening trade.
Is Trump, as he says he is, ready to do transformational trade deals as long as he gets his interests taken care of? Because if he is, that gives a huge opportunity for the UK to really move the dial on its growth with the US. So I can't imagine that you would shy away from that prospect if it's genuine. What remains to be seen, is it genuine on the part of the US? And we have to test that.
Don't miss the opening trade, live every weekday.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Tom McKenzie in Frankfurt. This is Bloomberg.
Welcome back to Open Interest. Let's get a check on these markets right now. You can see selling in vogue on this Thursday. The S&P 500 down 2.6%. We're off our worst levels of the session. Now, it's hard to look at these moves knowing that yesterday was such a huge day. It's only natural that you would expect to see some of that enthusiasm that came through yesterday to be wrung a little bit out of the markets today, and that is certainly what's happening in big tech. The NASDAQ 100 off by about 3%. The bond yields on the 10-year Treasury yield also down a little bit, about 2 basis points. We've seen a lot of gyrations there, to put it mildly. But guys, let's take a look at the sector level. I think this is really interesting to highlight just how defensive the trade is today. You have 10 of 11 sectors in the red right now. Your sole winner on this day, the day after, is consumer staples, up about 0.7%. So even that isn't really seeing a lot of robust bidding going on.
88 of the more than 100 stocks in that NASDAQ 100 are in the red today. So defensive tone. To your point about the bond market, interesting also. That auction went okay yesterday.
It did.
There's another one today, a 30-year.
Yeah.
I think that'll be interesting.
I'm glad you brought that up, because it definitely got lost in the sauce, because we got that Trump Truth Social post about 20 minutes later. But you actually saw the S&P 500 spike a little bit after we saw that strong demand. Someone quipped to me that, you know, the U.S. is trading like an emerging market. When was the last time you saw stocks rally because a bond auction went over well?
A dearth, apparently, though, of direct bidders, of foreign bidders not buying U.S. Treasuries. So I think something that we can continue to watch. And I will remind everybody that even though we had this insane rally yesterday, we still haven't climbed back to absolute levels that most people were calling as a bottom.
Yeah.
Right? We haven't even come back to 5,500 on the S&P 500, and we were at 6144 at the end of February.
But at least we know where the strike price on that Trump put is. It's somewhere around 5,000, maybe 4,000.
Well, that's the question. Is it on stocks, or is it in the bond market? Was he watching the long end of the bond market rather than
we know
the
he
S&P?
was watching the bond market, but as Sliman made the point, I believe it was Andrew Sliman, the two are connected. If you see that 20% drawdown in the stock market, you're probably going to see some pain in the bond market as well. It was a good point.
Yeah.
We're going to talk about some good points with Steve Case up next. This is Open Interest.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
He helped build the early internet as a co-founder and longtime CEO of AOL. Now Steve Case is investing in the next wave of American innovation through his venture firm, Revolution. We are happy to welcome him on Open Interest today. Steve, thanks so much. I wonder that we see these markets swinging. You know, yesterday was a massive up day. Today is a pretty big down day through Trump's trade war. What does this kind of volatility mean for investment, for innovation, and for the American competitiveness that you're working on?
Well, obviously the markets have been jittery. What the president called a little bit of yippee, and which I guess is good for ratings for business shows like yours. But most investors, most entrepreneurs, most executives find it confusing to figure out how to navigate. And in the long run, I think the American innovation engine is still quite strong. Obviously, America has a strong lead on new technologies such as AI. We're making some progress, need to make more progress, but some progress around trying to level the playing field, backing entrepreneurs in different parts of the country, what we've done with Rise the Rest. So that's all positive. But the bigger companies are starting to get a little more defensive. A few months ago, they thought maybe the door was open on M&A, and now they're maybe a little more nervous about that. The tariffs obviously create some uncertainty and risk, uncertainty about what happens in the next couple of weeks on the tax front here in Washington. So there's a lot of uncertainty. Not surprising, the markets are pretty chaotic. But if you take the long view, and venture capitalists, you have to be thinking more of 10 years out, not 10 minutes out. I think things are pretty well positioned for this next age of innovation, entrepreneurship, and America is well positioned to continue to lead.
Yeah, Steve, you make a number of great points there. I mean, you think about all the optimism that was built, not just around M&A, but IPOs, exit opportunities of that type. It certainly feels like a long time ago that we were talking about that. But, we've been chatting about how you think about the big tech companies, the Magnificent Seven, how exposed they are to China, how much of their cost of goods sold comes from China. I know that you're confident in the long term here, but take us into how exposed the average tech, the average AI startup is to what's going on at the global scale.
Well, it's kind of a mix. It kind of depends on what the company's doing and whether it be AI or other technologies, how they're using it. The ones that are more software, kind of pure digital, companies, it's less an issue. The ones that have a hardware component is much more of an issue. I happened to talk to an entrepreneur yesterday who's launching a company in the fall. The manufacturing of that product, it's a hardware, software, service kind of hybrid product, is in China. And suddenly looking at 125% tariffs potentially obviously creates significant risk and uncertainty, which will impact pricing and even better to think about about where else they should manufacture. And the larger companies like Apple that obviously are reliant on manufacturing in China, there's more risk there. But most of the innovation economy, most of the sectors that we're backing, they're less focused on tariffs because they aren't necessarily manufacturing in China or some other country. There may be some components that they need for some of their products or some of their infrastructure, but it's less of a front and center issue. The entrepreneurs typically care about access to capital. How do we get more capital, and particularly outside of the major tech hubs like Silicon Valley? Even that we saw in the election, President Trump won 31 states, but if you add up all the venture capital that went to all 31 states, it was only 16%, 1/6. So those states really are underrepresented in terms of venture capital. Therefore, it's harder for the entrepreneurs to start there. You don't see the same job creation, economic growth there. And so we do need in this next phase, not just to make sure America continues to lead the charge as China and others step up to the plate around this next frontier, but we also do it in a way that brings along more people and more places. So we have a more distributed innovation economy in our country, not just a few big tech hubs doing well, and lots of parts of the country being left out and left behind.
Right. I want to double down there for a moment. Access to capital, because of course investor sentiment has been very bruised of late. You also see that capital markets freeze, really the IPO market not opening up as investors had hoped for or expected this year, and the number of public companies just shrinking. So what does this mean for younger companies? Is there as simple as a valuation reset, or is there something more existential going on?
I think we've seen progress last decade, including around Rise to the Rest. 1,400 new venture firms were started in these rising cities, so that's good. But the challenge is, are they going to be able to raise a second fund or a third fund? Access to capital for venture funds has gotten harder, just as access to capital for the startups, the entrepreneurs, has gotten harder. So that's a challenge. As you know, the public markets we've seen a reduction in IPOs. There was a little bit of a boom a decade ago. I was working on the Jobs Act that passed, I think it was 11, 12 years ago, that created a better path for emerging growth companies, and you did see more IPO action. But it has slowed, in part because of the risks and costs associated with being public, and I know Congress has taken a fresh look at that, but mostly because the late-stage private capital markets have been so robust, companies could raise whatever amount of capital they needed to fuel growth without having to go public, which is different. When companies like mine, AOL, went public, or Microsoft went public, or Amazon went public, their valuations tended to be a few $100 million, and they're raising tens of millions of dollars in their IPO. Now those companies are able to do that in the private market and stay private for much, much longer. Now, there also is a little bit of a reset in those late-stage growth markets, and so that will result in some companies having to look at a public option maybe sooner than they otherwise would have. But it's not just about your regulatory policy around IPOs. It's also, is it a path that you need to consider to have the capital you need for this next chapter in your journey, or can the private markets achieve that for you?
Yeah, it's a structural change. But I mean, even with that in mind, I want to talk about some of the investments that you do have right now, because you've invested in the likes of Kava, Sweetgreen, which actually our team is eating after the show today. Both of those went public and you were investors there. But when you think about some of the investments that you have in the AI space, do you have any IPO candidates in the pipeline, or are you waiting out the storm?
We do have some in the pipeline. One company that went public about a year ago, Tempus AI, focused on healthcare, done quite well. They're using AI and genomics to create a more precise way to diagnose disease, and doing a lot of things with data in partnership with a lot of pharma companies. It's a great company based in Chicago, founded by Eric Belkowski. So they have had a successful public entry. They have seen their stock price gyrate, as many have in recent days, weeks, months. But the long-term trajectory for that company, I think, is very solid. And there are other companies that we have taken public that have AI as part of their strategy. Clear, for example, we use biometric technology to clear people faster through airports and other venues. We back some private companies that are using AI that are showing real momentum. And each of them will have to decide when is the right time to consider going public. It obviously depends on their specific needs, and not just access to capital, but are there some strategic benefits of being public, having more visibility, having more transparency, having more of a currency to use for M&A. Each company is a little bit different.
All right, Steve, great to speak with you. Really appreciate your time. That is Steve Case. He's the chairman of Revolution and the co-founder of AOL. Let's get back to these public equity markets. You can see that we're off our worst levels of the session, but still in the S&P 500 down about 2.3%. As we've been discussing, it's big tech that's leading losses today. Volume is elevated, Shanali, relative to our 20-day average, but compared to what we've seen over the last few days, it certainly seems a lot calmer out there.
Right, it's wild to feel that 2.4% doesn't feel like a lot based on what we have been dealing with. Let's get a look at stocks moving this hour with Bloomberg's Isabel Lee, because a lot is moving.
A lot is moving, so we can look at Carnival. It's edging almost 9%. So this is interesting because Carnival has upgraded to equal weight from underweight at Morgan Stanley. The company said that a lot of bad news seems to be already priced in given the share price decline. So basically Carnival's risk reward is now fairer. They did reduce their price target from $25 to $21. So cruise stocks, as we know, have seen really a huge drop this year. In general, they've averaged around a 41% decline from the beginning of the year. And I guess really, analysts say this in general, that in the event of a recession, you would really want to steer away from cruise stocks.
It is a bit unfortunate that they're saying the bad news is already in the price and it's down 8%. But
it's tough. CarMax is also getting more than decimated here, even though used car prices are going through the roof, and I guess this is because they can't maintain their forecast.
Exactly. So they're edging lower by almost 20%. So they backed away from the timing of their financial goals. So they said that they're making progress towards that, but they're just not issuing any timeline. So that is what's spooking investors. So they really just joined a growing list of companies citing the difficulty of predicting where their company will go, their bottom lines, their share prices in this uncertainty, this volatile environment. We also saw the company reporting a worse than third quarter estimates. But also we know that the auto industry is more affected than normal than others. We have a 25% levy on them. So we have a lot of car buyers rushing to dealer lots.
Yeah, Matt Miller is keenly aware of that dynamic. So interesting moves in CarMax, to say the least. Let's round it out and talk about what's going on with Constellation Brands, because it has been quite a volatile morning in that stock.
Exactly. So when I first looked at it, it was in the red, and now it's in the green, fluctuating between gains and losses. So Constellation is a beer, wine, and spirits maker, and they issued a downbeat guidance, and they did say it's because of tariffs and just generally muted demand in alcohol. I guess people these days are drinking less, and the company expects earnings to be lower than expected for a 2026 fiscal year. And Truist actually said that they were surprised they even issued guidance at all, because as we've seen with other companies, they really aren't. But even before this whole tariff hullabaloo, they have been having weaker demand.
Hullabaloo has been called. I like that.
I can't even say the word. Isabel, we thank you so very much. That is Bloomberg's Isabel Lee. Now coming up, the bank earnings parade kicks off tomorrow morning. We're going to preview what to expect with Stephen Bigger of Argus. This is Bloomberg Open Interest.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to? The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Now, JP Morgan, Morgan Stanley, and Wells Fargo kick off bank earnings tomorrow. And policy and economic uncertainty are, of course, in focus. Joining us now with what to expect, Stephen Bigger, Director of Financial Institutions Research at Argus. A lot's going on, right? You had recession calls put up and then pulled back in the case of Goldman, for example, with the uncertainty around tariffs and the change in positioning. But fundamentally, we did see a lot of capital markets activity that was expected not come to the surface. Consumers are on high alert given the concerns around potential future inflation. How does that read through to the banks?
Yes, good morning. Well, certainly all true. I think the much hoped for recovery in capital markets has been put on hold for the most part. We've seen some very large IPOs expected to come, such as Klarna, that are now on ice. And I don't think yesterday's actions with the pause on tariffs is going to result in any great constructive conversations to improve that for quite a while until there's more clarity. So yeah, it is daunting for the banks at this point. I mean, it will probably overshadow what we think was a reasonable fourth quarter, or first quarter rather, with trends largely tracking those of the fourth quarter. But yeah, the conversation will certainly shift to what will likely be weaker loan growth, continued margin pressure, and now the question moves also to credit quality and what a downturn will mean there.
How concerned are you about that? Because we've seen reports from various Federal Reserve banks that savings and checkings balances are down, debt is growing, inflation-adjusted debt beyond pre-pandemic levels across all income levels. Are we making too much out of it? Because the U.S. consumer often proves skeptics wrong.
Well, certainly the soft data has pointed to some worry spots, consumer sentiment coming down, and we'll see if that actually does result in some weaker loan growth. I will point out that, yeah, this week has been two negatives for the bank group at large. On Monday, we got the consumer credit, particularly revolving and non-revolving credit, and non-revolving credit was down 0.3% for the month of February. That's weak. That's a number that very rarely declines on a month-over-month basis. It just continues to go up month after month, year after year. So that's a bit worrisome there. Even revolving credit, things like credit cards, home equity loans were up 0.1%. So you can't get much shallower than that on the positive side. And then just yesterday, as I think you're pointing out, the Fed results on the delinquency rates for 60, 90-day cards have moved up to a 12-year high. So it's hard to say that we're not making too much of it at this point. I think clearly a slowdown. The somewhat good news for banks, though, is that they have even last quarter, mentioned that they were expecting a 2025 increase in unemployment for kind of the 5 to 5.5% rate. We're down here at 4.2, so they're fairly well reserved. They're expecting some weakness in the labor market in 2025. So I don't think we're going to get enormous increases in loss provisions. But later this year, and I think that's where the commentary will focus, how much they do need to set aside for that.
And Stephen, I want to get specific here and talk about some of the names in your coverage universe. I mean, you cover all the big guys, of course, JP Morgan, Goldman, Citigroup, Wells Fargo, the list goes on. Who do you think is best positioned in this environment when you look at your stable of coverage?
Well, you certainly tend to move back to the tried and true companies, the JP Morgans that have, certainly has the diversification of revenue sources, and they're tend to fare the best in IPO and with the league tables, and remain high in those spaces. Trading also, that's been the one certain positive in this environment is trading revenues have just been explosive. Given the volatility we've seen, not just in stocks, but in fixed income and currencies, commodities. So that will be a decent offset going forward if volatility remains. So that favors the Morgan Stanley and the Goldman Sachs type firms, but with a big offset with capital markets. So they're more of the pure plays there. And from a trading perspective, yeah, I would prefer the JP Morgan or even a Wells Fargo, a PNC. Some of those large regional banks that have good service territories and also have that revenue diversification.
I want to point out, it's fascinating. Goldman Sachs is down 13% on the year, whereas JP Morgan is only down just over 4%, less than 5%. Do you think that there's more room to fall for a JP Morgan or more upside at this juncture? Because even with that drop on the year, it's still trading at roughly 2 times its book value.
Yes, well, that's what you tend to get for banks that have premium metrics such as return on equity, market share. The price to books and PEs tend to be a bit higher for firms that have that consistency of earnings growth as well. So Goldman is going to show a lot of volatility in the earnings stream here as we move through these quarters and have this uncertain, particularly in the capital markets environment. So that's why the favorite sort of moves towards the more consistent earnings stories, which JP Morgan is one.
All right, Stephen, great to preview the big bank earnings with you. That is Stephen Bigger of Argus. Meanwhile, a check on these markets because the selling has resumed in the S&P 500. We're now flirting with session lows on the big benchmark, down about 2.9%. You can see that slide resuming and picking up momentum in big tech as well. The bond market has been pretty stable, and that continues. The 10-year Treasury yield only down about 2 basis points. This is Open Interest.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Today's Today's CFOs focus on much more than revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has.
We're in an evolving business.
Our first job is to intimately understand and anticipate the consumer's needs.
We've been on a journey to be higher growth, more nimble, and more capital efficient.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this spring, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The retaliatory tariffs, you have a situation where basically production sort of grinds to a halt because there's these interdependencies, and that is very bad. It's almost like another COVID in that it raises costs, it lowers revenues for companies, and it worsens the capital markets.
That is Bridgewater founder Ray Dalio speaking earlier with Bloomberg's Francine Lacroix. Of course, his note this week has been making its rounds across trading desks. People trying to look at the long term here amid this short-term volatility. Another conversation I had yesterday was with Ann Walsh, for example, of Guggenheim, that's looking back to the Reagan era to think about how things might change in terms of the U.S. manufacturing base.
Yeah, I'm looking forward to hearing a little bit more of that interview, of course, with Ray Dalio. I keep coming back to Larry Fink. I believe that was all the way on Monday, which feels about a year ago with Eric Schatzker, though.
I listened to the whole thing.
I'm sure you did.
Yeah, at the Economic Club of New York.
Yeah, and I mean, some of the points he made, that the CEOs he's talking to are acting like we're in a recession. We heard that from the Delta CEO, that he and his peers are acting like they're in a recession, and you have to wonder, okay, we have this short-term relief, but what happens after 90 days? I mean, how does a business plan, even still, there's still so much uncertainty
And
here.
even if they are waiting those 90 days and have some sense of relief, if CEOs already believe we're in a recession, it pauses activity, it pauses hiring, it pauses M&A, it pauses capital markets activity. Right. It makes it very difficult. And to your point that you made earlier in the week, sometimes this becomes a self-fulfilling prophecy.
Absolutely. Human psychology, Matt Miller, it's a powerful thing.
Well,
I was a psych minor in college.
I'm looking at, that served you well.
Kind of.
That was a good choice. I'm looking at Polymarket's odds right now at 53% of a recession. That's down from 65% yesterday, so a significant reduction, but still greater than half. And I have to say that if you're one of the big businesses, right, if you're a Walmart, it's a little bit easier for you to handle this kind of thing.
Yeah.
But we had the guest on who makes the electric guitar pedals.
That was awesome.
And I get messages every day, multiple messages from people who run small businesses, from people who run Main Street businesses, and say they cannot cope with what's happening right now. They are forced to raise prices, and they have no other choice because they can't rearrange their supply chains.
Yeah, I do wonder if you're going to see this interesting dichotomy when it comes to the market and investors on one side and businesses and CEOs on the other, because again, they're running a business. They have to think about capital expenditures and all that, employment as well. But then you have investors who are saying, okay, we have some relief. Let's just run with this.
Can we do something for you in particular, Katie, and pull up the Russell 2000 on the year? Because this was a trade that we were talking about last year. Investors were piling in. It's down more than 17% this year.
It's a lemon.
Pretty brutal.
Yeah.
And also, if you think about how much small businesses have been employers in the United States over the last few decades, it doesn't bode well for the job market either.
Yeah, it's interesting because, I mean, these are small companies. They're domestically focused. The bull case was that they'd be more insulated from tariffs from some of these multinationals. Obviously, that has not panned out.
That's not the case. And I'm actually, though I'm talking about much smaller businesses than this, right? And the reason I think about it, yesterday you heard Scott Bessent on a competing network, I can't remember honestly which one, saying that It was Wall Street's turn, now it's Main Street's turn. And he was talking about for prosperity. The problem is these small businesses on Main Street that employ, 3, 4, 5 people, they're the ones who are having the most problems. Coming up tomorrow, Max Kettner of HSBC and Joanne Su of Michigan. This is Open Interest.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, right, which means they can read, but they don't choose to read.
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Investors, they are back on edge after President Trump's tariff pause and monster rally yesterday. And this as tariffs on China remain in place. Markets now bracing for a potentially protracted period of global trade volatility. Let's check in on these markets. We're currently up over the last 2 days, almost 8%. Remember the euphoria that swept through the markets as tariffs are put on pause. All countries except for China now have a 10% blanket tariff. But we drop again once again today, Ed, and it looks as though the anxiety about what China really means for the broader markets is still there.
Yeah, let's give some illustrative examples of the companies impacted, right? Tesla jumped 22% yesterday. This is a 2-day chart. It's pulled back today. So it goes from having its biggest jump since 2013 to pulling back. Apple, another company impacted, right? Switching up the boards and looking at Apple. 90-day pause on 56 countries that had tariffs implemented while the administration boosts the tariff level on China. Apple's so interesting, and later in the show we'll dig deep into it. Why? That Reuters report that they airlifted tons, literally 1.5 million iPhones from India into the US. This is kind of crazy markets news cycle, and I'm here for it.
Aren't we just? And President Trump's tariff pause is a welcome relief, Ed. But look, investors are remaining wary of the wider economic impacts of those 125% tariffs still on China. White House National Economic Council Director, that's Kevin Hassett, saying there have been well-advanced trade talks and offers with other nations. Bloomberg's Kaylee Lyons breaks it down. Just the intricacy, the 10% blanket tariff on everyone but China, but some get close to a deal, it seems.
Yeah, according to Kevin Hassett, who was speaking on another network, he's the director of the National Economic Council. They've already had more than 15 deals presented to them, and they are intending to take these bilaterally, one by one. The entire trade team, which could include Hassett, but as well as Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick, and of course President Trump himself, who admitted yesterday that while this is about negotiation, it was also about the market, despite the messaging we initially got from the White House press secretary and Secretary Bessent that this was always part of the plan. This was the art of the deal. It's all about negotiations. The president himself admitted he was watching the bond market get a little queasy and felt that people were getting yippy, and that contributed to this move, at least to lower or to pause 90 days reciprocal tariffs on all countries except China. But yes, that 10% is still in place, and that 125% levy on China in place as well, in addition to the 84% reciprocal tariff that China has placed on U.S. imports. And that could effectively have the effect of starting a decoupling of the two largest economies, which obviously has major implications for firms with heavy Chinese exposure, including the technology companies that we saw ripping yesterday, as you guys were just talking about, giving back some of those gains today, as there is still risk here for a company like Apple and Nvidia. And although President Trump said yesterday he does think China wants to make a deal, he's expecting a phone call from Beijing and would love to talk to Xi Jinping. There has been no sign from Xi or the Chinese government yet that they are interested in making that forward progress, suggesting that China does not necessarily want to blink first here, keeping in mind that the idea that there's still ongoing conversations over a TikTok divestiture deal adds an additional piece of leverage and complication to any conversations that are had.
You know, Apple's going to be a big focus in the show today because the White House keeps talking about it. Yesterday's jump, the biggest since 1998. It's just crazy times, and India's a focus. I was interested in our reporting that Bessent listed India as one of the nations he'd speak with early on. What is the DC reaction, right? If you're a Democrat and you're trying to respond to the White House tariff policy, what are you hearing?
Well, essentially what Democrats argue is that this is just chaotic, that there is so much uncertainty around the policy, and then that has the same detrimental impacts of these policies staying in place. There was also a lot of concern on the part of primarily Democrats yesterday about the potential market manipulative effect of President Trump's swings when it comes, or vacillations when it comes to this policy, keeping in mind that it was yesterday morning he said on Truth Social it was a good time to buy, then hours later sparked the biggest rally we've seen since 2008 with this decision. And many, including Senator Adam Schiff of California, have suggested that this requires an investigation into possible insider trading. So that is another narrative we are hearing. All of it, though, just speaks to the uncertainty around this policy, keeping in mind that while the president is now saying that China tariffs are sticking in place, that there is a 90-day pause in place for other countries, we have seen time and again that he does have the power to change his mind and to do so very quickly. What stands today on Thursday isn't necessarily going to stand tomorrow necessarily. And of course, we're going to have potentially multiple opportunities to hear from the president today. He's scheduled to be holding a cabinet meeting right now, signing a bill later, present some opportunities for him to speak to the press, and we'll see if he has any additional surprising tariff news for us.
Bloomberg's Kaylee Lyons in Washington, D.C. Thank you very much. Another story overnight. China also announced it will, quote, moderately reduce the number of U.S. movies allowed into the country in response to the U.S. government's tariffs. The move is seen as a new front in the trade war and could signal Beijing's willingness to target American services, which could include travel, intellectual property, royalties, and transportation. Kara.
Still so much to digest on the wider tariff implications on tech. Let's get to it. Jay Hatfield's with us, Infrastructure Capital Management CEO. Can you trade in this erratic market?
You can, but it's very easy to lose a lot of money doing so. So it's really better for most investors is to hold their positions. Although I will say, we have been, even before the tariff halt, we had said that 5,000 was a good support level. So now that we've kind of bounced off that hard, I think we're just neutral on equities right now. But I would counsel even hedge fund managers to trade cautiously because there's erratic policy coming out of the White House. They can announce it at 1:10 in the afternoon. And so it's better to just get to your position and kind of hold it.
When you're thinking about potentially the names that you like and want to recommit to, how much are you thinking about exposure for China at the moment?
100%, I guess, and also to the overseas markets. So we favor, I think you had a guest on earlier, regional banks. They have no exposure to international. They do have credit exposure, but we think we have a non-consensus call that the economy is pretty strong. And so those banks have come down almost as hard as the investment banks, but they're not dependent on investment banking. They're really just dependent on rates and spreads. So be more conservative in this market.
Jay, I'm just staring at a 5-day NASDAQ 100 chart. And I'm staring at it because effectively net, we're flat over the course of 5 trading days. Then you think about the drama that we're within those 5 trading days. Do you net understand the tariff policy of the White House, and are you able to make informed markets decisions based on your understanding of that policy?
Thanks, Ed. Definitely not. I mean, that's really why we're neutral on equities. We're actually very constructive on inflation, which that view is validated this morning. So we had negative headline inflation. And just to mention that, too, that everybody wants to talk about tariffs, but nobody talks about the 20% drop in energy. That's very profound. That's very stimulative to the U.S. economy. It's very positive for inflation, but it never gets mentioned. But to your point about uncertainty, there's basically 2 camps in the White House, the hawks and the doves. The doves are more pro-business. You kind of saw that when Elon Musk called Navarro a dumb bag of bricks. Like, that's almost unprecedented. I don't think that happens in normal organizations where colleagues are highly pejorative. So because we don't really know who's going to win that debate, it seems like Besant has the latest victory. We are, like I said, we're neutral on stocks. We'd be more conservative, and also fixed income looks pretty attractive.
Jay, recession calls were pulled on the White House's 90-day pause. Should our audience of technology investors, technology employees, founders, startup leaders be braced for a recession in your mind?
Our call is there's no recession, but slow growth. But the real thing that also people are missing, in our opinion, is that the slowdown is mostly caused by hawkish Federal Reserve policy and not by tariff policy. As I mentioned, energy decline pretty much offsets the tariff increase. So the real issue is ultra-tight Fed policy. We think the Fed has a flawed structure, policy framework. They're very dangerous, and they potentially could create a recession. But we do think the inflation data is going to be so positive, they'll be forced to cut rates later in the year.
I'm really interested in that U.S. economy positivity, basically, and the fact that means maybe we've got a resilient consumer for Apple phones, maybe we've got a resilient consumer for Amazon products. Are there any stocks in the tech world that you think are worth adding to, not just regional banks?
Absolutely, and this doesn't sound conservative, but we think is more conservative. Amazon. They're kind of half Walmart, and they're price insensitive. They're just pass-through entity. And the CEO is on this morning saying that AWS demand is extremely strong. So they get traded like a tech stock, but they're half a retail stock, and they're cutting costs. So that's, again, like regional banks, pretty defensive in a market that has been destabilized by this White House that can't really sort out who's in charge.
Andy Jassy been putting out his investor and shareholder letter today and responding to some of the, well, current volatility that his consumers see. But then push us forward as to what your view is on AI, and if AWS still sees insatiable demand. Many have been trying to work out whether the AI bubble that has so inflated this market is anyway intact. Is it?
We think so. I mean, everybody looks at the market and says, oh, well, the stocks are way down, so AI must be falling apart. They're just high beta stocks. They have 2 betas, so they're twice as volatile as the market. So the market's going down. What do you sell? You sell the volatile stuff. You sell the investment banks. You sell tech stocks. This doesn't mean the AI market has changed. And that's one reason, though, because we do believe there will be continued AI spending, and Jassy's comments certainly validate that. Really, it's investment and not consumption that drives recessions. So AI spending is offsetting a slow housing market. And another thing that people haven't focused on, rates have come down 50 basis points. Yeah. It was disconcerting yesterday when they were skyrocketing, by the way. I thought the market might crash then. But that is helpful. It's not going to get the housing market to boom, but stabilize. So if you look at investment, you can predict recessions pretty well. Stabilizing housing, strong tech spending, that adds up to slow growth, say, in that 1% to 2% range.
Jay, our case study today, I think, is Apple. And in the short term, they're airlifting iPhone handsets from India into the United States. In the long term, the White House sees a world in which the iPhone is assembled in the United States. Do you see that future being achievable for this White House?
Not really. That's sort of the fundamental flaw of the hawkish trade outlook, is there's a notion that you can have a trade balance with all countries, which is ridiculous in the sense that, low-income countries have low labor. They're going to be exporters. That's one way they grow. And then the second thing is, if you run a gigantic budget deficit, you have to have a trade deficit. Financial flows need to equal physical flows. So the first thing you need to do if you want to have zero trade deficit is lower your budget deficit. So that objective is ridiculous.
Yeah.
It might have led to the bag of bricks comment from Musk, not me. And so that's why it's disconcerting to be in this market, because one side is arguably nutty and the other side is more pro-business, and we don't know who's going to win.
Jay, at the moment, it looks as though the House is going to adopt a plan to advance Trump's tax cuts and also the debt ceiling hike. I want to get your take on how we can align what many had thought would be a tax policy that offsets some of the volatility of tariffs. If the House can push forward and agree $1.5 trillion in cuts for the budget, is that the right policy right now?
Absolutely. So that offsets if we end up with sort of 2% of GDP, that's about a $600 billion tax increase. So we need to offset that. And in fact, that's what the flaw of the initial strategy is that it just came too fast. You could have just said, well, in a year we'll do this, and then you had plenty of time. And so they came way before the tax cut, and that's what's destabilized the market. And it's just an own goal if you play soccer, because they didn't need to do that. It was just coming out of this.
Yeah, oh, good.
Yeah, good. I tried that with one of your reporters, and they looked at me like, what does that mean? I'm not the biggest soccer fan either, but I know what that is. So that's the issue, is that timing was horrible. They could have gotten the exact same place by just saying they're going to do this without doing it right away, waiting for the tax cut, waiting for the Fed to figure out inflation's coming down. So it was just at the absolute wrong moment. Also, it wasn't earnings season. We think earnings season will calm people down, maybe not get the market to skyrocket, but when you hear from companies, their stocks tend to rally, because then you get certainty, even if it's not great, like Delta's guidance was highly, was bad actually, and stock, this is before the announcement, skyrocketed. So we think any news, or most news, will be viewed positively, and the earnings season will stabilize it. So all this tariff news came into absolute terrible time during a normally weak March. So now, not that we're super bulled up about the market, but we think it'll stabilize kind of in this 5,000 to 6,000 range. It's not very stable, 5,000 to 6,000, but be banging around in that range. So we're neutral, not negative. We were negative before this policy change.
Jay Hatfield of Infrastructure Capital Management, who I think was quoting Howard Marks on the own goal analogy. Thank you very much. Now, coming up, tariff threats actually helped fuel TSMC's AI-related growth surge at the start of the year. We'll have more next. This is Bloomberg Technology.
can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भाला के चक्कर में मेरा ही बुरा हो जाएगा।
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Quick check on the US listed shares of TSMC, their ADRs. Look, they're going to be following the broader market lower at the moment, off by 4.8% after they rallied hard yesterday. But we've got to keep in mind that the company actually posted sales growth, 42%, on, of course, AI demand ahead of US tariffs. For more, let's bring in Peter Elstrom. And what's interesting is the inventory buildup is so plain to see. This is the chip provider for Apple, for NVIDIA.
Right, we don't have all the numbers from TSMC yet. All we've gotten is the revenue for this quarter. As you say, though, it's a 42% growth rate. It's very, very strong. They bumped up revenue to $25.5 billion. So you've got a $100 billion run rate company that's growing at 42%. It's pretty extraordinary. What we don't know, what we'll find out next week as they report more broadly their earnings, we'll get more detail on that. We'll figure out how much of this is inventory. As you say, there's probably some stockpiling going on right here. Two of their biggest customers are Apple and NVIDIA in particular. They may be accelerating some of their purchases to get ahead of some of these tariffs so that their customers don't have to pay high tariffs as they get into the next few days.
You know, the data is highly analogous with what we saw from PC shipments, right? Front-running tariffs they knew were coming. That's short-term. Long-term, TSMC has pledged billions of dollars to build chips in this country. Have we learned anything more about that in its progress?
Well, they didn't say anything at this point, but you're right. They had previously pledged to invest $65 billion. More recently, they said they're going to add another $100 billion onto that in U.S. investments. They clearly want to make chips in the U.S., partly to diversify themselves geopolitically. Partly they'll be able to serve these customers like Apple, like NVIDIA, like Tesla more effectively if they're able to do it in the U.S. And they'll avoid some of those tariffs if they're going to get hit with those. Now, TSMC doesn't sell that many chips directly into the U.S., but via Apple and via NVIDIA, some of their other customers, they could get hit by tariffs that go through their end products.
Bloomberg's Peter Elstrom, thank you very much. Right, next on the show, more on Apple, really important conversation. Stay with us. This is Bloomberg Technology.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to?
The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Quick look at shares of Apple falling after yesterday's massive rally. But there's also reports that it shipped about 1.5 million iPhones from India to the United States in an effort to beat President Trump's tariffs. It's according to Reuters. Ed, it's fascinating that 600 tons worth from India. Who knows what they were shipping on jumbo jets from China?
Right. I did the math. I checked the math. 600 tons, the average weight of an iPhone around 7 ounces. So with packaging, I think 1.5 million makes sense. That's short term. Long term, the only question is, can they build the iPhone outside of China and where? Here, the United States? Who knows? Let's get more on the fallout of US-China tariffs and its impact on Apple. Carolina Milanesi, president and principal analyst at Creative Strategies, joins us. I mean, in a world where the iPhone's built in America, there are many estimates. Bank of America this week said it would be 90% more expensive. That is an interesting scenario, Carolina.
Is a very interesting scenario and one that I don't think is going to happen anytime soon. I think that Apple has other options before coming to the US, and that's because unless we are moving part, at least of the supply chain, to the US, it's really unreasonable to think that Apple can be successfully building iPhones here. So what you're seeing with the shipment coming from India is that Apple has the opportunity not just to ship, but to actually rethink how and where they build iPhones that are targeting the U.S. market. So they could shift from China to India or other manufacturing facilities to avoid some of the harsher tariffs that China is faced with today. Obviously, all of this can change tomorrow or this afternoon.
What about, of course it can, but the margin pressure? How much will they suck up some of the margin pressure? How much do you think they can pass on to a pretty stressed consumer here in the US right now?
There's two aspects of it. One is to remember how strong Apple relationship with their supplier manufacturer is. And so there might be a negotiating part there where it's not about just Apple passing on to the consumer, but is Apple trading with their supply chain to see how best everybody can ride this wave, right? At the end of the day, you want to keep the Apple business with you for the longer time. And then when it comes to consumer, I think it's a very critical moment for Apple here in the US market when it comes to services and Apple Intelligence in particular. So they will want the upgrade cycle to continue. And they might decide that it's worth sacrificing some of their margins in the short term to then have more revenue coming from services and Apple Intelligence longer term.
A story's hit the terminal just now clarifying that the Trump tariffs on China now add up to 145%. You see Apple declines accelerating 5%, NASDAQ 100 pushing even lower. An airlift, though, have you ever seen that in your career? We just have 30 seconds, Carolina.
I have not. It's definitely something new, and I think it comes with the volatility that we're in right now.
Carolina Milanesi, there with all the expertise and the context, president and principal analyst at Creative Strategies. Thanks so much for joining us from Vegas. Meanwhile, coming up, more on the market reaction as we see losses accelerate. The NASDAQ is currently off by more than 4%. Nancy Tengler, the voice we go to, CEO of Laffer Tengler Investments, where she's adding. This is Bloomberg Technology.
Asia is a continent of contrasts. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
If NASA is designing a lander, their approach is they're designing a Formula One car. So we take, say, a Jeep approach.
Minso, give us a sense of how you translate Korean architecture for the rest of the world.
We call this madang. In general terms, it's where we can be ourselves, where we belong.
There is an old saying in Korea that says, "거미 불루, 화이 불치." It means simple but not humble. So it has a tremendous impact on Korean architecture.
People tend to think the robot AI taking the job from them. We want to use the robot as a basic asset, meaning people have an income through the robot.
From space tech in India to robotics in Japan, Asia is driving the future, reshaping industries, societies, and the way we live. Join me as I take you through the bold innovations. Discover Asia's next-gen technologies on Momentum.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Tom McKenzie in Frankfurt. This is Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. Quick check on these markets, Ed, because we are accelerating our losses. We're sub 4% on the NASDAQ 100. After a monster rally yesterday, the biggest gain since 2008, we fade some of that. Is it profit-taking? Is it, once again, trying to understand what Chinese tariffs that now are to the tune of 145%, what that means to the overall risk sentiment? We're off by 4% on Bitcoin, but hold above 80,000. Move on to the individual movers that I want to shine a light on, because, look, JD.com up more than 3.75% in terms of ADRs traded here in the United States. China looking to improve stimulus locally. That means e-commerce players that are domestic related and focused are going to be doing well. But we are fading our rally in Alibaba. We're fading, of course, ever more on Apple. Best rally since 1998 yesterday. We're now off by more than 5% as those tariffs to China impact that company. Amazon off by almost 5%. Andy Jassy looking strong into his investor and shareholder note. But more broadly, we're worried about exposure there as well. Ed, what have you got?
Well, let's get back to the tariff story. President Trump's tariff on Chinese imports now total at least 145%. Bloomberg's Kaylee Lyons, who leads our political coverage for us in D.C., is actually going to come and do some math for me because I've lost track on whether this includes reciprocals, it doesn't, and how we got to 145%. Kaylee.
Yeah, Ed, this really is about math and how these tariffs layer on top of each other, as there are different tariff regimes that China is subject to. As President Trump made clear yesterday in his post on Truth Social, he has raised the reciprocal tariff rate on China to now 125%. That, of course, has been escalated multiple times due to China's retaliation. But that did not include the 20% tariff that he had already put into place on Chinese goods earlier this year over the trade of fentanyl. So it's about adding that 125 to that 20% that was already existing, which gets us to the total rate of 145%. Now, this was actually all there in the White House's fine print, but obviously, it's difficult to understand with this fast-moving story how all of these tariffs work in tandem together, but it does seem that this is a figure that was higher, at least, than the market previously understood it to be, which is why we are seeing things take a turn. And this comes despite the fact that President Trump in the Oval Office yesterday said that he couldn't imagine taking tariffs on China any further than he already had, but maybe perhaps this is further than was previously understood, keeping in mind that China has still an 84% retaliatory rate on U.S. goods. It remains to be seen whether or not they will escalate that further and whether or not they are willing to pick up the phone and talk to Donald Trump, as he has suggested he is willing to talk to Xi Jinping, wants to make a deal, thinks China wants to make a deal, but we have seen no sign of that yet, as this trade war between the two largest economies only seems to be intensified.
Bloomberg's Katie Lyons, out of DC, Chief Mathematics Correspondent. Appreciate it. Thank you very much. Let's get back to the market's reaction to tariffs, specifically the pause on tariffs. Like yesterday afternoon, crazy. Bloomberg's Ryan Frostelica, who covers the tech sector, joins us. Apple, I think, biggest jump since 1998. Tesla, biggest jump since 2013. The question's why? Like, why those levels of gains and now the pullback this morning?
Hey, thanks for having me on. So obviously yesterday was a huge relief rally, and I'm sure there was some short covering, some algorithmic trading, all kinds of things just feeding into the massive gain that we saw yesterday. But I think once the dust settled a little bit, people kind of realized, hey, the tariffs against China were raised. There's still 10% tariffs kind of broadly. There's still a lot of uncertainty, and I think just sort of the pause in itself is just a sign of how sort of erratic all the policies have been. There's been introductions, retaliations, escalations, and now a pause, and it's very hard to know what the next step is going to be, and therefore it's very hard to know how to position or understand what the economic outlook might look like.
Ryan Frostelica, with the ongoing uncertainty narrative, we appreciate it. Let's try and get some certainty on what to do with your portfolio now. Nancy Tengler, CEO and CIO of Laffer Tengler Investments, joins us now. And look, you've actually been committed to adding certain names, Tesla being one of them. Why do that with the exposure to China?
Yeah, well, that's a great question. we were adding to it since the market peaked because it got clobbered, and it was actually below current levels. But that is an ongoing concern, though we own that stock for, and we talked about this after Cybercab, Robot Day in Southern California, but we own it for the energy business, and we own it as an AI play. So yes, the EVs matter, but I think it's analogous to Apple, early days when we were buying it, 2013, 2014. The iPhone was a means to the services business.
Really interesting to bring broader context you can still hold on to amid these day-to-day volatile moves. NVIDIA, another one you've been adding to.
Yes.
Many have been quick to say exposure to China. However, some analysts are coming out now saying this is one of our favorite picks. They're actually pretty protected from the broader tariff impact. How are you looking at that name?
Yeah, and we know that Jensen Huang met with the president recently to try to get a carve-out. We're looking at that as part of what we think, I was on the air on the day DeepSeek came out, which was another chaos. I seem to attract it, chaos, that is. And what we thought was that it would increase the use cases and the availability of AI as an option. And we saw that in the fourth quarter earnings, even though they're backward looking. We heard from CEOs how broadly they're using it across sectors. And you heard today Spotify saying, we're not hiring anybody unless you can prove that their job can't be done by AI. So I think NVIDIA is obviously the core of that. Most of our investments have been on the software side. We shifted to software about 5-6 months ago, but we still like that name. It's much smaller holding than our major holding Broadcom, which we've called the poor man's NVIDIA, but we do like to add to it on weakness, and it gets these periods. It has historically, just like Tesla. If you've owned Tesla since the IPO, it's been in a bear market almost 50% of the time, yet it's up thousands of percent. So you just have to pick your spots. Be sure to trim in these more volatile names when they run up, and that's what we did last summer, and then we're adding back in.
Hello, Nancy. It's always great to have you back on the show. I don't think you attract chaos. I think you just invest in the areas that attract chaos. It's different. There's two names that you haven't discussed, and every time you come on the show, I always say you haven't discussed one in particular, which is Meta, but also Amazon. Caro brought up a really interesting point earlier, which is, Amazon has this dual mandate. It is a technology stock and it is a retail stock, depending on how you look at it, like a Walmart, or it's a cloud provider. Talk to me how you feel about them both.
So Amazon was in our 5 for 25 that I published on 12/31, and it's a member of our 12 Best Ideas portfolio, and then we own it in our growth strategy. So I love the name. I think it's a defensive technology name that you can be adding to in here, and we have done that. But I wrote my notes a couple days ago, and we've added to it since then. So I think it's an important name to own. Our poster child for our investing theme of old economy companies that have pivoted to the new technologies is Walmart. You saw them confirm their annual guidance, and then Andy Jassy came out today and said what Jamie Dimon said: we're cutting costs. We're not frantically cutting costs. We're going to our management teams and saying, where can we save money? That's a well-managed company. I think it's an all-weather stock. Meta we sold, as you know, and bought Spotify. And so I was beating myself up until I went and looked at the relative performance since we've done that. And we've done much better in Spotify, though I think Meta is a name you can easily own again and add to in this weaker environment. That said, the ad revenue for Amazon is projected to go down half as much as Meta's if this all continues. So I think Amazon's the better player from here, and that's where we've been putting our money to work. And then Spotify and Netflix are names that we think will hold up in kind of a low growth, potentially recessionary environment, though Goldman withdrew their recession forecast, so maybe we're just getting slow growth.
Nancy, how do you assess communication from policymakers over the course of the last 5 days?
It's been horrific, Ed. I've been at this for over 40 years. I have never seen a more botched policy rollout than this. And I think it did a lot of damage to the administration. I know yesterday, we got the declaration that this was intended all along and you just don't understand the art of the deal. And then Bill Ackman came out and said, oh, this was executed perfectly by the president, which makes me think he was selling yesterday into the strength. That's just speculation. But I think it's been horrible. And you're seeing more and more of Scott Bessent and Kevin Hassett, and I think that will benefit the administration, though their message has been imperfect as well. It makes no sense from an economic standpoint. Now, 10% tariff would kind of act like a flat tax, and it would it would stop distorting behavior. But right now, if you think about factory build, we're up last 3 years, it has exploded, and it continued into the first 2 months of this year. We're now hearing new factories being put on hold. That's what happens when you distort policy.
How do your clients feel about it? How are they about remaining committed to funds exposed to equities?
So we've spent a lot of time doing webinars with our clients since the market peaked because there was already, a sharp correction going on.
Yeah, this whole DeepSeek was actually the Mag 7 problem, not MAGA.
Right.
Did you agree with Bessent?
Oh, no. I thought that was also ridiculous. I'm sorry. I thought that was when it started, though, the sort of franticness. But then we got a rally. No, of course not. I think that's where these guys are losing credibility, because those of us that do this for a living look at it and go, no, that's not in fact what it.
Bessent used to do it for a living.
I know. Isn't that interesting? Yeah, and took a very hard stance on many issues. But no, but when you go to an administration, your job is to be an advocate for the policy projected by the administration, which is why I will never be in politics. But our clients are pretty measured. I got calls yesterday, should I add more money? And it was like, no, let's wait. This is not done. But mostly we've seen flows in. Yeah, not mostly, 100%. Yeah.
For Tengler Investments, Nancy Tengler, it's good to have you back with us. Thank you very much. So coming up on the show, Meta faces backlash from whistleblower testimony to Congress and prepares to fight the FTC on antitrust allegations. We'll have more on the social media giants' battles next. This is Bloomberg Technology.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. The names that move markets are on Bloomberg.
The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond.
Nobody covers business like Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to? The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Quick check on these markets. The losses are accelerating. We're off by more than 4% across the S&P and the NASDAQ. We wipe off about a third of yesterday's gains. The points drags, when in fact there's only 6 or 7 names in the green on the NASDAQ 100, everything else in the red. Booking Holdings is a key point drag. ASML, its ADR is a key point drag, but so too is Meta. And let's just talk about Meta and social media a little bit more, because the EU's governing rules on digital platforms like X, like Meta, shouldn't be considered trade barriers with the United States. That's all according to the EU digital chief, Henna Verkunen. Speaking with Bloomberg's Oliver Crook, the digital chief really outlined how the EU's rules are fair for everyone. Take a listen.
These are same rules for everybody, so these are not like trade rules. So when we speak about Digital Service Act, Digital Markets Act, or AI Act, we know that we have same rules for all the companies who are operating in the European Union. So for the European companies and also for Chinese or USA companies, so it's very fair for everybody, and these are not creating trade barriers.
And the Digital Services Act, we've been expecting some decisions specifically on Meta and on X. Is there a delay to that due to the pressure being put by the Trump administration? When can we expect progress on those?
We have several investigations going on under Digital Service Act, 10 different investigations, and of course we are enforcing the rules, respecting also the due process. So always when we are doing investigation from the Commission side, of course, the main purpose is also that we want that the online platforms, that they are complying with our rules. And often this is the case during the investigations, that they are also changing their behavior. And that is, of course, what we want, that they are respecting our rules.
And so, for example, with X, which is, I think, the most advanced investigation that you have, what would you like, what is the end game? What would you like X to look like? How would you think is an appropriate way for it to sort of shift?
What we are saying in our rules, it's very much that online platforms, they have to have the processes in place, that how they are assessing and mitigating the systematic risks they are posing for civic discourse, for electoral processes, for people's well-being, and also that they are transparent with their actions, that the users know, for example, why certain content is shown for them, and the users has to have also choices how to change also the recommender system.
And I'd like to also get an idea of your sort of channel of communication to these companies. Have you spoken, for example, to Elon Musk? Have you spoken to Mark Zuckerberg? Who have you spoken to of the tech CEOs, and what are those conversations like?
Normally, it's, of course, our Commission's technical team who is working with those platforms' technical teams, with their lawyers, and that is all the time the dialogue we have going on. So when we are enforcing the rules, it's not only the investigation. So we have all the time several parts. So we have all the time dialogue with online platforms, especially, of course, it's done by our services. And then also also we have different code of conducts. We are preparing different guidelines. Online platforms, they are also carrying their own independent audits. So there's several parts all the time how we are implementing and enforcing the rules.
Mm-hmm. That was EU Digital Chief Henna Virkkunen speaking with our own Oliver Crook. Now, Meta is facing congressional criticism over its dealing with China following whistleblower testimony yesterday. Bloomberg's Riley Griffin back here with me in SF. The principal accusation is that made by the whistleblower is that Meta was briefing the Chinese Communist Party as early as 2015. But reading your story, it's more about the reaction and fury of the lawmakers, if anything.
No doubt. In fact, I think this congressional hearing ended up being an opportunity for members of Congress on both sides of the aisle, these senators, to take aim at Mark Zuckerberg. They called him inauthentic and disingenuous. Even Republicans were questioning his magnification, if you will, the comments he's made on Joe Rogan, the famous podcaster, to suggest he's aligned with Trump's agenda. So this proved to be a blasting of Zuckerberg, and one that we imagine will continue when they say that they're going to call him to Congress.
I mean, he's also potentially going to be speaking because of the FTC investigation as well. This is not a great time to have federal leaders seemingly not behind you, particularly when they're going to be questioning the purchase of WhatsApp, the purchase of Instagram, and potentially breaking this company apart.
Yeah, beginning on Monday, we're going to see perhaps the most existential threat to the company begin with the FTC trial. So you've got the threat from regulators, lawmakers, and then pressures internationally from Europe, as you had just posted in that video.
Meta currently off by 6.4% on the day, one of the worst points contributors to the downside. Riley Griffin, thanks so much for keeping us up to speed. Meanwhile, coming up, we're going to be digging into some other news, where ST Micro cutting as many as 2,800 workers over the next 3 years. More next, this is Bloomberg Technology.
In case you missed it, on Bloomberg Crypto.
We believed in crypto for a very long time. We believed in DeFi. When you look at DeFi and the power of that, I mean, it's really restoring the power back to the people. There's nothing that DeFi, there's nothing that cryptocurrency on blockchain can't do better, cheaper, in every way, faster, more transparently than the financial system that we have right now. There's not a Friday that goes by where I'm not chasing a swift wire transfer, hoping it comes in on, before the 4 p.m. deadline, or trying to send one out. You can transfer millions and millions and millions of dollars worth of Bitcoin overseas, while having a glass of wine with your wife at 11 o'clock at night. That's a beautiful thing. Our financial system in this country is antiquated. Our financial system in this country has been punitive to so many different people. And so we're reinventing the financial system. I'm all in, personally. I really, truly believe in this with every part of my heart and soul.
Don't miss Bloomberg Crypto live Tuesdays.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, former Treasury Secretary Larry Summers of Harvard on the consequences of the Trump tariffs. Ambassador Richard Haas of Centerview Partners on the TikTok deal, where President Trump might need to look to get the money to put into his sovereign wealth fund. And former Transportation Secretary Elaine Chao tells us how to fix the air traffic control system.
Reorganize the structure.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's time for Talking Tech, and first up, ST Micro announced plans to cut as many as 2,800 jobs over 3 years in an effort to increase efficiency and automation. Though there was no mention of tariffs, the semiconductor manufacturer says their latest cost-cutting efforts will reshape their manufacturing footprint and, quote, resize global cost base. Meanwhile, the company's supervisory board has officially backed its CEO Jean-Marc Chery just one day after the Italian government publicly withdrew their support over top management. Plus, Amazon had equipped some of its delivery vans in Europe with defibrillators to help speed up aid to heart attack victims. Called Project Pulse, the program involved over 100 contract drivers who were trained on the devices who would receive alerts from citizen responder apps. Amazon concluded the program after several months and is evaluating the feedback on future opportunities. And Tesla is set to open a showroom in Saudi Arabia, the latest sign that Elon Musk is putting behind a bitter feud with one of the kingdom's most powerful men. The showroom is expected to showcase its vehicle lineup alongside the Cybercab and Optimus robot. Tesla's entry into Saudi Arabia marks a sign of goodwill towards the Saudis and a potential growth market for the company. Caroline.
And let's just return to Amazon, because it also released its annual letter to shareholders this morning. CEO Andy Jassy acknowledging they want to be more like a startup, but also later discussed that sellers could be passing on some tariff costs to customers. For more, we're joined by Bloomberg's Tom Giles. Let's go to the letter first and foremost, because really trying to show that AI demand is still there, and also they're trying to be more agile with it.
They want to be very like a startup. They want to be firm. They want to be agile. And what Amazon, one of the sayings at Amazon is always day one. It's always day one. Remember what it's like when you are a new business, you're a new company, you're just starting out, and the world is your oyster. And that's something that Jassy has worried about Amazon employees losing over the last couple of years. That's why he said they all have to come back after COVID, after people were working from home. He said come back because people are losing that sense. Culture is extremely important at Amazon, and he definitely wants them to get that startup mentality, which is so important for these companies.
I just, Tom, want to quickly go to the conversation Caroline had with Andy Jassy earlier in the year, because it's all about CapEx, right? Listen to this.
You did say basically a $100 billion run rate for CapEx expenditure. Can you give us even like a percentage breakdown of how much that goes to distribution, logistics, and how much goes to AI?
Well, lion's share is, tell you most of it. Most of it. The lion's share is more than 50%. Yes.
Is it more than 80%?
We're playing the warmer and colder game.
Yes, exactly.
No clues in the letter about CapEx. Earnings isn't far away, but I think this is in the here and now what people care about.
Well, right now people are focused on tariffs, right? And we're seeing that in the markets. We're seeing it with the ways that stocks, including of Amazon, are getting whipsawed. He hinted at that in an interview with another network, talking about how, there's an expectation that some of their sellers are going to pass tariffs onto their customers. And look, they receive there's a lot of inventory, there's a lot of products, there's a lot of sellers who are China-based or China-affiliated. And so if that tariff stays where it is, that is absolutely going to affect Amazon's ability to compete with other online sellers, especially if those sellers are able to diversify their supply chain, get those products from somewhere else. A lot of it is made in China, so a lot of companies are going to be affected equally in many ways. Amazon's going to do what it can to keep prices low, he said, but there's no way that those prices will not be passed on in some way to end users.
Even as Bloomberg reporting yesterday showed that they've been trying to get that inventory, been changing it up in response to all of this. Tom Giles, who flew in on the red eye, landing this morning. What a hero. We thank him for being here in New York. Meanwhile, that does it for this edition of Bloomberg Technology. Ed, these markets whipsawing once again.
Yeah, you put it right earlier. It's a third back of what we gained yesterday, but there's still concern about tariffs. A 90-day pause sent markets to euphoria last night. I think everyone's taking a bit of a breather. Come back to us tomorrow on Bloomberg Technology. This is Bloomberg Technology.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
In case you missed it on the opening trade.
Is Trump, as he says he is, ready to do transformational trade deals as long as he gets his interests taken care of? Because if he is, that gives a huge opportunity for the UK to really move the dial on its growth with the US. So I can't imagine that you would shy away from that prospect if it's genuine. What remains to be seen, is it genuine on the part of the US? And we have to test that.
Don't miss the opening trade, live every weekday.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Welcome to Bloomberg Markets. I'm Vonnie Quinn. Manic markets following an historic rally in stocks. The benchmarks are lower once again as the reality that some tariffs remain in place hits investors. Convulsions in these markets, according to our Simon White, and you can see it once again. We're giving back about half or even a little more than that of the reprieve that we saw yesterday. So you have the S&P 500 down 4.6%, the NASDAQ 100 down 5.2%. Now the 2-year yield at 381 down about 8 basis points. A little bit of a reprieve for those investors looking towards the 1 o'clock auction because you have the 30-year yield trading now at 4.83% after CPI came in a little bit more benevolent than might have been perhaps. But let's take a look at the next board because we have the VIX right back up to the 45 area. We wouldn't have thought this morning, but it does seem like investors have been digesting all morning the fact that those 10% base tariffs are still going into effect. And we also have tariffs on China now up to 145%. So what really did we get yesterday? What did this 90-day pause portend? Crude back below $60 a barrel. Gold very close to its all-time high again at 31.57. And the dollar index plummeting 1.4%. Sterling stronger, the yen stronger, the euro much stronger. Is a recession back in the cards? We'll have to ask Goldman Sachs once more. But let's highlight a couple of individual movers, sectors and equities. Here's Bloomberg's Isabel Lee. Isabel.
Hey, Vonnie, you're seeing Nvidia, Apple, Amazon, Tesla all edging lower. In fact, Tesla is down by more than 10%, and you see Nvidia also edging lower by more than 8%. So risk appetites are vanishing yet again after the biggest burst of buying in years. We have stocks sinking as investors race to game out the hit in corporate earnings, economic growth, and new hiring. And that's really thanks to the effective freezing of Chinese trade. Next, we have big banks kicking off earnings. Tomorrow, we have JP Morgan, BlackRock, Wells Fargo, and Morgan Stanley all edging lower as well, down by as much as 5%. We have options traders preparing for larger swings than usual in the companies when they report tomorrow. And last, we have autos. So this is also a space to watch. Ford, General Motors, and CarMax edging lower. Look at CarMax. It's down by as much as 20%. CarMax backed away from the timing of its financial goals. And it really joins this growing list of companies that have cited the difficulty of planning long-term because of the Trump trade. Trump's tariffs, as we know, are expected to have a particularly harder hit in the auto industry. They have a 25% levy on those imports. In fact, we have car buyers rushing to dealer lots last month. Back to you, Vonnie.
Isabel,
Well, thank you so much. That is Bloomberg's Isabel Lee. Well, amid all of this volatility, traders, for the most part, perhaps have ignored fresh inflation data today that did show price pressures lessening. Let's bring in Michael McKee, international economics and policy correspondent. Does it matter anymore, Michael, since these tariffs seem to be going into effect at some point?
These numbers don't matter. They're from March, and March has passed, and we only had some tariffs in place during March. So we didn't see a huge impact from it. We did see CPI on a headline basis drop by 0.1%. A lot of that due to gasoline prices, which were down 6.3%, pushed the year-over-year number to 2.4%. If people cared, it would be really good news for the Fed and the idea that they could cut rates again. But talk about that in just a moment. CPI core up just 0.1%, and that also pushes down the year-over-year rate to 2.8%, much less than anticipated. But did this have anything to do with tariffs? No. Well, maybe a little bit, but not so much the tariffs where prices were raised. It was things that didn't happen because people were worried about tariffs. Smartphones down 1.1%. Nobody raising prices. Perhaps companies got smartphones delivered from other countries other than China. Furniture and apparel were both up. Those are areas that do come from China, but they're pretty much up the same amount they have been in previous Marches, so it doesn't necessarily mean we're going to see a tariff impact in these numbers. But look at airfares, hotel, and lodging. A lot of people started canceling trips, started backing off from going places because they're worried about the economic impact of tariffs. Fed officials not so worried about the impact of tariffs today, but down the road, we've had a number of them, including Lori Logan of Dallas, Jeff Schmid of Kansas City saying today we have to keep an eye on inflation because it's likely to go up, but we could also have a problem with growth slowing down. They could also have a problem perhaps with the markets. There was yesterday a thought, Vonnie, that we might have to see some Fed intervention because of the way the markets were trading. That all went away when the markets rallied, but now we're back down again. Beth Hammock of the Cleveland Fed talked to our Bloomberg economics team yesterday and basically said the markets seem to be working okay. There's a lot of volatility, but here's what Beth said. From my vantage point, which is a different vantage point from what I had 2 years ago, I'm looking at the markets. Markets look strained but functioning. And of course, she was the treasurer at Goldman Sachs, so she does have a sort of different viewpoint now.
Yes, strained but functioning, at least for now. We'll see what happens between now and 4 o'clock. Michael McKee, thank you so much, keeping an eye on everything that's going on in these manic markets. Well, amid all of this, Bloomberg caught up with some of the biggest names in finance and politics as well. Take a listen to their take on the past 24 hours.
The pause is not a stop, and you still end up in a place where you have 10% tariffs across the board and 125% tariffs on China, and that's going to mean that Americans are going to pay more for groceries, they're going to pay more for housing, and our companies, especially small businesses, have uncertainty because what's going to happen in 90 days.
We have to make some difficult choices. We might have to go through a brief recession in order to rebuild our foundation.
I think it's likely that we're going to be in a recession, and I think right now it's close call and it's probable.
The bond market had a fit in this sell-off, and it was largely due to, it wasn't a basis trade. It's the fixed floating swaps.
The thing the president has said that I think is encouraging is that he's open to negotiating, and the goal now is for him to define what does he want to accomplish in these negotiations, and hopefully for those things to happen very quickly.
So volatility, as we can see, gripping equity markets and long-term bonds still showing signs of uncertainty. We're joined now by Sarah Malik, head of equities and fixed income and chief investment officer at Nuveen. Sarah, from the moment I came in this morning, I was reading notes across the board saying, look, yesterday's bounce was nice and everything, but this is not over, far from it. In fact, not that much has changed. What's your outlook today on whether we're headed towards recession?
Markets aren't flashing the all-clear signal today because there's still tremendous tariff volatility out there. Even though yesterday was the 9th best day for the S&P 500 in all of history, we're still concerned about 3 factors. That's the impact on the economy, what's going on with China, and of course, first quarter earnings, which kicks off tomorrow. So starting with the economy, even with this 10% baseline of tariffs, that's a hit to GDP this year of about 1.5%, and it should increase PCE inflation by about 1%. So in that scenario, we we barely skirt a recession, and it could get worse from there because we don't really know where this China tariff escalation is going to end. So that's the second point, is we're still in this negotiation period for tariffs with all the countries, especially China being an issue where I think the Trump administration has shown they're very focused on our trade relationship with China. And then first quarter earnings, I actually, it'll be a backward-looking factor. We expect growth of about 7% year over year for earnings, but we're going to be very focused on company commentary. I think guidance may get withdrawn, definitely could be lowered, and so first quarter earnings could add some volatility to this mix.
Do you have a base case anymore? Is there any world in which that 10% base tariff moves lower at all?
Now, at this point, I'm not expecting it to move lower. Our base case is that it stays at 10%, and hopefully we're able to negotiate with a bunch of countries outside of China so it doesn't get much worse in there. But I would say there's just tremendous uncertainty in terms of where that tariff will end up, not only outside of China, but with China, of course, now hitting in the 145% level. This could continue to escalate for a while, and that's going to keep this market very volatile. Not surprised to see the VIX back up in the 40s today, and market, again, having these wild swings day after day.
Yeah, yesterday when we saw the reprieve, which may turn out to have been a synthetic reprieve, right? We don't know if it holds or if this half give back continues as the week goes on. We saw, all told, a 38 basis point move in the 2-year. We were at one point down as far as 363, and at one point we were above 403, Sarah. How can a market continue to function when you have those kinds of swings?
Well, government bond yields have been very concerning this week. And yesterday, before the announcement on the pause, what you were seeing was either tremendously increasing fear of inflation, or even more worrisome, the rest of the world perhaps turning away from the U.S. as a safe haven. And that's why I think you saw the spike with the 10-year. From our point of view, and we have over $1 trillion in publicly traded assets at Nuveen, markets are functioning still fairly well. There's a lot of liquidity out there. So we're not concerned at this point about markets breaking, but just thinking about where are we going from here on the S&P 500. I think we're in a trading range from here on out. If we do get a proper recession, the S&P likely bottoms at about 4,600, 4,700. We didn't get to that level. I think a deep recession is off the table for now if we can stick at this 10% tariff rate. And then on the upside, I think we need to see what the next catalyst is. Will we get those tax cuts we've heard so much about, deregulation, or even more watered down tariffs? Or finally, the Fed put. Could the Fed start to cut rates to help this market? I don't see that, at least for a couple of months, though.
Sarah, how much forced buying and selling are you seeing as opposed to positioning or repositioning?
I think yesterday was about short covering. You saw it. It was a lot of meme stocks, a lot of crypto, and I think people were not positioned for the pause. They were positioned for incremental downside leading to a recession. So yesterday was more about short covering rather than long only stepping in and buying, and that's why I'm not surprised to see somewhat of a reversal today. While the worst case is taken off the table, so I don't think we'll reverse all the way back down below where we were yesterday imminently, I don't think you've really seen long only large buyers step back in at this point.
If the market was cheered by the president and his affect yesterday for just a few hours, but that's already gone today, can we discount President Trump as a market mover, at least towards the positive?
I mean, I think either way, we're still going to be watching the Trump administration closely, and it will have an impact on the market. So, what's going to impact the market going forward? I think positively or negatively, the Trump administration, what is the Fed doing in terms of their commentary? Are they willing to look through inflation-related tariffs as a bump or more permanent? So will we get those 2-ish rate cuts this year? And then, of course, corporate earnings are going to be important. Can we stick to that 7% earnings number for the first quarter? For the full year 2025, we expect earnings to grow about 4 to 5%. That's still reasonable. I think if corporate America and the consumer can hold up, that would be a positive for the markets. I do think that's in question, though, and we'll find out more next week when we get retail sales on how the consumer is doing.
Sarah, given the volatility this week, is there a number of cuts that it's reasonable to price in right now, or can you even forecast that for 2025?
Well, Fed cuts have been all over the place. They went all the way up to 5 a few days ago, and I think now we're down with the market expecting about 2 rate cuts this year. We've been in the 2 rate cut camp for 2025 for this year. I think that's reasonable because the Fed is balancing sticky inflation. That it was great to see that moderate CPI number today, but we all know that's backward looking. So we need to worry about what are tariffs going to do to inflation. And they're balancing that, of course, against the economy, which is slowing. And how do they balance that? I think that the magic number will probably be around 2 rate cuts starting this summer.
All right, Sarah, thank you so much for watching the markets as closely
Thanks
as we
for
are.
having
That
me.
is Sarah Malik with Nuveen. Let's turn now to currencies, the dollar and the yuan specifically. China allowing it to weaken against almost all major currencies to support its economy. The weakening yuan makes Chinese products cheaper relative to other countries' exports, which can help offset some of the impact of U.S. tariffs. The dollar, of course, also weakening. Today, the Bloomberg Dollar Index down 1.4% right now. Let's discuss the FX markets with Wells Fargo macro strategist Eric Nelson. Eric, do we buy into this devaluation or are we done yet?
I think we're getting to a point here where we're probably going to see some intervention from somebody, whether it's Trump backing down further off tariffs or announcing some sort of deals with other countries. Maybe it's the regulators, so announcing changes to leverage ratios, things like that, to sort of alleviate balance sheet pressure on treasuries. Or maybe it's the New York Fed actually stepping in with more operations to outright offset some of this liquidity crunch. It's hard to say exactly what's driving this, but it's the price action right now is actually consistent with the UK LDI crisis and mini budget crisis of 2022, where you have U.S. dollars plummeting just as U.S. rates are going up more than a lot of peers. So it's remarkable to see this in the U.S. I think if you do see one of those actors come in to stabilize this, you'll see things normalize. So rates come down and dollar reverses higher.
When you say that you think that we are close to some kind of an intervention, do you mean the Fed pulling out one of its tools, for example? And if we didn't see that yesterday or the day before, is today really the day or tomorrow?
Yeah, it could be, I don't know if there's some sort of, sense of wanting to see maybe Trump be the first mover. We know yesterday he specifically called out the bond market in the justification for his, willingness to back down on tariffs. So maybe there's some hope that he'll, watch today's price action and again, maybe try and come off the, still aggressive tariff position that the U.S. has. But at a certain point here, if you start to see this spread more into pressure in repo markets, I think the New York Fed and regulators may have no choice but to intervene.
What would it take, or what is it taking for a reserve manager, say, sitting in Tokyo or the United Arab Emirates or Copenhagen, for that matter, to start reducing dollar assets?
Well, I think we've seen some of this. You look at the weekly data from the Japanese finance ministry, for example. That was the fourth largest outflow from foreign bonds from Japan in the last decade. It was a pretty big number, and that was last week. So we'll actually get this week's data next Thursday from a couple of different counterparties, including the New York Fed, which has sort of an aggregate measure. So we do get some decent data on this. It's hard to see it in real time. I'll say we know that in Japan's case, there was a lot more unhedged, FX unhedged holdings of U.S. government bonds and other foreign government bonds. So with dollar yen coming lower and bonds selling off, that's probably a painful combination for Japanese holders of U.S. Treasuries, and it may have led to some forced selling. But away from that, it's possible there's a confidence crisis in the dollar and Treasuries. It's very hard to see that in real time in the data for us.
Well, we did see the auction yesterday with some pretty decent demand, and we have another one coming up at 1 o'clock. Will that give us any kind of a clue, this 30-year auction at 1?
Yeah, I think these auctions certainly are important to get a sense of where foreign demand is. I think yesterday's numbers weren't all that great on balance, and I think there's still a lot. Certainly, the price action today speaks volumes. I think there's still a lot of concern here around where foreign buyers are in this market. So yeah, I think this auction is going to be watched extremely closely, just as yesterday's was.
Obviously, the main battle is between the U.S. and China right now when it comes to escalation. We saw China escalate overnight. Now we have 145% tariffs on many Chinese goods. We'll see what happens tonight out of China. We spoke with Heyman Capital CIO Kyle Bass earlier. He sees a clear winner for this tit-for-tat trade war, and that really, is one outlook on this, right? But China can devalue, and it can continue to devalue. How much can China devalue its yuan?
Well, the challenge here is, at a certain point, you have 150% tariffs. Devaluation is not going to fix that, right? It's not going to be enough of an offset. So I think there's a reasonable case here that, there's probably going to be some rerouting happening The tariff on Vietnam and India and some other countries in the region just went down to 10%. And the tariff on China is 145%. There could be certainly some rerouting. The problem with devaluation, I mean, for what it's worth, we do think China continues to kind of very slowly let the yuan, weaken. I mean, of course, the advantage is with the rest of, FX kind of strengthening versus the U.S. dollar, the Chinese renminbi is actually getting more competitive even without them having to devalue the yuan versus the dollar. So that's kind of convenient for them. But I think that, they don't want to cause a destabilizing move. They don't want to cause capital outflows, which ultimately would be, more harm than good for them on the domestic front.
Possibly, but they also have to counter this somehow, Eric. Can they stimulate the economy other ways? Can they, do helicopter money like they've done in the past?
Yeah, fiscal. I mean, the rhetoric from them on fiscal has gotten more aggressive. They're talking more about consumer demand, stimulating consumer demand. They certainly have that lever to pull. They've been, I think, hesitant to pull it because I think they are still holding out for kind of seeing where the final landing zone is here on Trump tariffs, and making a strategy there. I think that they clearly have some ideological opposition to full consumer side demand. We've seen that in the past. So I think they're still waiting to get a final sense here of where this lands before making any big decisions.
Eric, we're seeing the VIX now very close to 50. Once again, we have stocks at session lows with, the NASDAQ 100 down 6.2%. These are clearly markets in convulsion. Where have you seen the stress points strongest this week? What should we be looking for in order for maybe some kind of a shock to bring in the Fed?
What I've been shocked by is that this has not yet spread out into kind of U.S. dollar funding, whether it's cross-currency basis, kind of repo markets, all these kind of plumbing sort of metrics that we like to look at. Those have held in mostly okay. There's definitely been stress, but nowhere near what we saw in, say, 2020, 2008. I think that's why the Fed hasn't stepped in yet. They certainly have tools that are already kind of out there, the standing repo facility, FX swap lines. But this hasn't really reached that critical point yet where it's become a full-on funding crisis.
Every time we get a reprieve, and that's happened twice in the last few days, it seems like, we can all breathe a sigh of relief, right? And then the next day we're reminded, no, perhaps permanent damage has been done. What's your opinion on whether permanent damage has been done to the US dollar and to the US reputation as, lender to the world?
Well, yeah, I mean, certainly if you think about a world where the U.S. just trades less with the rest of the world, that's certainly a world where foreign reserve managers don't need to hold as many dollars. Right, that's just academic. So I think there's an element to that. Also, security guarantees, and also, I mean, we have to be honest about policy credibility. The sort of supposed goals of the Trump administration on this have changed every couple of days, both in perceptions and announcements. So I think it's a very difficult outlook for the dollar here. I think if we do see a genuine dollar funding crisis, it will very quickly turn into dollar strength because there's still a lot of dollar assets out there that need to be funded. But I think longer term here, this is, I think, ultimately quite bearish for the U.S. dollar over a multi-year horizon.
Really hate to ask, Eric, but do you have any kind of forecast for where the dollar bottoms versus, say, the euro or sterling or the yen, and then where it goes from there?
Well, if you're thinking about longer-term forecasts, I think it's fair to say the kind of medium-term growth productivity outlook for Europe has just gotten a lot better given the enormous German fiscal stimulus that's come through. And the prospects for U.S. productivity and fiscal stimulus as well don't look quite as good as they did a couple weeks ago. I mean, certainly tariff revenue, it's hard to use that as an offset given all the back and forth. And the budget bill is looking, maybe like it's going to be maybe somewhat underwhelming. So, I think it's seeing mean reversion up to over a 1 or 2 year horizon, 120. I don't think it's really out of the question here, and you can start to imagine higher numbers over a multi-year horizon.
120, wow. Eric, thank you so much. Hang in there, Wells Fargo macro strategist Eric Nelson joining us now. And we've seen significant volatility in the municipal sector as well. It is time now for Muni Moment, our weekly segment focusing on the US municipal bond market. An historic week in munis, seeing record-breaking action. The US muni market logged the most trades ever amid the tariff-fueled uncertainty over the past few days. For more on this, we're joined by Jennifer Johnston. She is the Director of Research for Municipal Bonds at Franklin Templeton. Is there anywhere in the municipal bond market that might be a safe haven at a time where we don't have that many of them, Jennifer?
Yeah, well, we actually believe that all parts of the municipal market can be a great place to invest. If you're looking to maximize yields, of course, you want to go out the maturity curve and down the rating scale. But one of the things that we love about the municipal market is that we're able to meet the needs of our clients. We have portfolios and different strategies, short, medium, long-term, high grade. We have high yield. We actually think there's value at all aspects of the maturity curve and all of that sort of thing. And we have an experienced research staff to help us really find those opportunities anywhere.
What happens to states with large agriculture-based economies or trade-based economies, or perhaps those with ports?
Yes, so the impact of the tariffs will directly impact certain states and certain regions more than others. And you nailed it exactly where we're kind of focusing our attention. It's those states that have the big agricultural areas that are very dependent on trade, and also those mainly coastal communities where they have large ports and logistic operations that normally handle the incoming and outgoing trade. And one of the things that we feel comfortable with, however, is that generally muni credit is very resilient. And if we look at the port credits as an example, many of them are diversified, meaning they have many streams of revenue, some of which will be less impacted by the tariffs. So ultimately, we think muni credit will be able to react well to some of the challenges that are going to be largely economically driven from these tariffs.
Jennifer, we've seen the administration pull a lot of funding from higher education, and we've also seen massive DOGE cuts so far. How are those actions affecting municipal bonds in those sectors?
Yeah, so you've hit on a couple of the sectors that we're watching closely. I'll take the DOGE cuts first in terms of employment, and I'll take the D.C. metro area as an example. And we're definitely going to see layoffs there. And, the D.C. itself, Northern Virginia, Maryland will be impacted. However, one of the things that we like to point out is, I'll take Virginia first. Virginia is a large state. The, D.C. area is a small portion of it. We're not really expecting any large impacts to credit on the Virginia credit. Largely the same thing in Maryland. DC is a little different. They were actually struggling and were already on negative outlook prior to the announcement of these costs. And what we're watching there is what happens to these people who've been unemployed. Can they find jobs elsewhere? Do they end up relocating? What happens to the housing market? And then related to some of the desires to reduce the amount of real estate that the federal government leases or owns, what's the impact going to be on the commercial real estate area in DC? To your question on private higher education and also healthcare in the same way, we're watching closely to see what happens with federal grants, whether it's research driven or Medicaid driven in terms of healthcare. We're watching to see what happens. On the private higher ed side, we actually find the market to be largely bifurcated when it comes to credit, meaning that you have a really strong portion of the private higher ed market. Think, credits like Harvard and Stanford and Yale and, the big flagship public universities. And then you have those small regional colleges, and those have been struggling for the past few years. Okay. We think a lot of these federal cuts are more likely to impact those stronger credits within the sector. So we feel pretty good, continue to feel pretty good. But
Jennifer,
it really
thank you.
goes to show
We do have to leave it there, unfortunately, but we appreciate your time. That is Jennifer Johnston with Franklin Templeton. These markets continue to sell off, and it is getting worse as we head into the lunchtime hour. The NASDAQ 100 down 6.7% now. We have the VIX at 53 and change. Do stay with us, continuing to cover these markets falling off a cliff once again today.
have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Welcome to Bloomberg Markets on this convulsive day for the markets. I'm Vonnie Quinn, and let's get a quick check on where we stand now midday. We have the S&P 500 falling off a cliff, basically. We are down about 6%, down around about 7% for the NASDAQ 100 right now. And we have the VIX climbing all session long. It's almost as if these markets are really internalizing what these tariffs actually mean. Almost like yesterday was some kind of an hallucination, to use an AI word these days. We did see the VIX climb and spike. So as you can see, we're at 54 once again. In fact, close to 55. When we topped 60 early yesterday, it was a panic moment. Are we close to a panic moment again? And what could save us this time? Is it going to be a tweet from the president? We do have 145% tariffs on China right now. And those base tariffs of 10% on every single country have gone into effect. So there are tariffs. We're in a new regime already. It's just that that 90-day window seemed to give investors pause yesterday. What does it really mean, though, for those countries that want to come to the table? As you can see, the 30-year, and we are waiting on an auction coming up at 1 p.m. We saw that 10-year auction yesterday not failing. It was okay. What's going to happen to the 30-year today? We saw a nearly 10 basis point move on the 30-year to 4.83%. Well, let's highlight a couple of individual equity movers, and good luck with this one. Bloomberg's Deniska Tsova joins us now.
Yes, let's start with United States Steel. Shares tumbled as much as 10% a day after President Donald Trump said he does not want to see the steelmaker owned by a Japanese company. He pointed to the producer's rising steel orders, evidence that that investment is not needed as of now. The stock is actually up 20% year to date. Let's look at the energy sector. It's actually taken a big hit today as Exxon and Chevron are down about 5%. Though the broader energy sector escaped the drastic tariffs from the Trump administration, we have seen a hit on oil demand, and we have seen oil prices fall below $65 a barrel. So that's definitely putting a lot of pressure on those companies. The outlook has soured amid the escalating trade war, and of course we have a shock output hike by OPEC. And one last name is Constellation Brands, which actually is up on the day, but issued a downbeat guidance amid US tariff, muted demand, and all of this is weighing on beer, wine, and spirits makers. The stock reversed losses from a big pre-market drop earlier today, but it's still facing steep tariffs on imports like popular Mexican beer. And of course, we have younger people drinking less and less alcohol, which is weighing on the stock. Back to you, Vonnie.
Yes, at least for now, Denitsa. We'll see if that continues. That's Bloomberg's Denitsa Tsakova. Thank you so much. Well, during all this back and forth regarding President Trump and tariffs, Oaktree co-founder Howard Marks wrote a note on Wednesday about the turmoil and its potential lasting impact. He writes this: "Last week's events remind us of the events of 2008 and the global financial crisis they produced. All norms have been overthrown. The way world trade has operated for the last 80 years may be of little relevance to the future." For more, let's bring in Kay Herr. She's the US CIO for Global Fixed Income, Currency and Commodities at JP Morgan Asset Management. So, Kay, thank you so much for coming in on such a wild day. They've all been wild this week. Are we in a new regime, and what does it look like going forward?
So first off, Ani, thank you so much for having me. And this week I'm reminded of James Carville. I don't know if you know who he was, but he was President Clinton's strategist. And if you recall, and I'm paraphrasing him roughly, he said if there's such a thing as reincarnation, he would like to be reincarnated not as a president or as a pope, but as the bond market, because the bond market intimidates everyone. And I think that seems to have been the case this week. So, you know, my dear colleague Kelsey Barrow was on with you yesterday, or on with your colleague Scarlett yesterday, and it's interesting to think that in 24 hours, on the one hand, so much has changed. On the other hand, so little has changed.
What are you doing at JP Morgan about calculating the impact on the economy of these tariffs? Yesterday we had Goldman Sachs putting out a recession call and rescinding it just several minutes later. And you know, no fault to Goldman. That was the truth of the situation at the time. Recession was on the cards, and then it suddenly wasn't on the cards.
Sure. So I think a couple of things. First off, you know, the president has talked about tariffs being a beautiful word to him. And so we started analyzing the potential impact of tariffs last year. And we looked at, if you look at the investment grade corporate universe, for example, running with cash flow of roughly 5% and stress testing that. And we think given where profitability is, I mean, basically, U.S. corporates are at record profitability. We think there is a margin. Obviously, there's a wide range of sectors, and stable sectors with resilient cash flows won't be impacted at all, potentially, or very minimally. Other sectors, it's going to be much more difficult. In terms of what we're doing, I think it's really important to take a step back and think about, you know, before I walked away from my office, which might no longer be the case, but volatility was starting to abate. And
no longer the case.
That seems to be off again. But maybe to look at the volatility we've seen in the last couple of days, we've had 30 basis point swings in terms of yields on investment grade debt. That's pretty material. Similarly, we've had 100 basis point changes in yield in high yield debt. But I think what's interesting is that from our perspective in trying to buy bonds, dealer balance sheets feel very light. So trying to put bids on liquid bonds, there really aren't any bonds to buy. I think before I walked away, and that may not be the case anymore, there was a semblance of normalcy back in the investment grade markets. There were 4 issuers testing the markets, and I think that is a good sign for functioning markets. I don't know if they've been pulled at this point.
Look, I think one thing we can say for sure is that the cost of funding is going to be higher for some time. How much of a premium does this uncertainty place on those funding costs?
So I think that's an excellent point, and that's really what's driving the fundamentals right now. You've got a question about what is the risk-free rate, and then you also have what spread premium is the relevant one, whether you're looking at investment grade or high yield bonds. That's exactly what the issue is. But I think if you take a step back, in the last couple of weeks, you've had the possibility of recession priced in not significantly, much more than it was. You saw high yield spreads touch 500 basis points yesterday. You've seen investment grade spreads out to 120 basis points. So there's now some possibility of that in, which had not been in previously.
We have Austin Goolsbee coming out just in the last few minutes saying that volatile tariff policy means that the Fed should wait. But he also says this, that political interference makes big rate hikes difficult. Now, that's not something we would have read a couple of weeks ago. We every now and then would raise the possibility that the Fed might have to hike down the road, and typically we'd be laughed out of our chairs, right? Inflation was still the big problem. However, big rate hikes is now possibly something the Fed is thinking about.
So I haven't had a chance to read what he said, so I'm not going to comment on his comment specifically, but I would remind you that as recently as 2023, people were worried about reacceleration in the economy, stickiness of inflation, and that the Fed would be hiking again, and they certainly were not. So to me, those fears seem premature at this point. I think it's important to remember that tariffs are essentially a tax. From an economic perspective, it's going to be a one-time shift upward in prices. And when you look at market-based assessments of inflation, those are actually coming down because the market is increasingly pricing in the possibility of a recession. In terms of whether a recession comes or not, I think debating the percentage, as you mentioned, some sell-siders have been doing, is very difficult given the fluidity of the information that's coming in. But I think if you just think about corporate behavior and consumer behavior, given the level of uncertainty, what happens is a pause. Are people going to make a big capital expenditure? Are they going to hire big people? That pause in and of itself arguably puts more pressure and increases the likelihood of recession or slowing economic growth.
And we've seen many stock buybacks, right? That's another option for companies to be doing. Now, you're across fixed income currencies and commodities. Have you seen signs of real strain, and where? Pinpoint those places for us so we can keep an eye on them.
Yeah, so I think the first thing we should all acknowledge is there's been a pretty significant increase in volatility, and when volatility increases, delevering and de-risking comes in. So yes, there's been some movement in the basis trade people are talking about, where hedge funds are putting material leverage on things like that. So increase in volatility can be problematic for that. We've seen some de-risking. We've seen some surprising moves in areas that I wouldn't necessarily have expected, such as municipals. We saw municipal bond yields widen 50 basis points. I think there's some significant technicals going on right now, particularly in that market. So as a public service announcement, tax day is April 15th. So it's not uncommon for people to sell short-dated securities or municipal bond securities to pay their taxes. So some opportunities there in volatility. But broadly, as I said, fixed income markets functioning.
Last question.
Yeah.
What was the one question that you got most in the last few days?
I think the question that we're really getting the most, and we've had a number of client calls lately, what are we doing right now? And I think this is exactly the time to stop and think about fixed income and what's it do. Recession risks are rising, bonds are on sale, fixed income is providing stability in portfolios, yields greater than cash, the yield curve's positively sloped. So really for clients, it's the time to defend assets, so fixed income can do that, to diversify those risks in portfolios, and to lean in where we've seen some opportunities.
But is the 10-year at 4.35 a risk-free rate anymore? That is the question that stays with us. Kay Hur, thank you so much for joining us. Very difficult times, very exciting times as well. Kay Hur, JP Morgan Asset Management. Time now for our stock of the hour, and CarMax shares falling after the company removed timeframes associated with its long-term goals, citing, quote, the potential impact of broader macro factors. It also missed on its fourth quarter earnings. Bloomberg's Craig Trudell now joins us to break this all down. Craig, you know, CarMax is one of those companies that you might have thought would pull through this, right? It sells used vehicles at a time when tariffs are going on new vehicles. It sells parts for cars, and people might want to be repairing their cars. So what exactly happened here?
Yeah, I think this was a case of a company that was sort of on people's lists as a place for refuge, and for them to come out, post some earnings that, you know, I don't think the earnings themselves were actually that bad. If, you know, it's not every day you see the headline of a big established company touting, you know, an 80% increase in earnings year over year, and yet for them to walk back from some of their timelines for their long-term goals, I think it just speaks to this idea of companies really being you know, nervous about sort of the volatility that they're feeling. And even in the case of a company like CarMax, you know, while they would benefit from increased demand for used vehicles, they will feel you know, cost increases of getting those parts for people who want to repair their car instead of buying a new one. And even procuring used vehicle supply is going to be tricky, because dealers, I can tell you, all over the country are rushing to get their hands on more in sort of anticipation of demand. So this is a crazy time for the car industry, and even used car retailers are going to see increase in costs as well.
Now, we saw the big automakers lobby in Washington, D.C. to at least have tariffs removed or minimized on, you know, very small parts that were being imported, just little parts to help, I suppose, with the overall cost of making a vehicle. Where did that go? Did we end up getting any kind of concession for those types of imports?
I think honestly, at the moment, the industry feels like it's come up empty. But I can tell you that everyone is extremely concerned about the impact that these tariffs are going to have on the sector. It's a sector that the president has long emphasized when he talks about trade. It tends to be sort of the first thing that's on his lips or the first thing that's on his mind. I remember when Business Week sat down with him as a candidate last summer and got going on trade. It was the first sort of tangible thing that he pointed to, and it's something that I think will be more difficult for members of the administration to sort of talk him off. You can sort of maybe convince him that certain industries aren't worth bringing back in the U.S. I think the car industry is something that in his mind he wants to see car plants coming back, and doesn't want to hear that may take years. He's someone who wants announcements and wants sort of tangible progress, and doesn't want to hear about how that's going to be complicated or difficult.
Bloomberg's Craig Trudell, thank you so much. And certainly CarMax's stock getting absolutely really dinged, down 19-20% just from pulling its guidance and being honest. Look, we don't know what's going to happen. Is that going to happen to more companies? We're joined now by Gina Martin-Adams, Bloomberg Intelligence Chief Equity Strategist. Perfectly reasonable thing to do, to say, look, I don't know. I don't know what's going to happen. Let's pull our financial guidance and wait and see. But investors don't like it. Is that fair?
Yeah, it is fair. I think that you are going to see a number of companies pull guidance as they work through this transition period, because the tariffs are so tumultuous, because we've had so many different layers of communication, a lot of implementation and then pullback. Companies are really struggling to plan, and therefore if they're struggling to plan their operations or struggling to plan their approach, it doesn't make a lot of sense for them to give us any kind of guidance when they're really more day-to-day, week-to-week, month-to-month. I think we're going to see this pretty profoundly across the index over the course of the next quarter or so as we work through this.
Which is terrifying, because that publicly traded companies like CarMax depend on smaller companies, right?
Yeah.
Small and medium-sized businesses to do much of their business with. And so what's going to happen as a secondary effect to those businesses?
Yeah, I think it's a really good point, because you've got the biggest of the big that are probably most profoundly impacted by this in terms of they were drivers of multinationalization, multi-globalization. They were creating more and more vertical supply chains, taking advantage of global companies. Those companies will be at the forefront of implementing changes, while the smaller companies face the immediate direct cost hit as well. We've done a lot of analysis on this, and we did second and third layer COGS estimates for every S&P 500 company. We actually find 40% of the overall cost of goods sold for the S&P 500 comes from outside of the United States. So if you were to tariff that 40% at something like 20% or greater, which right now it's looking like we're going to get an average tariff rate of about 26% after the announcements yesterday. But if you were to tariff that cost of goods sold at the 40% of cost of goods sold at even 20%, the net result is a 7% decline in S&P 500 earnings this year overall. And that, of course, is much more profound for certain companies in the index, certain industries in the index.
Well, exactly. And when you realize that, it's not universal across countries, China is being tariffed at 145% and is charging tariffs of 84% on U.S. goods for the moment, you have to imagine that companies are going to really see a huge amount of variety as well in those cost of goods sold.
Exactly. So you've got a 145% tariff on China right now specifically, but you've got 10% on everyone, and selected tariffs on Mexico and Canada as well. So it's very pervasive. It's just a matter of degree. If you have any global exposure in your supply chain, you will face an increase in cost.
Companies are priced on, what people think their growth is going to be. How do you do forward earnings profiles right now?
Yeah, it's very, very difficult. So what we do is we look at analyst consensus, we look at what's priced in the market, and then we start to scenario analyze, right? Yeah. So analyst consensus expectations are for 9% earnings growth over the course of 2025. That seems incredibly unlikely considering today's environment. But the market itself, even at its lows, was priced for 15% earnings growth to emerge. So that tells you why we're so volatile here as we're starting to reprice an earnings reality for the S&P 500. Our models at large say your downside maximum risk at this point is you actually enter some form of economic recession and have a 17% decline in earnings emerge this year. So that's a huge range right now of potential outcomes. Most likely, if you look at the moving run rate of economic data, which is a pretty good predictor of likely earnings for the S&P 500, that says most likely right now you have somewhere between a 3 and 5% decline in earnings emerging over the course of the next 12 months. We'll see how companies navigate the risk of tariffs as we go, but you could see that result in some form of economic recession as they pull back spending, as they right-size operations. If that's the case, then your downside risk is much bigger.
Gina, incredible. Thank you so much, and thanks for keeping us in the loop as you change your models, not just on a daily basis, but likely on an hourly basis. That is Gina Martin-Adams, Bloomberg Intelligence Chief Equity Strategist. And now for a look at the moves in metals, copper, aluminum and zinc in particular. We are seeing a little bit of a bounce back today, but that's from extraordinarily low lows in some cases. Copper, though, trading there on the LME a ton, just below $9,000. We learned also today that the EU actually, let's now get to President Donald Trump.
There'll always be transition difficulty, but we had in history, it was the biggest day in history, the markets. So we're very, very happy with the way the country's running. We're trying to get the world to treat us fairly. This is something that should have been done 25 years ago, and it wasn't. Should have been done 40 years ago, and it wasn't. But no president was willing to take it on, but you had to. It's not sustainable. It wasn't sustainable. And as you know, without a lot of money being added, because there's a lot of money that we could add, the country is making approximately $2 billion a day. And when you think of it, we've never done that before, never come close to it. And the number is probably $3.5 billion a day. And that makes us a very strong country. But we have Scott here and Howard and some of the people that are working on deals. And the biggest problem they have is they don't have enough time in the day. Everybody wants to come and make a deal. And we're working with a lot of different countries. And it's all going to work out very well. I think it's going to work out really very well. But we're in good shape. There's no inflation. There's very little inflation. And I went 4 years without inflation, and I took in hundreds of billions of dollars from China and others, taxes in China. But we took in hundreds of billions of dollars a year from China, and we had no inflation, essentially. So we think we're in very good shape. We think we're doing very well. Again, there'll be a transition cost and transition problems, but in the end, it's going to be a beautiful thing. We're doing again what we should have done many years ago. We let it get out of control, and we allowed some countries to get very big and very rich at our expense, and can't let that happen. It's not a sustainable formula. So I wanted to just thank everybody at the table, and maybe I'll go around and ask some of you a little short couple of answers. Pete just got back from Panama, and he's been all over the place, and you want to give us a little report on that and whatever else you might have to say. Everyone at this table is doing an incredible job, by the way, I have to say. Incredible. And the relationships it's like they're friends. They're really, the relationships are very strong, really good, really strong. And these meetings are very good. And I think, I don't believe there's any other president that allowed the press to come into a meeting such as this. These are very sacred meetings. These are very private meetings. But we have nothing to hide. And I think it's good. I think it's a good, we want to be, a word you like to use, Jeff, is transparent. So we want to be transparent, and we'll do that by starting with Pete. Go ahead, Pete.
Yes, Mr. President, we just got back from Panama last night. We were at the Panama Canal with our Southcom commander ships, F-18s, troops, and signed a couple of historic deals. One which is with the Panama Canal Authority, a framework for U.S. vessels, first and free through the Panama Canal. Right. And then also a memorandum of understanding with their security minister for the presence of U.S. troops. Fort Sherman is an old U.S. base there, as well as their naval station and air station, jointly with Panama to secure the Panama Canal from Chinese influence. That's something you said, we're taking back the canal. China's had too much influence. Obama and others let them creep in. We, along with Panama, are pushing them out, sir. And so we had a very successful trip. Their president, President Molino, sends his regards, very complimentary of the U.S. He's a great ally, and I think they want the Communist Chinese out. And with our troops there partnering with their forces, we've got a chance to push them all the way out, sir.
We've moved a lot of troops to Panama and filled up some areas that we used to have, and we didn't have any longer, but we have them now. And I think it's in very good control, right?
Yes, sir.
Okay. Thank you, Peter. Very good. Howard?
So, so we've have so many countries to talk to. It is it's incredible. I think Scott and I'm not sure we could ever have enough time in the day to talk to all these countries because they want to talk and they want to talk now, and they have come with offers that they never, ever would have come with, but for the moves that the president has made, demanding that people treat the United States with respect. We're getting the respect we deserve now, and I think you're going to see historic deals, one after the other. And then I'm very excited that within a week and a half, we're going to start with the gold card, and the Trump card is coming out, and we're very excited about that, and that's coming soon. So very excited.
Good. Thank you very much. Good job. Linda?
Well, on a couple of fronts, we have been addressing the issue of anti-Semitism on campuses. There's been some grant funding and contract funding that we've reviewed, and some we've canceled and some we've put on hold, waiting for that, while we do an investigation. On the other side of what my responsibilities are in having education go back to the states, we're meeting and talking with governors. I was with, this week, all 50 commissioners of education around the country, and because we also want to provide them with tools and best practices as education does move back to the states. Making great progress, great response from the states, and very positive.
And what about colleges? You're holding back $400 million from Columbia, $8 billion from Harvard. Can you imagine the money we pay Harvard? They have a $60 billion fund, and we're giving them $8 billion, and we're trying to figure that out. And then they hire de Blasio, the worst mayor in the history of New York, and they hired the woman from Chicago who was a disaster, total disaster, and they pay them massive salaries, and they're supposed to be teaching you government. That's not Harvard. That's not Harvard the way it used to be. So, do you have anything to say about that? The dollars you're holding back from quite a few universities that were not behaving.
Yeah, and the other, there's Princeton, Cornell, others that are coming in, and actually getting calls now from the presidents of the universities who really do want to come in and sit down and have discussions. And so we're investigating them, but in the meantime, we're holding back the grant and the fund money.
Okay, great job. Thank you.
Very thankful for the House voting for the President's budget resolution along with the Senate bill. Made a ton of progress this week in working with members to ensure that a desire for flexibility in the Senate was not misconstrued as a desire not to slow and do spending reforms. And so we're very thankful for that. And now we can get after writing that bill, getting the President as big a package of his agenda to his desk. So very good week.
Good. That's right. We just got the House vote. And now we're well on our way to getting, as we call it, the great big beautiful bill. It's a beauty. There's never been a bill like this one. We're trying to get it all into one beautiful bill. It's tax cuts, regulation cuts, and many other things. The border, a lot of money for the border. Well, you're doing a fantastic job. So, but we just got a report that we, as you know, you knew before us. Were you surprised we got the vote? Got the vote. And we're happy to get the vote. So I think we're going to be in very good shape. Okay, please.
Mr. President, last year, the
Chinese received 1,700 orders for new ships. American shipyards received 5. Under your leadership, like so many other industries, we are going to revitalize and make shipbuilding and maritime great again with these blue-collar jobs. These are the cranes, the ports, opportunity zones, and drive that investment back in. We have, under that executive order, and also one to streamline foreign military sales for people that want to buy our equipment, and of course acquisition reform, all just this week under your leadership, Mr. President.
So we're going to be rebuilding our shipbuilding business. We may would have to go to Congress for this, but we may buy some ships from other countries that we're close to and that do great jobs with ships, but we're going to start the process of rebuilding. We don't really essentially build ships anymore, which is ridiculous. It's going to be a very big business for us in the not too distant future, but in the meantime, we have countries that do very well at building ships, and we'll be dealing with those countries, and we may be ordering top-of-the-line ships from those countries. And within a fairly short period of time, we'll be building our own ships. So we'll probably have to go to Congress for that, but we're not going to have a problem. Susie, thank you very much for the job you've done. Go ahead, please.
I just wanted to make sure you know that this cabinet, I think, pretty uniquely collaborates and cooperates and works together to accomplish all that you've asked them to do, and I think they deserve a lot of credit for that.
It's true. You're doing a great job. The chief of staff, doing a great job. Lee, go ahead.
Mr. President, the Biden EPA was strangulating the economy. The Trump EPA understands it's not a binary choice. We can protect the environment and grow the economy. Working with Doge and Elon Musk, we've now canceled $22 billion worth of grants. And we have launched what is the largest deregulatory action in the history of the country, just in one agency. That's how much of a mess the Biden EPA left us. It is going to end up reducing the cost of living. It's going to create jobs. It's going to make it easier to purchase a car. It will be easier to heat your home. We're proud of this effort. The effort that we have is fulfilling the mandate that you earned from the American public. Clean air, land, and water for all Americans, unleashing energy dominance, permitting reform, advancing cooperative federalism, making America the AI capital of the world, and bringing back American auto jobs. When you called me that day asking for me to take this position, I was honored. And you were very specific and clear in what you wanted us to accomplish. We understand our mission, and at the Trump EPA, we're going to make it proud.
Great job. You're doing a great job. And you have a lot of applications for approvals for power plants, which are going to really power the regular plants, and they're going to be right next to each other because we can't rely on our grid. It's old and it's tired, and it's very subject to being attacked, whether by rain or by bombs or by anything else. And we're letting people build their own power plants, and these are a lot of them being built with the AI and beyond the AI chips, and we're letting them build their own power, and never been done before, and we're going to get it done quickly and approved quickly as part of a plant. They'll have a sort of be their own power company, and it's very exciting. They couldn't believe it when I told them that. I said, we're going to get you the approvals very fast as part of your regular plant. You're going to build electric producing plants, and it's very exciting. And they're able to do it very quickly and very well. And you made it possible. Thank you. You have a lot of applications for some of the biggest plants that have ever been built in the world. These are serious plants, aren't they? Huh?
Approved. We are open for business. Working with Secretary Burgum, Secretary Wright, we are going to make you proud.
Good. Sean?
First off, Mr. President, it's Brooke's birthday today, so she's getting younger, so happy birthday to Brooke.
Thank you.
I want to thank you as well for the shipbuilding at EO. Again, to build ships, we also need mariners to sail those ships. I was just up at Kings Point for the Merchant Marine Academy a couple days ago, and we have some of the greatest young men and women who are learning how to be mechanical engineers, to rebuild and fix the engines on those ships, but also how to sail ships. I would tell you that over the past decades, this academy has become, it needs some love. It's been a little bit dilapidated. We have to invest in sailors, and I appreciate you taking the initiative. To be a global power, we have to build ships and have sailors to sail those ships. These are the very people that help Pete should we come into points of crisis to support the military. So thank you for that. Number two, the last administration announced 3,200 projects, big, beautiful roads and bridges. Most of them are good. But they announced them, they didn't sign a grant agreement. 3,200, so the money doesn't go out the door to build the infrastructure in the country. And it's fun to do an announcement. It's actually the harder work to put together these grant agreements. So we're doing the work right now at DOT to get these grant agreements done and build the projects. Most of them are good. And they also put in all of this green and social justice requirements on roads and bridges. We're pulling all that out and putting the money toward the infrastructure, not the social movement from the last administration.
Good steel, right, as opposed to green paper mache. Okay, thanks. Great job.
Sir, first, we are, I would say, more than friends. We've all become family, and I think that what you have assembled in your vision is a turning point and an inflection point in American history. And so just being a part of that is the greatest honor. So thank you for that. And again, just the relationships here and the honor and respect we have for each other is a reflection of you and your leadership. So I just wanted to say that first. The second thing I want to say is that on behalf of the farmers and ranchers, food security is national security. We have to be able to feed ourselves. And your idea of using tariffs along with deregulation and tax cuts, but your idea of using tariffs to ensure that we are putting forward and putting America first, no one understands that better than our farmers and our ranchers. But having said that, emerging from 4 years of Biden with a 30% increase in inputs for our farmers and ranchers, with an almost $50 billion trade deficit. When we left the first time, it was zero, meaning that they are hurting. So the period of uncertainty we're in, they know that your vision will move us into an age of prosperity for all Americans, but for my people, for the farmers and ranchers, unlike any they have seen before. And I think they are really, really excited and so grateful for your leadership. But also, you have never failed to say that you have the backs of our farmers and our ranchers. It was the first phone call that I had after I was voted with the Senate, and that message just resonates with an almost 85% support of you in the last election. They're with you. Interestingly, the biggest budget driver at the United States Department of Agriculture is not farming and ranching or agriculture, it's food stamps. And so as we emerge and embark, Secretary Kennedy and I, on your vision of making America healthy again, a massive part of that is realigning and reworking our food stamp program so that it better serves those who need it. And yeah, to the point of getting the transgender, DEI, Green New Deal out of the USDA and realigning is really important. So
it's out of the military, right?
Yes, sir.
Is it 100% out, would you say?
99.9, sir. I'm going to get that last point.
Get the rest of it.
But thank you, sir.
We've got a much different military, I will tell you. Thanks very much. Good job. And eggs are down.
Eggs are
big,
down.
right?
Yes.
Big.
Yes, sir. Wholesale prices. Retail will come. Easter is the Super Bowl for eggs. So, you know, there may be a little fluctuation, but no, we feel really good about it. Thank you.
That's what I hear. Thank you.
Thank you.
Good. I'd echo what Howard said on the trade queue, that we've got over 75 countries that want to come in. So it'll be Treasury, Commerce, Jameson at USTR, and we're putting a process in place. And as you said, you're going to be part of the negotiations too, because I've had these countries call me up and Secretary Bessem, we're happy you're going to be negotiating. Well, President Trump's going to be involved too. So bring your best deal. On the budget, it's moving quickly in the House and the Senate, thanks to your leadership. We're also going to have debt ceiling in there, so we're going to get an increase in the debt ceiling. So, and that will be the done and dusted for.
Part of the bill that we just got to vote on today. So.
Part of the bill. It'll be done and dusted for 2 years. We won't have to worry about that. And then I gave a speech yesterday to 1,400 small and community bankers, and they were so happy to hear from your administration. And I told them Wall Street's done great for the past 4 years. 10 years, 20 years, it can continue doing great, but it's Main Street's turn now, and it's those small bankers through deregulation, through emphasis on Main Street, your Main Street agenda, bringing back jobs, that is going to power the smaller communities. And then finally, the bond auction went very well yesterday. We had a lot of foreigners show up as the support, showing that the U.S. is still the best place to invest. The inflation report, as you said, was quite good. And energy prices are down more than 20% since January 20th.
Amazing.
That's great. Really good numbers.
Great numbers.
Thank you. Pam?
President, we've had some great wins in the last few days. That you were
we just heard from the Secretary Scott Bessent alongside other cabinet officials at a cabinet meeting live in the White House. Thanks for joining us on Bloomberg TV and radio. This is Balance of Power. I'm Kaylee Lyons alongside David Gura in Washington. As we were just hearing multiple cabinet officials talk specifically about tariffs, the Treasury Secretary Scott Bessent saying that there is a process being put into place for negotiations in which he will be involved, but President Trump himself will be involved. And President Trump began this cabinet meeting with the press assembled in the room by saying that they are working with a lot of countries, though he did note there will be transition cost and transition problems as we go through this. We also heard from another important voice when it comes to this administration on trade, the Commerce Secretary Howard Lutnick, saying that countries want to talk and they want to talk now, suggesting they're coming with offers they never would have come with without President Trump's policies. So perhaps no surprise, David, that they're obviously very focused on trade given the developments of the last 24 hours, the pause in the 90-day pause in reciprocal tariffs for most countries, hence leaving room for these negotiations, that the tariffs on China remain in place and actually elevated to at least 145%.
And the Commerce Secretary allowing there's hardly enough time in the day to talk to all of these countries who are calling the White House now, trying to talk through what a deal might look like for each of them. Again, a fairly short time horizon here for all of these deals to be worked out, and we see the president sort of making his way around that cabinet table in the cabinet room. If in fact he fields questions from reporters at the conclusion of that, rest assured we'll go back to capture some of that for you here on Bloomberg Television and Bloomberg Radio. I want to turn now to Michael McKee, our international economics and policy correspondent, who has been, listening in as the president and his team have been speaking, but also paying very close attention to the 30-year bond auction that we saw just a moment ago, and also the undulations that we have seen and continue to see in the markets, both in the bond market and the stock market, and to the economic data that we got as well, the CPI data this morning. Mike, I just want to get your reaction to what you heard there, and maybe give us your sense of sort of what these next 90 days look like. Here we have an administration eager to broker deals, as we heard there in that meeting. That's meeting with the realism of how difficult it is to broker trade deals historically, all the nuances and details that go into them.
Well, I took a year, more than a year, to renegotiate NAFTA, and almost nothing was changed in that treaty that came out as the USMCA. So I think you have to approach what this administration is saying about these deals with a great deal of skepticism. For example, we heard there, and we've heard from others in the administration, that 70 countries have approached the administration. But Kevin Hassett said this morning on one of the other networks that there are 20 countries. So, I mean, what is the actual truth, and what are we actually going to get out of it, and how much of this is going to be tariff reduction, and how much of this would have anything to do with non-tariff barriers? I mean, remember, they went after the Europeans and the British for having a VAT tax. Does that get addressed? Yeah. So a lot of reasons to be skeptical about what they're talking about. But what we can say will happen is if these other tariffs that are already in place stay in place, we will see prices go up, and we will see the economy slow down. It's going to be very interesting. These are very heavily weighted, obviously, towards China, and we import a lot of stuff from China. So how is that going to affect the American consumer's psyche if they can't get things from China?
Well, and investor psyche as well. After the remarkable gains of yesterday, the best day since 2008, obviously we have a massive reversal on our hands with 5% losses on both the S&P 500 and even greater for the NASDAQ 100. And we know markets did play a role in the decision-making of President Trump yesterday, though he was specifically concerned about the bond market, talking about queasiness, Mike. And I wonder if a little bit of that queasiness has been abated, not just by the tariff moves, by once again, for a long-duration Treasury auction, the 30-year yield, it looks like demand was was a bit better than expected.
Yeah, the 30-year comes in reasonably strong. It stops through 2.7 basis points, about what we saw with the 10-year yesterday. It does suggest that people are out there looking for duration. Dealers took less. Directs, though, took a lot more than they did yesterday. Direct bidders and indirects were down a little bit from their average, but still relatively strong. So not a major change in the auction statistics, but a well-received auction in this case, as was the 10. So that may supply a little more confidence to people in the fixed income markets about foreign demand and overall demand for U.S. Treasuries. There's been some talk that people were backing away from investing in the U.S. I think the equity markets are reflecting what normally happens in these kinds of situations where you have a big turndown. This is what we've seen before, where you get these rallies and then stocks go back down again. Very much the pattern after 2008, after Lehman Brothers. So you just have to wait and see how long that takes to play out and where people start to find value again. And it may be hard to do in the sense that people can't trust exactly when all this tariff news is going to stop and we'll have what there is.
Mike McKee, at the start of that meeting, the president remarked on the inflation data that we got today, the CPI data, and he said, quote, "There is no inflation." He then corrected himself. There's very little inflation, he said. We know that those data are looking backward, not forward, and there's a lot on your agenda today. You couldn't escape for the speech that Austin Goolsbee of the Chicago Fed gave at the Economic Club of New York, but he brought this up and talked about the inflationary aspect of these tariffs and indeed the difficulty that it's going to pose for Fed policymakers going forward here, having to navigate, yes, these kind of inherently inflationary policies, but also what we saw over the last 24, 36 hours, that being a chief policymaker who's making a quick reversal on his policy priorities, seemingly. Talk a bit about the way that policymakers, yes, the ones that you cover most closely here in Washington, have to focus on, but those around the world who are trying to figure out the direction of policy going forward here and how they sort of complement that.
Yeah, it is an issue for central bankers around the world, but a little different in different places. It is possible that because the Europeans, for example, will be putting on, if they actually follow through, lower tariffs than we're putting on, and it depends on what they tariff, they may not have an inflation problem. They may have more of a disinflation problem. And so the way they're going to approach this is different. Because the U.S. is driving all of this, we can have a growth slowdown and we can have inflation rise. And pretty much all of the Fed officials who have spoken this week have addressed that conundrum for them. What do they do in that situation? If you raise rates to bring down inflation, you might hurt growth and vice versa. So they're all saying we've got to be careful. We can't make decisions right now. We have to watch what happens. They've sort of all leaned into the idea that inflation is the thing that would matter more. But the formulation that they've always used is we'll look at which number is deviating the most from where it should be and attack that. So the bottom line message from them all is it's going to be tough on us. Don't get mad. We'll get around to it when we have some idea of exactly what we're doing.
All right, Michael McKee, Bloomberg International Economics and Policy Correspondent. Thank you so much for joining us as we're keeping an eye on financial markets. We may be off of session lows, but the NASDAQ 100 right now down 6.2%, still on pace for its worst day since March 2020. So let's get a check on the latest with Charlie Pellet in New York. Charlie, I'm having COVID flashbacks for sure.
Certainly a day of fast-moving developments. We got you covered on Bloomberg Television and radio. Let's recap and reset here in terms of U.S. markets as our market coverage continues. Investor psyche does remain fragile. We are on track for the fifth decline in the last 6 sessions. Right now, the S&P is down 5.4%. Keeping that in context, you run the HCPI function on the Bloomberg. We were down 6.3% at the worst level of the session, but right now, a drop of 5.4% on the S&P. We're down 291 points. The S&P at 5164. The Dow down 1,866 points. That is a drop of 4.6%, with the NASDAQ Composite Index down 1,050 now, a decline of 6.1%. The Russell 2000 Index of small cap shares down 6%. NASDAQ 100 Index also down by 6%. Bottom line here, another day of steep losses for the U.S. equity market. 10-year 4.35%, the 2-year 3.81%. Gold is up $76 the ounce, up 2.5%. $31.59 the ounce on spot gold, and West Texas Intermediate crude is now plunging by 5%. WTI $59.24 a barrel. So bottom line here, steep losses again, fear engulfing Wall Street, with the S&P now down by 5.4%. Our market coverage continues on Balance of Power. Back we go to Washington once again. Your hosts, David Gura and Kaylee Lyons.
Charlie, thank you very much. Charlie Pellet there in New York, following the markets for us as we look at the sell-off this afternoon. Gold, that glimmer of green in a sea of red. As we look at this kind of violent reversal, and I'm kind of curious here, Kaylee, to watch all this unfold, sort of what fundamentally has changed? Yes, I think we can all agree it's a good thing that a trade war isn't being fought on 70-plus fronts, but it seems like the biggest battle, the most fundamental one here, is between the U.S. and China. Yep. And we were talking a little while ago just about the notion of decoupling and sort of where we are in that conversation, but a very deep divide now between these two economies, and I think investors are reckoning with the fact that that's the case.
Well, and it's not just any two economies. It is the two largest economies in the world. So while it does have major ramifications for both the domestic economy and the Chinese economy, there could be ripple effects across the globe as well, as we consider that when you add on the 20% fentanyl tariffs to the now 125% reciprocal tariff President Trump has placed on Chinese goods, that gets us to at least 145. And of course, China has slapped 84% tariffs back in the other direction on U.S. imports. And that leaves specifically tech companies incredibly vulnerable. If you're an Apple or an NVIDIA with that China exposure, perhaps the euphoria of yesterday is giving way to a bit of a reality check on that front today. And it's on that note we go to Mike Regan, Bloomberg senior editor, joining us from New York. And it is remarkable, Mike, after the best day since 1998 for Apple yesterday, that stock down 6.5%, NVIDIA taking it on a chin as well. It does seem that technology stocks are looking particularly vulnerable in this Thursday selling.
Yeah, Kelly, and I would sort of reiterate what Mike McKee just said about whenever the market has one of those just insane rallies like we saw yesterday, that doesn't necessarily inspire the type of confidence you would think it would. Wall Street traders are all too familiar that those type of eye-popping rallies really only happen in the middle of bear markets. We saw it in COVID, during the financial crisis, and many other bear markets. So I think when you think about the difference in mood from yesterday and today. Yesterday, the rollback or the delay of the tariffs for 90 days was certainly good news. It wasn't likely worth almost 10% in the S&P 500. What seems to have happened, according to a lot of investors and strategists, and just looking at the data itself, is that there was a massive short covering. When you think about some of the most sophisticated, biggest hedge funds and other investors in the world, many of their strategies actually can be boiled down into something very simple and trend following. We've had this downtrend in the market since the middle of February, and that just inspires a lot of traders to short this market, to borrow securities in hopes that their prices will go down further and they can buy them lower and sort of pocket that difference when they repay that loan. So a big part of that rally yesterday, I think, was short covering. That happened in a flash, and now it's over. And we're back to really thinking about these fundamentals and the uncertainty around the fundamentals and the market resuming that downtrend.
I was reminded of something I read from RenMax Neil Dutta yesterday in light of what you said there, Mike. He wrote in his latest note, when markets rise 10% in a day, it's not a sign that things are healthy. I think getting at the point that you were making there. What is your sense from going through notes this morning and sort of getting a sense of where the market is today, of what investors are looking for here, what that kind of clarity is that they need to see here? There was that allowance from the president yesterday that he intends to be more flexible than we thought he was going to be going into this, perhaps an indication that he's willing to carve out some exceptions, something that he and his economic advisors had sort of ruled out flatly at the beginning of this process. What more do investors need to see here to kind of cheer them, or is this something that you think we're likely to see going forward over these next 90 days, this kind of anxiety about the uncertainty, sort of how these deals come together?
When it comes to that sort of looking for clarity, David, one of the really, I think, most illustrative things I read this morning was from our colleagues writing about Walmart. Walmart basically told one of its suppliers in China that produces Christmas ornaments, don't put the price tags on the ornaments. That was typically the last thing they did before shipping them out. You know, Walmart would tell them, put this price on each item, and they'd ship them out with the price tags on them. Now they're saying, don't put those price tags on these Christmas ornaments. And that really, I think, speaks, it's a great anecdote that speaks to the unknowns throughout not only the C-suites of companies like Walmart, but in the spreadsheets of investors trying to figure out exactly what to expect for the rest of the year. You know, we've seen Delta pull its earnings guidance. We've seen CarMax pull its earnings guidance. A pulled earnings guidance is almost as alarming to investors as a reduced earnings guidance. In some ways, I think they would prefer to see that. At least there's some numbers to work with. When a company completely pulls its guidance and says, we just don't know what we're going to make this year, it's very alarming for investors. And that's really the clarity, I think, from the Wall Street, from the trading side of things, is clarity on what that earnings outlook is going to look like. And there's just none to be had right now because of all the issues, all the uncertainties, and lack of clarity from Washington. You know, Trump is famously can change his mind from day to day and increase tariffs, pause them, eliminate them, and you know he's just impossible to predict. So that just sort of feeds into all the decision makers in the C-suites around the country and the world, really, and all the investors trying to put a value on what these stocks are worth. And it's just a very hazardous situation when you don't have answers to all these questions.
Mm-hmm.
Well, and Mike, that's an excellent reminder that big bank earnings kick off tomorrow. JP Morgan will be reporting at 7 a.m. Eastern time on Friday. For banks that came into this year thinking there was going to be a revival in animal spirits, investment banking fees potentially were going to fly. Obviously, we're living in a bit of a different reality. You were just speaking to the idea that earnings guidance is getting pulled, but we've seen IPOs pulled as well due to the volatility in markets right now. And I wonder what you're expecting the banks might be signaling tomorrow and how much of a catalyst that could be for wider equity markets.
Right. Well, they're in the books earnings through the end of March won't tell us a whole lot just because a lot of this turbulence has happened since then. For this current quarter, I mean, some of the big banks, you know, that have trading desks might be able to put up some great numbers for those trading desks. But those don't tend to really impress Wall Street investors because they do come at the expense of everything else you're talking about, IPOs being pulled, likely some M&A that is being reconsidered. And it just, you know, it's going to be a volatile outlook for the banks. I think the remarks, especially from the likes of Jamie Dimon, will be the most important thing. Again, the banks aren't going to be able to give us any more clarity than anyone else can. But as we've seen, you know, even yesterday, the words of someone like Jamie Dimon mean an incredible amount to investors. So I really think his conference call remarks will be must-see TV, or at least must-listen to earnings call for all of Wall Street coming up.
Mike Regan, thank you very much. Mike Regan, senior editor on markets in New York. And I think back on what he just said there, we've heard an awful lot from President Trump this week. Maybe second to him, we've heard a lot from Jamie Dimon. There was the lengthy letter that he wrote to investors earlier this week, followed by that interview, which was in a way kind of unprecedented here during a quiet period before earnings, going on Fox Business and having a long conversation about the economy with Maria Bartiromo. And then, as Mike was alluding to there just a moment ago, the comments we expect him to make on the earnings call that JP Morgan has in the coming days. I want to go to Terry Haynes now, the founder of Pangea Policy, and I suspect that he was shaking his head as I was asking Mike Regan for sort of a sense of the rational response that we might see in markets to what the president is doing here. Terry, we talk a lot about sequencing in the context of the president's legislative and economic agenda. Let me ask you about sequencing in another context. That is, how this White House, how this administration goes through what they say is a long call log, a long list of countries and trading partners eager to meet with this administration to hammer out deals. They want to send a sign to the markets, to Americans, that in fact they're making progress. Who needs to be at the top of that list? Who should they be prioritizing as they go through the sequencing of these trade deals?
Thanks for having me. I think they should sequence in a couple of different ways. One, they should probably look at the United Kingdom, in Europe, but not of it, so to speak. I'd also look at major unaligneds, particularly India. India is hugely important, and working out some deal with Modi would be a great signal. Let's remember just 2 months ago in Washington, Modi came here and talked about MAGA plus MEGA, make India great again, equals mega. So maybe Trump should figure that out. And finally, somebody in the Asia Pacific, either Japan or Australia, would be very good. I think those three would send large signals about the seriousness and kind of the direction of travel of the administration.
Well, as we talk about the seriousness of the administration, Terry, and it's great to have you back here on Bloomberg TV and radio, I wonder if you see any kind of credibility dent that the administration is now going to have to contend with as it conducts itself in these negotiations, considering, once again, we have seen an extreme change in tariff policy and a flipping and flopping of the narrative. Does that actually give these other countries who are coming to the table a little bit more leverage? Is there a bluff to be called at some point?
Oh, sure. There's credibility gaps all over the place. There's a credibility gap on the part of the administration to some extent. There's an awful lot of allies and friends of the United States that feel whipsawed and feel bruised in a lot of different ways, and this pause does a lot of things. But one of the things it does is gives Trump an opportunity to right-size those relationships and frankly reassure people. One other thing that we should all be aware of too was that. Lutnick's people at Commerce were out to a number of major countries, and I assume others as well. I know of a few that giving people a laundry list of what they wanted to talk about, both in terms of tariffs and other sorts of trade barriers, before the tariffs even went into effect. So, I will give the Trump people good marks for being able to talk to allies and friends and others before all this started. So hopefully that can help push things. Thirdly, I would point out as well, I thought Mike McKee gave a very good summary of all of this a few minutes ago on your air. One thing I would add to that, though, is that countries may well be able to come to deals by making future promises. The United States itself does this by saying, we're going to reach a deal to do X, Y, Z on trade, and as part of that, we promise within a certain period of time, we're going to pass legislation, we're going to change rules, whatever. Those countries will do similar things, I think, in order to make deals.
It must be grading season. We have here Terry Haynes giving his marks to the White House. Ira Jersey, our chief rate strategist for the U.S., giving his marks to the auctions that we've seen over the last couple of days, giving the 10-year auction an A+ and a 30-year auction an A, saying that they were really solid. Makes me ask you, Terry, sort of how you look at this administration's visibility into the markets and their response. You wrote earlier in a note that perhaps the White House, we've misjudged how much this president cares about market moves. And I think yesterday we saw perhaps an indication that it's still something that the president cares quite passionately about, that he could see those startling moves in the bond market, for instance, and feel like he has to do something that things aren't going to course. Do you care to revise the statement that you made earlier? Have things changed this week vis-a-vis our sense of the way that the president looks at the markets?
No, I won't revise. I will extend my remarks, though.
Fair enough. You may.
On Capitol Hill. I will extend my remarks in this way. When markets say, geez, Trump cares about the markets, I mean, to me, that's a illusion and a rationalization extraordinaire. Because they don't really mean Trump pays attention to the markets. What they mean is we, the markets, are actually the masters of the universe, and Trump will do as we wish. Well, I've been telling markets for a couple of months on tariffs, that's not going to be the case. The reason why it's not going to be the case is because the goals here are geopolitical. This is not 2017. The reason why it's not is because economic policy is roped and yoked to geopolitical goals across the board. And, you can even see that with tariffs, where some of the tariffs exist for geopolitical reasons. Presidents don't think about the markets all the time. The markets are not the only thing that needs to be dealt dealt with. And, so what I would say to folks is that, you've shown, as Trump has shown, that he's certainly interested in where the markets are on these things, but he's not paying sole attention, and he's not gonna dance to markets tunes, number one. Number two, I think the other thing we need to remember here too is anybody on Wall Street that's self-congratulating today shouldn't. Because one of the reasons why these tariffs happened is essentially that Wall Street let them happen. In Washington, silence equals assent. If you're silent, that means go ahead. And they didn't really raise any objections to what was about to happen until well after it happened.
Well, it's a very fair point. Certainly, we're seeing, it seems, some protest happening now, looking at the red on my screen, Terry. Also on my screen, I would point out we are still paying attention to the cabinet meeting at the White House, which is ongoing. The president has gotten reports from almost every cabinet secretary at this point. The Secretary of the Interior, Doug Burgum, is speaking now, as you can see if you're with us on Bloomberg TV or on YouTube. We still have Secretary of State Marco Rubio to hear from, and then the president may well start taking questions from reporters. We'll dip back in for those if indeed that happens. In the meantime, though, Terry, as you speak to this idea that the president isn't exclusively focused on the markets, what have you learned this week about the influence others in his administration may have in interpreting the market action and then shaping presidential policy by extension? As we understand that Scott Bessent and Howard Lutnick presented a kind of united front to the president yesterday, which helped lead to this change in tariff policy. Is this actually a sign that Wall Street's initial expectations of Scott Bessent being kind of a steadying hand, if you will, when he was tapped for this position may indeed be serving in that role?
Markets still have a policy concern, of course, and in large part because this is a pause. It's not a volte-face or a throwing away of the policy. And Trump still has a lot of urgency around this. So markets are right to continue to be concerned. Where I think the White House has improved here is, though, in communication message, something that's important. And we've been talking for 6 months now about a so-called team of rivals that are headed up by Bessent and Lutnick. And I think what you saw yesterday here is Bessent put pretty much in charge of the messaging to Wall Street, while Lutnick is supposed to be responsible for the shepherding forward of negotiations and potential deals. Bessent has a foot in two camps right now. Bessent is trying very hard to push the tax cuts bill, and they'll try to push a bill and get it done, frankly, I think within this 90-day period. They have a pretty good chance of being successful at that. But at the same time, Bessent's going to continue to be the soothsayer for Wall Street, and that seems like the right conclusion for the Trump people to reach, since Bessent tends to stoke some confidence where I think Secretary Lutnick, for rightly or wrongly, doesn't.
Terry, you've mentioned a number of names there, and one that didn't come up is Jamieson Greer, Ambassador Jamieson Greer, the U.S. Trade Representative. And there was that photograph that we saw from the House hearing yesterday where the Truth Social post went out. And an aide had to lean over toward the U.S. Trade Representative and show him what the president had done. Where does he fit into this pantheon of economic advisors, and what does that tell you? Is it at all worrying that the man who has been charged here with trade policy wasn't in the Oval Office yesterday as Howard Lutnick and Scott Bessent and President Trump sat down and pounded out that poetic, important post on Truth Social?
Well, the USTR is typically given cabinet rank, not always by every president, but typically given cabinet rank. But at the end, not only does he get his power from the president, but he's essentially a staffer of the president. I mean, they all are, but they're not cabinet secretaries or anything else. And the USTR in this case, I think, is treated a little bit more as a staffer than as a peer of Secretaries Bessent or Lutnick. I also think, in Greer's defense, he's pretty new to this. Just got confirmed very recently, and probably not quite as up to speed on it as everybody else. But I think the net of what you point out clearly is that the three people who are in charge of all this are the president as the decision maker, Bessent as the person who has his eyes most clearly on the markets broadly, and Lutnick Nick is the person who's supposed to go out and execute these deals.
Terry, finally, all of this conversation on tariffs and the activity we're seeing in financial markets today, which I would point out the NASDAQ 100 right now off of session lows, still down, though, 5 full percentage points. The S&P down by about 4.5%. Seems to have overshadowed what happened on Capitol Hill earlier this morning, which was a successful vote in the House to pass the budget blueprint that was passed by the Senate, advancing forward the budget reconciliation process in the aim of achieving President Trump's legislative agenda, which is expected to include sweeping tax cuts. We keep hearing from this administration, tariffs are just part one. You have to wait for the second half of the economic policy. And I wonder how that factors in, although I understand now that President Trump is taking questions from reporters from the cabinet room at the White House. So let's listen and watch live on Bloomberg TV and radio.
I think Scott went out. Scott, you want to have a statement on that?
Sure. Look, the up 2, down 1 is not a bad ratio, or up 10, down 5. And I think as we have talked about, as we go through the queue and settle with these countries who are going to bring us their best offers, we will end up in a place of great certainty over the next 90 days on tariffs. But we had very good inflation numbers today. Oil's down. We had a successful bond market. So I don't see anything unusual today.
And next steps for China, sir?
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable. And we're talking about many presidents, not just a couple. But they did, and all we're doing is putting it back in shape. We're resetting the table. And I'm sure that we'll be able to get along very well. I have great respect for President Xi. He's been, in a true sense, he's been a friend of mine for a long period of time. And I think that we'll end up working out something that's very good for both countries. I look forward to it.
Mr. President, China retaliated today by reducing the number of American films that can be shown there. What's your reaction to them now targeting cultural exports from the United States?
I think I've heard of worse things. Yes, please.
Also on China, the Ukrainians say they have evidence that Chinese soldiers have been found fighting for the Russians in Ukraine. Can the U.S. verify this? And if so, what does the U.S. plan on doing to China to combat that?
We'll look into it, but I think beyond that, we're really looking to get that war stopped. They're losing 2,500 and even more than that young people a week. They're Russian and they're Ukrainian. They're not American, but they're people. And we're seeing if we can get it stopped. And I think we're making progress. I appreciate the ballerina who was released. It was at the request of a very good friend of all of ours, actually. Dana White called me and he said it's the friend or the relationship of one of the fighters for UFC or one of the fighters. And Dana's an incredible guy, and we spoke to President Putin about it, and they made a deal. They released the young ballerina, and she is now out, and that was good, so we appreciate that. We hope that we're going to be able to make a deal relatively soon with Russia and Ukraine to stop the fighting. It's so senseless. It's such a horrible thing. It would have never happened if I were president, but it did happen, and we were given that card. And I think we're going to get it. I think we're going to get it stopped. Got to get going. We got to get it. We have to move it faster. Likewise with the hostages, we're making progress. We, there's 59 hostages, but only 24 of them are living, and that's the way it's been presented to me by the mothers of some of the dead, mothers and fathers of some of the dead hostages, and they want the bodies of their baby, as they say, their baby, their young boys. They want them back as much as if they were alive. It's amazing, because when I met the hostages 2 weeks ago here, I couldn't believe what they had to go through, by the way. But when I met them, they said, yeah, there's 59, but 24 are living. And they actually consider, I guess if you're a parent, you do consider it this way, that the remainder who are dead, the 24 that are alive, the remainder that are dead, They want them back just as much as they would want them back if they were alive. It's really pretty amazing and pretty sad. So we're getting close to getting them back. We have a lot came back. A lot of people are very grateful. Some came back in pretty bad shape. Some came back, they're okay. I think they're going to be scarred mentally for a long time, because if you sit down and talk to them, as I have, what they went through is incredible. But we're making progress. We're dealing with Israel. We're dealing with Hamas, and it's a nasty grip.
Mr. President, how close are you to the first country coming to actually make a deal with the United States over tariffs? Is it days, months?
Well, I think it's very close, but we have to have a deal that we like. We don't want a deal that's going to be a bad deal, or I could make every deal in one day if I wanted to. I could do this all in one day. I could just say, here's what we'll do. And I was saying to the people before, to Scott, mostly to Scott and Howard, and some of the other people that work with us on the negotiations. We have a lot of law firms that have paid me a lot of money in the form of legal fees. We're going to probably use those firms to, if we can, I think we can. I'll make a contribution to the country, but they're great firms. They're the best firms, the biggest, and really the most prestigious. And we may be using them to help you guys out, because you're going to need a lot of lawyers. And I'm not sure Pam's going to be happy if I say, can you send over about 200 lawyers that work on trade? She's working on criminal stuff, and I think that's going to be her focus more than anything else. So we'll find out if we can do that. But we have a lot of lawyers that you've been reading about, where they paid $100 million a firm on average. Now we have the final 4 or 5 are at $125 million. So I have a lot of legal fees I could give to you people, and we might as well use them. Hopefully I won't need that many legal fees or that much. I may. Who knows? After it ends, after we leave, maybe I'll need it. But if I do, it's not going to be very pleasant. So I think we're going to try to use these very prestigious firms to help us out with the trade, because we have a lot of countries. But we want to make deals that are proper for the United States, not just we can make deals easily. We want to make them proper.
Mr. President, if you aren't able to reach the deals that you want to see at the end of the 90 days, will you put those higher tariffs in place, or will you extend?
Well, that's what would happen. I mean, if we can't make the deal that we want to make, or we have to make, or that's good for both parties, it's got to be good for both parties.
You wouldn't.
And then we'd go back to where we were.
Go back to the numbers that you announced last week.
I think so.
You wouldn't extend the pause.
Yeah. We'll have to see what happens at that time.
Thank you, Mr. President. You said yesterday you were considering some exceptions for companies. Can you talk about what you're considering, and then also on the reciprocal tariffs that would be substantially lower? Is the same math formula going to be used, or is that tossed out?
I'm not considering now for any country or company, but it's possible that I would. But I'm not. We don't have that situation right now. People understand where we are, what we're going to do. But it could happen. It's called flexibility. You have to have certain flexibility.
What are you planning on using the money that you're gaining for revenue through the tariffs on?
Paying down national debt, reducing taxes, creating good budgets, helping Christie with the border and all of the other things. I built hundreds of miles of wall, as people now understand, 571 miles of border wall in the first administration. But we're going to beef it up, and we're going to add more. And the numbers are incredible. Really, the numbers are what's taken place. We had great numbers, but these numbers are topping my last administration. And Christie and Tom Homan have done an amazing job. But it's an expensive process. This weekend, where they used to have hundreds of thousands of people standing there pouring through the border in Tijuana, Mexico, this weekend they had nobody. You had a man sweeping this massive piece of concrete, which is, the area where they said massive. And I've looked at that during the Biden administration. You couldn't see a piece of that concrete. There were so many people on it. You couldn't, if you had a helicopter shots, you couldn't see concrete. Now, this weekend, you had nobody there but a man with a broom sweeping it and cleaning it up. pretty amazing. It's really an amazing job. But it will be used for that. It'll be used for a lot of things. It'll be used by the Department of Justice for doing a great job. Pam is doing a fantastic job. So it's going to be used for a lot of different things.
Mr. President, on the 10% tariff, is that a basement? Is that the
It's a
floor?
baseline.
Can countries negotiate that to bring that
It depends
down?
on what they're adding. You know, some countries we have massive deficits with, or they have big surpluses with us, and others it's not that way. So it depends. That's why it's really they're all different. Every country is different. Some have certain advantages that others don't have, and certain things. We have some. China has a surplus of $1 trillion. I mean, the numbers are crazy, and others have basically no surpluses. You know, we have some that are pretty even, but they hurt us in other ways, and we just want to get that taken care of. So everyone is a little bit different.
So are you negotiating with the EU as one bloc or individual nations for the tariffs?
We're looking at it as one block. They've been very tough, but they were very smart. They were ready to announce retaliation, and then they heard about what we did with respect to China and others, but China, and they said, you know, we're going to hold back a little bit. They decided to hold back. I thought they were very smart. Look, the EU is very smart, but they really have taken advantage of the United States. They were formed for the purpose of taking advantage of the United States. And I don't blame them, and I don't blame China. I don't blame anybody. I blame the people that were sitting at that desk in that other beautiful Oval Office for allowing it to happen. Many presidents I blame. They should have never allowed it to happen. And I'm doing something that a lot of them wouldn't want to do. But I'm here, I do those things, and we're going to make this country great again. We were taken advantage of by almost everybody. I sat back in the last administration. I would actually read them. I don't have to read them now. I know them so well. I would read some of these documents that were signed, deals, and I said, who would do a deal like this? Who would do it? You've seen it, Elon. Yeah. I'd look at deals where it's so one-sided. Even we have a deal with Japan, and we get along great with Japan, and we had the Prime Minister here. He was fantastic. As you know, Abe was great. Shinzo was great. He was a good friend of mine, unfortunately no longer with us. But we defend them, but they don't have to defend us. I said, that doesn't sound too good. But we have a deal, a defense deal. We pay hundreds of billions of dollars to defend them. But if for any reason, in other words, we pay all the money. They don't pay anything. But if we're ever attacked, they don't have to do a thing to protect us. I said, oh, that sounds like a wonderful deal. So that's just one out of thousands. And I just wonder who did this. And it's people that either hate our country or didn't care, an expression that you use. I think it's really a lot of them didn't care. It's just hard to believe how bad they are. Now that's a little bit of a defensive deal, but I'm talking about trade deals, the same thing. They're so bad, you would say, how come? And even when I'd renegotiate, like I'd go to a country, they'd give me everything I asked for. I said, why didn't somebody ask for it like originally? They give me everything. I think when they were negotiating, they didn't care, or they didn't ask, or they were shy, or they were very stupid, or they hate our country. Yeah, go ahead, Jeff.
You were speaking about Japan. Can you clarify what your vision is for U.S. Steel? You referenced it yesterday.
Yeah.
There's some questions about what you actually want to see.
Sure. Look, U.S. Steel is going to do very well now because of tariffs, and I don't know why they even need a deal. But the only thing is U.S. Steel, if you go back 80 or 90 years, that was a behemoth in this. That was our biggest, most... if we were around, we would have been very proud of it. Today we have different types of companies that are big. Google, it's not the same as U.S. Steel. And I love Google, and I got to like the people that run it. They're very capable people. They didn't like me so much in the first administration, but they like me a lot now. I don't know what happened, but I like them. But, you know, I think they would be the first to admit, when I envisioned, you look at some of those steel factories from 90 years ago, it was a different kind of a country. but they were miles long. Today you see just empty hulks. Those hulks are going to be filled up very soon because of what I'm doing with tariffs. It was a different kind of a thing. But if I didn't do that in the first term, my first term, if I didn't put tariffs on, we would have, because China and others were dumping steel, billions of dollars of steel. Our steel companies were all closing. Every fact, we wouldn't have one steel plant open. And now we have a steel industry that's doing very well, but soon it's going to be thriving, really thriving. And those factories are going to be filled up, but more importantly, they're going to build brand new ones. Nucor and so many other companies call me, Nucor being a big steel company. They're building massive new steel plants, and it's great. And likewise, car companies. We have many, many car companies. 3 of them, I'm not looking to hurt Mexico, and I like Mexico. And by the way, I think the new president is a terrific person, a fantastic woman. We've had many conversations. She's a very elegant, just a fantastic person. And she's been very nice, very, very nice. But I'm not looking to hurt them, but we have 3 car plants that were under construction in Mexico. They stopped constructing, and now they're going to build in the United States because of tariffs. See, we should have never let this happen, because whoever it was that was president at the time, we lost 90,000 plants and factories since NAFTA. 90,000. It's not believable. How about that, Laura? You know, you're in that sort of world of factories and
build back
plants.
manufacturing, construction jobs, bring those workers back home.
That's right. We're going to bring them all back. But think of it, from that period of time, which isn't so long ago, we lost. I said the other day, if you had a map on a big wall like this, and if you had pins, 90,000, I don't know if you'd have enough. I don't think you'd have enough room on the map to put the pins. 90,000 factories that we've lost since NAFTA. And it's not even, and about 6 million jobs. Really, I think probably a lot more than that, but they say 6 million jobs. We're going to bring many of that back. I think we're going to bring more than all of it back. We're going to be better and stronger than ever before. But if a president, when they were leaving, said, look, you can leave, but if you're going to build a factory someplace else, and you think you're going to come and sell your steel or your car or any product that you make, your pharmaceuticals, which we're going to do, we're going to get them all back. But if you think you're going to just, all they had to do is say this, and they wouldn't have left. You know, I said it the other day. I said it with respect to, I made a speech a year ago, and I told them if I win, we're going to charge a big, big tariff at the border. And people were thinking about building in Mexico a car plant. And I said, we're going to have a big tariff. So if you want to build a car, you're going to have to pay 25% more than the cost of that car. You're going to have to pay 25% tariff at the border. They would have never left. They could have kept everybody. If a president said, if you leave this country, you leave Michigan, you leave Detroit, you leave anybody, any of our states, because to me they're all the same. I love them all. I love them all, and I probably won them all, but they say I won most of them, but I think I won them all, but that's okay. But all you had to say if you were the president is, if you leave and you think you're going to now fire all those workers, leave all that, everything behind, and you're going to build in another country and sell it and no, you're not going to. You're going to pay 50% or 100% tariff. They would have never left. And all you had to say, Marco, all you had to say very simply is, you don't have to write it down. All you have to do is say it verbally. If you leave, you're going to pay 100% tariff. Therefore, don't leave. They would have never left. But they left 90,000 plants. I mean, it's hard to believe that many. It's not, you can't envision it. So just getting back to your, because I'm the great weaver of all time. To weave, you have to be a genius. To go on tangents, anybody can do that. But we'll get back to your original U.S. Steel. U.S. Steel is a big name in this country. It's Babe Ruth is a big name. We have a lot of big names, but not too many. U.S. Steel is one of the great names in the history of our country. And normally I wouldn't mind so much. I wouldn't be thrilled with it. But to buy for a foreign country, and we love Japan, but for a foreign country to buy that cherished U.S. Steel brand, That's hard for me to do. I mean, somebody else may want it. The company Nippon that's involved with it is a big, powerful company who do a good job. But why can't they just build a plant themselves? I mean, why do they have to, take U.S. Steel? So as you know, I rejected the deal. Now they've come back in a different form. They're coming back as an investor. And I feel better about that, I guess. But, I know them very well. I know the thinking. It's the investor. They'll invest, and somebody else maybe is sitting in this chair, and they will no longer have an investment. They'll have the whole thing. That's the way it works. They're very smart. They're very, very smart people. We're dealing with very smart people throughout the world. Great geniuses, actually. Look what they've done to our country. And again, I don't blame China. I don't blame anybody. If I could have done it, if I were in that position, I'd have great respect. I have great respect for the people. They ripped off the United States, and all we had to do, have a president that knew what the hell was going on, and none of those countries would have left. Those companies, none of them would have left. So that's a little lesson in basic business, and it's really basic business. It's not complicated business. It's very basic business. And we'd have every one of those car plants going just the way they were 30 years ago. None of them would have left, but now they're coming back.
Mr. President, the Labor Department has confirmed that $400 million went to fake people for unemployment benefits.
Yeah.
I just want your initial reaction.
I think it's terrible. I just heard it from Lori, and I appreciate it, and you heard it from Elon's people, right?
That's right.
Elon's done a fantastic job. Look, he's sitting here, and I don't care. I don't need Elon for anything other than I happen to like him. But I'm telling you, this guy did a fantastic job. I don't need his car. I actually bought one and they said, "Oh, did you get a bargain?" No. I said, "Give me the top price." I paid a lot of money for that car. But honestly, he makes a great car. You know what I do with it? I let the people in the office drive around in it. Margot and Natalie, they're all Chamberlain. They're all driving around the most beautiful car. It's gorgeous. But I did that as a sign of just a show of support. Numerous people have done that. Just a show of support. Because, he's done a fantastic job, but he hasn't been treated properly. Hasn't been treated properly, yeah.
Mr. President, can you talk to us about your communications with China? Has President Xi reached out at all since the terror?
Well, I don't want to say who's reached out. I just say that I think it's going to work out, hopefully well.
Including TikTok?
They're very big. It's hard to get over, if you're me, what they've done to our country. They've destroyed our economic base to a large extent. The good news is we're very vibrant, and we're going to get it back fast. We already have. Look, we're making $2 billion a day now, and during Biden, we were losing $3 billion a day. Biden was a disaster. He was the worst president in the history of our country. And to me, worse than that, because the money you can make if you have the right guy in this position, worse than that was what they did on the border. By allowing the jails of the world, not South America, all over the world, to be opened up so that we take everybody from Africa, Asia, South America, Europe, the bad ones. They opened up their jails and they dumped them in the United States. And now this beautiful young woman who seems to be, boy, she loves what she does, though. I think she loves what she does because she's a patriot. She hates to see it. And Tom and all the people. But for us to spend, hundreds of billions of dollars, this is just, I don't know. They either hated the country. Who would do this? Who would want millions of people to pour through an open border? We have no idea who the hell they are. And just walk right through. And half of them, whether you like it or not, you could look at them and you could say, they are not going to help us. These are some rough people. But they'd empty out their jails, and they'd empty out their mental institutions, insane asylums, and they let them into the United States of America. And inflation we can fix, and all of the other things we can fix. We'll get it going. But this is something, it's such a horrible thing, and it's really hard. We have to do deportations. Now we're doing self-deportation. We're coming up with all sorts of ideas. And they must have known it's not going to work out well. And, we want people to come into our country, by the way. We need them badly for the jobs. But we want them to come in legally. They have to come in legally. They have to show that they can love our country. Thank you very much, everybody. Thank you. Thank you very much.
The Democrats are making allegations about market manipulation yesterday.
Thank you.
All right, everybody, you have been listening to President Trump there at the White House holding a meeting, talking about a variety of things. Very good afternoon. Live on radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week for this Thursday, April 10th. Another day where, again, we're focused on tariffs. We're seeing market volatility, Tim.
Yeah, the stock surge, that was so yesterday. The S&P 500 down 3.4%. The NASDAQ composite down 4%. The Dow down more than 1,000 points, 2.6% to the downside. We're going to have more from Charlie Pellet in just a minute.
Yeah, and we should point out we are bouncing off our lows of the session, but nonetheless, a reversal, not giving back necessarily everything that we gained yesterday, but nonetheless, again, a negative tone, risk off. We've got a great hour coming up. We're going to talk with Goldman Sachs Asset Management's Global Head of Insurance Asset Management. He has seen a lot of market cycles. He's got to figure out how to put money to work, investments to work in this environment. Curious to see what he has to say. But let's get to the trade, your top business stories on this Thursday. Here's Charlie Pellet.
Hi, thank you very much. Again, another day of selling on Wall Street. It is the fifth decline in the last 6 sessions. As Carol mentioned, we are well off session lows. You run the HCPI function on the Bloomberg. I can tell you the S&P 500 index was down by 6.3% at the worst level of the session. Here's where we stand now. We've got the S&P down 3.3%, down 179. The S&P now at 5278. The Dow, though, down 1,025 points on the Dow, a decline of 2.5%. The NASDAQ Composite Index right now down 687 points. That is a drop of 4%. The 10-year, 4.36%, with the 2-year that's currently yielding 3.84%. Spot gold higher by $80 the ounce, up 2.6%. The precious metal now at $31.62. Bitcoin is trading lower by 4.4%, 79,477 on Bitcoin. Cannot ignore West Texas Intermediate crude was trading below $60 a barrel. Back above that level right now, 60.21 on WTI. It is down by just about 3.5%. So bottom line here, we do have stocks plunging again today as economic angst continues to hit Wall Street. The S&P 500 index down now by just about 3.1%. Briefly, Prada is buying Versace for about $1.38 billion in cash, strengthening its position as Italy's largest fashion group by adding one of the luxury industry's best-known brands. Prada ADRs, they're up by 7.7%. Again, recapping, S&P lower now by 3.1% for on-demand news. 24 hours a day. Subscribe to Bloomberg News Now wherever you get your podcasts. Keep it locked into Bloomberg and television and radio for the latest. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are up to date on the markets. We're going to focus on the markets until we see the close today. But we do want to mention, of course, we're just off a cabinet meeting, President Trump holding one at the White House. Let's get some thoughts in terms of the policy, the implications. Ed Mills is Washington policy analyst, managing director over at Raymond James. Ed, safe to say many would assess that this is a very different political environment, geopolitical environment, and investors have to make sense of it. What do you make sense of what you just heard from the president and really the last 24 hours?
Yeah, Carol. So what I've been telling folks here at Raymond James is that there are 3 paths forward here on the tariff discussion. Number 1, Trump cuts deals or changes his mind. 2, the courts or Congress stop him. Or 3, he doubles down, and we're going to see a change of the global world order that's been established since World War II. I think in the immediate aftermath of the tariff announcements, the markets was over-indexing number 3. Yesterday's announcement was a move back to, Trump is going to cut the deals. And I think that was a positive reaction. But as we're digesting this, here at Raymond James, we calculate that actually a 10% across the board, but 145% on China, the dollar-weighted kind of trade impact there is about 40% higher than the original announcement. So we get relief, but the China issue here is a huge issue. And from a dollar-weighted average, a significant increase of tariffs across the board.
Ed, in your view, does the China issue get resolved?
I think it's a question of what does resolution mean? We have seen a greater openness from China in the last 24 hours than we've seen since January 20th. When I've talked to my China contacts, Tim, is that there's a sense that China doesn't want to get involved in another drawn-out negotiation. You go back to the first term. It took 3 years before we got the quote-unquote first kind of phase of that trade deal done. Xi does not know what Donald Trump wants. China does not want to negotiate and have the goalposts moved on them. They can't really sustain this forever, so something has to happen. But what Donald Trump wants, what the administration wants, is not clear enough just yet.
Ed, real quickly, 30 seconds. Can you invest in this market?
I think you can. I think that the bull case from here is that we get the deals. Congress, the House passed the budget resolution today. We're moving towards tax cuts. We saw executive action on deregulation. If we can build upon that, that's an investable market. We tell folks at Raymond James, stay the course, stick to your plan.
All right. Uncertainty, though, still the watchword. It certainly feels that way. All right, Ed, going to leave it there.
Absolutely.
Thanks for weighing in. Ed Mills, Washington policy analyst. He's also managing director over at Raymond James.
Well, back to the selling on Wall Street, because at one point today, the S&P 500 was off the most going back to March of 2020. It's bounced off that low, but still down 3.2% right now. Whenever we whip out these superlatives, we know things are getting a little, well, I don't want to say
I don't know, they're
scary,
becoming the norm, kind of.
I was going to say, it's going to be like, you know, it's kind of relatively rare, but the last week, Carol, we've been doing this quite a bit. We've also been checking in with Eric Weiner quite a bit. He's a Bloomberg News senior editor of Equities America. He joins us here in the studio. What happened between yesterday and today? Why the change in tone?
Well, yesterday was kind of a euphoric reaction, and you had this momentum of everybody waiting for that, you know, that delay and it coming in. And then as that happened, we went up about 4%, and then the short squeeze started coming in, and liquidity was
and yesterday
really
was a lot about short covering, wasn't it?
Yes, that was it. So you had liquidity tight,
right?
So it just basically pushed everything way beyond where you would think it would go based on the news. And then there wasn't a whole heck of a lot of analysis on exactly what the tariffs meant, to speak to Ed's point, where China actually means a lot more. So escalating on China versus de-escalating on the others was, you know, something that had to be figured out overnight. Once the session ended, on our team, we started talking about preparing for today, and we were talking about 2% to 3% down. It went further than we thought, but there's a lot of correlation in the market right now. So things are moving in groups and in clumps, much more so than they normally do. And when you see that, you get these massive moves one way, massive moves the other way.
So dollar down, stocks down, bonds down?
And yes, and also broad sectors of the stock market down all at once. So it's not just selling, say, tech, it's selling all of tech, everything in tech, and the whole sector goes.
Can I ask you, what's the significance, though? Because this is a thing that we've been talking about since we've seen the selling, is that global investors in general, maybe not looking at the U.S. as being a safe haven, whether it comes to stocks, whether it comes to the treasury market, the real worry, right, the dollar as well?
That is exactly what's going on. We actually saw some movement away from utilities and REITs, where people get their dividends. So that's like the safety play in the market, in the stock market in general, and people are moving. The Europe Stock 600 is up today. Was up today. So it's, you know, people are finding other places to put their money.
You sat with us a week ago. You sat with us earlier this week. One common refrain we've heard from you is this has been an orderly demonstration of actions in the markets, whether it's been up or whether it's been down. Do you stick to that?
Yes, although at 6% we were preparing for the shutdowns. The circuit breakers, okay. Exactly. Well, actually, yeah, because it would just be a 15-minute hold.
But still orderly to you?
Still relatively orderly. What we haven't heard and what we're waiting for is some hedge fund can't make their margin call. You know, some counterparties not showing up and there being empty trades. We're not hearing about that. Things are still working, yes.
What would make you change that view? What are you going to look for to say this is no longer orderly? I'm getting flashbacks to 2020, to 2008, 2009.
COVID, yeah.
And flashbacks to the dot-com bust.
Yeah, when we start hearing about a fund going under, we start hearing about funds being caught, because everybody's caught off sides here, but caught dramatically off sides. And it's a lot of leverage in the system. There's still a lot of leverage. So when that starts unwinding, we will start getting calls like, oh my God, we're hearing a fund is going to go under, and it's a big fund. And that's when things start getting really concerning. We haven't reached that point yet.
Oh, TBD.
Yeah.
Just kidding. Eric, thank you so much. Eric Weiner, Bloomberg News Senior Editor, Equities America. All right, stocks down, and this is despite some good inflation data. Yeah, folks, we got a CPI report this morning. I know it feels like hours ago. It was hours ago. But let's talk a little bit about the economic fundamentals and someone who here at Bloomberg just kind of rolls in trade policy, the global economy, everything into one. Michael McKee is back with us.
Yeah, but
I'm talking you up, so you better deliver.
I thought Duke was going to win the Final Four. So.
Spoiler
alert. Well, I know.
A lot of people missed it. How are you? Okay, inflation was good.
Inflation was good.
Yeah.
And it really doesn't tell us much, which is kind of the cliche that we were all going into this with, because it's before the tariffs came on.
Yeah.
But it was better than expected. The headline dropping 0.1%, and that was largely due to gasoline prices going down 6.3%, which isn't necessarily good news because prices went down because people were marking down growth outlooks. But we also saw furniture and apparel. We get a lot of those from China up, but they were up by about the same amount they usually are in March. So it wasn't a big deal. There were two things that were interesting. Smartphones down 1.1%. You would have thought that maybe prices would have gone up unless Apple was, we saw a story today about how they brought in a bunch from India.
Right.
But then travel is the one area that seems to be already taking a big hit from tariff talk. Airfares were down 5.3%. Hotels and lodging down 3.5%.
That's real.
And what was really interesting is Omar Sharif, Inflation Insights, he gets granular with this stuff. It was all hotels in the Northeast, which to him suggests it was Canadians.
Oh, interesting.
Okay.
We've heard that from people on the states here on the East Coast that border.
And so maybe this spreads into the next month, but because it's the timing, the Fed isn't going to pay much attention.
But from a tourism perspective, if you can attribute that to Canada at this point, or if Omar Sharif can do that, is it economic uncertainty that we can also attribute to the decline in hotel prices and the decline in airline prices? Are companies not booking to the same extent that they were several months ago as a result of uncertainty?
It definitely seems that way, and we're getting tourist boycotts, and so this could be a major impact on the economy. Tourism is much bigger than people think, certainly big in New York City. That's something we have to keep an eye on, and what's also kind of interesting is we don't know how long any of this will last, but remember next year we're supposed to have the World Cup here, and there are people already talking about...
Well, not just here, but throughout North America.
Yeah, well, everybody will go to the games in Canada and Mexico, but will they go to the games that are here?
That's really interesting. Hey, listen, our most read story on the Bloomberg right now in the past eight hours, stock slide as economic angst hits Wall Street. When you look at the economic fundamentals, when the Fed, Mike, is looking at the economic fundamentals, right, we know what their mandate is. How are they assessing the situation right here on this afternoon, and how are they maybe thinking about the market volatility and how that plays in?
Well, I haven't talked to anybody this afternoon, but I suspect that, like everybody who's a professional at this business knows, this is kind of the pattern that you see. You get the big up day and then it goes back down again. And so they're not going to be surprised by that at all. Depending on how bad the correction gets, you could have a wealth effect issue that would slow growth. We'll have to see on that score. The real issue for them was what was happening in the bond market.
Right.
And we did talk to a number of them yesterday, including Beth Hammack, who used to be the treasurer at Goldman Sachs, so she knows the markets. And they basically felt that there was a lot of volatility, but there wasn't a systemic issue. There wasn't an imminent failure of market operations, which would be about the only reason that the Fed would get involved. So it's good news that when we're having these kinds of disruptions, that the system is holding. And you were just talking about how this is an orderly decline. I mean, we're getting 3-4% down a day. We're not. Yesterday we had the big rise, but we're not seeing the kind of collapses that we saw in previous episodes, like when you have a Thursday down 7% and a Friday down 5% and a Monday in 1887 22%.
Right.
That hasn't happened, so it doesn't suggest there's a panic out there that the Fed would have to worry about.
Okay, well, 30 seconds on that, Mike. A host of Fed speakers making news today. How would you characterize that they're looking at this?
Oh, it's almost like they're singing from the same script. They're all saying, we have to keep an eye on this. We could have a problem with growth. We could have a problem with inflation. We're more worried about inflation than we are growth at this point. But we are unable to make a decision about moving rates one way or another because there's not enough information. But the good thing is where rates are is perfectly acceptable to us. So you just expect them to stay on hold and to not say anything controversial for quite some time.
20 seconds. I'm going to squeeze in one more. Anything that could a Fed rate cut do anything to kind of appease our trading partners? Like, I think about the trading picture overall, how global investors, how other countries are looking at the United States and feeling uncertain about the outlook or what we might get from the White House next.
I don't think a rate cut would make a difference because it wouldn't be coming from the administration, so it wouldn't have any policy impacts. It could have an impact on the dollar. It could, in theory, bring dollar's value down, but it seems to be doing that on its own.
Yeah, it's doing just fine on that.
I'm not sure.
All right, cool stuff. Michael, thank you so much. Mike McKee, he's Bloomberg News International Economics and Policy Correspondent. Let's talk a little bit more about the U.S. Treasury market, the U.S. rates market. Bloomberg Intelligence headquarters out in Princeton, New Jersey. That's where we find Ira Jersey. He's the team's chief U.S. interest rate strategist. So, Ira, glad we could talk to you. I feel like it really is about the bond market. We did have a 30-year auction. Looks like I think it went fairly well. So talk to us a little bit about that and the overall trade that we're seeing in treasuries today. We also had, of course, that inflation print that Mike just talked about.
Yeah, so the long bond, the 30-year Treasury bond, had sold off pretty dramatically this morning, and I think some people were trying to say, oh, let's hop in here a little bit. We can get cheaper levels, and the auction went very well. I mean, the auction, we graded it an A, and after yesterday's 10-year that got a grade of A+, the people don't mind buying demand at auction, but it didn't stick, and I think that that's an important factor here, whereas yesterday you kind of got this big snapback and a pretty big, large rally after such a strong 10-year auction. Today we rallied a little bit, but as I mentioned, it didn't stick. And the yield curve has just steepened absolutely massively. And the question becomes, is that because of some flows and just people getting out of the long end, like private pension funds or insurers from overseas?
Trump administration
does it have to do with people thinking the Fed's going to cut rates and that's going to stem inflation in the long term? Or is there something more nefarious going on under the system? And some of these things we don't know yet. I suspect that a lot of it is just people who are fearful that foreign investors who have had such a big bid for long-term Treasury bonds, that bid's just gone away, and now we're trying to find a new level where buyers care.
I mean, are you talking Japan, China? Who are you talking about?
Well, we're just about everybody. I mean, so for one thing, a lot of people have been saying, "Oh, is this China selling? Is this China selling?" You know, I don't know, but at the same time, China has a lot of FX reserves, the same as Japan, and foreign exchange reserves generally are not held in long-term treasuries. They're usually held 5 years in.
Some terrible formatting from the news providers here. That's the Trump administration wanting to pursue legal arrangement that would put Columbia University into a consent decree. That was not mentioned in the prior headlines.
Long-term treasuries are private investors. It's the insurance companies, the hedge funds, the sovereign wealth funds certainly are own them. So I suspect that it's some combination of them and it might not even be them selling. It's just fear that they won't be buyers. And I think that that's a big thing that we have to remember. Sometimes the market reprices not because of actual flows, but because people think that those flows either will or won't materialize. And there is. is. There's private foreign investors globally own a ton of duration risk. We put out a note earlier this week where we show a chart just of how much duration they own, and it's hundreds of billions of dollars. So it would not be a big surprise that if a life insurer in Taiwan gets a nod from their board and says, hey, don't buy treasuries anymore, that wouldn't surprise us at all, because it's with what's going on with trade flows, that's going to affect boardrooms and how people perceive U.S. treasuries as an investment vehicle.
Net, Ira, because I've been thinking about this a lot, and we've had everybody talking about, of course, the stress that they've seen in the Treasury trade. We heard the president addressing it and the reason why he put that 90-day pause in. I mean, has that gone away, and do we truly understand the stress points at this juncture?
Well, if you mean stress points, like when I look at the market and market depth, the market depth certainly has gone down a little bit, but I think in large part that's just because of the volatility. So generally speaking, you're talking about bid offers getting wider as the market becomes more volatile. So that's a natural cause. I do think that there are some stress points insofar as that dealers, so Treasury dealers, were as long Treasuries as they've ever been as of last week. Now we get more of that data. We get a new read on that data as today at 4 o'clock, and so because they're so full, I think they went into this sell-off without having the capacity to buy more. So that's one reason why doing something like exempting treasuries from the supplementary leverage ratio or the supplemental leverage ratio.
U.S. leveraged loan funds see a record $6.5 billion of weekly outflow.
You can have elasticity of dealer balance sheets that just doesn't quite exist today. And like I mentioned, dealers also had over $400 billion of treasuries on their books, the highest ever a couple of weeks ago. So they weren't able to buy more, and that just means bid offer has to widen. That means that it's harder for them to intermediate the long end, right? These long duration, high risk, price risk securities anyway, in the 30-year. Meanwhile, the front end, that rallies, right? Look at how massive this curve steepening's been. It's been incredible. It's been a great call by us, not the way that we thought that the curve was going to steepen, but that was our key call starting the year, was being steepeners.
Ira, there's been a lot of reporting in the last 24 hours about why we saw the 90-day pause from the president yesterday, and some reporting has indicated that the bond market helped him make that decision or helped his officials move him in that direction. How do you view the power of the bond market when it comes to this president?
Well, for every president, the bond market is key. The U.S. Treasury market is how we fund our debt. It's how we're perceived globally in terms of having both the safe haven currency or have the reserve currency and a safe haven asset that is U.S. Treasuries. But we're still going to have, regardless of what President Trump and what Congress tries to do, we're still going to have multi-$100 billion, if not trillion-dollar deficits for the next few years. And in order to fund that, you need to have a functioning Treasury market, and obviously, if you're the government, you want to have interest rates that are as low as possible, especially given whatever the economic environment is. So all of those things are true. So the Treasury market is key, and if people aren't buying Treasuries globally, or I should say that people buy Treasuries globally because of the recycling of dollars, because we export a lot of dollars because we buy other people's goods. If that goes away, you're going to see probably in aggregate interest rates are a bit higher than they would be if we did export a whole lot of dollars.
What I want to go to, though, is what the Wednesday sell-off that we saw, the basis trade that everybody keeps talking about, right?
It's not the basis trade. Oh, my goodness. It's like the basis trade's in two-year notes. Two-year notes are rallying. If this was due to the basis trade, the two-year notes would be selling off, and they're not.
Okay. Well, that's why, because I'm trying to, everybody's kind of shooting stuff out there in terms of exactly what happened, and I just want to have the right context in terms of the president pointing to the bond market, everybody talking about it. Do we really understand what happened, and are we in a better place, I guess is my question.
Well, I don't think we completely understand what happened, and I don't think anybody does yet. We will find out over time. But in terms of the basis trade, right? The basis trade, I think, is scary to a lot of people because it is so large. Mm-hmm. But keep in mind, the basis trade exists basically for two reasons. One is that asset managers, so general investors, whether they're hedge funds or mutual funds and the like, they go out and they buy Treasury futures. Well, if they buy Treasury futures, someone else has to be on the other side of that.
Right.
And the person person on the other side of that has to hedge their interest rate risk then. And so they do that by either buying treasuries or receiving in interest rate swaps. And either way, you wind up in an environment where someone has to put on that basis trade. And there's been a lot in 2-year notes, 5-year notes, and 7-year notes that people have been doing this. And it's in large size. Is it a systemic market risk? I don't think so, right? It's only a systemic risk if everyone, only one side of that trade wants to get out of that trade. So that's where I question whether or not it's the basis trade is driving this volatility.
It's what I wanted to ask you yesterday, and I couldn't get to you, and now I got to you today. So I'm so glad we could. Ira, thank you. Really appreciate it. Bloomberg Intelligence Chief U.S. Interest Rate Strategist, Ira Jersey.
Hey, keeping an eye on markets is Charlie Pellet. Let's get to him for an update on the markets and, of course, a business flash. Hey there, Charlie Pellet.
Well, hello there, Tim. We are lower, off-session lows. Do want to begin, though, with a couple of developing stories, headlines right now on the Bloomberg Professional Service. The U.S. wants to install federal oversight of Colombia. The Trump administration wants Colombia to enter into a consent decree, that according to the Wall Street Journal. Also getting word that Novartis, the drug maker, is going to invest $23 billion in U.S.-based infrastructure over 5 years, and Novartis up now by about 0.1%. A lot of red on the screen today as the selling continues. We are down in 5 of the last 6 sessions. Right now we have got the S&P 500 index dropping by 2.9%. At the worst level of the day, we did see the S&P down by roughly 6.3%, but again down 160 points now on the S&P. Dow Industrial is lower by 904, down 2.2%, and NASDAQ is down 637. For the NASDAQ Composite Index, a drop of 3.7%. The Russell 2000 Index, broad-based selling, down now by 3.6%. Small cap shares moving lower. The 10-year, 4.38%, with your 2-year at 3.85%. Spot gold up $82 the ounce, $31.65, up now by 2.7%. West Texas Intermediate crude down 3.7%, just above $60 a barrel, $60.02, and Bitcoin is now down 4.2%, 79,700 on a Bitcoin. So again, the Dow, the S&P, NASDAQ, all declining, off-session lows with a 3% drop right now on the S&P. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, you're up to date on the markets. Again, volatility and uncertainty, the watchword. We've got a great next guest who's got a global view, has seen a bunch of market cycles. With us is Mike Siegel. He is a partner at Goldman Sachs Asset Management, serves as global head of the insurance asset management and liquidity solutions businesses, as well as co-head of the client solutions group in Asia Pacific. You do see a lot. Also with us as Bloomberg TV Global Finance correspondent Shonali Basak, who actually brought us Mike. So we're so grateful because there's so much going on, Mike. And we want to dig into your specific worlds, but you do watch everything globally. And I'm assuming everything is connected. You watch a lot of different markets at this point. Let's start with the environment. We had one auto parts CEO describe it to us as the great financial crisis, the COVID shutdown, and the auto strike all rolled into one, at least for him specifically. How do you see today's market environment?
Well, Carol, thanks for having me, and thanks for that question. I think that people are clearly on edge and are reluctant to make any significant decisions until we get better clarity as to where the tariffs are going to end, where that situation is going to end. Once we have more clarity to that, you can then go back and see the markets will react, they'll adjust, the Fed will react, it will adjust, and so will companies in terms of how they're going to invest, including my insurance clients and including the liquidity clients.
We don't know how it's going to end, but I'm curious if you've mapped likely scenarios for how they'll end. What do you think is going to happen?
Well, we do map scenarios, and so first I'll stick with the insurance industry, which is very well capitalized and not levered in the sense that they're not over their skis. They don't hold a lot of equities on the balance sheet, so the equity market volatility that we've been seeing is not creating a capital strain. They are primarily fixed income investors, and by the way, we're seeing the intermediate and long end of the curve rise. We're seeing credit spreads widen. So on reinvestment, that's a pretty good situation. as long as it just doesn't continue to cascade into something much more significant.
Even though it's good for the longer term, for people who are reinvesting in bonds, you have insurance clients that are holding long-term bonds, and 10-year, 30-year notes are really blown out at this point. Are they suffering through a lot of pain because of it?
Yeah, so Sonali, you're absolutely right that on a mark-to-market basis, these bonds have lost value. But most of these institutions don't have to report on a mark-to-market basis. They're able to hold their bonds to maturity. So really, they are more benefiting from the ability to reinvest at higher yields than what's been happening to the current holdings. Not the same thing being true for hedge funds, example, or other institutions that are marked on a daily basis may have to provide collateral as their asset values are dropping. But that's not the case for the insurance industry.
But do they feel that there's a certainty that this does get resolved sooner rather than later? I think I love your interview you did with Boaz Weinstein, who I thought was assessing the situation and saying the thing is here, we have a president who's in for just under 4 years here, and that he said the uncertainty genie is out of the bottle. So do we continue to, in your view, and you've got to think about short term, longer term, medium term, that uncertainty will be with us throughout this tenure?
I think uncertainty will be with us, hopefully not at the level that we have right now. And again, it's are companies in a position where they're forced to act or not? And to the extent that they're not over-levered, they're not forced to act, they could sit, watch, and look for opportunities. And I could tell you...
Are they nervous at all?
Oh, absolutely.
Okay. Keep going. Sorry.
So I would say, when you game plan out, right now, this has primarily been an equity market event. Concerns that it becomes a bond market event. Rising yields are not that much of a problem. Draining liquidity becomes a problem. So there's a concern or a watch for that. Also, I would say for our insurance clients, they are long-term holders of corporate debt. How are those corporations going to fare? And certainly, some corporations are going to be much more affected by tariffs, which would weaken credit. Others are immune to it.
WTI crude May futures today are down $2.28 or 3.66% on the session.
What is the sensitivity to the tariffs or not?
Well, on a micro level, some of that uncertainty has already led companies on a case-by-case basis to pull guidance. CarMax today, certain financial goals that it's just not giving. Delta earlier this week. You mentioned a lot of uncertainty, and I know yesterday Goldman Sachs rescinded its call for a recession this year. Are you seeing signs of a recession?
So let me say this. So one of the things we want to talk about was the survey. First, I would say on the insurance survey...
it's a 14th annual global insurance survey, 405 companies representing over $14 trillion in balance sheets assets combined. That's a lot.
That's a lot. It's about half the global industry's asset base. I bring that up because one of the questions we said is, what are you concerned about? And that question they got absolutely right. They're concerned about inflation. They're concerned about geopolitics. They're concerned about tariffs and market volatility.
Welcome to our world in a nutshell.
What they didn't get right, and nobody did, was the magnitude of the tariffs and the implications for that. So they didn't see recession this year. That view is changing, including at Goldman Sachs and within our clients. They thought the equity markets would be well-behaved, not rip-roaring, but well-behaved. That view is changing quite dramatically. But they also thought that rates had peaked and would be coming down slowly, both at the short end and the long end. And I still think that that's the prevailing view. So this backup in longer-term rates is looking like an investing opportunity. None of our clients have been selling or directing us to sell on their behalf. They are looking for opportunities to get into the market, but they're not in a rush. They want to see how things settle out. Once they see how things settle out, then they'll know where to put capital to work.
You mentioned that you're looking bond by bond right now. And the reason that's so interesting to me is because you're already seeing somewhat of a capital market
U.S. Treasury updates Iran-related designations, adding some Iran-linked vessels to the OFAC's SDN list.
For the way people have confidence in investing in corporate debt in the future, in new issuance, for example.
Yeah, so Sonali, that's really going to be industry by industry, case by case, and that gets back to this uncertainty. Until we know how this unfolds, and it may not unfold to a point where we have definition. This is that this is the way it's going to work. You've elevated the amount of uncertainty, which is elevating the amount of risk. I need to get paid a bigger risk premium to hold any of these instruments. And that's why we see credit spreads widening out.
You know, a lot of people are saying this is also a golden opportunity for while public capital markets are freezing to look at private capital, because you're seeing these private credit giants just float right in as the public markets are closed. But are you concerned that there's still a lot of pain under the surface in private markets, given that, you know, they call it the denominator effect? These companies are seeing their public portfolios really shrink and their private portfolios therefore become a bigger proportion of their holdings.
So let me take that question into break that into two parts. One is the underlying asset values themselves. And so we've got private equity, we've got real estate, we've got infrastructure, we have private credit. At the moment, we're not seeing any of this flow through to the existing investments that have been made, but we have to see how things unfold. And if we end up in a deeper recession or a deeper recession, that's going to weaken the underlying asset values. Now, the thing you said about the denominator effect is the ability to put new capital to work. And there's two components to that. One is I already have a private equity portfolio. I was hoping to get realizations, give me fresh cash to put back to work. And if the public markets are closed, particularly the IPO market, you're not going to see as many of those realizations. So I'm going to be keeping more of my capital tied up in those assets. And then the second point you're making, which is more applicable, quite frankly, to pension plans and sovereign wealth funds, is as the public assets, particularly the equity assets, decline in value, all of a sudden my exposure on an asset allocation basis to the private assets has increased. Again, reduces my willingness to invest more. So
because this was supposed to be the year, right? That all of a sudden we could tap the public markets, sell some assets, IPO, whatever, right? Or M&A, and it.
Well, this was supposed to be the year. It is only April.
Okay. Well, so you are hopeful that it gets better?
Well, I'm always hopeful, but we shall see.
I guess I'm just saying in an environment where if we expect more uncertainty over the next 3.5 years, that makes it tricky, right?
It makes it tricky. I think, you know, right now the administration is in the middle of trying to rebalance trade through tariffs. At some point that will settle, and then the markets can assess what does it all mean. And then I think you will see markets open up again. You'll see more flow of capital.
We're talking about the risky stuff. Yeah. But I'm also wondering, you have one of the biggest money market businesses in the world under your purview. So how are those behaving? What are they being used for in an environment like this? Because it's generally safer than a lot of the debt markets that we're talking about.
Yeah, so Sonali, we manage over $700 billion of short-term liquidity products. We consider that to be the canary in the coal mine. So we're always watching what's happening with flows there. And at the moment, things have been very stable. The vast majority of the assets are government assets, you know, short-term treasury bills, et cetera. And we don't see flows coming into that market. We take that as a good sign. Another part of the market, which is called prime, includes a lot of commercial paper and other short-term debt of corporations. And we don't see companies moving out of prime. So at the moment, and we watch very closely, things feel calm at that end of the market.
When money leaves your money market funds, where does it go?
Well, over the last several crises, if I could say it like that, it's been actually coming into the money market funds. Basically, you know, the two competing forces would be bank deposits and money market funds. And, you know, some of the crises have called into question, you know, creditworthiness of banks, so it comes into the money market funds. If people are very nervous, it's going to go into government money market funds, so primarily T-bills and other government-guaranteed forms of debt.
Are you calling this a crisis right now?
No.
Are you seeing money coming into money markets?
No, as I said, we're watching on a daily and minute-by-minute basis, and we haven't seen any flows come in, unusual flows, nor have we seen flows moving out of prime into government.
Guys, by the way, every single crisis for the last decade or so, Mike has been one of my first calls, which is exactly why I wanted to bring him.
How's it going?
Sonali, I hope that's not why you called me in today.
Is any money going outside the U.S.? Increasingly?
So, you know, you've seen, so a coming into the beginning of the year, it looked like the U.S. economy was going to be the fastest, outside of China, the fastest growing economy in the world.
Exceptionalism, right? We talked about American exceptionalism.
Exceptionalism. And you also saw the dollar strengthening over a long period of time. So if I took foreign money and put it into the U.S. market, I had probably a underlying market that was going to rally, and I pick up the currency appreciation, a double whammy. Right now, the dollar's weakening, and the U.S. markets are selling off, so I'm sure that that's putting a damper on those flows.
I want to go to China and specifically the U.S. relationship with China. You spend a lot of time in China. You live partly in Hong Kong. You're co-head of the Client Solutions Group in Asia Pacific. Is the relationship between the U.S. and China broken?
That's really not in my bailiwick, but I will tell you our relationships with the government entities and the companies that are there, between our firm and those entities is very strong. What's playing out is just playing out above everybody's head, and we're leaving it to play out at that level.
But it has significant implications for the way that companies do business with one another. If one country has tariffs that exceed 125%, if it exceeds that, that's a big deal.
It's very important for the two countries to have good relationships, and then that translates down into the entities that we work with and the relationships we have with them.
Can I ask you one last question? Oaktree Capital Management co-founder Howard Marks wrote today that Donald Trump's tariff policies have the potential to be the biggest economic event of our lifetimes, and warned that reversing them could still have consequences.
$63.33 a barrel, which is down $2.15 or 3.28% on the session.
Volatility has a cost. It's undermining, people's confidence to invest, whether it's corporations building plant and equipment, whether it's investors putting money to work. So there is a cost of volatility, and we're seeing that by the declines in the market and the widening out of spreads.
So appreciate this. Thank you so much, so much. Mike Siegel, partner at Goldman Sachs Asset Management, global head of the Insurance Asset Management and Liquidity Solutions business, also co-head of the Client Solutions Group in Asia Pacific. Mike, thank you very much. Really appreciate it. And Shonali, thanks for bringing us Mike, Bloomberg TV global finance correspondent. So if she calls you, you know what it's about. Is this a crisis?
But he says no for now. He says no for now. All right, let us know if that view changes. I do appreciate it. Thanks again to Mike Siegel.
Thank you
Let's now head on over back to Charlie Pellet. He's been keeping his view on the markets. Hey, Charlie.
Hi, thank you very much, Tim. Here's what's going on. Economic angst, big time again today. We are off session lows, but the Dow, the S&P, NASDAQ, all very much in the red right now, looking at a 2.8% drop on the S&P 500 index. We're down 153 right now at 53.03. We've got the Dow lower by 2.1%, NASDAQ down 3.5%, keeping that all in context. Again, the S&P down by 2.8% of the worst level of the day. We did have the S&P falling by more than 6%. The 10-year 4.38%, with the 2-year currently yielding 3.84%. We got a whole lot more on the markets coming up with our Gina Martin Adams. Spot gold is surging $90 the ounce right now, up by 3%. Precious metal at $31.73 the ounce. West Texas Intermediate crude down 3.2%, 60.38 on
the U.S. State Department confirming that the meeting with Iran on Saturday will determine whether or not the Iranians are serious.
On Bitcoin. CarMax backing away from the timing of its financial goals, joining a growing list of companies, indicating that uncertainty around President Trump's trade war is making long-term planning difficult. CarMax right now down by 16.1%. And we're just getting word that a passenger jet carrying at least 2 members of Congress was clipped by another commercial plane on the ground at Ronald Reagan Washington National Airport. Developing story. We got the headline right now. We'll have more details as they become available. We're recapping S&P now down by 2.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now.
We're seeing a text release here from Fed's Goolsby now. Says now is the time for U.S. central banks to wait and see on interest rates.
Charlie, thank you
Current
so much.
tariffs will drive up inflation in the near term and hurt growth. The Fed should keep all policy actions on the table. Bar for Fed policy change now is pretty high. Long-term treasuries still appear to be the safest asset in the world, and Goolsby says he prefers market inflation expectations data over surveys. Current data suggests the job market is solid.
That's right.
Goolsby says, I won't speculate on how the Fed would respond to the market stress events. Broad financial conditions indexes can be hard to read. Bond market sell-off showed that the U.S. was not not the only nation getting hit.
Solid
Solid 10-year Treasury auction reduced worry about the market, and that current tariffs are higher than most scenarios, even with Trump's pause. Current tariff scenario is a big scenario, but says he's not hearing much from business contacts about
You
layoffs.
reminded all of us the market did not bottom until March of 2009.
Yeah, this is something we did earlier this week, is just looking at these major capitulation moments in the S&P 500 and put them in context of what's happening in the fundamentals. And what you do find is that the big sell-off, VIX spikes, capitulation moments, whatever you want to call it, in the midst of economic distress tend to happen way earlier than the ultimate bottom occurs. Whereas you can use things like capitulation, VIX, pairwise correlations, whatever technicals you love to show capitulation. You can use those for timing bottoms when the bottoms are a little minor 10% corrections that are not necessarily affiliated with major economic distress. But the simple fact that we're in this period of extraordinary uncertainty, and our other models, our more fundamentally oriented models, are telling us that the economic downside has really yet to be fully priced in the S&P 500, that kind of context would suggest to us we could be in for a more extended period of volatility, even if the volatility never reaches the levels that we got with Liberation Day.
So even though we're like off our lows, I mean, like how are you thinking about like how we end up today and what's important coming off of yesterday's rally?
I think the most important thing to watch right now, frankly, is fundamentals. I think that the market is going to be volatile. I think it's going to jump around. It's, I wouldn't be surprised in any given day if we're up 5,000 and down 5,000.
The VIX kind of tells us that, right? A little bit.
Hold on. Say that again. Up what?
5,000 or down 5,000 on the Dow, not the S&P 500, which of course is at 5,000. It's a huge move.
That's a huge move.
Yeah. So I would not be surprised to see extreme volatility because our sensitivity levels to any kind of policy movements right now are enormous, right? We saw that yesterday. What I think we want to keep our eye on now is what are companies telling us throughout this earnings season? Are they going to start pulling guidance, because that's usually a sign of pretty extraordinary uncertainty? How are they navigating this crisis? Are they planning to push costs onto the consumer? And then further, are they starting to change their operations in response to the tariffs that are enacted?
We've kind of heard that that's happening already. We heard CarMax and Delta this week. Amazon CEO Andy Jassy said, and I'm going to get this, I'm not looking at exactly what he said, but the gist of his comments were, we think that producers will pass along the increased cost to consumers.
Yep.
That's happening.
Yeah, and I think they'll try. And then,
what do you mean
the next, I think they'll try to put those prices out on the market, but will the consumer accept those prices
if you don't buy it, right?
Or also, is there a substitution, right? I think that this is very interesting in the context of China in particular, which provides an enormous amount of our consumer-focused goods.
Is there a substitution there?
Is there a substitution? Does the consumer have to take the price? And then the consumer only has so much disposable income to go around. What are the alternative categories that they have to cut back on
Gold
in an
extending its
environment of
gains,
accelerated
rising
price? Because we
3%
know
to a
wages are
fresh
only
record
growing
of
at a single-digit pace. Tariffs are already coming in at
$3,154.89 an ounce.
26% on average. That's a whole lot faster than wage growth is, and especially for the lower income consumer, could be very, very meaningful at driving the ultimate pie and how they slice up that pie of income in their spending.
Bank earnings.
Yes.
What are you going to be watching out for?
Oh, I think this is going to be really interesting because we've seen such a tightening in financial conditions. Our sector strategist, Mike Casper, runs a macro model of financial sector earnings. And one of the things that model told us earlier this week is to expect financials earnings to be about half as much as consensus is anticipating. That's in terms of a growth rate. So some sensitivity coming for financials because we've seen such tightening in financial conditions. So what does that mean? What do we look for then? How tight are financial conditions, and are banks starting to prepare for a downturn? Because you would see loan loss provisions accelerate. You would see bank sort of lending get tighter. You would see them talk about the credit quality, what's happening with delinquencies and default rates. Those sort of indicators are things that we want to watch for in the banks specifically.
Well, we got a little clue, right, from Jamie Dimon being on Fox and talking about the prospect of recession.
What about basic day-to-day movement of customer funds, what they're doing with their debit cards, what they're doing with their credit cards, how they're doing paying this stuff off.
Yeah, I think that that's a great point because you can get a lot of that data now in today's world of alternative data.
Yeah.
You can get a lot of that.
You don't need to wait for the banks. You don't need to wait for Bank of America or Brian Moynihan to tell us what's going on there.
How are consumers actually handling this situation? What are they spending on? You could get that out of MasterCard data. You could get that out of all kinds of second measure data.
Are you seeing anything of concern there?
You know, I haven't looked in the second measure data that's available on Terminal. It's something I'll put on the to-do list, the laundry list of to-dos. It's something we should definitely do in advance of the consumer sector earnings season, especially. I think, given that tariffs really just got implemented, we're at the point where we can start to really follow that data series. But it's not something, I have to admit, it's not something we've really tracked too much.
You do follow the economic data. So what's the next data point you're thinking about here?
Oh, God.
I know earnings, obviously, but...
So we have consumer prices and producer prices this week. We're sort of in the midst of getting those indicators out now. I think the Fed is going to be absolutely critical to watch. You know, what tends to happen in the sequence right now is the market starts to acknowledge that recession risk is real. They start to follow the earnings numbers, and the analysts will mark down their expectations. And then the market will feel so lost and confused that it starts to look to saviors, right? It looks to the Fed, and we've already seen how the market looked to the White House as a potential savior from this. I think the market will start to really push on the Fed, and how much will the Fed be able to respond in the environment of inflation and growth is going to be absolutely critical. I think the job market is also really, really interesting right now. Challenger layoffs are at levels we only usually see in recession experiences already. So we're getting the layoffs there, but we're not seeing it in the non-farm number. Why are we not seeing it in the non-farm employment? Why are we not seeing it in the unemployment rate? Some of it, I think, is just survey. Some of it is we're still creating some jobs to offset those layoffs. Will we see job creation then start to slow? And will we also ultimately see the unemployment rate start to rise? Because those are really key triggers for the Fed.
I'm going to ask you the question that I asked you yesterday, but a day has passed and we have new data.
Yes.
Are you more or less concerned today than you were when you walked in yesterday?
Oh, I'm still very concerned. I don't think it's changed a whole lot.
It hasn't changed at all.
I think if anything, the only thing that I can say is at the very least, it does look like we had our panic. Our major first big capitulation event has happened.
Yeah.
I mean, does that make me feel really better that we won't have another one? Not necessarily. You know, I think that this whole the tariff situation is just incredibly uncertain. We still have average tariffs to contend with of 26%. Even if it's 10% on everybody, that still is a big sea change for the economy to contend with.
That's what we were thinking about. Or we had some guests yesterday. Maybe it was you too, who just said, look, let's not forget 10% in any given environment. Tariffs would be a big deal.
Yeah, huge deal, considering we're coming from an average tariff pace that had been close to 3.
All right, we're going to leave it there. Gina, thank you. So appreciate it. Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence, our go-to every day in terms of the trade. Tariffs, we heard a lot about tariffs at the White House today from President Trump.
Yeah, Chinese imports, tariffs on Chinese imports are at least 145%. We heard White House National Economic Council Director Kevin Hassett say that trade talks with some U.S. counterparts are already well along, including deals that were close to done last week.
A wild 24 hours. I hope you're keeping up, everybody. Bloomberg News White House correspondent Stephanie Lai has to keep up. She's out there at our Washington, D.C. News Bureau. All right, where are we? The latest. We know the president held his cabinet meeting. Negotiations with countries. What are we hearing? Update us.
Certainly. So the president did not mention whether or not he was speaking with President Xi as of yet. There really is no word from the administration as to if conversations have been happening with China. However, with other allies, there has been discussion among some of his economic advisors that there will be deals underway. This morning, Kevin Hassett had told a various number of news outlets and reporters that the U.S. has already been in discussion and that they have about 15 deals that are in the works right now, as according to the USTR.
But does he really know? And the only reason I say that is I feel like Tim and I have been talking about this, different reports about who's saying what, and then the president comes out and says something. Like, who really ultimately, is it what President Trump decides in any given moment, or is there somebody who really has his ear hour to hour?
Yeah, so the president said just an hour ago in his cabinet meeting that most of the discussions are being led by Secretary Besson and Letnick, and that President Trump is looped in on these conversations. Kevin Hassett also earlier this morning tried to insinuate that there's a orderly system for how this gets done, that the Chief of Staff, Susie Wiles, is coordinating all of this with the secretaries who then will make the deals and run them by Trump.
I anticipate, Stephanie, this is going to be on a country-by-country basis, but do we have any idea what a deal looks like when it's done?
It's actually funny that you mentioned that, because Hassett himself said, you know, it's kind of an open question right now what a deal is, or what they're considering an offer from these countries. And so really it does seem like something that is an open conversation between the two nations to you know, try to bring down the tariffs.
Look, again, country by country. Here, you know, we're not just talking about China, or we're not just talking about a trading partner such as Australia, or maybe even the entire European Union. But what's on the table to satisfy the president?
You know, it's not just trade. Just yesterday, Trump had mentioned that he's also open to a number of other projects. One big one that he's mentioned quite a bit is LNG plants, and there's a number of things that he's just trying to get, and concessions that he's trying to extract from our trading partners.
I'm just thinking about kind of where we go next and what the expectation is. Because I do feel like the president tends to kind of gear up Monday, Tuesday in a big way, and then kind of wind down heading into the weekend. But we're living in unusual times, safe to say. I'm not going to say that. But so what are we expecting tomorrow in terms of the president? Might we hear some updates?
Yeah, so tomorrow what we know right now is that he is going to travel back to Florida for the weekend. As you note, he tends to wind down, but that doesn't mean that the work stops. You know, what some of his economic advisors have been saying is that the work is really just ramping up now, and that they're having these conversations with the trading partners, and that for the next couple of weeks, we should really expect a lot of world leaders to be coming to Washington to be having these conversations with the president. So, you know, as much as this is behind closed doors, we might also get a glimpse of it playing out in real time.
Well, you know, I asked general questions to you about what a deal looks like with, you know, country X or country Y. The elephant in the room is certainly China and the 145% tariffs that are on the country right now, Stephanie. What does a trade deal with China look like based on your reporting?
Yeah, I think it might be too premature to say. Obviously, they haven't seemed to even have communicated yet. Not only is the conversation centered on tariffs, it's also, we know, it has derailed the TikTok deal. And so one big aspect of these conversations will also be, how does the U.S. move forward with the TikTok deal, specifically if they would move forward with the Oracle proposal. And that, of course, would need buy-in from the Chinese government. And now we had reporting last week that that was already in the works, that the Chinese government was informed, and that ByteDance was helping usher that deal into fruition. But because of the tariffs, that was derailed, and we saw the president extend the deadline. And so when it comes to a deal with China, that will most certainly be one of the aspects of the conversation.
I think there's also a notable entertainment angle here, Carol. Disney shares are down by about 6.5%. Early this morning, we learned that China will reduce the number of imported U.S. films and introduce more films from other countries. Disney got about 10% of its revenue from Asia Pacific last year. The president was asked about this. His answer, quote, "I think I've heard of worse things."
Yeah. What?
He was asked about this specifically during the cabinet meeting by press. He said, "I think I've heard of worse things." Yeah. As in like, it didn't really bother him. That was the takeaway that I had.
It's interesting because when I think about the movie studios and content and getting distribution in Asia, this is something when trade talks have come up over the last decade or so. This has been a big issue of contention, so something we'll continue to keep a watch on.
The studios worked so hard to get into China, and they have. Yeah. They work with every film to make sure that it works in China.
Exactly, right. It's very tricky in terms of changes and meeting, you know, certainly what the government will find acceptable. Stephanie, thank you so much. Stephanie Lai, Bloomberg News White House correspondent, joining us from D.C. All right, folks, that's going to wrap up this first hour of Bloomberg Business Week. We are looking at a market where the S&P 500 is down about 3.2%. NASDAQ 100, it is down about 3.8%. Dow, down 2.5%. We're definitely off our lows of this session. If you're watching on TV, the close is coming your way in just a moment. Tim and I continuing right here on Business Week.
Get your fixed income Trump Fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 of Bloomberg World Headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. We have recovered somewhat in the equity market in that we are well off the lows of the session. That's a 2-for-1. President Trump saying you have a first deal on tariffs. That's very close, and they'd love to get a deal with China. That helped to move the S&P off the lows, but we're still down 3%. It did nothing, though, when it comes to the dollar and the bond market as well. Those sell-offs continue. 10 basis point move on the 30-year yet again. We're looking at like 54 basis points over the last 5 days. And Bloomberg Dollar Index, the biggest sell-off that we've seen since 2022, Scar.
So clearly it's from U.S. exceptionalism to sell everything American. Yesterday's tariff reprieve did not last long, with U.S. stocks resuming their decline, bonds not getting much love, the dollar sliding, and corporate credit default risks rising. Now, reality is setting in that President Trump has narrowed his trade war into a high-stakes showdown with China. According to the White House, tariffs on China are now at least 145%, and Beijing shows no signs of blinking. So investors need to position for an economy that's likely to get worse before it gets better.
We might have to go through a brief recession in order to rebuild our foundation. And you say, how much longer can investors hold? Look, the market's not up and to the right, every year of every decade.
And companies are now doing the hard work of forecasting through a fog of uncertainty. CarMax following Delta and pulling its guidance, in this case, backing away from the timing of its financial goals. Others are deciding whether to absorb higher costs or raise prices, and then by how much. We're going to be speaking with Stu Leonards later in the program to hear how the grocery chain is positioning itself. Alex?
All right, taking a look at what we're about the relationship between the equity market and other asset classes here, I thought it was worth taking a look at the 30-year and the S&P. And this is a normalized chart that goes all the way back to the beginning of the year, and they relatively move somewhat in tandem. Now, the real dislocation started around Liberation Day. Let's take it back about 5 days ago, and you saw a huge move higher in the bond market as equities also drifted lower. So the question is, with this big gap between yields and the equity market, which one's going to be right? How can the equity market stay risk on in any meaningful way when the 30-year yield continues to grind higher? As I mentioned, you had a 54 basis point move in the last 5 days in the 30-year. The traditional kind of assets in the bond market shouldn't be moving like that. So how do you take on true risk positions within the S&P, Scar?
All very good questions. So let's kick things off right now with Gargi Chaudhary. She's Chief Investment and Portfolio Strategist of the Americas over at BlackRock. And Gargi, I want to start with that idea that the bond market is driving everything right now. Given the volatility that we're seeing there, how do you begin to price other assets?
Good afternoon. It's good to be here, Scarlett. So absolutely, on your point on the bond markets, obviously the auctions this week having passed, that I think there were big clearing events, especially the 30-year auction, that having gone off reasonably well, as well as the 10-year. I think that is giving a little bit of a pause to that vicious sell-off that we'd seen. Obviously, yields are higher today as well, but only on the very long end. The front end is still a little bit more stable. So I think from here on, we have to acknowledge that there is still uncertainties ahead. And I think the market got very excited yesterday when we saw that headline come through around 1 o'clock, but we still have slowing growth. We still have companies that I think are going to either pull guidance or at least cautiously guide lower. And then lastly, we still have the most liquid market in the world, the Treasury market, behaving in manners that can be quite panicky.
Do you guys have any signals that over the last few days there were liquidity issues in the Treasury market or no?
So a couple of things that we look at, obviously, number one, how ETFs trade. And that's one where the signal's been very good. ETFs as a percentage of the total tape being over 40%, that means risk is changing hands. There is that release valve in the markets. That's good. We also look at on the run and off the run spreads. Remember back to 2020 during the COVID illiquidity crisis where all of those spreads blew up pretty wildly. I think keeping an eye on that. And then repo markets. That's really big. Understanding, making sure that there is no massive swings there. And so far, again, those signs are not pointing to massive panics or anything that should suggest that the Fed needs to step in yet.
also as well what companies do and whether they proceed with their original plans. A couple of companies began tiptoeing back into the corporate bond market to raise some money. I know that Japan Tobacco, AutoZone, Diageo, among those marketing new bonds. As long as things like that keep happening, that's a good sign, isn't it?
I think that's an important sign to keep an eye on. Obviously, any kind of news that deals are getting pulled back is not a good sign, especially in times of stress. So yes, functioning in the markets is credit trading well, ETFs trading, and being a large part of what the total trace volume for high yield markets are. I think those are all great signs, and we're seeing that so far.
Is the U.S., though, in some asset classes trading like an emerging market at this point?
You know, the one thing that, especially last week, when we saw that at one point saw a 72 basis point swing from the lows in 30-year yields to the highs in 30-year yields overnight, as well as at the same time the dollar sort of going down maybe slightly, it did feel a bit scary. I won't go as far as to say trading like an emerging market, but it didn't trade how you would have expected it to trade. Having said that, look, at this juncture, we're just now learning about the impacts of growth. It's still too early to say that we're absolutely going into a recession or not. I think we all have to recognize that whatever your expectations of growth were on February 19th, the peak, it is much lower than that. Now, is it recession? We don't know yet. And whether it's going to continue to trade in a panicky fashion, we think investors should be adding hedges.
Right. And Larry Fink, of course, spoke earlier this week saying that for a lot of companies, they're already feeling like they're in recession now. How does this set us up for earnings season? Because obviously everyone's going to be fixated on what company management say about what they see. And there's really no upside for being too specific in your outlook right now because there's so much that's unknown.
So a couple of things that we're noting there is, number one, to what extent, like normally we get about 20% of companies that obviously guide forward, or 43% of companies that give you full year guidance of some sort. So to what extent is that getting pulled back meaningfully? And number two, to what extent are, instead of pulling back or giving no guidance, to what extent is it moving further negative? So right now, the spread between how many companies are guiding positively versus negatively, the negative is picking up significantly. That spread is the highest it's been in a decade, which makes sense. People are saying zero earnings growth for 2025. It's still too early. So what I will be watching for, number one, what are companies saying around what they're going to do around their margin protection? Are they pulling back CapEx? We're going to be watching for those kind of headlines. Are they going to do anything about headcount adjustments? Probably still too early for that, but certainly looking out for any signals there. And lastly, what kind of future guidance for the full year 2025 they're able to provide.
That's why I was so confused when Walmart was able to reiterate their guide for 3 to 4% growth. Like, how do you know that at this point when they were in the middle of all that turmoil? You mentioned earlier about adding hedges. Where, how?
Absolutely. So a couple of things that we're thinking about. First of all, let's look at what has worked in this kind of volatility and what hasn't. Certainly, assets like gold have worked. Assets like long duration, unfortunately, have not. We have a couple of market neutral strategies that have worked really well, that are up for the year. We have global equity market neutral strategies that have done super well, especially when you look at broad equity markets. We think adding those, what we like to call diversifying diversifiers. So usually bonds were your diversifiers. Now you diversify your diversifiers with other sort of market neutral strategies, add things like gold, and then frankly, add a little bit of defense to your equity portfolio as well. So don't move to cash. We don't think this is the time for that, but maybe going towards things like US minimum volatility strategies, which again have outperformed by 1,000 basis points since the peak of the market.
All right, Gargi, hang out for 1 second. Gargi Chaudhry, Chief Investment and Portfolio Strategist at BlackRock. She's sticking with us. We do want to briefly touch on some of the company stories today, and one is U.S. Steel. That stock is down by 8% after President Trump reiterated his long-held position. He doesn't want to see the steelmaker owned by a Japanese company. Bloomberg News' Joe Doe joins us with more. Joe, can U.S. Steel survive on its own?
Yeah.
Okay, so why is the stock down?
Everybody is just paying attention to a deal. And to be clear, this market is... What's happening in the broader markets is affecting U.S. Steel, right? Like last week I was on the phone with an arb trader who you could call in any day and say, okay, what's the stock price of U.S. Steel saying right now about the probability that a deal will happen? And this particular person said, I guess it was on Wednesday, I don't know, because right now the markets are such that we're having trouble pricing the fair value of the steel market.
Ah, I see.
But Putting that aside, U.S. Steel, I mean, this is like a crazy chart, right? So the President of the United States yesterday afternoon after the markets closed came out and said in so many words when he was just talking about the steel market but decided to talk about U.S. Steel, I don't want U.S. Steel to be owned by a Japanese company or any other, which we think he was referring to other foreign companies. He came back today in the cabinet room and was asked about steel, in particular tariffs, and he said, and by the way, the tariffs are helping the steel industry, they're helping U.S. Steel, that's why U.S. Steel doesn't have to be owned. And then he threw in another comment, which was, we like Japan, we like Nippon Steel, they're a big, great company, but we think they should be an investor. We've heard that comment before. The investor comment came back in February when he said he didn't want them to be majority owned by Nippon Steel. He wanted them to be an investment. We had reporting back in February that said when the President of the United States said that, the two companies were shocked by the comment. They didn't know that was a comment that was coming. And the question the market had was, what does an investment mean? My point is, we're back at that point. What does an investment mean? We thought Monday, wow, they're going to re-review this CFIUS review, the National Security Review, going to give them 45 days, and that'll give the President of the United States the cover to say, you know what, maybe it's a good deal.
So investors want to see something happen with U.S. Steel. U.S. Steel wants to stay independent. Are there any other tie-ups, maybe domestically, that could be in the works or are being discussed?
Sorry, to be clear, U.S. Steel doesn't want to stay independent, right? U.S. Steel has said, we like the deal on the table, which is the $55 all-cash deal that Nippon Steel, but it could survive on its own if it had to. What are other options? I mean, there are plenty of rumors out there, but this is the focus right now of all the biggest holders. You're trading at, I don't know what we're at right now, 45, 46?
41.56.
41, sorry, that was a few days ago.
Right.
We're still well below that $55 a share offer, but you can ask any of the investors, they would say, give us the $55 a share and let's get out of here, and then we'll let Nippon figure out how to operate the company moving forward.
So do the tariffs actually help steel companies because they increase steel prices so much? In theory, right?
In theory, they help them in the short term.
But
in the long term, it's a lot more questionable because then you're getting into the variables of actual fundamentals in the market. Construction's being crushed, the automotive market's looking weak, and now we have these across-the-board tariffs that I think it can go without saying, have affected the entire calculus behind the markets, and that hits everyone all the way down to U.S. Steel.
All right, lots of unanswerable questions here when it comes to U.S. Steel and how it moves forward. Bloomberg's Joe Do, thank you so much for recapping all the headlines there. Let's bring back in Gargi Chaudhary. She is Chief Investment Strategist and Portfolio Strategist at the Americas at BlackRock for her perspective on all of this. And Gargi, I guess one of the big things investors were looking forward to was a spate of deal making, the animal spirits unleashed with the new Trump administration. But as Joe made really clear, there's a lot of cross currents. And now with the tariff question still, unresolved, people and companies are afraid to move because they just don't know the operating environment. How much of a tailwind does that remove from the market?
Yeah, and I want to take us back to, if we can even remember, the time before April 2nd. So we think back to February and March. The markets were already selling off. We were already down 10% before Liberation Day, and that wasn't anything to do with these large reciprocal tariffs. A lot of it was just personal real disposable income slowing down. A lot of people had come into the year with the expectation of about a 1.5% GDP, and the recognition was that that number was perhaps going to be a little bit weaker. So I think now with the added pressure of higher prices, even if they are transitory, I think with the higher pressure of higher prices and goods inflation going up, I think it's just going to be a little bit more uncertain, i.e. volatile for some period of time. Now, if we see a deal come through with China, for example, if we see some headlines on taxes, for example, can we see a reprieve in the market? We obviously saw what happened yesterday when we see one positive headline. We can absolutely see that, and I think the positioning has been a little bit more cleaner today. But I think that broadly, we need to recognize that markets aren't cheap. And at the same time, yes, we've had a pullback, but at the same time, the forward is still a little bit more murky. We're not out of the woods yet, and therefore add hedges. Don't move to cash, add hedges, add some minimum volatility, add some front end for fixed income. These are great opportunities to clip some coupon, but not take a lot of duration. And we think gold has held up pretty well. That's another good one to hold in your portfolio.
It's so true. And also what I was struck by what Joe was saying is that it's really hard for the arb traders to value a stock because you don't know what's in it. Like what is macro, what is micro, and what is just straight up say just it's over-owned or oversold or whatever. how do you guys, how have you changed your models in the last 4 minutes?
Yeah, you know, one of the things that I was talking with my team about is everyone's pointing to the PE and looking at how much of a, you know, it used to be trading at 20 and now we're at 18 and now it's no longer at such a premium. But we don't know what the E is. No one, so looking at any of that doesn't make as much sense. So I say, again, I'll repeat, add some diversifiers to your portfolio. Remain quite nimble because there are going to be opportunities. I think this is a trading environment. I don't think we're going to see the highs that we had seen earlier in February for some time as we begin to learn how to dissect the new news on growth, on inflation, and frankly, what that means on the Fed. We haven't even discussed that, and I think that's because it's less relevant these days. Yeah. And finally, I'd say just the huge moves in the bond market themselves has led to tighter financial conditions, which also have an impact on growth. So all of that, plus the destroyed wealth effect that has taken place, I think is going to weigh in on markets for some time.
And I'm sure the Fed is happy to be out of the spotlight for a while here because they're also trying to grapple with everything that's happening right now. In light of all this, you talk about diversifying your portfolio. What are the safe havens? Because treasuries have not proven to be much of a haven the last few days.
So we've been telling investors, look, if you think that the peak of uncertainty is behind us, and if you want to start sort of buying the dip, if you will, there are pockets that can work well for you. I think there are parts of tech, again, those that are a little bit more software focused that can work for you. But we think at this moment of time, defend and diversify. So defend with things like USMV, which is US minimum volatility strategies, which have a lot of staples and utilities and things that are, again, a little bit more defensive in nature. One area of the market that I think can continue to, again, defend, but yet has good earnings potential is actually healthcare. That's something that has held in okay, and we think that can, again, broadly be all right. Front end of fixed income, clip some coupon in a world where we're probably not going to see a positive number in your year-to-date return for S&P for some time. Clip some coupon, own some BINC in your portfolio that's giving you that income of about 6%. And then finally, diversify with gold.
Yeah, to Gargi's point, consumer staples up 0.5% right now, Alex, and you look at a name like United Health, gaining for a third day, up 3 to 3%.
Yep, I mean, there was fundamental news for that too, right? Because of the Medicare reimbursement, but still, nonetheless. Gargi, before we let you go, we were talking about sort of companies coming to the credit market and issuing debt today, so it was open a little bit, but spreads have really started to blow out in a way that we haven't seen in the last 6 months, right? When do you get worried?
So I won't use the term blowout quite yet. Yes, they've widened, but if you look
relative basis,
relatively from where they've been, I don't think they're at worrying levels. Yes, high yield and IG have both widened, but if you look at where they were versus the average of where they've been from GFC to now, we're significantly below levels we had seen. So blowout, no. I think if we get to 150, 200 basis points wider than here, if high yields get back to levels that we had seen, high yield spreads get back to levels that we had seen in the pandemic, so 550-ish type levels, I think that could be something that people stop and get concerned about. But for right now, the starting fundamental point of credit is actually pretty strong. If you just look at the index HYG, a lot more of it is BB rated than used to be about a decade ago. I think that's a good starting point. On top of that, for now, low default rates, maturity walls have been pushed out. Those are all okay signals, and there are buyers that like the all-in yield that 8% in high yield provides.
All right, we're about to start earnings season. The big banks kick things off tomorrow. What about earnings seasons could surprise us?
So I think we've all turned quite negative for all the right reasons. So I think if it's a blowout earnings seasons, I think the market will be very surprised by that. If all companies are coming in beating, I think that's going to be a surprise. I think if we're hearing nothing around profit margin squeeze, I think that could be a positive surprise, which the market needs at this point. On a negative side, I think if we start hearing about any kind of capex pushback or any kind of positioning around headcount readjustment, I think that could be something. And then another, obviously, a big negative surprise for the markets would be if many companies just push back on giving any guidance altogether. I don't think that's a good sign.
Well, I mean, we saw that with
Delta. We saw that with a couple of companies this week. If that continues to happen, I think that becomes a little bit worrying.
I mean, I just don't know how you can possibly give guidance. This very much feels like that first quarter of the 2020 pandemic, right? Gargi, it was so great. Thank you so much for your time and for coming into the studio. Gargi Chowdhury, Chief Investment and Portfolio Strategist of the Americas over at BlackRock. So speaking of, you got the financials falling. KBW Bank Index is down by about 5%. It's not been a good couple days for the KBW Bank Index. We got JP Morgan, Morgan Stanley, and Wells Fargo reporting tomorrow. Here to discuss is David George, a senior bank analyst at Baird. Hey, David, I don't even know where to start, but let's try and dissect it this way. What would be a positive earnings result for the banks, considering it's all going to be about guidance?
Yeah, I was just going to say, Alex, good afternoon. I think the earnings are going to be, I would say, fine to good. The traditional business of banking has been fine. Loan growth has been a little slow, but would expect favorable net interest income trends and fees, particularly out of JP Morgan tomorrow, may be a little lighter from an outlook perspective. Trading, we think, is going to be pretty good, actually. So Q1 is going to be probably pretty good. Unfortunately, that's not going to give us a lot of answers. The game has kind of changed a little bit, Alex, in the last week since Liberation Day.
You think?
And there's going to be a lot of questions, obviously, around guidance. As you and your guest just were discussing, does guidance get pulled? We think there'll probably be, because 70% of the bank's P&L is net interest income, and I think you have pretty good line of sight around that. Credit and investment banking and more fee-centric businesses, I think, are a little bit more questionable at this point. So I think maybe you may see some companies consider giving a wider range of guidance based on a certain number of outcomes. But clearly, there's going to be a lot of questions. Jamie, tomorrow is going to be, I'm sure, a must-see TV, so to speak. So we're looking forward to seeing what we find out from the banks tomorrow.
Absolutely. I wonder how much of a better trading revenue picture we're going to get, because most of the volatility really happened in the last couple of days, and that's after the quarter ended. But how much of that will be reflected in the first quarter results, and how sustainable does that tend to be of volatility-induced record trading revenue?
Yeah, it's not particularly sustainable. Volatility is a very mean reverting statistic, right? So it's unusual that you have a 50 VIX, and it typically doesn't stay like this for a long period of time. But the volatility has been not only in equities, but in rates, so fixed income rates, currencies, commodities. So there's been a lot of movement in the first quarter. So we would expect the likes of B of A and JP Morgan to benefit from that. And it wouldn't surprise me, Alex, to see JP Morgan with that excess trading strength throw a little money in the reserve just to prepare for what is clearly now a more uncertain environment.
Well, to that point, I wonder if we can distinguish between banks that are more geared towards the capital markets versus banks that are more geared to the consumer. Because first line of defense is going to be the capital markets just seize up and nothing happens, versus, say, what happens with the consumer, what happens with loan demand, what happens to net interest income. That's going to take a little longer to filter through.
I think that's right. I think you said it very well. On the fee side of things and capital markets, as I said, trading is going to be very good. Volatility clearly in April is quite high, so I would imagine that Q2 trading should be good. But M&A, which there, as you know, post-election, there's ironically was so much optimism around M&A, and to your point, I think that activity levels have ceased in M&A, and it's very logical. It's really hard to know kind of the rules of engagement and what profit margins in certain sectors are going to look like. So we would expect that to have an impact on M&A for the balance of this year, or at least the next 3 to 6 months. And then I think corporate loan demand is going to suffer a little bit as a result as well. Now, fortunately or unfortunately, the stocks are coming into earnings season, guys, with pretty low expectations. Yeah. We stressed the bank earnings for 2026 and assumed a 300% increase in losses, and we came up with not only the banks being profitable, but they trade around 9 times that adjusted earnings number. So just to kind of give you a sense as to how low expectations are.
Yeah, high single digits there. So what are the growth areas, David, for banks? What will they want to talk about? And I bring this up because I saw that Chase, for instance, is offering 100,000 bonus points for people who sign up for its high-end Sapphire credit card.
Yeah, so in the case of Chase, they obviously, given their size, are unable to do a lot of M&A, but they really have been a leader, Scarlett, with respect to investing in the franchise, really throughout all of their major businesses, whether it's just a traditional retail bank, capital markets, asset management. They've been on the kind of the leading edge as it relates to technology. So organic growth, I think, is going to be a focus for JP Morgan, but I think that's going to probably take a backseat to kind of what we're all talking about all day, all night as it relates to the markets and the kind of the implications of that.
Yeah, totally.
I feel like we're probably in a 3 to 6 month period of just potentially, I would expect a shallow recession, and I would imagine that the commentary tomorrow about the macro is definitely going to turn a little more negative.
Silly question, David, but based on what you hear from earnings, how willing will you be to adjust your price target or your outlook, considering that things can change? Like we saw what happened yesterday, for example, with tariffs. Like, what's your conviction level?
The lower the stocks go, the more conviction we have, Alex. We typically like to think about banks through on a normalized lens. And what I mean by that is, what is the normal earnings power for a bank? And that right now, banks are benefiting from abnormally low credit costs and potentially a little bit below normal net interest margin. So if you normalize everything, the banking sector is probably 7 to 8 times earnings. So it's not going to really change. A 3 to 6 month slowdown in capital markets activity isn't going to really change our outlook. Now, the credit side is, I think, a bigger wild card, and clearly there are going to be some segments of the economy, both in the corporate and the consumer sectors, that are going to have some challenges in the near term. Fortunately, the industry is very well capitalized and has got pretty significant earnings power to earn through higher credit costs, but that's going to be what we're focused on for sure.
All right, good stuff. David, really appreciate your joining us. David George is Senior Bank Analyst at Baird. And of course, we've got Wells Fargo reporting earnings tomorrow, along with JP Morgan Chase, and all eyes on the guidance that these executives are able to offer right now. Alex, we're looking at a market that is down, down, down. I mean, it really has not, we have not seen much of a relief, a sustained relief from the reprieve that President Trump gave yesterday when he put on hold most of the tariffs, except for China, which goes up to now 145%.
Yep, talking to Justin Wolfers on inflation coming up next, right after this. This is Bloomberg.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because people they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to?
The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
It is just about 3:30 in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Seal. Taking a look at these markets here, we're well off the lows of the session, but we're still looking at a decline of over 3%. The VIX also, again, off the lows of the session, but still high at around 44, but we are not near that 50 level that we saw earlier.
I don't know what it says about the current environment that we both looked at the markets down almost 4%. It's kind of like, oh, okay, no big deal. Not that it's no big deal, but it feels relatively modest compared to what we saw in previous days.
Yeah, Scarlett had FOMO last Thursday, and I was like, there's going to be plenty of time to get involved with all of this. What's so staggering to me, though, is the difference that we're seeing in the bond market and the FX market. You're still having the 30-year up by 12 basis points. You're still seeing that sell-off in the dollar, despite stocks off the lows of the session. It kind of begs the question, like, what's leading what?
Right. The bond market, clearly, it was what the Trump administration was looking at yesterday, right before President Trump hit pause on most of the tariffs. You mentioned the dollar right now down 1.3%. That is not a normal move in the FX market.
It's not what you usually see for the world reserve currency. Also, we saw some economic data today, of course. That was CPI coming in a little lower than estimated. But tomorrow we get PPI, so we wanted to get a read on that with Michael McKee, economics editor with Bloomberg News and Bloomberg Television, economics editor and political. Your title changes every time I read it, so I don't know what's up with that. But all right, what did we learn from CPI? What do we learn from PPI tomorrow?
We didn't learn a lot from CPI. It was good news. Absent Donald Trump and the tariffs, it would have been seen as very good news by the markets because it would suggest the Fed is making significant progress on inflation. And now it's just sort of, well, nice, but we got to worry about what happens going forward. It was down 0.1% on the headline, which was good, but that was largely because gasoline prices went down 6.3%, which was largely because people were pricing in the idea of an economic slowdown. And we had the same thing happen with airline fares and with hotel charges. They went down for basically the same reason. So there wasn't a lot of information about what's going to happen going forward in this, but we may get a little more out of PPI because remember all the imports we got in the last 2 months of industrial supplies and things like that. We'll see if there were any price changes as companies ordered massively to try to get ahead of the tariffs. But still, it's what's going to happen in the April and May inflation areas that's going to matter really to the Fed, which is what matters to the markets.
And clearly the CPI report didn't do much for markets today. You could argue that PPI might not do much tomorrow. The data point I'm really curious about tomorrow is going to be University of Michigan because the consumer expectations on inflation has been pretty awful the last couple of times, and that's what everyone's fixated on, where consumers see inflation headed.
Well, you know, that's one of the things the Fed is fixated on, is they don't want to see inflation expectations get unmoored because then that feeds into future inflation. They tend to watch the shorter end, 1 to 3 years, much more than the longer end. They're not sure that the long end view that people have is going to be particularly accurate unless it goes significantly higher for a while, and then it just shows that people are worried about inflation. But they will be watching the shorter end, and it's gone up significantly. We're like 5.1% now, and that would be a terrifying number to the Fed if it actually got there. But just the idea of it, and then we want to see what people are saying. We've said many times that what consumers say and what they do can be two different things. But we get retail sales next week, and maybe this gives us some view of what consumers are thinking.
Well, they've been, buying up all kinds of things before tariffs kick in, right? That's kind of.
I mean, that's the game theory, right? We'll see if we
all
see
the articles online are talking about what you should be buying now.
Okay, going to the Fed real quick before you let you go, Mike. We had a slew of Fed speakers over the last 48 hours. Has the tone changed? Has the focus changed? Is it more about inflation versus growth? Is it still equally distributed?
Well, it hasn't really changed over the last week, ever since Liberation Day, the so-called Liberation Day. Fed officials have been saying that we're going to see inflation from tariffs, and we are probably going to see an economic slowdown. We can't measure that yet because we don't know exactly what's going to happen, but we have to worry about both. They're a little more concerned about inflation because it's harder to deal with than a slowdown, and it will come on us faster than an economic slowdown. So their focus is a little bit more on that, but right now, their focus over the last 24 hours was how the markets were functioning, and we talked to a number of them over the last 48 hours, and they basically think the markets are volatile, but functioning fine.
All right, Michael McKee, thank you so much. Chief Correspondent on International Economics and Policy, I think, has been one of his more recent titles, right?
Yeah, we'll go with
that. Just keep moving.
Just keep moving.
All right.
Call me on time for dinner. That's all that matters.
Mike McKee, thank you so much. All right, let's continue the conversation here on economics and policy and bring in Justin Wolfers, Professor of Economics and Public Policy at the University of Michigan. Justin, so good to speak with you. You heard what Mike was saying in terms of the setup here and the Fed focusing both on the inflation question and the growth question. Which are you more concerned with right now?
I mean, there's two great flavours coming right at us, courtesy of the White House. We've got fears about inflation getting reignited at exactly the same time that you might end up with the real economy slowing. So you should be scared of both. You should be worried about both. It's a very, very good time not to be Jay Powell because you can't fix both at the same time.
So, but based on that, though, is there a possibility that tariffs, okay, different question. How long does it take tariffs and that mentality to actually filter through to the hard data like CPI and PPI?
Right. So based on past experience, you'd probably expect it to take a few quarters, but equally, we haven't had a tariff shock like this in our lifetimes. This is a tariff shock larger than Smoot-Hawley, the famous Depression-era tariff. So it's very hard to get a lot of guidance from that. You know, on that point, there's actually, I think, two economic crises right now. One is tariffs, and that's driven a lot of the market action. But I think one of the reasons you saw markets respond so strongly is there's a crisis of confidence. It's a crisis of confidence in the competence of the administration. They've rolled out tariffs based on formulae that make no economic sense. They stick with a plan where, they say it's all about one thing and then they roll it all back and then say, you know what, we've been lying to you since Sunday when I already decided to change parts. Tariffs on China yesterday, we were told, are 125%, and today they're 145%. And I want you to stick with that for just a moment. You've got tariffs between two of the world's great economic powers, and people in the White House couldn't tell you the correct tariff within 20 percentage points, which would normally be the entirety of an entire trade war, and they forgot whether it was 125 or 145.
Feels like the more important thing is just that it's a high number. It's a big number. It's a wow, eye-grabbing number, and that's what they want to go with to shock Xi Jinping to the negotiating table.
Look, if you want to shock the Chinese to the negotiating table, absolutely you've done that. By the way, you could probably just pick up the phone instead. But if what investors are looking at is the competence of this administration and how much they trust this economic team, it matters a whole heck of a lot. Look, I think this is a time where if I were on the economic team, and no part of me is joking right now, I would be checking everything for spelling mistakes, literally spelling mistakes, because right now they look like Keystone Cops. They look like they're making it up as they're going along. And if that's not the case, then they want to take every opportunity they can to signal competence. Instead, they've done the opposite.
Okay, so that's your take. And then what's the filter through to the actual economy? Or, is that what you think is unfolding now through the data and through the equity market?
So we're seeing equity markets move by extraordinary amounts, much more than could be based on than would make sense purely on the tariffs. So that's the sense in which I think the confidence crisis is here at the same time as the tariff crisis. Look, if you want me to back that up, I'm happy to math it out for you a little bit. We saw U.S. equities fall by 14% after Liberation Day. Markets had already surely priced in 2/3 of what Trump's plan ended up being, which means that the true effect must be 3 times larger. 3 times 14, what's that? 42%. It seems implausible that tariffs could take 42% off the net present value of future corporate profits. It must be the case that markets were responding to something else. What is it? It was a misguided policy that the administration was happy to double down and keep doubling down on. That's the only other shock that comes to mind.
Yeah, there's a lot of question marks there. And of course, the way that this whole tariff policy has unfolded raises a lot of uncomfortable questions and raises questions about the reputation and the credibility of this administration in negotiating some of these tariffs, which it apparently is actively doing right now. Talk a little bit about how much we can then rely on what happened in the first Trump administration. I know that up until yesterday, we were saying you can't use Trump 1.0 as a template for Trump 2.0, but apparently you can because he is willing to negotiate now. The renegotiating of NAFTA into the USMCA, does that kind of serve as a template for what we can look for when it comes to tariffs for Canada and Mexico?
I think that template matters for 2 very important reasons. So Trump arrived, had a free trade agreement with Canada, said it was terrible, ripped it up, wrote a new one. That's what he did in the first term. By the way, turns up, arrives in the second term, has the same agreement he negotiated, rips it up, says he's open to creating a new one. So that says he likes ripping up agreements. So that says something about the credibility of any promises the United States makes in this round of renegotiation. Look, everyone's going to play ball with him. They're just not going to go home and believe that he's going to follow through. And if you don't believe that, then you're not going to make the appropriate investments around that, which means we're going to get the costs of tariffs, but not the benefits. Having said that, Scarlett, let me come back. I actually think what you just said is really, really smart and exactly on the money. So here's how the first administration played out. NAFTA created essentially free trade between the United States and Canada, as well as Mexico. There were a few carve-outs for politically sensitive industries, so it was essentially zero, but not precisely zero. Trump arrives, points at the few cases where tariffs aren't zero, gets very upset, rips up the agreement, starts a trade war, and then says, I'm open for negotiation. Negotiates, and then decides to basically write down the same agreement because, well, zero tariffs was pretty good 6 months ago. It's still pretty good. The politically sensitive stuff is still really hard to do. So we end up with NAFTA, just they get out the pencil eraser and relabel it, give it a new name, and he struts out and calls it the art of the deal. Well, what we have is Europe and most of our other trading partners already have very, very low tariffs on average, 1 or 2%. Don't believe the numbers the White House are telling you. They're not telling you anything about average tariff rates. We essentially have free trade around most of the world. He's ripped up those agreements. In some cases, they're not agreements. They're just countries doing what they want to do. Summons them to Washington, D.C. Very quickly, he's going to discover you can't get tariffs below 0%. So if they're nearly 0%, you can't negotiate something much better. Of course, he'll negotiate something close to 0%. It's pretty much where we already are. Slap his name on it, march out to the front lawn of the White House and say, look at me, art of the deal. I got tariffs, say, with Vietnam, close to 0. I just want your viewers to understand they're already close to 0. So this whole shebang can't move us very much in a positive direction because global trade is still, before this week, mostly tariff-free.
Justin, just to push on that for a second, how would then you categorize China, for example? I mean, clearly there are trade imbalances, right? Like, I mean, we've heard this from both sides of the aisle, right? So doesn't there need to be something fixed there?
Alex, there are real problems with China, but saying there's a trade imbalance is not one of them.
Why not?
That just means we buy more of their stuff than they buy of ours. That's all that says. Look, there are real issues with China. Issues like intellectual property is, I think, probably one of the most important ones. And so I said most of the world, but it's still the case that most of our trade with China, if you go back a couple of months, was at pretty close to no tariffs. There are issues with China, some of them geopolitical. Those would call for a very specific tariff response. That's not what we're seeing. You don't put a 47% tariff on Vietnam because you want to bring China to the table to talk about intellectual property. So, yes, there's a serious way forward. There's also questions of China's influence in the region. The White House recently has been saying what we need to do is get countries in the region together so that they can talk to China collectively from a position of strength. That's something that was once called the Trans-Pacific Partnership. We had that agreement. He ripped it up. He's going to rediscover it. And hopefully we'll actually move forward with it this time.
All right, Justin, We'll get you back. Want to talk about break-evens, too, because they've been moving. So we'll put on your economics hat next time. All right, Justin Wolfer is professor of economics and public policy at the University of Michigan. All right, time now for top calls. A look at some of the big movers on the back of analyst recommendations. First up, Adidas getting a big upgrade from HSBC to buy from Hold. The broker says the company's market share gains could accelerate during a time where macro conditions are tough, calling the sportswear brand a beacon of hope compared to other competitors like Nike and Puma. HSBC did cut its price target to €240 from $260. Shares, though, still down by about 3%, Scar.
All right, I'm looking at GM, which got a downgrade at UBS to neutral from buy. The bank citing the possibility of tariffs raising prices and disrupting production, saying, quote, we see potential for a new era for U.S. autos with lower volumes and higher costs to produce. GM's price target also reduced to $51 from $64. You can see the shares down about 4.8%, and